averages at 54,666. So make or break level for the Nifty Bank. If it sustains above this level, we have a 1,000-point runway on the Nifty Bank on the way up from a technical standpoint. The good part yesterday was we saw some signs of early short covering. Earlier, there were some longs that the FIs were building, but Nifty and the Nifty Bank, the open interest came down even as the indices moved higher. And that told you that there were some shorts that were covering their position. And that's what data suggested as well. FIs bought 636 crores in index futures, added about 1,200 longs, but more importantly, covered 2,145 shorts. Does it move the needle? Not by much. But remember, in the last 5 days itself, the FI longs have inched higher from 7.4% to 10.8%. And yesterday's up move in long exposure came in on account of short covering. So short covering typically first happens slowly and then suddenly. Let's see whether that sustains or not. For that to happen, the Nifty has to close above 25,100. Why do I say that? Because there is a lot of call writing at 24,950 for a premium of 150 rupees. We've also seen base move higher to around 24,900 to 24,950 because we're seeing call writing at 25,000 and 24,950 as well. The Nifty important level upwards of 25,100 is 25,154, which is obviously the August 21st high post Prime Minister's Independence Day speech and the rally that we saw. 3 stocks I'm watching out for. 1, OFSS enters F&O ban. Obviously, globally, there's been a big move in Oracle, no relation with India, but that's something we'll watch out for. And a lot of short positions added on Angel One and BSE. If no adverse ruling comes, then maybe these shorts will have to position themselves for a covering.
Keep an eye out on both of these names. Of course, Mangalam, thank you for that. And the big news of the morning, Infosys, the buyback has finally arrived after a long wait. Last evening, the largest ever buyback announced by the company. Reema is here to break that down for us. Reema, morning.
Hi, good morning. Indeed, a very large buyback. 18,000 crore is the buyback by Infosys this time. A tender buyback at a price of 1,800 rupees per share. This is a 19% premium to the stock price. Now, the company has said they will buy back 2.4% of the outstanding shares. This will be the 5th buyback done by the company and the largest ever. The last one was done towards the end of 2022 and 2023, and that size was 9,300 crores. So effectively, the company's practically doubled the buyback size, and it's also come in much higher than street estimates. You remember that Morgan Stanley note, they were talking about a buyback of about 10 to 14,000. Most of the analysts we spoke to said it should be about 14,000 crore. So compared to that, 18,000 crore is actually much higher, and it's a tender buyback at 1,800 rupees. And this will take some time for the company to close, which means in the interim, you are going to get some earnings prints, maybe Q2, maybe Q3 as well. And this buyback will support, it will be supportive. Even if the earnings are weak, you will always have that cushion of a buyback supporting the price. But big news, and I expect the stock to do well today.
Indeed. We keep an eye out on Infosys. Reema, thank you for that update. Take a short break. All the global updates from the other side. Stay tuned. Welcome back. Now, amidst early signs of easing trade tensions between US and India, the US Commerce Secretary Howard Lutnick has said that India must make meaningful concessions, starting with reducing their reliance on Russian crude to maintaining strong economic ties with the US. Listen to what he had to say.
We're going to sort out India. You know, India basically has to open their market, has to stop buying Russian oil. You know, people don't remember, India didn't buy Russian oil before the war with Russia and Ukraine. They had 1% of their oil was from Russia. And now 40% of their oil is from Russia because we've sanctioned it so they can buy it, you know, $7, $10 a barrel cheap. So they're buying it, refining it, and then selling it to the rest of the world and making a bundle. So the president called nonsense on that and said, you got to stop that stuff. So I think India will sort it out once they stop buying Russian oil.
On to Wall Street action then, and the weekly jobless claims showed a jump to the highest level since October of 2021. Now, the traders are also anticipating that the latest reading of the key inflation gauge will not stand in the way of the Federal Reserve lowering its benchmark interest rate next week. And as a result of this weak labor market update, the Dow Jones and the confirmed certainty of the Fed cutting rates next week, the Dow Jones ended with gains of over 600 points. The S&P 500 and the Nasdaq, all of them ended at a record high in yesterday's trading session. The Dow above 46,000, the Nasdaq above 22,000 as well. That the big trigger of yesterday evening before the jobless claims came out was the consumer price inflation, which also came in hotter than expected, mind you. The jobless claims accelerated and it was a mixed signal for the Fed policy next week. CNBC's Rick Santelli brings us the fine print of that.
Let's look at initial jobless claims, shall we? Now, given their seasonalities when you have things like Labor Day, holidays, but ultimately, just on the surface, 263,000 on initial claims. That's the biggest number going back to the fall of 2021. And it doesn't end there. We also had, of course, our August read on the Consumer Price Index. And that inflationary group of data points was warmer than expected. However, let me rephrase. It was very close to expectations, but sequentially warmer, meaning 0.4 on the month over month. That's higher than last month, but as expected. Take out food and energy, the core, 0.3, a little hot based on history, higher than our last look, but as expected. If you looked at the year-over-year headline, 2.9, as expected, hotter than the rearview mirror by 0.2. The only number that wasn't hotter, that was equal expectations and equal sequentially to the rearview mirror, was year-over-year core at 3.1%. But that's a 3 handle. The Fed's objective is 2%. And I know that the PCE is closer to 2.5, 2.6, their favored inflation gauge. But it seems to me that we see a market in equities continually making new highs. We see an interest rate complex that looks like rates want to go lower, but the 10-year seems to be fighting to stay above 4%. Ultimately, I think we're trying to match the data with the market performance. And I believe that the interest rate complex may find more selling going into the weekend because I thought many traders looking at the flattening yield curve were expecting the 4% level to be breached in a much more significant way than the 1 basis point we saw today after the 8:30 numbers. As for tomorrow, University of Michigan sentiment, and that will be the end of an important week. And this week in particular, not only the last week of important top-tier data. We've had the job report, PPI, CPI, PCE data, which means it's up to the Fed next week on Wednesday to decide. 25 basis points is built in. They'll give us 25. Many thought we could see 50 with the data points today, but if the market doesn't price it in and Fed guidance doesn't allude to the fact that it is or isn't priced in with respect to whether they believe it to be accurate this close to a meeting, no surprises. 25 basis point cut most likely on Wednesday.
And the CME FedWatch tool also indicating a 93% probability of a 25 bips cut next week from the Fed. Let us also hear what economists had to say about this inflation data and the market reaction to that.
It's going in the wrong direction, that's for sure. I do think we're seeing some tariff price pass-through. Core goods inflation has accelerated over the past couple months, which is where you would expect to see that tariff price pass-through. So, it does look like, as was mentioned earlier, the core PCE number, which is what the Fed focuses on, that's going to hang out pretty close to 3%, we think, when we look at both the CPI and the PPI together. So that's not a great story. On the other hand, I think there's clear evidence that the labor market is weakening, and that seems to be taking precedence in the Fed's thinking here. I'm not so worried about this morning's claims number. It seemed to be a lot concentrated in Texas, looked a little fluky. But last Friday, we did see an ongoing rise in the unemployment rate. And I think that's going to be, the real story here, because if that really continues, of course, then the downward pressure on wages presumably would halt any worries we're going to have about inflation in, 6, 12 months from now.
Certainly, we have seen that with the inflation numbers today, the Fed is probably not going to be cutting rates by 50 basis points in September. However, it did add another rate cut this year to 3 rather than our earlier expectation of 2. So I think that would be an encouragement. Also, when you look at the fact that we are seeing new all-time highs, not just here in the U.S., but also overseas, that is a confirming factor that tends to improve the average price performance 3 months out, as well as the frequency of advance, to the point where I think investors really are trying to find reasons to sell stocks when, in fact, that's probably what's going to continue to support and maybe even propel them.
So not a 50 basis points cut, but 25, but 3 instead of 2 for the rest of the year. And that's the view coming in for the Federal Reserve. Take a short break. On the other side, we get you excerpts from our conversation with the CEO of Dabur. Stay tuned. We'll be right back. Welcome back. Now, the new GST changes are set to kick in just 10 days from now. The expectation is that a huge consumption drive is on the cards and consumers are the biggest beneficiaries. My colleague Shivani Bajaj caught up with Mohit Malhotra, the CEO of Dabur India, to understand his views on the GST rationalization and how will it impact the industry. Listening.
No, I think it's fantastic because we never expected this kind of a reform will actually come into play. But I think government is actually surprised it, and these reforms have actually come at a time when the food inflation is very high for us, and the whole country is reeling with a lot of consumption going down. So the consumption is almost at a very big issues that we are facing, especially the urban consumption. So this GST reform will actually completely resurrect, I think, the consumption. The consumer confidence index will go up. Because the consumption will go up, the investment will go up. Because the investment will go up, I think there'll be more revenue and more money in the hands of the farmers also. And I think entire ecosystem will actually benefit out of this, right from the farmer, which is the farm, right to the folk, which is the consumer who's actually using it. Yeah.
Okay. So you spoke about consumption and how this is strategically, timed just ahead of the festive season. Is there a ballpark figure in terms of percentage that you see the consumption growing from here in this particular festive season?
You know, one unique thing about this is that these GST reforms are actually coming, which is going to bolster the consumption in urban India. And urban India will actually benefit from the GST reform. So it is just not a focus on have-nots, it's a focus on haves also. So the middle class surge will actually happen. I can't exactly give you the number, I think it depends. But I think there will be a consumption impact definitely in the long term, which will actually happen.
Okay. You also, the last question, sir, you also spoke about, how there was a disparity between taxation of loose items and then when it was packaged and added value to. From a perspective of Dabur, how do you see that from a Dabur portfolio perspective? How is that going to benefit the company?
You see, a lot of classification issues have been actually resolved. One example I gave you earlier, what used to happen is the classical medicines used to be taxed at around 5%, which were all generic medicines, and the branded medicines, which are more high quality medicines in which we are adding value to it, the entire value chain is more improved and better quality, that was taxed higher. So it was almost a penalty. So why would a consumer go for a high price product when a low price product is available, so he used to compromise on quality. So I think consumer will benefit because he get a better quality product, albeit now at a similar pricing. So we'll be able to reduce the prices of those products also and pass on those benefits to the consumer. So that entire anomaly between generics and branded has been resolved from my point of view. So if you look at paratha also, unbranded paratha and a branded paratha are now going to be taxed at the same rate. So it will reduce the gap between unorganized sector and the organized sector to a great extent.
And with that, we call time on the final edition of Power Breakfast for this week. From me and the team that put this show together, thank you so much for watching. But don't go anywhere. Bazaar Morning Call on the other side to set you up for the final trading session of this week.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you live as always from the CNBC TV 18 Motilal Oswal studios. It's been a pretty decent week for the market. It is Friday, which is a big cue. I'm Surabhi Upadhyay. With me is Reema Tendulkar today and the birthday boy in the house, Nigel D'Souza. Wish you a very happy birthday, Nigel. You're a fabulous colleague, fabulous friend, and we wish you all good things along the way over the next 1 year.
Thanks a lot for that, Surabhi. It's great to be here and receive all the love, and I've been here for 14-15 years, and every single birthday I prefer to work because the warmth, the love you get, and I thank CNBC TV 18 for that. It's been a good year, and hopefully the next one is even better than the past one. But thanks a lot for all your wishes.
You know, your warmth, your positivity, and your
energy
and the ever helpful nature. You know, the day you're not there in office, things are very quiet. So I hope this day is as vibrant and full of life as you are.
Guys, by the way, I've started the planning. The snacks are coming, then the party, breakfast, then the after party. I'm keeping the plan.
I'm on air till around 11 a.m. At around 11:30, you'll have fresh snacks on the floor for everyone. My PCR, makeup team, everyone, everyone who makes me look good and tolerates me every day. And as I say, the good vibes come from the fact that we never sleep without, making up for anything that was amiss during the course of the day. But thanks a lot for your wishes. We've got a market to get to, so let's get straight to the action.
Okay, and the market's actually been in decent form, you'd have to say. It's not been a bad week, like I said. It's not a week where you've had big pops on the index. It's not a week of huge moves, but all things put together, the Indian market has been climbing walls of worry. It has been climbing higher. So let's start with what the latest is. Now we are back to reading the signs and reading between the lines when it comes to the India-US relationship and dialogue. And let's start first with the comment that came in from Commerce Secretary Howard Lutnick. Now, he has said that India must make meaningful concessions, starting with reducing its reliance on Russian crude. So despite the social media exchanges between Prime Minister Modi and the US President, there are still a lot of noises around Russian oil. Take a look at this.
We're going to sort out India. India basically has to open their market, has to stop buying Russian oil. People don't remember, India didn't buy Russian oil before the war with Russia and Ukraine. They had 1% of their oil was from Russia. And now 40% of their oil is from Russia because we've sanctioned it so they can buy it, $7, $10 a barrel cheap. So they're buying it, refining it, and then selling it to the rest of the world and making a bundle. So the president called nonsense on that and said, you got to stop that stuff. So I think India will sort it out once they stop buying Russian oil.
So this whole Russian oil business is still a big talking point. But let's see, as long as you can talk, about it and maybe come to some sort of a understanding, it would be extremely helpful. That's at least the base case the market is going with. We've also got some comments from the person who's going to be taking charge in New Delhi as the US ambassador to India, Sergio Gore. And he has again, spoken about Russian oil, saying that the president has made it clear that India must stop buying Russian oil. And he also goes on to say, it tells you that Washington is watching the overtures between India, China and Russia very carefully. He goes on to say that we will make it a top priority to see to it that India is pulled into our side and away from China. There might be some slight moments of hiccups right now, but we're on track of resolving this in the ongoing trade talks. So largely positive. They're reiterating their stance on Russian oil, but talking about taking the relationship forward and putting it back on track. So that's as far as India-US is concerned. Now let's come to the rest of the market cues. And we've had actually a pretty strong close across Wall Street once again. And it's been a market, moving on steroids. The market itself is up about 1.5% so far this week. And yesterday was more of the same. Now, yesterday, twin factors played out, which made the market quite excited. You had labor market data, which was weaker than expected, and you had inflation data, which was more or less in line. So let's look at the numbers. That's the CPI number. 0.4% rise month on month, more or less in line. Some estimates were saying 0.3. The year-on-year picture of 2.9% is also in line, though it's inched higher versus the July print. So that's inflation, not a shocker. And look at the labor market data. The jobless claims data is something to take note of. Jobless claims in the US are at the highest level since 2021, and that number was above estimates. And that led the market to pick up the hope that, yes, indeed, there'll be a rate cut next week. 25 basis points is the base case if you're looking at the market indicators as of now. Because of this, there was a bit of a move in the money markets as well. Yields have been moving higher. Bond prices are rallying in anticipation of that rate cut. The US 10-year closer to the 4% mark. There was a slight drift down in the dollar as well. So we'll watch for this. All eyes, of course, on the US Federal Reserve. Coming to our market here, like I said, it's been a decent week. The Nifty has climbed about 1%. The mid-cap index has done even better. Look at that, 1.7% on the mid-cap index in the last 4 trading sessions. And if we talk about the levels now, Nifty is at 25,000. It probably is going to meet some resistance around the 25,150 mark, and the lower zone of about 24,800 to 900, where the moving averages come in. They are sound support. Right now, Nifty obviously is above everything, 20, 50, 100, 200-day moving average. The question is, can the bulls continue to build from here? Nigel, how is it looking when you look at the F&O action?
Well, it's looking good actually for the Nifty. And the good news is the Nifty is actually performing in step with what we are seeing in the global markets. Remember, in the past year or so, we've actually been underperforming. But it's good to see that we're performing in step for this week itself. And also, we're on a 7-session winning streak. And the close that we saw yesterday was a multi-month high. So that's very, very good news. Now, the few indicators that you're getting, going by this week's cues itself, GST rationalization, very, very good. It will lead the economic recovery, which is good. But the market's, positive sentiment comes from the fact that if there is some kind of movement on the India-US trade point, you'll say that, in fact, things are not so important with regard to the United States. We can offset some of that. But this is a sentiment indicator. And, this goes to show this week itself, all the positive cues that you have been getting, the sound bites as well, that the markets are actually fixated on this. India-US trade deal is something that the bulls want. The institutions, well, they are net buyers. Remember, the last few trading sessions, we have had large block trades as well. But for the last many trading sessions, the institutional number is a net buy. So you like that. What about the FIs? We've been making this point, right, that the FIs are not getting follow through on the short side, and sooner or later they'll have to do that. That's what's gradually beginning to happen, because the short positionings came down by around 2,100 contracts odd. The short positioning from around 92%, which is the highest we have seen ever in percentage terms, has come down to around 89%. And the next graphic plate will tell you the story. Because the short positioning has come down by around 10,000 contracts, the FI net short positions from around 1.92 lakh contracts on the short side, that's come down to around 1.82 lakh contracts on the short side. And that as well should come up for you. Just take a look at that. So there is some short covering that's taken place. And that perfectly ties in with the Nifty Bank, because the Nifty Bank was the one where the shorts were piling in. And in yesterday's trade, the total open interest on the Nifty Bank was down by close to around 4% approximately. So that's clearly telling you that there is a bit of a short covering bounce. This is the October contract. But the near-term contract, we're definitely seeing some bit of a short covering bounce that's taking place on the Nifty Bank. Moving to the options data, then the 24,950 call, the premiums around 150 rupees out there. And there are signs of writing out there. While on the downside, the 25,000 put. So just for today, if you're looking at it, on the downside, going by there is writing out here, the 24,900 mark becomes important. And on the upside, since that's writing at around the 24,950 call, the 25,100 becomes a bit of a resistance mark. So those are the crucial levels for today's trading session. Let's focus on the two large components of the index. One is the Nifty Bank. Yesterday was a good close. We ended pat in line at around the 20 DMA. You wanted to get past that and gradually move higher as well. So a close today on the Nifty Bank, it seems to be finding its form. That's going to be important. And Tech Rima will tell you about that. Infosys' buyback could support Infosys as a stock, and also because of its weightage on the index. We'll have to keep an eye out on that. And in the last month or so, Tech has suddenly come back. Year to date, it's an underperformer, but that one, in fact, has outperformed in the last week or so. So that's good news as well.
Well, it also helps that NASDAQ is ripping Wall Street.
Yeah.
The NASDAQ index closed up about 0.7%, and it was the 24th record close on NASDAQ for this year itself. In fact, U.S. equities did well. The Dow topped that 46,000 mark for the first time, and Asia's carrying forward the lead from Wall Street overnight. So you've got a Hang Seng, you've got this Korean market, Kospi up more than 1%. The Taiwanese market's also up close to about 1%. So things are looking good across Asia, but let's find out the cues that we've got from the global markets and how we can interpret it back here in India. William Lee, Chief Economist, Executive Director at Milken Institute, is now joining us on the show. Thank you very much for joining in. Let's start with the US CPI inflation print, right? A little hotter than expected, but not too hot. On the whole, in line. We kept thinking that this, the tariffs, will start hurting, will be inflationary. But is there any evidence of the tariffs imposed by the US impacting inflation? And then the weekly jobless claims at the lowest level in 4 years. What did you make of that?
Well, as far as inflation is concerned, people are looking with an extreme microscope to try to find some evidence that these tariffs are starting to take hold. They're starting to push up prices and push up prices on a widespread level enough to create inflation concerns. None of that has happened. We see some evidence that some prices are going up because of tariffs, but they are really small relative to the prices that are going up, not for inflation, not for tariff reasons. Households spend a lot of money on food. They spend a lot of money on shelter. They spend a lot of money on gasoline. Those are the things that are going up in a significant way that concerns the Fed, because the service inflation for housing really hasn't come down, despite the fact that real estate prices have come down. Energy prices, which were on a downward trend, have suddenly turned around. In fact, I think it's almost a 2% rise month over month. And that is a shocking reversal, considering that President Trump has made a high priority on lowering energy prices. And finally, food. Cattle prices and protein prices in general have popped up. And there again, it affects households' budgets tremendously, because again, we're talking about 12% of their budget on food, 6% of their budget on energy. And these are the items, I think, that where inflation is showing up, and that is not related to tariffs.
Okay, we'll see how those numbers shape up. As of now, just under 3% on a year-on-year basis, William. But overall, the U.S. market has been doing exceedingly well. Tech has been, rip-roaring higher. So if the market is doing so well, and if the economy is not really weakening, I don't know, give us your sense on the labor market because of those jobless claims numbers. Would you really... Yeah, and tie that in with the Fed expectations. Is the market and the economy is doing well? Why should the Fed cut rates?
The market is doing well because the inflation fears have not shown up. But the labor market fears and the slowing that comes with the labor market, those are starting to gain some momentum. Today's unemployment claims is important because it shows that the momentum is not slacking off. And by the way, the Fed's new framework says they will not just concentrate on the unemployment rate the way they did before as an indicator of labor market strength or weakness. They're going to look at all of the indicators in a more comprehensive way. And that's why these claims have gained so much more prominence now, even though in the past they were considered as just noisy short-term data. Now they are an important part of the mosaic that gives us a picture of what's going on in the labor market.
All right. Hi, William. Good to see you. And as always, what are the odds, though? The markets are running up. The U.S. markets are running up in anticipation of this rate cut. The problem is the dollar index is weakened, so that's going to make imports a little bit more expensive for them. Mm-hmm. And the other point is this tariffs now, the negative impact will start being seen in the next few months. So it's going to be a little bit tricky because the Fed will cut rates in all probability. Do you see that the U.S. equity markets, after the kind of run that we've had, the challenges ahead as well, and the valuations, it's getting to the stage where the U.S. markets peak out?
Yeah, I remember a lot of this market strength was in a specific trade, the AI trade, the tech trade. And it's starting to broaden out because there's more and more confidence that the investment incentives put in place by President Trump under the Big Beautiful Bill and the tax reductions and they yet to see the regulatory dismantling, those are the things that are supposed to spur investment. And so that's why the market started to broaden, but not so much yet, right? The main part of the bets that are in the market are still on tech and AI. And the fact that the tariffs are starting to come into shape to bolster more foreign capital flowing into these sectors, that's, I think, a very good sign that specific parts of the market are doing well. Now, you're right. The dollar has come down a bit. But it's still higher than it was 2 or 3 years ago. It's come off of a huge peak of February, and I think that's where the overvaluation was, rather than the normalization that's taking place now is normalizing rather than a source of concern for a weakening dollar.
William, what's the view on India's macros? The Q1 GDP print was blockbuster, 7.8%. Then you've got GST rate cuts, which will further fuel demand in the second half of the year. But on the other hand, the rupee continues to hit record lows. I mean, tie that in. And what's the call on India now?
I think the call on India is still an optimistic one because of exactly what you said earlier, which is that the relations between U.S. and India have not been completely fractured to the point where they cannot be repaired. I think the ups and downs that we've seen since early February to the lows of the recent period when Prime Minister Modi started to make overtures to China and Russia and more strident statements about the BRICS countries. I think the core of the U.S.-India relations has to be a longer-term view. India needs the U.S. because of the complementary type of investments that we could take place here. India also wants to be a player on the world stage and doesn't want to be a handmaiden to the U.S. And it wants to make sure that the world knows that they are not going to be kowtowing to the U.S. And so that balancing act, I think, is going on. And I think everyone realizes it is a balancing act, and there will be ebbs and flows, but on average, the trend is very positive.
Okay, all right. And the market's been taking note of that here as well. William, great conversation as always. Thanks very much. You have a good evening out there, and we'll, of course, catch up again soon. Thank you. Let's quickly run through the rest of the show lineup as well. And here's what we have for you today. At 8:35, we'll be in conversation with Richard Redoglia, CEO of Matrix Global, to talk about oil prices and what the trends are there in that market. At 9 a.m., we'll have Kumar Rakesh of BNP Paribas joining in, and he'll talk about the auto space. I mean, auto stocks are really revved up, so is there more to the rally after the GST cuts? We'll find out. At 9:20, Manishi Raychaudhuri joins in. He is our market master of the day. At 9:35, we'll be in conversation with the management of Prestige to talk about demand trends in the realty sector. After that, the management of Paras Defence and Astra Microwave will be in conversation with us. We'll talk about this 15-year defence roadmap that has been laid out by the government and what companies can hope to gain from it. And towards the end of the show, Sumit Abrol of Grant Thornton Bharat will be discussing trends in outbound M&A deals.
All right, time to slip into a quick break. We've got a lot of stock-specific action to track today. We get to that in just a bit in our special Top 10 segment. We're looking at Infosys, Lodha, Bharat Forge, JBM Auto, GSW Energy, NBCC, GMR Power, GSW Infra, Travel Food Services, and RailTel. That's sort of a day. We got positive news flows. We're having all our top stocks that could be reacting to positive news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. So the cues, I mean, across Asia are also fairly okay. Wall Street anyways had a very, very strong handover. And you look at some of those regional markets. The Hong Kong Hang Seng is racing away. The Japanese markets have had a very, very good week as well. Let's pull up the implied open and see if the bulls can indeed build on from where they left off things yesterday. That's not bad looking at all. 100 points higher. And if we do get that kind of a gap up, that's the first line of resistance that we start running into. So we'll see if that momentum can really last. Well, lots of stocks to focus on, and our team is standing by with the CNBC TV 18 list of top stocks to watch. Guys, hi, good morning and happy Friday to all of you. Let me go with Rima first. Rima, Infosys, buyback details are out. Tell us.
It's a big buyback, 18,000 crore rupees, much higher than market estimates of about 14,000 crore rupees. It's a tender buyback. The buyback price is 1,800 rupees. That's about a 19% premium. The company will buy back 2.4% of its outstanding equity, the fifth share buyback by Infosys to date, and this will be their largest ever. The last one was about 9,300 crores. So and this one is practically double of that at 18,000 crore. And as I said, expect the stock to do well, though it has done well. Yesterday it cooled off a bit. It was down 1.5%. But since the buyback announcement, it's been higher. But just the size, 18,000, is so much higher than what the street was anticipating, which was 14,000 crore. I suspect the stock will do well today.
Okay, all right, Rima, got that. So we're definitely keeping Infosys on our radar as well. Let's look at Lodha. Sonal is joining in. Sonal, Lodha seems to be setting up some massive mega data center just outside Mumbai. Tell us more.
In Palava, that is. And remember, Palava continues to be a big developmental center for Lodha overall as well. And they have a warehouse already, and now they have inked an MOU with Maharashtra government. The total investment will be 30,000 crore rupees. The company says the park will have a planned capacity of 2 gigawatts for green integrated data center, and it will be hosting multiple international and domestic players as well. Of course, it's at the initial stage only, and the data center will be set up in Palava. We need to understand how much investment will go in from Lodha, what kind of financials will come out of it. But yes, this is something which is positive for the company overall.
Okay, all right. Sonal, thanks a lot for that. Well, let's hop across to Sud. He is the man in focus all through the week, getting us something or the other. This time around, Bharat Forge and JBM Auto. Sud, tell us more.
Good morning, Nigel. So for Bharat Forge, it has made two announcements. So first, it has bagged an order from Abu Dhabi company, that is MP3 International. It's a defense order. And second is that it has signed MOU with a UK company that is known as Wind Racer. So first, talk about Abu Dhabi order. So its arm, that is Kalyani Strategic Investments, has bagged an order to supply artillery system critical spare parts to UAE. And they will supply large caliber 155 barrels for howitzers. Basically, this is used to deliver long-range, high-explosive fire support. Second, MOU with Wind Racers. So, Bharat Forge and UK's Wind Racers have signed 2-year MOU, and that is for deployment, localization and application of Wind Racers unmanned aerial vehicles, and that will be deployed across the country. For JBM Auto, its electric mobility arm, that is known as JBM Ecolife Mobility, has secured $100 million funding from International Finance Corporation, and that fund will be used to purchase and operations of more than 1,400 electric buses across the country.
Got that. Thank you. Let's go across now to Vivek for more stocks which are in the news today.
Well, that's right. Good morning. Quite a few stocks in focus. On the back of news flow, JSW Energy, the company has gone ahead and commissioned close to 317 megawatt of renewable energy capacity in August, taking the company's total installed capacity to 13.1 gigawatt, improving the earnings visibility. NBCC, a very interesting update. The company has gone ahead and signed an MOU with RICO, which is the Rajasthan State Industrial Development and Investment Corporation. Now, this particular MOU is for the development of Rajasthan Mandapam and infrastructure, various allied infrastructure projects near Jaipur Airport. The total value of the project is close to 3,700 crore, and RICO will actually provide NBCC an initial interest-free advance of close to 50 crore. Along with that, the Rajasthan government also will provide financial support up to 635 crore for the development of Rajasthan Mandapam. GMR Power, that is in focus. We don't talk about it too often, but an important development. The Supreme Court has gone ahead and dismissed civil appeals filed by Haryana as well as Odisha Discoms. So now the company will receive the extra payments in terms of coal price hike pass-through. So it's a positive development coming in as far as GMR Power is concerned, they will get both the balance amount as well as the interest for the last 8 years. JSW Infra, a small acquisition, the company's subsidiary JSW Port Logistics has acquired brownfield rail siding in Karnataka. This is a site that spans over 86 acres, and the total consideration for the transaction is at close to 57 crores. The rationale is that the company says they will develop an ecosystem of rail link terminals as well as establish multimodal connectivity.
Okay, all right, Vivek. So we will keep all of those stocks on our radar. Thanks very much. Let's bring in Vinny as well. She's tracking a couple of, I think, travel and, food companies. So let's find out more. Vinny, what's on your radar?
Hi, so I'm keeping an eye out on Travel Food Services. Now, a positive news flow coming in here as the company has actually been awarded the license to operate travel QSR and lounge as well as food and beverage services at the domestic airport in Kochi, the Kochi International Airport. This is going to be for setting up, operating, maintenance, management of food and beverage services, one at the lounge, at the bar, as well as the main security holding area, which they'll cover. They'll cover 11 QSRs, as well as one is going to be food and beverages in the lounge area as well. Time period, 5 years, can extend for 2 more years as well. So big one coming in because out of the 15 large airports in India, they have 14 of it now covered. So good one for the company. Also, RailTel, keep an eye out on that one. Again, order wins coming in for the company. One is a 70 crore order. This is from Nashik Municipal Smart City Development Corporation. Execution time period for this is till 31st of December 2026. And the other one is a 32 crore order win that's that they've received from Panvel Municipal Corporation as well. So total order wins of around 100 crore coming in for RailTel.
Thank you. Let's do a quick recap then of the top stocks with positive news flow are Infosys, Lodha, Bharat 4, JBM Auto, JSW Energy, NBCC, GMR Power, JSW Infrastructure, Travel Food Services and RailTel. And well, no stocks on our radar that are expected to open in the red today.
Okay, all right. Well, let's go back to Sudarshan. He's the busy man this morning, bringing us some top 10 stocks, going through a lot of brokerage reports. So, Sud, tell us what you picked up today in terms of reports.
So, before I go to the brokerage corner, do you know, Sonal was talking about Lodha, and because I stay in Palwa, do you know how much land parcel Lodha has over there?
No, please tell us, Sud.
It's more than 1,000 acres.
Wow.
And even Amazon is building one data center, like almost on that side of area only. Now, coming to the brokerage corner.
So that's interesting, you know. So I'll tell you what, I think I'll be coming across. We'll come to your place, you know, have a drink and then maybe look at some of that, you know, just for viewership purpose, but for drinking purpose, it's all drinks on you.
Yeah, I'll join in as well soon. See you soon. But for now, we've self-invited ourselves over. Now, after this, let's talk about the brokerage notes as well.
Yeah. So now talking about the brokerage corner. So first in the list is Citi has written on autos and it has mentioned few catalysts. All the catalysts already we know. And those are first GST rate cut. Second is income tax revision. And third is lower interest rates. And it continues to prefer passenger vehicles over commercial vehicles and two-wheelers. It says industry growth could be much higher than all the brokerages have factored in their estimates. And for two-wheelers, passenger vehicles base also remains low if you compare against two-wheelers. So Maruti remains top pick for Citi and it maintains buy call and target is raised to 17,500 from rupees 14,400. For M&M, again buy call target is raised to 4,170 from rupees 3,700 and for Hyundai target is raised to 2,900 from rupees 2,400 per share. Now coming to another brokerage, Investec has written on Lupin. It has upgraded the stock to buy from hold and target is increased to rupees 2,265 from 2,100 per share. It says company is well placed to ride upcoming GLP-1 opportunity in India and post-correction, recent corrections their stock has seen. Even valuations have become reasonable. In the base case, it's expecting a strong FY26. After that, a moderation in FY27 and again, EPS growth can be seen in FY28.
Okay, thank you very much for that. We'll slip into a break on that note. On the other side, we'll connect with Siddharth Khemka of Motilal Oswal Financial Services for some fundamental stock talk.
Welcome back. Hope you're having a good morning. Well, crude prices are lower this morning as concerns over possible softening of US demand and broad oversupply offset threats to output from the conflict in West Asia as well as in Ukraine. Richard Redoglia, the CEO at Matrix Global, joins us on the show. Hi, Richard. Good morning. Good to see you win. Well, unfortunately, some of the geopolitical issues have crept up yet again. But clearly, demand is rather soft and there is an imbalance between demand as well as supply, given that crude oil prices, they can't get above that $68, $70 per barrel mark. How are you seeing crude oil moving from here on?
Thank you for having me today. I don't think it's going anywhere. I think I've been on your show now for the last, I think since the Iran-Iraq affair, right? And we saw the spike in prices there. And what that spike showed us is a market that was structurally short, that the market, that the traders, that the money in the market had was structurally short. Those two events in Iran caused the market to cover those shorts, and that's why the spike came from, right? So our visit above $70, I look at WTI more than I look at Brent, come here in the States. Those spikes to $75, $78 were a function of shorts covering. Once the market looked at what was going on and realized that nothing was going on in Iran, that what we would see is the oversupply of the market come back in. And two things have happened. One is the market is balanced. And so the risk, or consider the war risk, has declined by a couple dollars. So that's out of the market. But equally as important is OPEC. OPEC has had a schedule for the last 4 years where they pulled barrels off the market between 1 and 4 million barrels. And they said, we're going to do this in an orderly fashion. And we're going to do it over time. And that's what supported the market effectively above $70 for the last 3 to 4 years. They're no longer doing that. Simultaneously to that, we're seeing a significant production coming offshore South America, both in Brazil and Guyana. And so there we have the effect there. As it relates to demand in the United States is not a problem. Demand is going to be what it's going to be, and the U.S. economy is going to be fine. It's more how one views demand in China, which is going to be flat, and more importantly, what it's going to be in India.
Yeah, so, and demand even, I guess, in India has been pretty steady. But Richard, then there is the Russia question as well, right? And no one knows, and we don't know if EU is going to bite the bullet, if the US is going to move first. What happens if Russian oil or oil assets get sanctioned? Does that lead to some sort of an immediate shock? I mean, it's a hypothetical question right now. I just want to know.
No, that is an excellent question. That is really the question we should be talking about right now. So China imports 2.2 million barrels of Russian oil. India's produced about 1.4 million barrels of Russian oil. I think the Trump policy is a bad policy. I think what he's doing, I think Trump, most of his policies are good. I think this is a bad one to threaten to put 100% tariffs on India and China because they're importing Russian oil. Both those countries, India in particular, can use Russian oil at a discount. If it's getting it at a discount, it's better for the Indian people. I'm sorry, the question is going to be politically. Is there a balance? China will not go by any type of sanctions. But let's see the example. Let's say India and China do. The market would spike significantly because that's about 3 million barrels that would have to find a home somewhere else. And it would also put a significant discount on Russian oil. So it's a question. I don't think that you are sitting in India, so you tell me. I believe that Modi will continue to buy oil. They might buy a little less. I think Reliance and maybe some of the private companies might buy a little less. But I imagine IOC and the other state-owned oil companies will continue to buy Russian oil.
No, absolutely. They have to now. And I mean, that's been the stated stance here, that really no one can tell us what to buy from where. And we need to do what is economically right for the people here. But just
100% agree. That's exact policy.
But just to go back to that point, in case, because now President Trump has lobbed the ball in the European Union's court, right, saying that you have to impose tariffs. But in case there are any sanctions on Russian oil, what happens to, say, Brent? Will it be a 3, 4, 5% impact? What happens?
Well, if the only way that can happen, so the only thing that's going to happen is, does India not buy Russian oil? That's the only. There's only two outcomes here. Does China not buy it, or does India not buy it? And if the answer is neither of them, both continue to buy it, then nothing's happened to price. The question becomes what happens from an economic perspective and the pressure that will come if the EU decides to do these 100% tariffs. I'd be surprised. I have no idea. I'd be surprised if the EU agrees to opposing those tariffs. Now, theoretically or morally, they should, because they are so against Putin and Russia. So really what they should do is kind of put their money where their mouth is. If Trump's going to do it, the EU should do it. Will they? I do not know. And that's another can of worms that we would be very difficult to get back into.
So, okay, talking in terms of price ranges, you said you look at NYMEX more closely, which has been, well behaved around 61, 62. As we look at the next couple of months going into the end of the year, what would be a range that you'd keep in mind?
I've been saying for the past few months, I think prices are falling. So the $62 price you're looking at right now on the screen, or $63.10 or whatever it may be, $62. That's the lowest price since June, right? So we are bumping up against what could considered to be. If you had a price chart, if you put a price chart up, you would see that we're in a very vulnerable area. If this WTI market or Brent falls another $1.50 or so, it's breaking out to prices the market had not seen all the way back towards the middle of the year, or excuse me, the beginning of the year. And so I'm thinking down. I don't think China or Russia are going to do anything. And but there goes makes the market. So if they do something, the market will move up a little bit. But even if it moves up, I think every rally will get sold. It'll just be a matter of time before those barrels re-enter the market, because there's going to be no home for them to go to.
Okay, all right, got it. So you don't see a big spike up happening,
right?
Which is good
at
news.
all.
Which is good news for consumers like us and importers like us.
Can I make one point? Can I make one point?
Yes, sure.
Can you see me behind my head?
Yes.
Right there. 24 years ago, that's where I was. I was at the base. See the two towers there below the World Financial Center?
Yes.
That's where we were 24 years. I was not there. My office is there. I worked there for 20 years, and my office is in that tower, looking at those two towers 24 years ago. So let's say, take a moment of, it's 9/11 in the United States.
Absolutely. It is a day that the world and definitely the U.S. is never going to forget. And we just hope that nothing of that sort is repeated on humanity ever again. Thank you so much, Richard, for joining us today. And on that note, we have to, I think, take a very quick break. And then we'll go back to talking local stocks here. We'll have Siddharth Khemka joining in a bit. Our technical experts will be with us with some trading ideas as well.
Welcome back. The bulls have been slowly controlling the markets now. We've had 7 good days on the trot, and today could be the 8th. The GIFT Nifty is currently up close to about 70 odd points, and IT could provide support today, particularly Infosys. Siddharth Khemka, Head of Research, Wealth Management at Motilal Oswal Financial Services, is now joining us on the show. Siddharth, the first question is on Infosys. Should shareholders tender in the buyback at 1,800 rupees per share? Is it attractive?
Good morning, Rima. Yes, I think if you look at it's a kind of dividend that the company is giving back to the shareholders. So definitely the current shareholders and anyone looking to get a good dividend yield in the current market, value investors, they would definitely like the kind of premium that the company is giving on the current price. So I think purely from a dividend yield perspective or a kind of a value investor should look at participating in this buyback from Infosys.
Okay, participate in the Infosys buyback. That's a thumbs up. Siddharth, good to have you in. But what about the rest? I mean, yesterday TCS started running because people then get, they get very excited. They think maybe TCS will also do something similar. I don't know. I mean, how do you look at the other large peer?
Yeah, good morning, Survi. I think there are two things to look at purely from a Indian IT sector perspective. The huge buyback that Infosys announced, that kind of shows the conviction that the management has that the worst is behind and the stability in the business going forward, and hence returning the cash that the company has on balance sheet. So in terms of valuation, we get some comfort that the downside is limited, the worst is behind, and that is a positive rub-off effect for the bulk of other large IT players sitting on cash. So there is definitely an expectation that some of the others, especially the largest Indian IT company, TCS, could also follow suit and announce a buyback or a special dividend, something by way of which they reward the shareholders in the bad times.
All right. Hi, Sid. Good to see you in this morning. Let's focus on Lodha. You know, they have inked an MOU with the Maharashtra government for a 30,000 crore rupee data center park in Palava. And if you want further details, my colleague Sudarshan lives around there. He's done an in-depth analysis. But we want to know about the stock. Tell us about Lodha. What's your view?
Good morning, Nigel. I think we have seen that trend in the past, Anantraj from real estate getting into the data centers. And now I think Lodha, with the huge land bank that they have, I think that's a good monetizing opportunity in the some of the emerging themes that these players can get into. So I think it's a better yield for them compared to what if they would have looked at a commercial place, because the entire space and the demand for data centers is huge. If a company gets that kind of size, space, and the infrastructure in one place, I think that's a win-win situation for all. So definitely, Lodha is something that we have been liking a lot in the Mumbai region, the MMR region. Lodha has had a premium positioning, and now with a new line of business they are getting in, I think that only adds to the overall positive outlook for Lodha.
By the way, the primary market is also active. So today is the last day to subscribe to Urban Company, and the other one is Shringar House of Mangalsutra. So Urban Company, we know, about 15,000 crore in terms of market capitalization. So far in the first 2 days, it's seen a subscription of about 9 times. And the opportunity ahead of the company is pretty large. And the other one is this House of Mangalsutra. Smaller company, market cap is about 1,500 to 1,600 crore rupees. The issue size was 400 crore rupees. But again, good subscription on the first 2 days, 8.25 times. The company, I think, has about a 6% market share in India's organized Mangalsutra. Last year, the company's top line went up by 30% to 1430 crore, and bottom line came in at 61 crore. Siddharth, as a house, are you all advising on these two, Urban Company and the other one is Shringar House of Mangalsutra, and what would the call be?
So Rima, unfortunately, we are not having any view on these IPOs currently.
Got that. In the platform plays, since, I mean, there is a lot of interest, but stocks have also done very well. They've skyrocketed, and now Swiggy is also coming up with this Quick India movement. So they're going to rival the Amazon Great India Sale or the Flipkart $1 billion sale. So they're saying it's time now for quick commerce to come out with these. And they've come out with a date in September. So, I mean, there's so much news flow. There is opportunity. Companies are tapping into it, grabbing market share, expanding the pie. But amongst the entire platform play, which one do you like?
So I think, yes, we like this space. Platform companies, the profitability has gone up. And especially if you look at the food delivery business, they have been consistently generating cash flows. That is something that we have been liking. I think the platform fee has been hiked consistently. The other factor is that in the quick commerce space, the intensity, the competitive intensity, that has come down. And with the new player Zepto saying that they now are focusing on cost and profitability with an eye on the IPO that they intend to do sometime later. I think that bodes well for some of the earlier players like Eternal and Swiggy, both of which we continue to like. We have what we believe is that the capex intensity will now come down in the dark stores. Profitability will improve both in the food delivery business as well as in the quick commerce business. Our preferred pick is Eternal. We have upgraded our target price to about 500 rupees. Sorry, 420 rupees. And Swiggy also we have upgraded. We had a neutral rating and we have upgraded the stock to now a buy with a target price of 500.
Got it. Okay, all right. Sid, stay with us. For the time being, Hormuz, he goes through all those big volume movers and whether or not they have some delivery-based buying or selling. Hormuz, good morning. Fill us in with the list.
Good morning, Nigel. Wish you a very happy birthday as well. And some of the names that you talk about in this list today, it's not too bad losing a race after all. And that Aurobindo Pharma's shareholders proved that yesterday with the stock. Of course, it's not confirmed reports for sure, but the stock was up the most since June of 2024 last year, 5.5% higher there. The volumes on the stock were the highest since April of this year. Almost 60 lakh shares changed hands, 20-day average of 13 lakh shares. And even the delivery-based buying, 18 lakhs, almost 17 lakh shares marked for delivery compared to a 20-day average of just around 6.5 lakh shares. But of course, the stock has been an underperformer this year, down 18% so far, despite this move in yesterday's session. Fedbank Financial Services, it came out in that late 2023 IPO rush. It was barely made it through in terms of subscription as well. Yesterday was up 7.5%, and it was the second best day since the stock had since its listing. And because of this, it has closed above its IPO price for the first time since December of 2023, which is just a few days after its listing. And despite it being at a 52-week high, the stock is just 9% above its IPO price. The Thursday's volumes were highest since November of last year. 60 lakh shares traded compared to a 20-day average of close to 10 lakh, and almost half of that, or 27 lakh shares, were marked for delivery compared to a 20-day average of 4.5 lakh. Now, Greenpanel Industries is another one, the biggest single-day gain in 6 years yesterday. The highest ever volumes in a single trading session for the stock. 2 crore shares traded yesterday. 20-day average is just 85,000, and 18 lakh shares were marked for delivery. 20-day average is only 54,000. But despite this, of course, it has managed to trim some of its year-to-date losses, still down 12% for 2025. And another name, Tollens Tyres, seen some heightened trading activity in the last few trading sessions, particularly in the last 2 days when the stock has gone up 20%. Now, from its listing in September of 2024 till the 21st of August, the average daily traded volume on Tollens Tyres was around 2 lakh shares. Since the 21st of August, it has gone up to 5 lakh shares. Even yesterday, over 1.2 crore shares changed hands. 20-day average is 3.5 lakh, and 6.2 lakh shares marked for delivery, a 20-day average of just 94,000. And yesterday's turnover, which was well over 230 crore rupees, was 1/3 of its overall market cap, and still down almost 18% from its IPO price, which is around 226 rupees for Tollens Tyres.
Thank you very much for that. Let's talk about GAIL. Yesterday, GAIL was in focus on the hope that the long pending pipeline tariff hike may be announced soon. The stock closed up with a gain of about 3%. But Sonal is now joining in. Sonal, there is a Citi note and there is more good news in store for the company.
Tariff continues to be the big trigger point going forward. The Citi note talks about one of their subsidiary possibly getting listed. That's GAIL Gas, which is the city gas distribution arm of the company. They have a buy rating with a target price of 220 rupees a share. They say that GAIL is inviting expression of interest from investors because they want to list GAIL Gas from here on. And it is operating currently 16 geographical areas, and this is directly. And there are 9 geographical areas which are through joint ventures. Additionally, GAIL is also in the process of transferring some of its own geographical areas to GAIL Gas, which will increase the volumes overall for that company. They say these are early days, but still, if it lists, it could unlock 5 to 6% of the value for GAIL, which would be 10 to 11 rupees per share in terms of value unlocking. Given stock price at current levels is ascribing no explicit value to that particular business, it could be a value unlocking exercise for the company and the stock overall.
Okay, all right. Thanks a lot for that, Sonal. Well, we'll slip into a short break. We come back. We'll get you the pre-open rates. We'll also be joined by Kumar Rakesh of BNP Paribas. Stay with us.
Welcome back. We will be getting our pre-open rates in another 7 to 8 minutes. Still in conversation with Siddharth Khemka. Sid, so it's upcoming festive season, the GST play. Give us your top 3 picks. GST/consumption/festive picks. Which ones will you go with?
Sure. So I think definitely there is a lot of hope that the consumption basket that should do well, and within that, what we believe is that if you look at, it's a wide range of consumption discretionary plays that we can like. So the top pick there is first is the company called Vishal Mega Mart VMM. It's a offline first retail stores largely present in tier 2, tier 3 towns. We believe that the strong expansion, strong growth, and the value retail format that where they have a good leadership and strong brand recognition that could do well. The other is Swiggy, as we already discussed. We believe with the GST rate cuts, the consumption boom, and the profitability coming back in the quick commerce business, that could be another stock to play for the overall consumption theme. Then the third stock what we can see is the hotels. Again, GST rate cut, traveling, GST rate cut below the 7,500 mark, strong expansion. So our preferred pick there is Lemon Tree.
Okay, all right. Sid, what about the metals pack? You know, that's suddenly shining yet again. And NMDC is a stock actually that's been quite strong. And the reason is that we're going to get into the post-monsoon period, which is, you know, the important period that we look at. So demand comes back out there. And also global pricing has strengthened a little bit. That in turn will make the case quite strong to go ahead and take a price increase here in India. What's your view at NMDC? I think yesterday it closed in the ballpark 75, 76 odd.
Sure, I think, Nigel, there are 2-3 factors that are also supporting the global metal prices. If you look at, there is a possibility of a rate cut by the US Fed that has also supported sentiments for metals. And we have seen the metal prices going up both in the ferrous as well as in the non-ferrous segment. Plus, as you rightly said, post-monsoon, the volume of take that will pick up, chances of price hike. Plus, the government has also come out with the rare mineral earth policy where some of these mining companies can possibly get another source of diversified business income. So we like NMDC. We have a buy rating and a target price of 84 rupees. It plans to double its capacity to 100 MTA over the next 4-5 years to capitalize on the overall rising steel production in India, higher iron ore demand. And we believe with the strong volume growth visibility, the margin improvement probability, and the prudent capital management, one can definitely look at NMDC from a long-term perspective.
You're also bullish on the consumer luggage sector. You believe it offers a multi-year structural growth story. So the top line can compound at a growth, double-digit growth of about 12%. So you like both Safari and VIP here? And if go ahead.
Yeah, go ahead, please.
So tell us the rationale behind Safari, VIP. Between the two, which one is better placed? Because now there is a change in management when it comes to VIP also.
Sure. I think the entire story is that the luggage sector offers a multi-year structural story shifting from utility to lifestyle. And we believe that the organized players with almost 52% market share, growing dominance, the branded luggage industry is set to gain further with rising income, premiumization, and the domestic the Indian travelers now taking up a lot of up to travel. So while we also like the hotel space, we have been liking it for quite some time. Another way to play the overall travel leisure segment was through the luggage sector, and there we believe that the travel revival, weddings, students, corporate mobility, all those things could lead to a 12% industry CAGR over the next few years. Within these stocks, I think both of the stocks we like, both VIP. There is a recent underperformance, but now with the change in top management, we expect a revenue CAGR of 10%, but margin improving and EBITDA CAGR of almost 50-60% going forward, driven by both volume growth and sharp improvement in margins. Safari has been a leading player, continuously outperforming the industry, 30% market share. They have reported a revenue CAGR of 36% in the last 2-3 years. They have focused on building the brands like the Safari Select, Urban, Jungle. These are the premier positioning. And then I think there also we are expecting a steady growth of about 25-30% earnings CAGR over the two. So between the two, I would say the preferred one is definitely Safari, consistently delivering strong growth. We have a buy rating with a target price of 2,700 on Safari. But someone who's looking for more risk or a kind of turnaround play, that there they can look at a VIP Industries where things are likely to improve going forward. Again, we have a buy rating and a target price of 530 on VIP Industries.
Okay, all right. So travel, consumption, delivery, and a lot of consumer-related plays. Got that. Siddharth, thanks very much. Good to have you on the show today, and you have a great Friday. We'll connect again soon. Well, we'll start getting the pre-open rates in the next couple of minutes, so good time to bring in our technical experts. Shrikant Chauhan and Mitesh Thakkar are joining in. Gentlemen, good morning to both of you and happy Friday. It's actually been a happy week for the market. Quietly, slowly and steadily, the Nifty's managed to come up to about 25,000. Mitesh, what's the approach going to be from here on?
Yes. Good morning, Surabhi. Been advocating that we will head towards the upper end of the range, and you have some recent historical supply pivots around 25,150 and then 25,260 to about 300 zone. So I think these are the two targets which I have in mind. People who are carrying long positions on the index should take some profits around 25,150. And in case we start getting past that, I think 25,260, 300 would be the zone where I would suggest significant profit booking will come in. So that's the approach which we are taking. But on stock specific basis, and for last many days, we have been trading with long bias. And as you rightly said, this is a week, when the markets have done better. I think next few days also look biased on the upside.
Got that. Shrikant, do you want to start with the index approach on a trade?
Good morning, Rima. Good morning, Surabhi, and many happy returns of the day to Nigel.
Thanks a lot.
Yes. While looking at the setup of the market, one thing is very clear that we are heading higher and we may even surpass the level of 25,200 because it's a gradual up move that we saw in the market, and number of sectors they are participating in the market, and the way there is a gradual activity, we can expect further more activity in the broader market. But the ideal strategy should be to look for adding position if there is any correction during the day. And since the last 3 days, whenever there is a correction in the market, we are seeing good amount of buying interest or strength from participant in the market. So today, as per GIFT Nifty, we may see opening somewhere close to 25,100, 150. There we can see some profit taking because FIs are consistently selling in the market. But in case if there is any correction close to 25,000 sort of levels, there we should look for creating some long positions. And also we like Bank Nifty, which is around 54,500, 600. There also we are expecting targets of 55,500 sort of levels. Currently we are witnessing good amount of buying interest in PSU banks, but very soon we can expect activity in private banks also.
Okay, all right. Well, let's get to individual stocks then. Mitesh, you go first. What's on your radar?
Morning, Nigel. Wishing you a very happy birthday.
Thank you.
On the stock side, I have all buy calls, all long calls today. The first one is Gas Authority. I think I just heard the pre-market discussion. Yesterday, there was a good gap breakout, a bullish candlestick pattern, a jump in volumes. Looks like the stock can head towards 190 and it's a buy with a stop at 175. I also have a buy on Hindustan Zinc. It's managed to clear supply line, resistance line. So buy with a stop at about 439.5. Look for targets of 460. A buy call on Bharat Forge. We had a big breakout 3-4 days back, and last couple of days were spent giving a pullback, and the price was nearly flat. But yesterday there were signals of continuation. So buy here with a stop at 1190 for targets of 1250. And Steel Authority is the final buy call. Keep a stop at about 128.5. Look for targets of 140.
Okay, 4 trading calls coming in from Mitesh, GAIL, Hindustan Zinc, SAIL, and the last one is GAIL.
Sorry,
SAIL and
no, I have Bharat Forge.
Bharat Forge, yeah. Okay, let's get in Shrikant Chauhan's trading ideas for the day. Shrikant?
2 stocks are catching my attention. One is GMR Infra. There we are seeing good amount of buying interest in the stock. There was a good amount of block deals in yesterday's trading session for the stock close to 87, 88 levels. From here, the stock can move towards 92, 93 sort of levels. So we should look for adding this stock at current levels with a stop loss close to 85.5. And the other stock on which we are bullish is Steel Authority. All these metal stocks, they are doing well, especially steel stocks in that Tata Steel, Steel Authority, Jindal Steel and Power. All of them are showing a lot of good amount of buying strength. But yes, we like SAIL. There we have a target of close to 140, and we can keep a stop loss around 129 for the same.
Thank you, Shrikant. Pre-open seems to suggest about a 50-point pop on the Nifty, supported by IT. So Infosys could be the top gainer, 2.5% higher. And the other IT companies, stocks are being supportive, Tech Mahindra, TCS, HCL Tech. also perhaps likely to open in the grain. But moving on from tech to auto and technical ideas, the auto industry leaders have all welcomed the big GST reform. Speaking from the sidelines of the 65th SIAM convention, the industry leaders hope the GST reforms will translate into strong festive season sales. Listen in to their commentary.
Yeah, I think, it's been a really welcome move and a major reform which was very much awaited. I would say this was a request by the Automotive Association for a long period of time, I must say. It's a welcome move. It is coming just ahead of the festive season. So there will be a big boost in the short term. And in terms of how this whole thing will pan out is something to be observed. But, let me first talk about the short term. There has been a pent-up which has been building for 1.5 months since the time, after 15th August, people have been waiting for the GST reduction and, waiting to book their cars also. So after this announcement has happened, and then you have seen that pent-up being released in terms of bookings and all.
Biggest thing is that this GST is not sector specific. It is touching everyone in the country, every sector, every consumer in the country. And therefore, the overall demand or the overall consumption is going to go up significantly. And once the consumption goes up, whether it is a toothpaste or a brush or a car or a scooter or anything else or cement, or it has to be carried. It has to be carried on a truck. And therefore, the freight traffic is bound to increase. I think the biggest trigger for us is not the cut in the price, but this freight traffic which will increase, which will directly impact the industry in terms of needing more trucks and more buses to be able to carry these goods and passengers.
Okay, so those are some voices from the industry at the SIAM Summit that was underway yesterday. Let's take the conversation forward. Will auto stocks continue to be revved up, and are they a good bet? Let's discuss this with Kumar Rakesh, India analyst, auto as well as IT services at BNP Paribas. Of course, we're discussing autos for today's conversation. Kumar, great to have you in. Okay, let's start by understanding now what's happening. From the 22nd onwards, the new price cuts roll in. But most OEMs, I think, almost everyone, has already announced price cuts. So what is the inventory position, and has it become clear? I mean, what happens to the inventory? How is it going to be marked in terms of tax? And what should we expect over the next 3-4 weeks?
Hi, good morning, Surbhi. So we have seen about 2 to 11% of price reduction that has been announced by major PV OEMs. So bulk of the entire GST reduction has already been getting passed through to the customers in terms of price announcement. What happens in terms of the inventory position? Now, we understand that the GST part will be refundable, but the cess is still being debated, what happens on the cess side. So that is an overhang, what happens to the inventory on which the cess has already been paid. But we believe that should more of a transient issue. This reduction is permanent, and once we are passed through these transient teething issues, the industry should continue to see the benefit of stronger growth across all the segments.
Hi, morning. This is Rima here. I think you're neutral to negative on most of the two-wheelers. I think neutral on Bajaj Auto, Eicher, Hero, negative on TVS Motors. With this GST rate cut and the boost it will provide, is it time to get constructive on any of the two-wheelers?
Hi, morning, Rima. Yeah, for sure. For the next couple of quarters, we'll see very strong growth for two-wheeler names as well. What we are concerned about is the outlook on the ABS implementation. Government had spoken about that from 1st January, the new ABS norms will get implemented for two-wheelers of 125cc and lower. And if that gets implemented, it will largely offset all the price GST rate. And because of that, we would see the impact coming through.
I think we have Kumar on a bad line. Kumar, can you hear us? I think we've lost that line. We'll see if we can get him back in a bit, but I'm just going to quickly run through some of the BNP recommendations. The stocks that they're positive on are Ashok Leyland, Mahindra & Mahindra, Maruti Suzuki, some Vardhana Motherson and Tata Motors. But they're not that over-the-top optimistic on a lot of the two-wheelers, like Rima was pointing out. They're equal weight on Bajaj Auto, on Eicher Motors, and on Hero as well. Kumar, sorry, I think we've got you back. So just complete your point and also tell us, why the preference for four-wheelers, passenger vehicle makers like Maruti, because the GST cuts aside, I mean, there was also this other debate all these years, right, that intrinsically the customer has moved on and he or she doesn't want small cars, he wants SUVs, and therefore the whole M&M story. So just tell us what makes you still optimistic on PVs, including names like Hyundai and Maruti.
Yeah. So on two-wheelers, as I was just completing the point that the ABS price increase can potentially wipe out some of the benefits which we are seeing. And on the passenger vehicle side, we believe that the entry segment is still aspirational for a large set of customers, if you see, because the price point at which those vehicles are available, that is still pretty high from average salary or average income of Indian household. So if you look at the first-time buyer, it has fallen from about 49% to 40% in the industry. So we believe the pain in the entry segment or the small cars is more of a reflection of first-time buyers being lower in the market compared to how it used to be.
Kumar, we'll leave the conversation here for now. Thank you very much for joining in. Great chatting with you. It's 9:10. Let's get in some more trading ideas. Mitesh?
Yeah. I'll go with the buy on Gas Authority for the day.
GAIL in focus, fundamentally and technically. Pre-open, stock is up nearly 1%, adding on to the 3% gain of yesterday. But Nimesh is now joining in with the standout brokerage report of the day. Nimesh.
Hi, morning, Rima. Today's standout is on pipe companies. It's a second initiating report in a week in that particular sector. After UBS, now JP Morgan has initiated coverage on two names, Astral as well as Supreme Industries. On both, they have an overweight rating. On Astral, they have a target price of 1,700. And on Supreme, they have a target price of 4,700. So overweight on both these names. Now, the JP Morgan note says that they expect a demand recovery and demand actually at an inflection point. In fact, they see a demand recovery in second quarter and a margin recovery in the second half of FY26. In fact, they forecast a 17 to 18% EPS growth over the next 3 years. The only risk to this call is the PVC price hike. That could be a bit of a dampener. But overall, from a sector perspective, they see a bit of a re-rating going on. Similar was a call from UBS as well earlier this week. Even they were expecting a volume recovery in the second half of FY26, and even they had they also had a overweight on Astral. So two sector reports, overweight and turning positive on the pipe companies. First was UBS, and now it's JP Morgan.
Okay, all right. Thanks a lot for that, Nimesh. Well, let's focus on some of the capital market stocks then. They tumbled in trade yesterday and reports that securities market regulator is likely to float a consultation paper to consider ending the weekly derivatives contracts. Vamakshi is with us on the show to tell us more about that. Hey, Vama, morning.
Good morning, Nigel. Wishing you a very happy birthday today. And let's get straight to the news then. Sources yesterday were indicating that SEBI is likely to float a consultation paper to phase out weekly FNO contracts within a month. They were, they were weighing on transitioning to monthly expiries, and they would also consider a same-day expiry across exchanges. This was a story that was brought about by our colleague Yash. And, after that, we did see a very sharp fall in all of these counters. We saw a fall of anywhere between 2 to 5%. And the fall in stock price in most of these counters was also accompanied with the rise in open interest. So therefore, fresh shorts were added to the system in these counters. Now, take a look at the volume and delivery data as well. The volumes yesterday was approximately double the 30-day average for counters like BSE, Angel One, as well as Nuvama. But 361 WAM was an exception because volumes here were lower as compared to the 30-day average. Take a look at the delivery stats as well. Now, for most stocks, it's not starkly different from the 30-day average, with the exception of Angel One. Apart from that, take a look at, Jefferies has also conducted a scenario analysis on speculation around the extension of the expiries to monthly, fortnightly, and, the potential impact that they assess could be between, could drive a 20 to 50% cut to FY27 EPS for BSE, which is a massive cut. Apart from that, they're expecting 15 to 25% cuts to FY25 EPS estimates for Nuvama. Now, they have highlighted that there has been a 15% price fall since July, so shift to fortnightly expiry and separate settlement seems priced in. And today there is a SEBI board meeting, so all eyes will be on that.
Okay, all right, got it. Thank you very much, Vamakshi, for the details over there. Let's quickly recap. How a lot of the top movers that we had discussed earlier, how they have finally opened out for trading, at least in the pre-open. So if you go by the large cap names, that Infosys is really cheering the buyback. 1800 is the price, remember, so it's a substantial premium compared to where the stock is right now. It's actually pulled up TCS along with it as well. Let's pull up Lodha now. Lodha making that big investment for data centers in Palava. Lodha is up 3%. Bharat Forge was the other one. JBM Auto also up about 3%. Travel food services adding more airports to their sort of portfolio. 3% up over there. RailTel high. Let's pull up NBCC because NBCC has struck a big order with the Rajasthan administration. The value is, I think, 3,700 crores. NBCC is up about 2% and some gains for GMR Power there as well. Well, down to the last couple of seconds. So we're going to kick it off with the Nifty opening higher by about 70 points. The bell goes off. And that's what we have, about 70 to 80 points higher on the index. The mid-cap index is actually doing slightly better. Mid-cap index has opened up with a gain of about 0.5%. Bank Nifty is very quiet as the day goes on. But we've opened up with a good bias in terms of far more stocks advancing than declining. So it's looking like a good start. Let's see if the bulls can build on it. Infosys, obviously, as you'd expect, is the key gainer out there. Let's pull up the heat map and just see how the overall picture is like. There are, of course, many, almost out of 50, almost 45 stocks that are advancing. Of course, a lesser number of reds today. So it's looking good and it's fairly mixed on the upside for the time being. Infosys, TCS, of course, are taking the top position. By the way, the IT index has gained 4% this week. That's been the kind of surge that we've witnessed. And overall, Rima, it's all about Infosys and the excitement around this 1,800 per share price.
Indeed. And it also helps that IT had underperformed and valuations were fairly attractive. So that on the positive. And plus, because this buyback will take about 3 to 4 months to execute, the street believes that even in this period, we get negative earnings, the stock still gets supported.
There's a floor.
Right? There is a floor in place, even if the earnings, take some time to recover for now. So Infosys is your top gainer. In fact, the Nifty IT index is now 4.8% up for the week. So it's only building on and piling on gains. HCL Tech, TCS right on top. The other gainers on the large cap screen include a Hindalco that's up 1%. Maruti Suzuki, Kumar Rakesh of BNP Paribas was just telling us why it's his top pick. Tata Motors, a couple of these auto names throw that in, are fairly supportive. ONGC, L&T on the green side. On the way down, consumption has taken a back seat. So the top three Nifty losers are Eternal, HUL, ITC. Not big by way of drags, just down about 0.2, 0.3%, but in the red for now in terms of the opening take. The Nifty is consolidating above 25,000. It's a gain of about 60 points. And this would be what, 8th day that the markets are up in the green, at least for the benchmark indices, supported by IT today, and mid-caps are outperforming.
Well, that's right. Take a look at JBM Auto. That's flying away. That's up closer on 6%. Big move is what you're seeing on JBM Auto. Pull up a couple of other names. I think Sigachi was the stock that Hormuz was talking about yesterday. That's up closer on 4%. Volumes are massive out there. Brainbees, yesterday there was a very large trade, I think of around 28 lakh shares on Brainbees. That's got out of the way. The stock, in fact, is higher. It's up closer around 2.5%. So we'll keep an eye out on this particular counter as well. Vare Energies, everyone was talking about maybe there is no big visibility in terms of earnings and the likes. The stock has done very quickly, 2,300 to around 3,800. Just take a look at the recovery on that particular name. Massive move is what we're seeing out there. HFCL reacting to positive news flow, so that's higher. Lodha as well is higher in trade today. So pretty good start, particularly for the broader markets, and that's why your portfolio will be feeling quite good this morning. AQR Lighting, yesterday as well the stock did see a rally. For this week itself, it's up more than 10%. And in today's trading session on large volumes, that one has bounced up closer around 5%. And the other one is Precision Camshaft. It saw a big run this week, and then in fact it saw some kind of profit taking, I think, yesterday. But for the time being, that stock has opened up with big gains. And a viewer just messaged me that happy birthday. And Nigel, last year on your birthday, the markets rallied. I just went and checked that data point. The markets are up close to 2% last year on 12th of September. So if the markets rally, I don't mind taking some kind of, I mean, I don't mind that it could be because of me. If it doesn't, then it's the market for you.
It's the market's problem. Yeah. And it has nothing to do with the date.
By the way, BSE and Angel One are also recovering. After yesterday's big gashes down 4-5%. Today, BSE is up close to about 2.5%. Angel One is in the green. And Jeffrey says that even in the worst case scenario, the valuations is still pretty okay for BSE. I think they've put that number out, 30 to 40x in terms of FY27 PE. So they believe, I mean, in a way, the downside could be protected from here on. So they've bounced back. And Astral is the other one. Nimesh was highlighting it in the Standard Brokerage report. The target price set by JPM is 1,700 rupees. Astral now is sub 1,500. So they see upside. Stock is pushing up.
Absolutely. And I mean, when it comes to these capital market stocks, one can only hope that there is quick clarity on the regulation as soon as possible. Of course, our story is, what Yash had put out yesterday was that there seems to be a conversation of completely doing away from the weekly options products and only having one single monthly expiry across all exchanges, all products. So let's see. That's one school of thought. That's what we are picking up.
And there's a SEBI board meet. There is a SEBI board meet today.
Yes. So the sooner, we have the final regulation, the better. You can just sort of,
let's see whether they deliberate, discuss on it, and we get any kind of sound bites or clarity.
Absolutely. Otherwise, the market's fine. I mean, in the mid-cap space continues to bounce around. Plenty of stocks which continue to find traction. Some of the defense names, by the way, we'll have a discussion on defense in just a bit on this 15-year roadmap. So some of the names like MTAR, Paras Defense, they are actually fairly excited today as well, 2 to 3% higher. On these ones, MTAR and Paras Defense, on the private sector names, they are up and about this Friday morning. So let's take the conversation forward. Manishi Raychaudhuri, CEO of MR Capital Partners, is with us. Manishi, great to have you on. Thanks for joining in. So, GST bonanza, income tax cuts, RBI cuts, all of it is coming together to really lift sentiment in the market. And the market's also responding. The question is, can it really translate into better earnings? Where are you, Manishi, on the earnings estimates for this year after Q1 and after the range of policy announcements that have, that have just taken place?
Thank you very much for having me, Surbhi, and a very good morning to your viewers. First of all, the earnings environment in India for the past year, right from September 2024, has been quite bleak. We have seen consistent earnings estimate downgrades over the past year. And it hasn't stopped over the last 2 quarters. So one will have to watch very keenly the result reporting season for this July-September quarter, which will be across October and November. I have a feeling that this might turn out to be the worst quarter before we have a certain degree of, bottoming out of earnings estimates and a gradual recovery in the beginning of next year, in the beginning of 2026. The reason why I'm saying this is, number one, there's a lot of fiscal and monetary stimulus that has gone in. If you look at the latest GST cut, that is something around, 0.5 to 0.6% of GDP. We have had the jumbo rate cut earlier, and RBI, believe me, has a lot of dry powder. Today, the real policy rates are close to 4%. It's only been twice as high as this over the last decade. So RBI, even though they have cut by about 100 basis points, they can cut potentially by maybe another 50 to 100 basis points spread over the next 6 to 12 months. So, number one, we have had a lot of fiscal and monetary stimulus. There's room for more monetary stimulus. At some point of time, this would have an effect on, on the domestic consumption and investment environment. We're already anecdotally seeing that. There are, the signs of demand recovery in automobiles, for example. We have seen some companies cutting prices even, earlier than the September 22nd deadline. So, I think we will have to watch out very keenly for, for September, for the September quarter results to come out across October, November. But beyond that, I think there's a case for earnings estimates bottoming out and beginning to revive.
So Q2 should be the bottom, and Q3 onwards, things should start on an uptrend. Manishi, hi, morning. When we last spoke, you said you were completely avoiding IT and I think consumer staples. We'll get to IT, but first on consumer staples. Is there a case for a buy on consumer staples FMCG post the GST cuts?
Well, there would be some benefits, no doubt, to that sector. But at the same time, look at it this way, that consumer staples are well penetrated across India. And that is why, for years and years, the leading consumer staples companies are reporting top-line growth in the mid-single digits. At the same time, they trade somewhere between 40 to 60 times PE multiples going forward. So in a nutshell, a single sentence answer to your question would be no. Despite this GST cut, I'm still not enthused about the consumer staples universe.
All right. Hi, Manishi. Good to see you, Ben. Manishi, you know, the theme that has a longer runway has to be some of the stock market plays. The problem is, in the last 24 months, they ran so hard that they've all come in for profit taking. Case in point being the exchange that's listed, that's BSE. From more than 3,000 rupees, it's closer to 2,000 rupees. You have Angel One, another stock, you know, that was up, I think, around close to 3,500, 4,000 rupees. It's having around the 2,000, 2,200 rupee odd mark. What is your view on these capital market plays? You know, for a longer term investor, it could probably make sense. Would you believe so? But the near term, that could be a lot of pain. Your take?
Great. Thank you for that question. Very interesting. And even before I answer that question, Nigel, let me wish you a very happy birthday.
Thank you so much, Manish.
So, you know, looking at that capital market universe, you see, there are a few different segments over there. Number one, you have the wealth managers. You know, you have the likes of, Angel One, Nuvama, who are targeting the retail clients, very high net worth clients. You have the exchanges, you know, which basically have to depend on trading volumes and IPO volumes. And these exchanges are also much more regulated. They're also much more, you know, if I may use that word, slave to the regulations which keep changing. So, for example, I mean, if you have the same expiry date across, all exchanges, obviously that has an impact on the trading volumes in the derivatives segment. So, you know, I, for one, am more bullish on the wealth managers. Some of them are, despite the fact that they have run up, are still trading at reasonable valuations. Many of them have had earnings estimates being, taken up over the last 6 months to 1 year. So one has to tread carefully in this segment. It is a good choice for India, which is likely going to have a capital market boom over the next decade. But one has to be a little careful in his choice, in his top choice over here.
So Manishi, what are you most bullish on now at this juncture? You like wealth management, but what else?
I still like, and I may be sounding like a broken record here, I still like the private sector banks. India's 10 to 12% GDP growth would have to be financed largely by the private sector banks. Yes, the public sector banks would play a role, but the private sector banks would obviously gain a lot of market share over the next few decades. Their asset quality is way better than the public sector banks. Their valuations, look at HDFC Bank, which used to be at 4 times price to book. It has now come down to somewhere close to 2 to 2.2 times. So that is, really front and center of my sector choice. I also like consumer discretionary. Again, one has to be a bit selective about valuations here. I do like the four-wheelers, automobiles over there. And certain segments within the consumer discretionary, I would include the health chains, the domestic healthcare chains like the hospitals and the diagnostic chains in here. I also like the industrials selectively, including the defense names, which have run up too sharp and valuation support may not exist there. But a combination of government infrastructure investments and potential revival of private sector capex would have a tailwind on that sector eventually.
Manish, I just want to come back to that point that you made on consumption. You said you're not quite convinced and you're not sort of jumping from the rooftops with that theme. Just expand on that. does that call only apply to, say, pure FMCG staples, or do you mean across the board? And if you are not too enthused with these GST cuts and the consumer space, just tell us why.
Well, I wouldn't say I'm not enthused in the consumer space, because if you look at consumer staples and discretionaries have, I think an outsized impact, as far as the GST cuts are concerned. They are much more price sensitive. I mean, the price elasticity in the consumer discretionaries are way more. We are already seeing that anecdotally in automobiles. So I'm actually quite positive on the consumer discretionary space. It is actually in staples where the most of the companies, most of the sub segments are actually very well penetrated in India, and they're trading at humongous valuations. That is where I am a bit cautious.
Okay, all right. I understood that point. On IT, what's your thought process? And I mean, how are you looking at IT in the traditional sense, IT services, and a lot of these new age companies that have now become part of the listed universe, right? So, and tell us how an investor should approach it. The traditional firms, they do have cash. They're willing to share cash with their shareholders, like we're seeing in the form of Infosys. So, do these older stocks still have a tactical place in the portfolio? And on the other end of the spectrum, you have the platform companies, your food delivery, quick commerce, and now urban company, house help, etc. So much more. Where would you put them? And how much would you be willing to allocate to new age tech?
Right. So, again, to answer in a nutshell, in a single sentence, I would certainly be more enthusiastic about the new age tech companies. If you look at the traditional tech companies like the TCS and Infosys of the world, it is very clear that these companies, they don't really have too many avenues to invest the surplus cash that they're generating, and that is why they're resorting to buybacks. No doubt, it's good corporate governance to return excess cash to shareholders through dividend or buybacks. TCS has been doing it for many years. Now Infosys has joined the bandwagon. But it also tells us that the core business volumes that these guys were relying on, that is under threat, either from the geopolitical tensions in the Western Hemisphere or from the threat of AI, which is writing a lot of code. And therefore, this manpower arbitrage model is, unlikely to work for a very long time. On the other hand, the Zomatos, Swiggies of the world, they have a very fast growing market because despite the growth that they have had in the past few years, there's a humongous amount of space, a very large portion of the consumer which still don't utilize their services. So yes, I think the headroom in that second space, the new age tech, as you call it, is a lot higher.
By the way, the Nifty Bank has dipped into the red. It's a minor 50-point downtick. But from the day's high, it's lost about 220 odd points, and autos have overtaken IT now as the top sectoral gainer. The auto index is up 1%. You've got Eicher Motors right on top, and Eicher Motors this month has added nearly 13%. Tata Motors, Hero MotoCorp, Maruti, M&M, all gaining about 1.5%. So the first 15 minutes have seen autos make a comeback, also buying interest in many of them. Manishi, so in the consumption basket, discretionary, give us subsectors or themes that you like. Is it airlines? Is it the hotel plays? Would it be the travel platforms like your Ixigo's and Yatras of the world? Would it be the luggage sectors, footwear? Is it Trent and the likes? The themes in the discretionary consumption space, other than platforms, which attracts you?
So there are three broad areas that I would talk about. First, the domestic discretionaries, and right at the forefront are the automobiles, particularly the four-wheeler passenger vehicles, right? So they would likely grow faster than the two-wheelers, even though we are seeing some buoyancy in the rural demand as well. The second area would be the tourism-related sectors, and in that, quite a few smaller subsegments would come in, the hotels, the airline companies, the tourism platforms like you have. So, again, this sector, one would have to be a bit careful about the valuations. And the third, which I briefly alluded to, as the population becomes more affluent, they also become a little more health conscious. And this is not really a tailwind for the pharmaceuticals, but more for the hospital and diagnostic chains. So these are the three big focus areas for me right now as far as discretionary consumption is concerned. And I think they will remain so for the time being.
Okay. All right, Manishi, we will leave the conversation there for today. Thanks very much for joining in. Appreciate you being with us. Have a good weekend, and we'll connect again soon. Well, that's a view from Manishi Chaudhary. The market is a little quiet this Friday morning, taking it easy. 40 points up on the Nifty. Mid-cap index has also cooled down a little bit from the opening highs. The Bank Nifty's got a little bit of a tinge of red on it, like Rima pointed out. So we'll see. It's a quiet start. Let's see if there's a pickup later. Let's focus on some stocks that are catching the eye. JBM Auto is definitely one of them. It's been up 5-6%. This company has managed to get some funding to purchase more EV buses. Let's go into the details with Sud. Sud, really revved up, JBM Auto.
That's true. So stock is currently up almost 8%. It's on the back of the announcement that company has made that its electric mobility arm, that is JBM Eco Life Mobility, has secured more than 100 million funding from International Finance Corporation. And that company is going to use that fund to buy and to bring those electric buses in the operations, and the number is going to be more than 1,400. It's 1,455, and also will finance the deployment of these buses majorly in 3 states for which company had bagged the tender under PM scheme, and those 3 states are Assam, Maharashtra and Gujarat. Now remember, government has a target to increase the penetration of electric bus to 40% by FY30. So the stock also has been moving higher for the last few months, and now on the back of this funding, today also it's up more than 7%.
Okay, got that, Sud. Thanks a lot for that. Let's hop across to Sonal. Sonal, tell us about Lodha.
Oh yes, so Lodha is in focus because the company has signed an MOU with the Maharashtra government to the tune of 30,000 crore rupees. This is for green integrated data centers. The park will have a planned capacity of 2 gigawatts. It is designed to host multiple leading international and domestic players as well. The data center will be set up in Palava, and do remember, Palava continues to remain a big focus point for the company. In fact, in their Q1 presentation, they had indicated that Palava and Upper Thane will deliver 17,500 crores of sales in the next 3 decades with 50% EBITDA margins, and it will emerge as a data center hub as well, will create sizable recurring revenue stream for the company. The size is not given, but this is a move in the right direction, and that's why the stock is in focus today.
All right, Sonal, thanks a lot. Well, since you spoke about real estate, let's take the discussion forward. And to help us out, and we have our next guest on the show, who is Mr. Irfan Razack, the CMD at the Prestige Group. Thanks a lot, Mr. Razack, for joining in. Just give us a minute. We'll just run our viewers through the top 3 talking points that we're looking at. Point number 1, the demand trends in Bengaluru as well as in Hyderabad. Point number 2, the IT slowdown. Is it impacting demand? And point number 3, what are the pricing trends? Well, Mr. Razack, help us out with all of these then. Let's start off with the demand situation first in Bengaluru as well as in Hyderabad. Are you seeing some signs of weakness, both in terms of volumes, in terms of pricing as well? Because the indications are that IT demand has seen some kind of weakness. So is it reflecting on real estate demand?
Good morning, Nigel. First of all, let me wish you a very, very happy birthday.
Thank you so much, sir. Thank you for your good wishes, your support over the years. It's helped me a lot.
Now, to answer your questions, I think demand is pretty steady. Now, it also depends on which demand we are talking of. I think Bangalore and Hyderabad are doing extremely well. The only thing is in certain cities, like certain regions, some of the developers have made very, very large homes, and those are under pressure. But if I'm targeting the mid-income group housing with a decent ticket price, I think the demand is pretty robust and it continues to sell. And I think both in Bangalore as well as in Hyderabad, there's no change on any change in the IT hiring or whatever, because the economy is still robust and things are on ground very good. And you talked about pricing. Pricing also have stabilized, they've strengthened. At the same time, I think they've come to a level which has got the acceptability of the customer. We are trying hard to see that the price doesn't go too high too soon, because that's counterproductive. So that's always our endeavor, because one side the land price is high, the other side you have the construction costs, which are slowly creeping up, and with cement, the GST on cement being a little reduced, I think that will help us to contain the construction cost as well.
All right. What about NCR? That was one of the larger contributors, right? Some believe that maybe that market is peaking out. Would you concur, or do you believe it's got, a bigger headroom to move?
No, I think NCR has got a lot more potential. The only reason is the number of players are much reduced, and credible players are missing in that region, except for a few. And that's where the demand is coming towards them, including us. And NCR, we as a company have only one project which we've launched, and that has done very, very well, continues to do well. And we intend growing our footprint there, but surely, but steadily, and carefully, of course. And I think that is the strategy we have in the company.
All right. Mr. Razak, what about the office occupancy? That's the other spot that there has been some focus for you as well. So you help us with a couple of details. Office occupancy actually has been very strong. Could you tell us what is the total area under management, and what kind of leasing will you see for this fiscal year? And do you think this is the year for the REIT?
No, this is not the year for the REIT. Let me answer the last question first. I think we need to get a critical mass, and it will take us at least 3 more years or 4 years for us to get that huge mass that we are looking at. But on the leasing part, yes, you're absolutely right. Leasing has been pretty robust. We don't have any vacancies, or if the vacancies are there, it's just a few percentage, 3, 4, 5%. So that's the very, very positive trend. And even office, the lease rents itself have firmed up very nicely. Then again, it all depends on the product and on the location. If your location is good and your product is good, so automatically leasing will happen. But if you've got a rank bad location and a rank bad product, then there's a pressure. But I believe that the future is bright on office leasing. GCCs have now come in, and they are now bringing in the demand apart from IT, ITES, so that helps the cause. And then, of course, data centers is the next big thing. But then data centers don't really consume too much space. What they need is a lot of power, and not the high-tech type of space, but high-tech in terms of the overall quality of power that we give them.
Mr. Razak, hi, morning, sir. Since you touched upon data centers, we're really talking about it today because one of your peer companies here in Mumbai, Lodha, they've announced a mega investment, I think 30,000 crores with the MOU with the state government just outside of Mumbai. How are you looking at this segment? I don't know if you already have, projects that you're building on the data center side, and just tell us the business dynamics. As a developer, is it remunerative to be getting into the data center business, or would you be better off doing what you anyway do, which is residential office, just in terms of margins and profitability metrics?
In the data center business, we will continue to be the infrastructure provider. We don't want to get into the data center business per se. We also, as a company, Prestige has signed a MOU with the Maharashtra government to do data centers. And the government is very keen to allot us some 50 acres in Navi Mumbai, and those discussions are on. And I believe that this is going to happen very soon. Apart from this, we're also looking at Andhra for the data center. We'll establish the data centers. There are many players who would like to operate that, and we are talking to them. So it becomes a win-win situation for the operators, because they'll get a ready product. Because what they are looking for is the infra in terms of the setup of power, the setup of the building itself. And the buildings for data center are very, very different than what you do as an office building.
What I'm trying to understand, sir, the cost dynamics and the margins. Is the data center business more lucrative than, say, the regular office spaces that you set up, less, equal? Just trying to understand the business dynamics behind it.
The volumes may not be there in data center. You will definitely not get the square footage that you do in office space. But if you're asking me for return on investment, unless we don't get a decent return on investment, there's no sense in doing that business. So we look upwards of 15 to 18% return on investment. And I think that we should get that easily. And of course, there's no such mass sort of India now is a 1 billion square foot market for office. That can't happen in data centers.
Right. You spoke about that partnership, sir, with the Maharashtra government for data centers. I think that in Navi Mumbai, I think you all have also committed an investment of 12,500 crore for the same.
Exactly. Not only a data center, but also
logistics.
Logistics. So these are the two things that we had committed, and we have signed the MOU. And hopefully we will pursue this. It's not a partnership. It's the state government will support us in terms of providing the land, and the rest of the investment has to come from the company.
So what's the timeline?
And, we are pretty serious on that, and we shall do it.
Okay. So what's the timeline? When will all this come on stream, get commercialized? By when will you make this investment? It's a large investment of 12,500 crore rupees. And what is the expected revenue from it? You spoke about the IRRs before.
Yeah, I mean, see, it's not something that has to be spent on day one. So it's work in progress. The first thing is investment in the land itself. Then it's on the infrastructure, power, buildings, and all of that. So it's a outlay which will take between 5 to 7 years, starting from just now, which is the investment in land.
Okay. All right, sir. One final question then. How far are we from the IPO for the hospitality segment?
Yes, I think that's work in progress. The teams are working diligently towards this. And I think we should be about a month away from the listing, hopefully.
Oh, all right. So Diwali then, a good Diwali for that particular vertical.
Hope so. The teams are working. We've got the SEBI approval, but there are many regulatory steps that need to be done. So let's hope and pray everything goes well and we are able to do it as planned.
We're hoping with you, sir. Wishing you all the best. Appreciate you joining in. And we look forward to catching up with you to understand how the demand trends are going and also on that much-awaited IPO. Wishing you a good day ahead.
Thanks, Nigel. Thank you so much.
All right. Time to slip in a short break. After the break, we have Mr. Atim Kabra of Astra Micro. He'll be joining in. And Amit Mahajan of Paras Defense as well will be joining in to discuss opportunities from India's 15-year defense roadmap. You don't want to miss this.
Welcome back. Schloss Bangalore is seeing a bit of a pickup. There is an Ambit note where they've initiated coverage. Their target price stands at 540. So that's a significant premium. The stock today is at 425, 3.5% up. It's compounding on luxury And valuations too, according to them, are about 22 times 1 year forward EV to EBITDA. They like Leela and Samhi too in the hospitality hotel space. So now Schloss Bangalore, buy call 540 is Ambit's view on the stock, and that's pushing it higher today. But let's talk about Lupin. That's in news. Vinny joins in with an update.
Hi, good morning. So yes, we're keeping an eye out on Lupin. This is on the back of a brokerage note from Investec, where they've upgraded the stock to a buy from previous hold rating, increased the target price to 2,265 rupees. Previous target price was 2,100 rupees per share. Now, what Investec is saying, what are the positives that come in? Lupin will see a good benefit coming in from the GLP-1 opportunity that will start next year in India. So those generic launches for semaglutide that will come in, Lupin will be a big beneficiary. And do not forget, Lupin is already a key player in anti-diabetes as well as cardiac arrest therapies. So because of that, they'll always have an upper hand on that front and a beneficiary there. Now, other than that, recent approvals that have come in for Lupin are indicating its expertise in complex injectables. So they'll start benefiting on that injectables front for the company as well. And Investec expects a potential of around $20 million to $30 million annual sales for each of the injectables that are there. Post-correction, what Investec is highlighting is that now valuations are quite reasonable, and that is why for their base case, they're expecting strong FY26 performance, moderation in FY27 in terms of EPS, and growth will actually start coming back from FY28 and onwards.
Okay, all right. Thanks a lot for that, Vinny. Well, let's go across to Nimesh, who's here to tell us about Astral. Stock is high with a gain of around 2%. Nimesh?
Well, not only Astral, Nigel, the pipe companies are buzzing off late because there are a couple of initiating reports in just 1 week itself. After UBS, today JP Morgan has initiated a report on the pipe companies, and they have an overweight on both Astral as well as on Supreme. On Astral, they have a target price of 1,700, and on Supreme Industries, they have a target price of 4,700. For the pipe business overall, they expect the demand recovery at an inflection point. They see a demand recovery in second quarter and a margin recovery in the second half of FY26. In fact, JP Morgan expects a 17 to 18% EPS CAGR over the next 3 years. The only risk is the PVC price hikes which might come. So that's the JP Morgan call. Only 2 days back, even UBS had initiated on the pipe companies, and even they had a overweight on Astral, and they had a target price of 1,800 rupees. So net, I guess Street is warming up to pipe companies for a recovery in the demand, and initiating reports coming in for Astral as well as for Supreme Industries.
Okay. All right. Got it, Nimesh. Thank you very much for that. Well, let's move to our next discussion then, and we're putting the spotlight on the defense space. The Defense Ministry has unveiled a comprehensive modernization 15-year roadmap for India's future-ready warfare programs. To discuss what this means in terms of an opportunity and a boost for the sector, we have two key players from the private sector space. Atim Kabra, Director Business Development and Strategy at Astra Microwave. And we also have Amit Mahajan, Director Technical and R&D at Paras Defense. Thanks, Mr. Kabra and Amit, for joining in. Great to have you both back on this discussion. So what we really want to just, break this down and understand what this means in terms of an opportunity and whether it gives an additional fillip to the plans and to the estimates that you were already working with. Mr. Kabra, if I could come to you, because this has been divided in a very comprehensive manner across the procurement that the Air Force will do, the Navy will do, and of course the Army will do. What have you made of the 15-year roadmap, and does it give any additional impetus or thrust to the procurement that we're already seeing?
I think it's a very, good morning. I think it's a very transformational document which shifts us from import dependency to be a globally competitive, self-reliant powerhouse, growing in exports and at the same time based on indigenous innovation. I think the critical focus here is on indigenization, modernization, and operational agility, which calls for fairly advanced capabilities, technological self-reliance, and collaborative growth. We are talking of advanced network-centric human-machine teamed platforms with real-time situational awareness, at the same time, which are cyber-hardened, if I would say. So all I hear is solutions, right? And user requires timely solutions, and we need to respect that. Where do you really see user laying out his next 15 years roadmap? So to that extent, this is fairly transformational.
So Mr. Kabra, are there any projects which are mentioned in this long strategic roadmap that you're already working on? And would you require to undertake incremental capex to meet a potential increase in demand?
The Astra has very deep footprints, as you are aware, both horizontally as well as vertically in microwaves, radars, electronic warfare space, So from that point of view, there are a lot of projects which are ongoing, which will be feeding into the requirements. At the same time, I think what we will see is resulting in multiple JVs across the industry, by the way, in my opinion. So our shareholders, for example, benefit significantly from one of our hidden gems, which is our 50% stake in a JV with Rafael Israel, which makes SDRs, software-defined radios. Right? So this is a company which can dwarf Astra, possibly, in years to come. And that results in kind of a collaborative approach and new technologies being brought in. So while we have our own capability set, which will work in very well with the requirements, but at the same time, I think there will be a need across the industry for multiple tech platforms to be brought in out here. And with the procurement process being in the process of being streamlined, I believe announcements are expected pretty soon. I think this should be resulting in a fairly set of business for the industry as a whole. Astra definitely will be one of the beneficiaries. But as I keep saying, this is not an industry which you should look at it on a quarterly basis, right? So you look at stacks of 2 to 3 years, and these stacks should result in significant incremental improvements, which are fairly irretrievable, if I may say. And we go from capability set to capability set. So this document kind of defines that.
All right. Hi, Mr. Kabra and Mr. Marjan. Mr. Kabra, since you briefly mentioned about that JV with Rafael, what kind of possibilities, what kind of opportunity size, if you could throw some color on that, because that clearly is something that, is exciting investors, but we don't really have a number or some kind of value that it can be given to it. That could be another hidden gem. Tell us more.
Absolutely. It is a hidden gem, which is not much appreciated outside, the company. But we are expecting this year itself should have at least $100 million assured kind of business order book. In the JV. Of this, about 35% odd flows down to Astra itself. So it's a fairly significant business, which adds value not only to the overall space, but also Astra, which ends up doing significant work for the business.
Okay, so the JV itself. So the JV will create a value of about $100 million, right? And then it'll be shared.
Order book.
The order book.
Yeah.
Okay, to be obviously shared between Rafael and yourselves. Would that be correct?
It's a 50-50 JV, yeah.
50-50 JV, yeah. Okay. Gives us a sense.
Profitable JV, and there are not too many profitable such initiatives around, right? So it's a testament to the managements of both the sides that we've been able to do this.
Yeah, absolutely. I mean, all of you companies, along with the defense PSUs, all of you make us proud with going after, cutting-edge technology and really bringing that Atmanirbharta message back home. Amit, let's bring you in as well. You tell us, and we want to really understand this from a shareholder perspective. People want to understand, how do things scale up? Say, let's look at the revenue numbers now. So Paras Defense, I think at the end of FY25, your revenue stood at about 370 crore rupees. So as you work on a lot of these projects and procurement orders, when does the big kicker come in? I mean, and I'm not asking you for 1 quarter, 2 quarters. Say 2 years down the line, what will the company look like?
So firstly, good morning, everyone. And thank you so much for having me on the show. It's been a while, and it's so nice that all the 3 of you I can talk to. And, like Atim Saab mentioned, I think what we need to derive out of this 15-year roadmap, and we need to understand it's a 15-year roadmap. This is an industry which is a long-term industry. This is not a short-term, quarter-to-quarter game. But what is interesting to see is the impetus is being given on the legacy platforms, the legacy technologies, the upgradation of your existing military might. And there is a good blend of the new threats that you can see. You can see a lot of loitering munition. You can see a lot of UAVs. You can see a lot of anti-drone technologies being given that importance, because what we have seen across the world, these are the technologies we are now started influencing your security infrastructure. So in this case, what we are seeing is the technology readiness is not at one particular point, but it has divided into very many spectrum of technologies. And Paras, if you look at, we've always believed that because we are working for Ministry of Defense and we are working for this industry, we should have all the variety of products that we can offer. Yes, strong point of our company remains the optics and optronic systems, but we also are trading into defense electronics. We are also into electromagnetics. We are also into heavy engineering.
So we know that. Amit, we know that. We've spoken so many times. My question is very specific. Investors want to understand the scale up in terms of just the revenue pie itself. Like I said, you're at about 370 crores now. 2 years down the line, what are you gunning for? When do you touch 1,000 crores in revenue?
So if you look at the growth trajectory that we have given, 40-50%. Now, when we look at these kind of news coming in from the ministry, it only solidifies your future. You are not looking at an inflection point where you'll take this to 100-150% growth. You will phase it out. Everything does not come at one particular point. So these are programs which will percolate down, and you will have a linear growth. 40-50% when you're looking at a growth, this only justifies that and maybe improves that particular possibility.
Okay. If I could just get, since the idea of this is to reduce our dependence, increase our indigenous capability, Atmanirbhar, what would your dependence be on foreign imports right now, Amit? And how will that come down by? Is there any number that you could both, if I could request both of you to share with us, Mr. Kabra and Mr. Mahajan?
So we primarily focus on developing technologies all by ourselves. Yes, there are collaborations that we have with certain Israeli companies, and we are bringing those technologies to the country. But the dependency for justifying the opportunities that are lying in front of us fairly lies on the domestic development capabilities, which also include DRDO, and they are the backbone of our development. But the dependency on foreign technologies is limited, and it will reduce further from here on.
And for, if I could request Mr. Kabra as well, for you, for your manufacturing, etc., what is the dependence on foreign imports today?
I think it's the component level where a lot of components are imported. The basic building blocks, they get imported into the systems. And so I would say, Amit is absolutely bang on target, right? As far as the solutions are concerned, it is the overall solutionizing which will be Indian, but I still expect that the chipsets, etc., which are not made out here, they will continue to be imported. So we have a fairly significant import content, if I may say, but usually that is passed on in the orders across to the clients.
Okay. And Atim, you spoke about enhancing exports. Exports is, I think, 10% of your overall revenue pie today?
Yeah.
Okay. Do you have a number in mind, say 5 years down the line, what that number could look like?
So I will make a distinction between deemed exports and exports of solutions. I would say export of solutions is something 5 years down the line should be at least 10 to 15% of the company from nearly zero at this point in time. And that's a very significant playbook that we are talking about, because by the end of this year, Astra is expecting that we will have completely indigenous, completely 100% Astra-owned, at least 3 radars plus very significant counter-drone systems with latest technologies built in multi-layered approach. And I think these are fairly global in nature. So we really hope to make a fairly significant dent. Plus our space business, we are more than a decade old in the space business. We are in conversations with guys who will source subsystems from us for their global space programs. I hope it works out pretty soon. You're already aware of our alliance with our arrangement with Teledyne, one arm of Teledyne. And we are really hoping that chip exports from our designed chips will also play a role in that. So at least 15% on an enhanced order book 5 years down the line from near zero will be the bare minimum that I would see for export markets.
Just very quickly, gentlemen, want to get your latest estimates on order book and order inflows for the next couple of months as well. And now in near term, we've spoken about the distance. Want to also get some near term clarity. Mr. Kabra, I believe your order book as of the end of first quarter was around 2,230 crores, if I have the right numbers. As you look ahead and as these roadmaps are announced, I mean, I'm trying to understand if the pace of awards is also increasing, if that's what you infer. And where do you think the order book position is going to be over the next couple of quarters? You'll be executing it as well, but in general, I mean, how will it move?
Astra has a guidance, if I'm not wrong, of about 1,300, 1,400 crores for the year incremental order book, which shall come in. The incremental part, right? Okay, which grows on, and then from that is reduced what we produce for the year. I think what we are looking at is, you're aware that we discussed last time, we have a significant order which has come in from Bell. And if we are able to procure that quarter end, it adds nearly 1,500, 1,600 crores over the years to our order book, right? Of which certain part will come in almost immediately. So we are fairly well placed, and we are quite confident they will achieve the order book that we are talking about.
And Amit,
we are talking of this 1,500 odd incremental going up to 3,000 plus.
Got it. So 1,500 crores, and if the BEL procurement materializes, then it will be going up to 3,000. Amit, same question to you very quickly. I think you're at just under 1,000 crores. What is the pipeline looking like for the next 2-3 quarters?
You're right. Our current order book is closing to between 900 to 1,000 crores.
Yeah.
We are looking at a good inflow of orders and a good revenue output as well. So with all of this put together, we should be closing this financial year with at least 50% better order book than what we have right now.
So 1,500 crores. Order book by the end of this year, 1,500 crores for Paras.
Yes.
Got it.
All right, very quickly, gentlemen. The scope is big, the opportunity is big. You have the government that's backing you all as well. Big runaway ahead. What about R&D spends? What is it currently, say, as a percentage of the sales mix, or if you could quantify it? And where do you see that headed? Because we have to be ready for a bigger runway, right? Amit, you go first.
So it's very tricky when you're working with defense and you're working with DRDO to earmark an R&D spend, because you're doing almost 30 to 40% of your revenues developing technologies with DRDO. So this is all that counts as an R&D effort that you're putting, you're developing technologies. So especially proactively doing R&D is on technologies that are new. Those are global in nature. And here for Paras, it is less than 10%, about around 5-6%. And this will continue to remain here because we are extensively extending our R&D for DRDO.
Okay, got it. All right. Adim, you want to come in as well?
Yeah, sure. Guys, Astra is front-loaded in terms of its infrastructure. So we are not looking at any incremental outlay, which is dramatically different from our yearly outlay on R&D. We have built up very significant capabilities and the machines, the testing equipment. We are very well placed, I think, to deliver. I think what we need to do is to cope up with the enhanced business, which we are expecting. We would be constructing within our premises another production floor, etc. And I think that's where a little bit of money will go in. But R&D wise, we are very, very comfortable.
Okay. All right. And just to clear the air, Mr. Kabra, you hold close to 3% in the company. You were an investor and then you started heading the company, or because skin in the game is something that investors like.
Yeah. Our board has, on the board, we have nearly folks who represent nearly 23-24% of the equity. My personal equity, I control about 5.55% or 5.6%. Don't hold me to it. Approximately, that's the number which I control, of which part is in my name, part is in a holdco, which I control. Yeah, so there's very significant skin in the game for the board, as well as all of us who are helping run the company.
Okay. All right, gentlemen. Great conversation, inspiring and spirited, and good luck to you. both of you, for all of those plans as India continues to move along the self-reliance path when it comes to defense procurement. Thanks for joining in. Well, with that, I think we've got some visuals coming in, and CP Radhakrishnan is going to be taking oath as the 15th Vice President of India. Remember, he was the NDA-backed candidate, of course, won by a clear majority. And I think shortly will be, those are the visuals coming in of the ceremony, and the oath-taking proceedings are ongoing. Okay, we'll keep playing those visuals. For now, a very, very quick break. Come back after the break and we'll get you a quick market update along with some more trading ideas.
Welcome back. The Nifty is still up about 70 odd points. JBM Auto is the star stock today. That's got a gain of close to about 8 odd %. Schloss Bangalore, we were discussing it, that Ambit Note 540 target price. Realtel continues to move up, and BSE has rebounded after the losses from yesterday. So that stands out. You've got Sigachi higher again. I think yesterday as well, the stock was up close to about 10 odd %. This week, 35% up on Sigachi, Atul Auto, Shakti Pumps, Apollo Micro, Hindustan Copper too has been a big mover, and large volumes coming through on Hindustan Copper. So the mid-cap screen is quite vibrant, active, lots of individual stock movers. Vinay Rajani is now joining in. Vinay, chugging higher step by step. Markets have been consolidating with a positive bias. From here on, what's the trade?
Yeah, good morning. So 8th consecutive session of rise in Nifty, and yes, gradually strength is coming in, though we are underperforming the global market. But going by the sectors and participation by the sectors, it looks like that Nifty is headed higher only, and we have been giving bullish view to our traders. So now the support for the Nifty is now 24,900, which should be utilized as a stop loss in trading long position. I'm expecting a short covering in the Nifty, and ultimate target of the Nifty should be 25,500 in next couple of weeks, we can say. So overall sentiment has improved, breadth of the market has improved, global market is quite good, and we have got a level about 25,000. There has been a downward sloping trendline resistance which has also been taken out convincingly. So yes, we are bullish with the stop loss of 24,900. One can expect Nifty to extend the gains, and the next resistance for the Nifty comes around 25,500, and Bank Nifty also we can see a movement of 800 to 1,000 points upside from this level. So yes, overall we are bullish, and stop loss in Nifty should be 24,900.
Okay. All right. That's at the index level. And what about stocks?
Yeah, so today defense sector has been doing quite good, and quite good momentum is there. So one of the stock which I like from this space is the Mazagon Dock, which has given a fresh breakout on the charts. So after healthy correction, stock started performing well. So Mazagon Dock around 2840, 2850, one can go long. For trading, I would suggest a stop loss at 2770. On the upside, I'm expecting a target of 2950. The second pick I would take from the private banking space, that is Axis Bank. So around 1100, 1104, one can go long. 1085 should be the trading stop loss. On the upside, I'm expecting a target of 1140.
Okay, all right. We'll leave it there. Vinay, thanks for joining in. Need to take a quick break. Come back on the other side. We'll be in discussion with two experts. M&A is going to be on the radar. Sumit Abrol of Grant Thornton and Bharat Bhavesh Shah of Aquarius will join in. We'll talk about the trend of outbound M&As from India and what it's telling us. Welcome back. M&A is on the radar, and we have two experts to talk about the trends. Sumit Abrol of Grant Thornton, and we have Bhavesh Shah of Aquarius with us. Thanks very much, Sumit and Bhavesh, for joining in. And, the genesis of this discussion is obviously some of the latest announcements, including the one that came in from Tega Industries, a small company looking to acquire an international giant. And it seems that, leverage buyouts perhaps are coming back in fashion or back in trend, at least in this example that I just quoted. But you tell us, how do you rate and rank some of the outbound activity that we've seen over the last 12 months from India, and what lies ahead? Sumit, let's open with you.
Yeah, thanks for having me on the show. And I think let me start with two simple words: very activated. If I recall, last year, 2024, we saw about 120 odd cross-border outbound acquisitions valued at about $17 odd billion. This year, 8 months fast forward into August, we've already seen transactions worth about 11 billion already getting transacted, about 100 transactions already done. And all this activity cannot just be concentrated and driven by the mega deals. So there is very significant mid-market participation in outbound cross-border activity. And that is expected, with what we've seen in the last 5 years in India, with Indian corporates not being in a better position or in a better shape to go after outbound expansion, with buoyant domestic demand, very healthy balance sheets, a very strong and supportive banking ecosystem, and very importantly, favorable capital markets, which are creating headroom on equity dilutions, which is creating that muscle power to support some of those exotic buyout structures, as you said, leverage buyouts, debt financing with equity coming in. And then, of course, there is that increasing gap in domestic versus international acquisition pricing, which is creating that headroom to deliver shareholder value. So I think overall, extremely exciting times and aggressive deal making by Indian buyers. And we are increasingly seeing a lot of Indian participation on most global deal tables, which are in play.
Sumit, lots of interesting points that you've raised, but let me pick on the last one and go to Bhavesh on aggressive deal making. Bhavesh, yesterday we had that big announcement by Tega, and Sumit was also talking about the rise of these mid-market champions from India going abroad, buying large assets. Look at Tega's example. It's a 13,000 crore market cap company, and they've gone ahead and acquired a company exactly of the same size, similar size. What are the pros and cons? Because there is some fear that Indian companies perhaps, or maybe in this particular transaction, you're stretching yourself too thin to make this buyout.
Good morning, and thank you for having me. I think there has always been an urge in the corporate India to kind of do outbound acquisitions. And we have seen this happening even in 2006, 2007, preceding the global financial crisis. And after the GFC, the trend kind of started, waning down. But the technology, the market positioning, the products that you get through international acquisitions is at a different level. I think the new drive is also driven by one of the major things which is now happening globally, which is the global trade rebalancing, which is happening across countries, driven by US tariffs. So the companies are even thinking about how do we now play the future in terms of markets, in terms of products, how do we export, how do we kind of place ourselves in terms of manufacturing. These are some of the important factors which is driving the corporate India in terms of the strategies. Some of these companies are large. They are, from a risk perspective, yes, the companies which are acquiring from India are, they're comparatively significantly larger in the international markets. But the question over here is, are the cash flows good enough to take care of the debt servicing that the companies are using to acquire them? And as long as the cash flows are good and there's a good amount of buffers which are put in as far as the operating cash flows are concerned, this may make sense with the very careful safeguarded measures. The outbound M&A can continue to do pretty well.
Absolutely, and that's really important, and that's exactly what we want to understand, whether the conversations are being as nuanced or not. And maybe quick sense from both of you, Sumit, on this. That's exactly my question. As deal makers, of course, your job is to get the deal, on the table and get it signed. But from a shareholder perspective, it's very important that a lot of the details, the intricacies that Bhavesh was pointing out are taken on board. So the deals that you're seeing off late in the conversations, I mean, how much of it is bravado because maybe there's easier PE money or easier access to funds? And how much is coming in from just maturity and very careful consideration?
So maybe I can come in there and just to kind of counter that point. Yes, as deal makers, the idea is to get deals done, but it all starts with establishing the strategic fitment, which I think is top of the considerations to build any M&A rationale. The moot question here is M&A risky as a corporate strategy? I mean, of course it's risky, but is it any significantly riskier than putting any new capital expenditure or launching new products or getting into new markets? Perhaps yes, but I think Indian corporates, as I said today, are in a position to better manage the nuances. First of all, the willingness to assume that risk on back of strong tailwinds, and then ability to manage that risk is at an all-time high. When we look at transactions, there are clearly 3 or 4 things that stand out. The first test is, as I said, strategic fitment, and we are increasingly see that a lot of these acquisitions are being done to fill in some very serious capability gaps versus these being just pure value arbitrages. And of course, there are favorable financing structures to these Indian companies which they have never been exposed to, which are now available in international markets, which are fueling some of that activity. But what I can tell you is what we are not seeing. We are not seeing any big ticket deals breaching some serious deal discipline on fitment. We are not seeing any billion-dollar gambles as yet on untested, non-profitable, high-risk business models. Some of that activity which has been more localized. I don't think we are seeing some of those trends and themes in international activity. And I'm seeing that increasingly Indian corporates are seeing this as a real opportunity to seize the global center stage and to build some of those multinationals from India. So I think broadly we are okay in terms of the overall discipline that we are seeing on transactions right now.
Sumit, are we seeing similar? Yeah, go ahead, Bhavesh.
Yeah, and to add to that, I think we as investment bankers, at least at Equirus, we kind of don't think about ourselves as transaction bankers, but as relationship bankers to the corporates. So we would always advise what is in the long-term interest of the companies and the shareholders. Now, in that regard, it is very important that those safeguards which I mentioned earlier are in place. But what we are seeing also increasingly is even the corporates are very, very careful in what they are doing. I mean, of course, these are opportunities which need a very short time of decision to kind of, turn around and say, yes, we are there, we are not there. But at the same time, there is a lot of thought process which goes behind whether does it make strategic sense and what is the risk involved if either of the variables, which is operating cash flows or the debt or the market changes, these are definitely considered while going ahead with
That's really good to know. It's very reassuring to hear that the aggression is measured, it's careful, it's calibrated. Very quick 10-second answer. So then the next hot sectors, the next set of big deals, where should we keep our eye on? Bhavesh, quickly, 10 seconds.
Yeah, I think industrials, pharma are one of the bigger areas where we can see some action over here.
Sumit?
Yeah, so the tailwinds of the shift in global supply chains will keep manufacturing industrials very hot. Technology-led acquisitions will continue to be in flavor for acquiring capabilities overseas. And then, of course, pharma is always right up there for big ticket deals on outbound.
Okay, gentlemen, we'll leave the conversation here for now. Thank you very much for joining in. Well, that brings us to a close in this edition of Bazaar. We leave the markets higher for the 8th day in a row, 0.25% up on the key indices. Thank you for watching. Don't go anywhere. Chartbusters is up next.
The Indian market joins in the global equity rally. The Nifty opens higher, sustains above 25,000 as autos and banks surge. FMCG stocks, however, see some profit booking.
Infosys announces its largest ever buyback worth 18,000 crore rupees, where it will buy 10 crore equity shares at a price of around 1,800 rupees per share. The stock is trading higher, though it's off the morning highs.
Lodha Developers trades in positive terrain, though off highs again after signing a 30,000 crore MOU with the Maharashtra government to set up a green data center park in Palava.
Lupin trades higher after Investec upgrades the stock to buy and raises the target price to 2,265 from around 2,100 rupees earlier. Brokerages cite reasonable valuations and the upcoming GLP-1 drug opportunity as the key triggers.
Shares of JBM Auto zoom after subsidiary GBM Eco Life Mobility secures funding worth $100 million from the International Finance Corporation to purchase and operate electric buses.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Manglam. Manglam, there's green on top of the screen. So good times. It's a good start to the Friday morning.
Good start to the Friday morning, Nigel. The Nifty Bank is the only one which is a slight underperformer, but it's at a very crucial juncture. It is at the 20-day moving average. So if it sustains above this level, the next technical important levels come only 1,000 points from here on. So let's see whether that happens or not. If that does happen, that will be a gift to the bulls. But speaking about gifts, Nigel, wish you a very, very happy birthday. Well, it's actually been a present to be working together and creating the kind of content that we've been doing with, the viewers. So we're on big camera, so let's go for that hug. Wish you a very happy birthday.
Thank you so much, Manglam. It's been a pleasure, working with you over the last 10 years or so. We have had our share of laughs, few tears, and it's great. The focus of the show has been to give our viewers the best. And I think we're doing a good job, but I think we can do even better. So thank you to all the viewers. Thank you, Manglam. Great friend, great support. And there are some office colleagues that you take all through your life, and you're one of them. So thank you so much.
Thank you so much, Nigel. Very kind words out there, and may this be the start of good times. And obviously, there is always room to improve. Speaking about room to improve and speaking about, just the party continuing, we do have Manas Jaiswal joining in. Manas, does the market have room to improve from here on? And we've been pushing you for a jig every once in a while. Do you want to do that today?
Good morning, Manglam. So, see, if you're talking about the trend, I think Nifty is sustaining comfortably above 25,000 mark, which is a very positive sign for Nifty. I believe that soon Nifty can test 25,250. But looking at the pattern on the daily chart, that is an inverse head and shoulder pattern. If it breaks the neckline, which is placed near 25,100, then I think you can set a bigger target of around 25,600. So I am still positive on Nifty, and I believe that till Nifty is trading above 20-day moving average, which is placed near 24,800, any decline would be a great buying opportunity, and you can set a bigger target of around 25,600 on Nifty. However, on Bank Nifty, I think in Bank Nifty one should wait, because Bank Nifty has resistance in the range of 54,700 to 54,800. But if it breaks 54,800, then you can set the bigger target of around 56,000 on Bank Nifty. So you can hold long position in Bank Nifty, keep your stop loss below 54,300. But I think a fresh long position should be taken only on a breakout above 54,800.
Okay. All right. Got that, Manas. What about individual stocks? What are you looking at?
Good morning, Nigel. So individual stocks, I think one can definitely look at defense counters, especially Mazagon Dock, where stock has broken its 50-day and 100-day moving average with great volume. So here one can take a long position. Stop loss should be around 2840, and the target would be around 3050 on Mazagon Dock. Second is a buy call on Hinduzinc, where stock has regained its 200-day moving average, and it has given a confirmation of higher tops and higher bottoms. So in Hindustan Zinc, one can take a long position. Stop loss should be around 444. Target would be around 465.
All right. We're seeing some traction build back in rail and defense names. Do you think they're good for more from here on? BEL, for instance, is at the high point of the morning. We saw RailTel win some orders over the last few trading sessions. That stock's been doing well as well. So just wanted your thoughts on a couple of these names.
So in defense, see, I have recommended Mazagon Dock, but I am still bullish on BEL. Even HAL is looking very strong. If second stock you want to buy in defense, I think one can definitely look at HAL. Keep your stop loss below 46.20 and target would be around 4800 to 48.50 in HAL. And in railway counters, I think one can definitely look at RailTel because stock has given a confirmation of higher tops and higher bottoms. It has regained its 200-day moving average. So one can take a long position here also. Stop loss should be around 360. That is a positional trade. And here the target would be around 398.
All right. What about the big boy Reliance Industries? How is that looking at the charts?
See, I think the positive point is stock is comfortably trading above 200-day moving average for last, I think, 3-4 trading sessions. Now, since stock has regained 20-day moving average today, I think one can take a trade for short term, take a long position in Reliance Industries. Stop loss should be around 1375, and here the target would be around 1420.
Right, we were looking at a couple of these auto names. JBM Auto, for instance, is higher because of the fundraise in Eco-Life. Atul Auto is up around 12% right now, and volumes picking up on that one as well. And, just before we let you go, Manas, do you have a view on any of these auto names? They've been on a fresh rev-up mode because they saw some profit-taking yesterday, maybe a pause for breath in the previous trading session. Do you think this is a start of something fresh once again after a pause for breath?
I think, look at JBM Auto because here stock has given a breakout of inverse head and shoulder pattern, and now the next target would be in JBM Auto is almost 740, 750. So positionally, I think one can take a long position even at current levels, keep the stop loss below 659. And in front line, I think most of the auto counters are looking very strong on the charts. You can buy Eicher Motors, you can buy Maruti, you can buy Hero MotoCorp. But in front line, if you want to buy one stock, then I think definitely one can look at Eicher Motors. Stop loss should be around 67.50, and here the target would be around 7,200. Positionally, you can take a long position in Eicher Motors.
Appreciate you joining in, Manas. Thanks a lot for giving us your view on markets as well as on individual stocks. But it's that time of the show where we move to our special segment where we get you a few ideas for profit from Money Control Pro. Madhuchanda Dey of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu, over to you.
We are talking about IRCTC that has underperformed the benchmark in the past year. IRCTC has a monopoly in railway, internet ticketing, catering and packaged drinking water. It also offers a variety of tourism packages. However, most of the businesses being matured in nature offers modest organic growth prospects. In fact, the Q1 earnings was quite lackluster with revenue growth driven by internet ticketing and tourism, whereas margin got support from all the segments except for catering. Given that the penetration of internet ticketing is high at 87%, this is unlikely to go up further. The medium-term earnings driver could be addition of Vande Bharat and other trains with a dedicated freight corridor, freeing up capacity for passenger train addition. Given that the railway travel and budget tourism are less vulnerable to economic slowdown and external challenges, we see little risk to IRCTC's modest growth.
All right. Thanks a lot for that, Madhu. Well, on that note, though, we'll slip into a short break. As we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles, and all the updates from the financial world. All of this at your fingertips. Download the CNBC TV 18 app from the Apple Store, the Google Play Store, or simply scan this QR code that's up for you on the screen.
Welcome back. A couple of stocks doing extremely well. We had Manas just speak about Hindustan Aeronautics. Look at that. That's moved to the high point of trade. Mazgaon Dock was one of these recommendations. That's doing well already. Bharat Dynamics is the other one, which too has moved higher. Though we're seeing a serious amount of profit booking in some of these FMCG names. So Berger Paints at the low point of trade. We have Patanjali Foods as well now, an F&O stock currently at the low point of trade as well. But it's just profit booking in the consumer space. Otherwise, the market's in fine fettle. And JBM Auto is one of those stocks which has been surging. A subsidiary secured funding of $100 million from the International Finance Corporation. Sudarshan joins in. Sudarshan.
So it's a huge boost for the company as its arm, and that is electric mobility arm JBM EcoLife, has secured $100 million funding from International Financial Corporation, that is the member of World Bank. And now company is saying that it's going to implement this fund to buy and operationalize electric buses, and majorly it would be done in 3 states. Those are Assam, Maharashtra and Gujarat. Remember, company had backed the tender under PM e-bus scheme for these buses. Already it has almost order book of more than 11,000 buses that would be deployed over the next few years. And it's very important considering government has a target to implement or increase the penetration of electric bus to almost 40% by FY30. And over the last few months, JBM Auto has been moving higher, and today also it's up currently 9%.
Okay. Thanks a lot for that, Sud. But the other one that's rallying in trade is Lupin. Investec, they have upgraded the stock to a buy rating. They've raised their target price. Vinny joins us to run us through the fine print. Vinny.
Hi, Nigel. Good morning. So, yes, Investec has upgraded the stock to a buy. Previous hold rating. Target price now is at 2,265 rupees. Previous target price was 2,100 rupees for Lupin. Why have they upgraded the stock? What are the positives that come in here? They believe that the company is quite well placed to grab and take the opportunity that will come in from GLP-1. And for India specifically, this is going to start next year for semaglutide. Lupin already has a very good base, one of the key players when you talk about anti-diabetes as well as cardiac arrest side of drugs and therapies, and that is why they'll have an upper hand that comes in terms of grabbing this opportunity for semaglutide. Other than that, the company has received a lot of recent approvals for inhalation, injectables, complex injectables. That is also a positive that will start playing out for the company, and they expect that, for the company, they could see some $20 million to $30 million annual sales for these injectables and inhalation products that they do have. Other than that, the company is saying the valuation right now is more reasonable, is what Investec is highlighting. And base case, they expect strong FY26, moderation in FY27, and EPS growth will start resuming for the company in FY28. That's the highlight coming in from Investec on Lupin.
All right, Vinny, thanks a lot for that. Lupin up around 3%. Titan is the other one which has moved to the high point of trade, so just keep an eye out on that one as well. Gold and silver obviously on a high, and we move towards the festive season right after this small short period. Another report that we have to highlight today is Nimesh joining in with the standout brokerage report of the day on the pipe companies. Nimesh.
Hi, Mangalam. So, it looks like the street is warming up to the pipe companies. First, it was UBS, and now JP Morgan has initiated coverage on pipe companies with an overweight on both Astral as well as on Supreme. On Astral, they have a target price of 1,700, and on Supreme, they have a target price of 4,700. The big theme is they expect that demand is at an inflection point, and JP Morgan expects a demand recovery in second quarter itself and a margin recovery in second half of FY26. They in fact see this sector to grow 17-18% EPS growth over the next 3 years. The only risk to this space is the PVC price hike. That's according to the JP Morgan note. Remember, 2 days back, even UBS had put out a big report on pipe companies. They too had initiated on a couple of names, including Astral, with a buy rating and a target price of 1,800. And even UBS believes that they anticipate a demand recovery in the second half of FY26. So, looks like stars are getting aligned for the sector, and now with the hope of demand recovery and margin recovery, few initiating reports with JP Morgan today putting out a note on both Astral as well as on Supreme Industries.
Okay, all right. Thanks a lot, Nimesh, for that. Well, let's move on then. The new GST changes are all set to kick in just 10 days from now. The expectation widely is that a huge consumption drive is on the cards, and consumers, they are the biggest beneficiary. Our colleague Shivani caught up with Mohit Malhotra, the CEO of Dabur India, to understand his views on the GST cuts and how will it impact the industry. Let's listen in.
No, I think it's fantastic because we never expected this kind of a reform will actually come into play. But I think government has actually surprised it. And the reforms have actually come at a time when the food inflation is very high for us. And the whole country is reeling with a lot of consumption going down. So the consumption is almost at a very big issues that we are facing, especially the urban consumption. So this GST reform will actually completely resurrect, I think, the consumption. The consumer confidence index will go up. Because the consumption will go up, the investment will go up. Because the investment will go up, I think there'll be more revenue and more money in the hands of the farmers also. And I think entire ecosystem will actually benefit out of this, right from the farmer, which is the farm, right to the folk, which is the consumer who's actually using it. Yeah.
Okay, so you spoke about consumption and how this is strategically, timed just ahead of the festive season. Is there a ballpark figure in terms of percentage that you see the consumption growing from here in this particular festive season?
One unique thing about this is that these GST reforms are actually coming, which is going to bolster the consumption in urban India. And urban India will actually benefit from the GST reform. So it is just not a focus on have-nots, it's a focus on haves also. So the middle class surge will actually happen. I can't exactly give you the number, I think it depends. But I think there will be a consumption impact definitely in the long term, which will actually happen.
Okay. You also, the last question, sir, you also spoke about, how there was a disparity between taxation of loose items and then when it was packaged and added value to. From a perspective of Dabur, how do you see that from a, a Dabur portfolio perspective? How is that going to benefit the company?
You see, a lot of classification issues have been actually resolved. One example I gave you earlier, what used to happen is the classical medicines used to be taxed at around 5%, which were all generic medicines, and the branded medicines, which are more high quality medicines in which we are adding value to it, the entire value chain is more improved and better quality, that was taxed higher. So it was almost a penalty. So why would a consumer go for a high price product when a low price product is available, so he used to compromise on quality. So I think consumer will benefit because he get a better quality product, albeit now at a similar pricing. So we'll be able to reduce the prices of those products also and pass on those benefits to the consumer. So that entire anomaly between generics and branded has been resolved from my point of view. So if you look at paratha also, unbranded paratha and a branded paratha are now going to be taxed at the same rate. So it will reduce the gap between unorganized sector and the organized sector to a great extent.
All right, a gap reduction between unorganized and organized sector, and that would boost consumption. Also, at the same time, price packs coming in with higher grammage could boost volumes, and we'd see a net EPS impact of anywhere between 3 to 5% over the next 2 financial years, notwithstanding the near-term disruption of stock changes that we'd see on this GST. That's the word coming in from the management at Dabur and all the other consumer companies that we've spoken to earlier as well. Meanwhile, Nykaa, the consumption discretionary company, actually doing a lot better. That's moved to the high point of trade. And we're also seeing some traction on something like a Nippon Life India. That one comes up for you too. So that's at the high point too. We'll take a short break, come back, get you more on the markets and a lot of stock-specific action. Stay with us.
Welcome back. The markets continue to hold in the green. As we speak, the Nifty, in fact, has moved to the high point of the day. So we're nearing the 25,100 odd mark. I'll tell you what, the call writers, they were hoping that this level will hold out. But if that's not going to be the case, we can see a bigger short covering bounce as of now. As we've been highlighting, we've just seen, a fraction of that because the short contracts are down from around, 192,000 odd to around 182,000. And in terms of percentage, it's down from around 92.5% to around 89%. So that short covering bounce is still pretty much due. Let's see whether or not that does take place. We have more in store, at least for today.
One of those famous quotes about falling asleep or falling in love can apply to short covering as well. The quote is, how do you fall in sleep or how do you fall in love? Slowly and then suddenly. That's something that can take place in short covering.
In a romantic mood, Mangla?
No, romantic mood, but you can also say I'm in a sleepy mood because it's a Friday. But either way,
no, let's not combine the two.
But when we speak about one of the triggers that could be for short covering, that could also be the rate cuts that may happen from the US Fed next week. And a big trigger for that was seen last night, where the US consumer prices rose almost as much as expected in August, while jobless claims too accelerated, presenting mixed signals for the Federal Reserve ahead of its policy meeting. CNBC's Rick Santelli brings up the fine print of what can be expected sometime next week.
Let's look at initial jobless claims, shall we? Now, given their seasonalities when you have things like Labor Day, holidays, but ultimately, just on the surface, 263,000 on initial claims. That's the biggest number going back to the fall of 2021. And it doesn't end there. We also had, of course, our August read on the Consumer Price Index. And that inflationary group of data points was warmer than expected. However, let me rephrase. It was very close to expectations, but sequentially warmer, meaning 0.4 on the month over month. That's higher than last month, but as expected. Take out food and energy, the core, 0.3, a little hot based on history, higher than our last look, but as expected. If you looked at the year-over-year headline, 2.9, as expected. Hotter than the rearview mirror by 0.2. The only number that wasn't hotter, that was equal expectations and equal sequentially to the rearview mirror, was year-over-year core at 3.1%. But that's a 3 handle. The Fed's objective is 2%. And I know that the PCE is closer to 2.5, 2.6, their favored inflation gauge. But it seems to me that we see a market in equities continually making new highs. We see an interest rate complex that looks like rates want to go lower, but the 10-year seems to be fighting to stay above 4%. Ultimately, I think we're trying to match the data with the market performance. And I believe that the interest rate complex may find more selling going into the weekend, because I thought many traders looking at the flattening yield curve were expecting the 4% level to be breached in a much more significant way than the 1 basis point we saw today after the 8:30 numbers. As for tomorrow, University of Michigan sentiment, and that will be the end of an important week. And this week in particular, not only the last week of important top-tier data. We've had the job report, PPI, CPI, PCE data, which means it's up to the Fed next week on Wednesday to decide. 25 basis points is built in. They'll give us 25. Many thought we could see 50 with the data points today, but if the market doesn't price it in and Fed guidance doesn't allude to the fact that it is or isn't priced in with respect to whether they believe it to be accurate this close to a meeting, no surprises. 25 basis point cut most likely on Wednesday.
All right, 25 basis points cut most likely on Wednesday. That's the word coming in. But the Nifty is up for 8 straight trading sessions. We got the mutual fund flow data yesterday as well. The market's at the high point of trade. And we are looking at prospects of some resolution between US and India when it comes to trade as well. All of this means that there is a lot of market talk which is expected. So you stay tuned to CNBC TV18, because right after this short break, on top of trading hour, we have Manish Chokhani of Enam Group joining in as the market master. You don't want to miss this conversation. Stay with us.
Hello and welcome to another episode of Market Masters. Today we have with us Manish Shukani, Director at Enam Holdings, one of India's most respected financial minds. It's been 5 months since we last spoke with Manish. Manish, welcome back.
Thanks for having me back.
The hot seat. Manish's big call when we last spoke, and it's been his call for longer than that, was that hard assets will do very well. Given the state of the world, I mean, given the general, should I use the word despondent state of the world, I went back and checked what has the Nifty done, what has gold prices done since last time we spoke, since we had Manish here, which is from the 15th of April. So, from that point on, MCX Gold, so we want to compare, same currencies. MCX Gold, which is in rupee terms, is up 17-18%. The Nifty in the same period, from the 15th of April till now, is up 6%. So you got, a 3x kind of outperformance on gold as compared to what the Nifty has done. Of course, this is a very short time period. You can stretch this longer, and I think the outcome does not change, maybe even gets even sharper in that sense. So he's got that particular call bang on. His other big call was that India is uniquely placed in the new Trump world. Now, the outcome for this has been a little mixed. We are uniquely placed, but on the other end of the spectrum. Manish?
Sure.
So I want to start with that.
You want to get me thrown out of the equity markets, yeah?
I mean, just crazy, right?
Yeah.
I mean, who would have thought?
Yeah, I mean, honestly, for what's happened with US and India was a surprise to everyone, I think, including to the protagonists over here.
Yeah.
Something changed during Sindoor.
Yeah.
And then I'm guessing something's changed over the last 1 week again to bring things back to what looks like even keel. But yeah, I mean, if you zoom back in a larger context, India and US have been the two best performing markets in the world, the best democracies and the best sort of places for capitalism to thrive.
Yeah.
So that narrative doesn't change. You get, as people say in geopolitics, from time to time you have spats with friends and you only have a spat with someone you love, I guess.
Yeah.
So I think that comes back on even keel. Having said that, this market was being driven or is being driven really by price agnostic domestic flows. And you saw it kind of shrugged off this tariff shock as if nothing had happened.
Yeah, the market has barely responded.
Yeah, but it's actually a small segment of the market which would have been affected because he exempted pharmaceutical, because generics, half of what the US consumes comes from India. So they would have been shooting themselves if they did that. And then they had to exempt electronics because all the iPhones which go would have landed up more expensive to them. So of the 80-odd billion, 40 billion was anyway excluded from this tariffs. And the big numbers which got affected were, unfortunately, textiles. Textiles constitutes a very small portion of the market.
Yes.
And there are 2, 3, 4 companies which are relevant over there, which also did not really fall as much. Because market also looked beyond ki 6-8 mahine mein ye kuch na kuch ho jayega. And which seems to be the case. Plus, there was also on the horizon the EU FTA, which also should then come and then give a fillip to all these exporters. But the larger issue, of course, remains that India, as an emerging third largest economy of the world, is still not a player in global trade. So we don't seem to have stuff which the world really misses, and therefore we didn't have cards, whether it came to China or like Trump famously says, you don't have the cards, you don't have the cards. So there were no cards really.
What are rare earth?
Yeah, so like how China just switched that off and, boom, there was no noise about China buying oil from Russia and so on and so forth. So we clearly will need to step up our act to become a little more important in the world.
So let me ask you this.
I'll just close on that, but it's also created some difficulty with every country in the world now wanting to localize and bring back investments into their country. It puts a question mark on FDI. Because if you were looking for Americans to invest in India, Europeans to invest in India, it may be written into our FTAs, like we signed one with the Europeans, excluding the EU, the one he did with Switzerland and others. But it's over 10 years. And if everyone is going to, for example, even in Europe, invest in their infrastructure, invest in their energy, and invest in their defense, US wants to bring semiconductors and everything back to the US. What is the 2-3% FDI flows that we were looking for? What happens to that? Number two, if this domestic flow keeps pushing asset prices up so much in India, the other smart money, which is private equity, tends to then not make investments in, and rather they've been taking investments out. And thirdly, you're finding the strategics to whom typically we sold our companies are now, the Akzo Nobels are selling to our Jindals, for example. And the Bhartis and the Singtels are selling down to our retail investors. The Koreans are coming and selling down to our retail investors. So that's a bit of a muddle we are in. And in that context, if you don't have an export engine firing, you don't have an FDI engine, you don't really have a capex engine, I think it was inevitable that what happened with this GST to kickstart this consumption cycle is a necessary and a great thing that the government has done.
Manish, so just to tie off that US-India point, what is your forecast? You think it'll get done before the end of the year?
I mean, look,
I mean, the 25% of course has to go.
Yeah, I mean, right? You're not going to get to, I mean, again, it doesn't change anything.
Yeah.
Even if you get to the 15 which the allies have, which is Japan, Korea, UK, I don't think we get to 15. But if you're at 25 and you have some way around that, let's see, maybe we end up at 20.
Yeah.
But again, like I said...
Likely is 20 or 25? Just for the...
My bet would still
I won't hold you to it, but...
Well, I would still hope for 20, but clearly can't be more than 25. I would hope for 20. But having said that, what is this 20? If it's still only textiles, gems and jewelry, because the whole premise was that we'll be able to become friend-shoring, to bring US manufacturing to India. And if you take the India narrative of the last 10 years, what have we done? Compared to the 1990s, when we took white-collar people and put them into making pharma generics and IT. The last decade has been the, how do I say, the formalization of the blue-collared guys to become a Zomato or an Amazon delivery boy or someone working for Indigo.
And I'm sure you have points on valuations there as well in terms of how we price. We'll get to which piece.
Valuation is what it is. I'm just saying as an economy, you need some drivers.
Yes, absolutely. And I'm going to come to that. But I want to ask you, just to complete that point, should we still expect stuff on pharma? There has been this fear-mongering around services. I mean, actually, in a way, I said that's our rare earth. I mean,
if you switch off the GCCs from India, you're going to hurt yourself because like saying I'm going to...
So logically, it doesn't make sense. But I think we should not think about that.
I won't worry about that.
And pharma, which is the other sectoral...
Pharma generics, I mean, they are so cheap that whatever they put, they'll have to bear it. So it doesn't make sense, which is why it was exempted. His problem is with US pharma and healthcare costs, which have gone completely crazy, and the profiteering. And it's very odd. If you look at the top pharma stocks there, just put Eli Lilly on a side. But Bristol Myers, Pfizer, Merck are all sub-10 PE multiples, which are innovator companies. If you take even the Europeans, Novo Nordisk, Roche, are at 13, 14 multiples. So I can't understand how Indian generics, facing this patent cliff, after which what else do you copy if there are no patents to be broken? How can we keep trading at the multiples we are trading at? Same thing with Indian IT, that we have these next few years where we have to create these data sets to make them AI enabled. But beyond that, the business models have to change from the pyramid structure of IT service companies to becoming a lot more AI enablers and using AI agents and so on.
So, this is, as you put it, this is a world market which is starved for growth. Growth is in what you call AI, in that sense, very clearly. So, Mag 7 versus the other 493 companies.
Mag 6 actually now.
Oracle.
Because Tesla and NVIDIA have Tesla and Netflix have not kept pace. The others are all 100 billion plus profits.
So let me ask you this, and it's just something that I've asked others as well. Do you think a lack of a pure play AI kind of story here in India has hurt? Because this is the dominant, if this is the apex technology of our times and people want in, then in that sense we have IT services, etc. to offer, but nothing in that.
Yeah, that's like a slow decline. It's like, you were in broadcasting and now the world's gone to OTT. It's a slow decline. It'll still be there.
We have OTT as well. I mean,
No, I'm not referring to you specifically, but how a sector, like how these ICE engines slowly have decayed in the world as the world has gone to EV. Is the same thing happening, that what worked for us in the last 20, 30 years is not going to work in the next 10 or 15. And we have to create new growth engines. And I've been saying it for last 10 years, as long as we've been speaking, that we need to have a lot more control of IP, technology, brands. And so far, for example, you see the auto guys, they are the ones who are playing the game to at least play on technology, that they can get into defense. Or like I saw this Motherson presentation where they've gone into, for example, into airline. They supply to Airbus and Boeing. They can also get into medtech. They can get into electronics because they have the core engineering skills to scale. And I've seen every country as it grows. When US grew, they became the technology leaders. Then when Japan came in the 80s, they became the technology leaders and they were bringing product to the world. Then it was the rise of Korea. Then it was the rise of China. India doesn't yet seem to have something which can go and be dominant on world stage. And we kept harping on we are the service champions. And we sort of missed a trick over there.
But I have to say this, and you would know better since you meet so many companies. And for example, you brought up aerospace. I recently spoke with the former heads of, long-serving heads of Boeing and Airbus. And now they are sort of trying to build up this aerospace ecosystem in the country.
More as MROs, right, for maintenance stuff.
Maintenance, but there's aerospace
and engineering
manufacturing
design
also.
Yeah, but who controls the IP then?
Yeah.
So the issue is like, say the Indian IT guys did all the work for the big six.
Yeah.
But the IP sat in the West. So each of the companies over there makes $100 billion PAT. Our largest company here will be, TCS will not even make a $10 billion PAT. I mean, that's the scale difference of someone who's doing work as a, how do I say, a contractor for someone as opposed to someone who actually controls the IP.
Semiconductor is a space, right? I mean, we're building packaging. There's one fab. But the point is, there is, again, I mean, we had that Semicon event. There's the second phase of the subsidies which are going to be rolled. I mean, the efforts at least are being made over the last...
I mean, look, you have to start somewhere. It's like back in the 80s, if you only had Ambassador and Padmini, if you did not come with Maruti and therefore that ecosystem got built, eventually you get to an automobile industry of some size. And I did say the coming of Apple in India was that moment for our EMS sector and the semi sector, that you'll get years of 40-50% growth. Now, it's like it happened with IT that, you priced it to 100p multiples and then, suffered for many years after that. So some of that is happening even now. And a lot of the action is happening in the unlisted space where, Tata's may be, actually emerging as the leaders over there. Foxconn and others have come and put their own factories over here and so on. But like I said, the value capture sits at the design stage. I mean, the money NVIDIA makes is more than all these fellows who will make whatever they want for the rest of their life combined. But it's a game you have to play. I mean, 10 years later, hopefully we get there. But
you have to start somewhere,
as
you said, right? So let's just close up this point. World starved for growth. What is your broad thesis? Money will keep chasing AI and hard assets? Is that the broad way to think about this?
So the hard asset bit is about, currency debasement. That if they keep printing money, and even now I'm amazed that the US talks of interest rate cuts at a time where their inflation target is 2x of their own target. The market's at all-time high. Home prices are at all-time high. Gold is at all-time high. Bitcoin is at all-time high. And the Fed talks of cutting rates. If you did that in India, for example, the rupee would have collapsed. The world has taken note of this, and therefore all central banks of the world have been shifting reserves away. So gold has now crossed dollar in terms of percentage holdings of forex reserves of the major economies of the world. So gold's in a bull market really as an antidote to the dollar. It's incidentally beating our returns for our Nifty over, I think, 20-year periods. And my colleague Sridhar, he keeps talking about this for a long time. That what has India done is that suffered from an inflation and a devaluation problem for years. And by keeping our currency so debased, we've effectively killed our domestic market as well. So let's say you got a 5% GST cut, but the rupee's fallen 5%. The price of your iPhone or of your car has not really changed then. So you don't then get that consumption fillip. So that's really the risk we run. But having said that, the move to hard assets is something which alternates every 10 years. You go from financial assets and technology to hard assets every 10 years. It's a recurring cycle. If you go back to the 70s when we broke Bretton Woods, in the 70s you got this bull market which went for gold, oil and silver, famously topped in 1980. That was hard assets. In the 80s, culminating in the bull market of Japan and Taiwan, which went up 12x in that decade, was the EM era. 90s, you come back to financial assets and technology, was the NASDAQ. 2000 to 2010, we got back to hard assets. So the rise of, China and in India was Vedanta, Reliance and the others, which were in a crazy bull market in that period. 2010 to 20 was again going to be back to tech. And that got extended with COVID as they printed money. And then this AI boom, it came out. The expectation was this decade money goes back to EMs, which was treated as a dead class. Like there's no money flowing to emerging market funds and so on and so forth. China was dead and flat on its back. And it started from a very cheap base. And you see the price performance of all of these in this decade is actually doing very well. I saw a CLSA report he puts out very well. He compared returns of some very fuddy-duddy companies like Tractor Supplies to Apple, or I forget the name of that company. I think Domino's Pizza versus Google. And the returns are same or probably better for the fuddy-duddy companies. So accepting something really crazy like NVIDIA, which I haven't seen in my life, that you know go 60x in profits. Or like this premise of Oracle, which itself seems to be based on the premise of OpenAI will spend the kind of money on you and raise the funding to be able to supply to you. And there are funny things happening there. But if you leave those 5-10 companies out, the 490 companies of the US have not particularly done very well. And therefore the money is rotated even into like Europe to go and find infrastructure stocks, defense stocks, and so on and so forth.
But your thesis then remains what it was back in April, which is top tier.
On a decadal viewpoint, money has to go out from, you can't be 65-70% of world market cap. That money has to move out. And when it moves out, you go back to hard assets because you've caused an inflation problem. And that inflation shows up as asset prices actually moving up elsewhere. And those asset prices are, factories are going to be costlier to build just because of these prices.
Right. So it goes out into Europe, it goes out a little bit into maybe hard assets, of course, and EMs if there is growth there, which has been a bit of a problem. Manish, stay with us. I have to take a quick commercial break here. We're going to come back and focus on India very much for our viewers in terms of where you see opportunity. So let's do that. Take that break, right back. Welcome back. We're in conversation with Manish Chokhani, Director, Enam Holdings. Manish, let's get to India for our viewers, right? Let's break this down. According to you, what is price to perfection? Different lists. Let's just identify buckets.
Yeah, I mean, there are lots which...
But I know you have strong views about a few, so let's just start there.
It's not strong views. Like, I've said this before to you on certain shows, that even when at the peak of the IT boom, if you paid a very, very fancy price, you didn't make returns. So the businesses will do very well. So it includes all, for example, EMS is growing 40-50%, no doubt about it. But it's also going to suck in capital, and therefore they will keep diluting you. And if you're paying these, 100 multiples, 60, 70 multiples for them, from a return perspective, you got to be clear, like what is the time horizon on which you're in. Same way, like food delivery as a business is now a $50 billion market cap. So even if you look forward, how many $1 billion of profit do you see coming out of this whole pack over the next 5 or 10 years? So there's things like that.
Capital markets, I think.
Capital markets is, again, it's like a secular thing. It's a trend line which continues. But again, there are stocks I also own there, so I better be careful that if you're paying 35, 40 times, and even for the ancillaries are now priced at 35, 40 times, and there's fresh supply going to come from the ICICI and the SBIs of the world who presumably will list their AMC soon, maybe this broadens out and you don't make those kind of returns anymore from there. So, look, as an investor, I'm doing what you call mergers and acquisitions. At what price would I buy this entire company? And you don't really typically make money by buying things very expensive.
Correct.
And you buy when there's pessimism. And pessimism may be in different pockets of the market.
Yeah.
So, we talk about that.
There is pessimism in at least IT services, but this falls for you in a bucket. Slow derating.
This
IT, pharma,
IT,
FMCG.
generic pharma. So this is old tech in a way.
Yeah.
And unless it transitions to new tech in a way, the value capture, for example, in pharma in the next 5-6 years, with both biotech and AI coming in, is going to be new drug discoveries coming not from chemicals but from maybe the biological side of stuff. Same thing in IT. We will do a Y2K for the next few years to create the data sets to make them AI enabled. But beyond that, the business models will really have to change substantially. Few companies will do it and they'll fall on the right side. But most of them, I suspect, won't. So that's also at 20, 25 type multiples. It's not pricing you the risk that you're running for. Like I gave you the example of old broadcasting companies, which slowly got derated down to 10x instead of where they used to trade in the past. So those would fall in that bucket. So what that leaves, for example, is I still think financials is the center of the boom in this period. Capital market guys are still very, very good. But when you do this whole consumption play, because I don't have exports, infrastructure, FDI and so on coming, we have no choice but to kickstart the economy with consumption. But that consumption has to lead to investment cycle coming back. And for that, the center of that will have to come back to, for example, there'll be companies like L&T at one end, and there'll be companies like SBI at the other end. That unless you see these two participating and performing, you don't really see a very big bull market continuation. So those, and then Finance Minister finally has come back to the magic word of privatization, where if the strategic sectors are left out of defense, aerospace and so on, there's no reason for the government to be holding on to, for example, its metal companies. Why are they in SAIL and NALCO and NMDC and so on and so forth? Why do they have so many PSU banks? Can they consolidate and bring a few of them together and so on? Now, it's a neglected space, so there is some room to be made there. They may or may not be well created unless they go in the right hands. But I remember in the 2000s when privatization happened and you sat in, say, a Hindustan Zinc, it's like more than 100x for you. So there are opportunities in the market, but overall, it's a market which is very optimistic. Like I said, strategics are out, FDI investors are out, PE investors are out, a lot of Indian promoters have sold their stakes down. And the market's being held by price-agnostic retail flows. And if a mood changes a bit over there, and I hope it doesn't, then we are in some, then you have to wait for the next cycle where you have similar optimism, which may be 3 years, 4 years later. So as long as you're holding with a business with a time horizon now of 4-5 years, and your return expectations are the normative 15% type for this market, you'll be okay. But if you're thinking that what we made over the last 4 years is going to continue, I think you'll be in for disappointment.
That's not going to happen. You kind of talk about one segment, which is right to win in that sense, right? Things like the space, Indian.
You mean so in the context of Indians going,
graphics will come up,
So in the context of Indians going out to win in the world, you remember when the Japanese came, we said Japanese can miniaturize everything because they're so tight on space, so they make things smaller. They made small cars, they made small electronics and so on. What is the kind of stuff which India intrinsically has a right to win, which the West will otherwise patent and take away? Like, for example, we're leaders in yoga, but you have power yoga in the West. Now, it's not something you can take as a product to the world. But certainly things like Ayurveda, can it go out from India? Indian design and fashion, which will then hopefully become a lot more center stage in the world.
For listed equity investors, are there?
People will make options. They will look very small today. But, for example, ethnic wear, which comes out of India and there's a big ethnic population, then over time what happens is that catches on. Like how you go out, you like Chinese food and Japanese food, you like Indian food as well. Now, the Indian whole travel and tourism industry, the Indian hospitality industry has some unique advantages. So can some of this stuff become our ambassadors to the world? Because so far, when you go out, you see like what they say in Sri Lanka or Indonesia, they call it Baja for the Bajaj three-wheeler. So there are products which have gone out, but or there are some of these Marico, Dabur, Godrej type companies which have indeed gone out. But you have to see a lot more of these because the global market size is then the TAM for you. Whereas the Indian consumer set, after a while, it kind of withers away. So people say in the US you can build tall and deep sequoia trees. In India it becomes a banyan tree because you have to go into so many categories. Like you see Nykaa as well, for example.
So just to wind up the conversation, last time you said we need a new wealth impulse. Right? And that seems so true. That you kind of maxed out on a few things, right?
I mean, look, the game for us for the next 10, 15 years, unless we build our own IP and tech and we have our own brands and we think a lot more about the world than only serving our market, we won't create the market caps. The big wealth creators of the past also, first you made it out privatization, that whoever took over what the government was doing, and you may still see that happening with Adani and Jio and so on and so forth. The second was about people who went out, like the Infosys and the Sun Pharmas and so on. If you're not in this kind of mix, you don't become a gigantic company. And real wealth creation is you buy something and you can sit on that trend for 10 years. You don't become that large. So today it seems to be the capital market space, but that's not big enough. Same way this organization of blue collar people, we're giving the market cap, but the profit pool, I'm not so convinced that it's going to be that large enough.
Last question, foreign investors are in big sellers, Manish. Do you see them coming back?
When they'll see growth, they come back. So when they come back in primary deals, they see good companies, they come back. Investors are, look, they are not political, they don't care about countries, they care about returns. If you see a return, even in China, the same Americans have gone to China. So I don't think it's
and how far out is growth coming?
Growth is a function of valuation comparison, right? So if the problem is if you get 25% growth in US on 20 multiples and you're getting 20 multiples in India for 9% growth, why would you put money here? So that's the challenge.
One has to, either growth has to pick up or valuation.
Either valuation goes sideways and we get cheaper relatively. Or
so broadly what I'm hearing is perhaps some more time correction may continue.
I hope. I'm a buyer always, so I hope for a time correction.
Right.
But usually markets don't give you that chance, so they will tend to then correct and throw you rolling opportunities in different sectors. Like it, for example, happened in textiles when the tariff thing happened, things got sold off. And if you can look beyond the hump and say, okay, it'll get solved in 6 months or a year, maybe an opportune time to have looked over there.
Manish, I have enough questions for another half hour, but we are...
Next time, two shows.
Two shows, back to back. Thank you very much, Manish, for dropping by.
Okay.
Really appreciate it. Thank you very much. Well, I think that is the word from Manish Chokhani with a perspective on markets. So basically, I mean, at least from an Indian perspective, some more time correction, valuations are to cool off, or earnings growth is to pick up, and that perhaps gets money back in, foreign money back in. Indian money remains very, very steady. Hopefully, that continues. That's it on this program, but we'll take a quick commercial break. Programming continues on the other side.
Hello and welcome to Trading Hour, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormuz Fatakia. Well, last day of the trading week. It's been a long week. But for today, bulls are cheering. So far, we are at the day's high, comfortably above the 25,100 mark for now. We'll have to see which way things go. We've seen a lot of choppy activity in the last couple of trading sessions, but we'll see which way things end for the week this day so far. At the day's high, 125 points higher, and some big names contributing to the gains that we are seeing as well. ICICI Bank at the day's high. We have Reliance Industries, which is at the day's high. A lot of contribution coming in from the banking names, actually. Kotak Mahindra Bank is also seeing some recovery from the lows. That stock is also doing really well. We do have Axis Bank, which is at the day's high as well. Some of these insurance names, be it SBI Life or HDFC Life from the Nifty pack, they are contributing. Of course, they are also at the day's high. A lot is happening with this entire space when it comes to the GST cuts and passing it on to the consumers and that input tax credit as well. So we'll keep tracking that story for you. This is what's happening as far as the benchmarks are concerned. But let's talk about the mid caps overall and the small caps as well. What's happening in the broader markets? Hormuz is here with us to put the spotlight on top movers in the market this hour. Hormuz, tell us more.
Well, before I get to those names, the Nifty is nearing a very important level. It's 25,154, which is the recent swing high that the index had made on the 21st of August after the Prime Minister's Independence Day speech, buoyed by those GST rate cut hopes. So we are very close to that level, almost just 20 points away from that. Well, the broader markets are doing fairly well for themselves as well. And some of the movers in today's session, the first one on the list today is Themis Medicare. And it's a 20% upper circuit for the stock, the biggest single day gain after June of 2021. It's gained in 5 out of the last 6 sessions. We have already had more than 10 lakh shares that have been traded today compared to a 20-day average of just 22,000 shares. And as a result of this move, the stock has broken above its 50-day moving average of 111 and is now closing in on its 100-day moving average, which is at 124. But despite this move, the stock has been a major underperformer this year. It is still down more than 50% year to date after having gained for 5 straight years in a row. The other name on the list today is Punjab Chemicals and Crop Protection. And that stock is now up almost 13% and is the 4th straight day of gains for the stock. It's gained more than 15% now in this 4-day gaining streak, majority of them coming today. We've already had 4 lakh shares of the stock change hands by the first couple of hours of trade compared to a 20-day average of just 12,000 shares. So very high volumes on this stock. It's also broken above its 50-day, 100-day moving average of 1184 and it's also now moved above its 50 DMA, which is at 1251. And the stock has also extended its gains on a year-to-date basis as well. Hitachi Industries was up yesterday, is up today as well, was up 20% yesterday, another 13.5% in today's session. It's up 35% now in the last 4 days. And we have already had 12 crore shares change hands in the first 2 hours, which is higher than yesterday's volume. And the 20-day average is 27 lakh. Yesterday's session had 11 crore shares change hands in the entire session. We've already had 12 crore in the first 2 hours itself. It's trading now at the 100-day moving average and the 200-day moving average is at 43.40. So another important level on the upside to watch out for on Hitachi Industries. And lastly, a news-driven name, JBM Auto, is one such stock up on back of news flow, of course. 10% higher on the stock, gained in 5 out of the last 6 sessions. We've had more than 1.5 crore shares that have already changed hands compared to a 20-day average of 1.5 lakh. And the stock with this move has now moved above its 200-day moving average of 677, but still an underperformer so far, down 11% on a year-to-date basis, Sonal.
All right, some interesting names there, such big movers in the broader markets. The market generally has been doing really well today, but we have to talk about a big story. Capital market stocks, all of them are in focus today. Vamakshi is here to tell us why did they fall yesterday, what's happening, the F&O positioning, volumes, delivery picture. There's so much to talk about, Vamakshi, but let's start with this first up.
Well, absolutely, Sonal. Yesterday there was a fall in all of these capital market names. There was a story that was done by our colleague Yash, and sources were suggesting to him that SEBI is likely to float a consultation paper in order to phase out weekly F&O contracts within a month. And in fact, SEBI is also weighing a transition to monthly expiry. Now, in addition to that, they also said that regulators are likely to consider a same-day expiry across both the exchanges, NSE as well as BSE. Now, yesterday on the back of this news flow, we did see a very sharp fall in all of these capital market names. Take BSE, Angel One, Nuvama, 361. All of these counters fell anywhere between 2 to 5% yesterday, and the F&O positioning also indicated that the fall in the stock was accompanied with a rise in open interest, which indicates that fresh shorts were added for all of these counters. Now, take a look at the volume as well as the delivery stats. Now, let me first look at the volumes. Now, the volumes yesterday were approximately double the 30-day average for BSE, Angel One and Nuvama. 361 WAM was, of course, an exception because volumes out here were almost half the 30-day average. Now, let's take a look at the delivery. The delivery for most stocks, if you compare it to the 30-day average, is not starkly different as compared to what we had yesterday. So that is what actually happened in the trading session yesterday, and that is how the volumes and delivery looked.
Okay, all right. But that's about the delivery stats, Vamakshi. In fact, Jefferies has done a scenario analysis on potential impact of elongated expiries and BSE and Nuvama as well. Tell us more about that.
Well, absolutely, Sonal. So in the first scenario, they're looking at, and this is for BSE, they're looking at fortnightly expiry. Now, in case there is a transition to this, they believe the industry index options notional average daily turnover could decline by almost 55%, while the premium ADTO could also see a dip of almost 45%. Now, in this scenario, they've taken two cases wherein if the expiries are on different days. Now, if that is the case, the market share is expected to likely remain stable at 29%. The options revenue, however, could dip by 38%, which could lead to a 22% fall in the total revenue and a 21% fall in the net profit. Now, apart from that, if there is the same day expiry under the same scenario, that is fortnightly expiry, the market share here then is expected to fall to 20% for BSE. The options revenue is expected to see a much sharper cut of almost 57%, leading to a 33% drop in the total revenue and a nearly 35% drop in the net profit. Now, the other scenario is for monthly expiry. Out here, they're expecting a much sharper fall in the industry ADTO of almost 80%, and the premium ADTO is also expected to decline by almost 70%. Now, again, two scenarios out here. If the expiry is on the different days versus the expiry on the same day. Now, if expiry on the is on the different days, the market share is likely to remain stable at 29%, but the options revenue is expected to decline by 67%, total revenue 39%, and net profit 41%. But if there is a same day expiry, the market share could decline to as much as 18%. And options revenue, it's again over here, it's a much sharper fall. 80% decline is what they expect. Total revenue minus 46%, and net profit could also decline by almost 50%. And the next scenario analysis is something that they've done on Nuvama. Now, they believe that this could impact primarily its asset services segment. Now, if there is a shift to fortnightly expiry, the impact on profit could be around 15%, and there could be a profit impact of 25% in case there is a shift to the monthly expiry. So, just to sum all of this up, basically the potential impact that Jefferies believes could range between 20% to 50% cuts to FY27 EPS for BSE and 15 to 25% for Nuvama.
Interesting report that from Jefferies, but Vamakshi, there has been a significant correction that both BSE and Nuvama have already had from their top. The BSE shares are down almost 20%, Nuvama is down even more. So, based on this scenario analysis, how much of it is already in the price, and what could be the further road ahead for these companies?
Well, absolutely, Hormaz, you're right. Now if we compare how these stocks have moved after hitting a high in 2025, BSE, like you said, is down almost 27%. Angel One is down 32%. Nuvama again down 26%, and 361 WAM down 19%. And Jefferies believes that, the stocks have already corrected significantly, and they feel that the fortnightly settlement with separate settlements is already baked into the price. But in case there is a scenario wherein the fortnight early expiry comes into place, with same-day expiry and monthly expiry, scenarios play out, then the shares could see further fall. Now, when we talk about the valuation, now Jefferies sees that the valuation for BSE and Nuvama is reasonable at 38 times and 18 times FY27 PE respectively. So therefore, they don't see a material derating. But today, Hormaz, all eyes will be on the SEBI board meeting, and we'll be waiting for what comes out of it.
Indeed, we'll be talking about this when we return next week, and important updates there. Vamakshi, thank you for taking us through this big story of the day and, of course, for the evening that lies ahead of us as well. Take a short break. The index still at 25,125. It'll be a good time to get in some chart ideas from Aditya Agarwala from Invest for Edu, who joins in on the other side. Welcome back. Paused for the 8th straight day of gains is the index, 120 points higher, heading towards that August 21st swing high as well. Aditya Agarwala from Invest for Edu is joining in. Aditya, good morning. Thank you for joining in. Now, with 8 days of gains, do you see some exhaustion at upper levels, or do we cross 25,154 and move even higher? What's your call on the index and your stock recommendations for the morning as well?
Morning, Hormuz. Thanks for coming on the show. My sense is this is going to extend. What started off as a tepid Friday morning session is now looking strong, both on the Nifty and the Bank Nifty. And especially, Hormuz, for the Bank Nifty, it's more exciting because we saw a dip early morning of 60-70 points. And from there, it's building on and led by large cap private sector banks, which is a healthy sign. So my sense is from here on, you will see incremental gains more on the Bank Nifty, could easily scale past levels of 55,000 on the Bank Nifty in the coming trading week. And then you could also see levels of 55,500, 56,000 as well on the Bank Nifty. So I'm quite upbeat on the Bank Nifty. And from here on, my sense is Bank Nifty will build on to these gains. I don't see any exhaustion both on the Nifty and the Bank Nifty anytime soon. Even for Nifty, my sense is this intermediate hurdle, which is 25,150, which was the previous swing high, should get breached either today or next week, and we should test levels of 25,400 on the upside next week, sometime next week. So overall, my sense is this upward momentum that we are witnessing in the markets should continue both on the Nifty and the Bank Nifty, while your broader markets could take a little bit of a backseat and large cap indices could outperform from here on.
So any picks from the large caps, or is it largely from the broader markets?
It's a mix from broader markets predominantly, Sonal. The first one is from the auto space, because this is clearly buzzing and then there seems to be no stopping this space. So Ashok Leyland is something which is looking quite interesting to me at current levels. I would recommend a fresh long addition in Ashok Leyland for a target of 142 on the upside with the stop loss at 132 on the downside. The second is from the defense space, because this has made a comeback and it's a strong comeback. So BEL is looking quite interesting to me at current levels for a fresh long entry for a target of 410 on the upside and a stop loss on the downside at 387. So BEL and Ashok Leyland, these are two top recommendations from my side.
Okay, all right. Thank you so much for joining in and have a great weekend ahead. That's the technical check on the markets, but let's go across to Mangalam. He's bringing us all the trends from the F&O space this morning. Mangalam.
It looks like the market got a booster shot ever since you guys went on the air, Hormaz and Sonal, you know, because the Nifty has moved towards the higher end of today's trading range, and it's been led by two engines which have been doing well for the markets in the earlier part of the week. We have the Nifty Bank as well as the Nifty IT index. Yes, there was a pause for breath yesterday for the IT index, but it's back up today as well. And the Nifty Bank doing well after a long spate of underperformance is something that, you know, the bulls would like. The important part for the Nifty now that it's just under that 25,150 mark, the 25,154 mark, very, very crucial, because, you know, ever since the Prime Minister's speech on the Independence Day, we saw a big rally all the way up to 25,154. That got fizzled out. So conquering that level would be the first milestone for the bulls to cross. For the Nifty Bank, it accelerated after it conquered the 20-day moving average, you know, comprehensively. So right now it's above the 20-day moving average. If it sustains above this level, then we have a headroom for almost 1,000 points on the Nifty Bank, because the 100 and the 50-day moving average come only close to 55,700. So that would be a technical, you know, free run for the Nifty Bank. So that's something we will watch out for. The other positive thing, the advanced decline ratio, that's doing well as well. So 1,700 stocks in the green for about 1,000 stocks in the red. Those lines are far and wide apart, with the green one much above the red one right now. The India VIX is lower as well. So that's telling you that, you know, the street is seeing some put writing. So that's visible on, you know, the options side as well. And there is short covering at the 25,000 call. Now that the Nifty is above that 25,100 mark. So the 25,000 call comes up for you. That's seeing some short positions being unwound. And we are seeing put writing at 25,100 and 25,050. What that tells you is that, you know, the support has moved higher. Psychologically, 25,000 now becomes an important mark as a support. If everything is good, what is the only fly in the ointment? The only fly in the ointment, or the only worry, is that are things getting slightly overbought right now after 8 days of a rally? The put-call ratio is at 1.34. Typically, the put-call ratio peaks out closer to 1.25, 1.3, but now at 1.34. Let's see how it goes 2 days ahead of the weekly expiry, which is on Tuesday. One stock I'm watching out for is HFCL. After the big open interest surge on that stock, it's you know, definite that HFCL may come into F&O ban if it sustains at this level of open interest, because it's above the threshold level of 95%.
Okay, all right. Thank you so much for joining us with all those cues, Mangalam. We'll do one thing. We'll slip into a short break. When we come back, we'll focus on the crypto market with Manisha Gupta on the other side.
CNBC TV 18 presents Crypto Corner, powered by CoinDCX.
In Crypto Corner today, we are focusing on major numbers. Well, let me remind you that there are almost 25,000 cryptos or tokens, and the overall market cap for all of this is at around $4 trillion. When you look at the top 10 cryptos in the world market, as per their market cap, Bitcoin, of course, stands first with around $2.3 trillion of a market cap. The dominance continues to be more than 55% onto this one, and this is being created as a world reserve currency in some countries as well. So complete support and focus continuing for Bitcoin. The second one is the leader of all smart contracts, and that's Ethereum, with almost $522 billion of a market cap. And then you have XRP with $177 billion, followed by BNB, which is $123 billion of a market cap. Solana, again, has seen a lot of scalability, efficiency, and efficiency in sense of cost and speed as well, is also at around $120 billion of a market cap. And then you have stable coins, the USD coin commanding nearly $72 billion in sense of market cap. And then there are meme coins as well. You have Dogecoin, which has $36 billion of a market cap, Tron at $31, and Cardano also holding $31 billion of a market cap there. But interestingly, it is about the crypto ATMs, Bitcoin ATMs that is, which seem to be catching up in the international markets there. Remember, in various countries, you can buy, sell goods with Bitcoin. You can pay in restaurants for a coffee by a Bitcoin as well. So when it comes to ATMs, this number seems to be doing quite well as well. Now, this data comes in from Coin ATM Radar, which says that in US itself, there are 30,800 crypto ATMs that you can make use of. Canada has around 3,600, Australia at around 1,900, Spain has 387, Poland not too far away with 300 crypto ATMs there. New Zealand has around 221, Hong Kong more than 200, El Salvador, a country which has adopted Bitcoin as a legal tender of payment, has 200 plus kind of ATMs there. Italy has 200 as well. So there are various countries in Europe, in Asia, especially US and Canada, which are looking at very strong numbers where you can use ATMs to withdraw or put in your cryptos there. Romania has 159 as well. So as I said, this number seems to be increasing. It's not just about buying in ETFs, in spot, in futures and options, and high yielding and yield farming, but it also is about ATMs, a number that seems to be strongly catching up.
CNBC TV 18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Still 100 points higher on the index, facing some bit of resistance at that 25,154 level, but no reason to complain. The 8th straight day of gains for the Nifty and set for a second straight weekly advance as well. Just before we call time on the show, some of the stocks that are doing well today are the defense names. Look at MTAR Technologies, up 8.5% now. Astra Micro is up 7.5%. Garden Reach is up 7%. And Apollo Micro, too, trading with gains of 6.5%. So defense as a theme continuing to do well. We call time on this edition of Trading Hour. From Sonal and me, thank you for watching. Halftime report on the other side.
Stocks trade firm after hope of a Fed rate cut keeps US equities upbeat. Industrials and autos notch some gains while FMCG and realty soften.
The board of Infosys has approved an 18,000 crore share buyback, its biggest till date and almost twice the size of its previous three buybacks. The tender offer price at 1,800 rupees is a 20% premium to Thursday's closing price.
Veteran investor Manish Shokani says the market is being held up by price-agnostic retail flows even as PE and promoters sell down. A turn in sentiment, he adds, can hurt investors with a less than 3 to 4 year horizon and over 15% return expectation.
US Commerce Secretary Howard Lutnick tells CNBC he is focused on a deal for India, but India needs to open up and stop buying Russian oil. Indian Commerce Minister Piyush Goyal reiterates the first tranche of the US trade deal should be stitched by November. You're watching us here on Halftime Report on CNBC TV 18. I'm Mangalam Malu. With me, Ekta Batra and Vinny Motiwala. We come to you live from the CNBC TV 18 Motilal Oswal studio. And what a good day it has been for trade. The 8th straight session for the Nifty gaining and now comfortably above that 25,000 mark as well. In fact, inching closer to the 21st August levels of, Prime Minister Narendra Modi's post-Independence Day speech level of 25,154. So that'll be an important mark to watch out for. Broader markets doing well. The Nifty Bank above 20-day moving average. So far, all is well.
Well, kissing distance, you'd have to say, from those levels on August 21st at this point in time. But yes, as you can see that the Nifty has gained that momentum. It's up for the 8th consecutive day. And week to date, that's actually telling enough in terms of the kind of move that the markets have made. So on a week to date basis, the Nifty is up around 1.5%. We have the mid-cap index, which has rallied around 2%. The BSE small cap index is up around 1.5%. And surprise, surprise, the Nifty IT index has really made a comeback this week, up around 4% at current reckoning. So all that going good for us. Let's see whether this sustains. But as of now, the noises seem to be correct when it comes to the India-US tariff negotiations as well. So all of that aiding in terms of sentiment. Hi, Vinny.
Hi, good afternoon, guys. So yes, absolutely a good day coming in and a good week also, because this will be the second consecutive week that we'll see the markets close on that positive side and Nifty close, with gains. So that'll be interesting to watch out for. Auto and pharma today are the top sectoral gainers. We'll be keeping an eye out on, these sectors, and we'll get more stock specific later on the show as well. But let's get started with the show and talk about some of the deals that have been happening as well. But in terms of JBM Auto, I just want to highlight that, before we go to more deals, JBM Auto, that's the one buzzing, right? 10% uptick that we're seeing coming in for the stock right now. And obviously, there's news flow, which is keeping the stock abuzz. Apart from that, keep an eye out on these capital market names. Nuvama Wealth, that's buzzing again in trade today. With BSE, that's managing to hold on to some bit of a green as well. So that is what we'll keep an eye out on. And that'll be interesting to see what actually happens in terms of that consultation paper that is going to be going on, and that is the key to watch out for in terms of these capital market names.
Right, and as we speak, the defense names as well are back in vogue. So we have BEML, which is up 7%, Garden Reach Shipbuilders up 7%. We're seeing big traction come by on some of these other names as well. Bharat Dynamics, for instance, up around 5.5%. Paras Defense, too, is up 5%. But Lupin, that's the stock on our radar. Ekta, Investec betting big on Lupin?
Yes, absolutely. So they've upgraded the stock to buy from hold, and they've raised the target price to 2,265 from 2,100. They say it's well placed to ride the upcoming GLP-1 opportunity in India. Lupin is a key player in terms of the anti-diabetes and cardiac arrest therapy segment. Recent approvals indicate Lupin's expertise in complex injectables. They expect to see potential of $20 to $30 million annual sales for each injectable. Post the recent correction, they view valuations as reasonable. Base case, a strong FY26, moderation in FY27, and EPS growth resuming in FY28. So that's on Lupin. That stock is up around 2.6%. But we have a larger topic to discuss now, and that is on the outbound M&A from India Inc. India Inc. is going global. What's fueling the overseas M&A? Nimesh is here with all of the statistics, all of the details and the numbers at the wall to tell us more. Nimesh.
Well, Ekta, as you rightly pointed out, the India Inc. has been on a shopping spree. It's not been only this year, but since last year as well. But this year seems to be standing out so far. Already in 2025, since in the last 8 months itself, we've seen M&A deals of almost 100 deals have been done, and the value is over $1.5 billion. So that's the kind of deal value and the number of deals that have been stuck in 2025 itself, which means in the last 8 months, this is the kind of M&A deals that we've done. Just to highlight some of the notable names which have come out with the and essentially this whole M&A deal has been done to play on the global supply chain. So that's the key theme on which a lot of Indian companies are doing M&As. Top of my mind is Tega Industries. A big deal got announced. I've been tracking this for a while now. But $1.5 billion, that's the size of the company which they've acquired, which is called Molycorp, that they acquired, and they've announced the deal very recently. So that was one big deal, outbound deal, which got announced from a mid-cap company. Tata Motors was another deal. They've acquired an Italian company, and that's the deal size for Tata Motors as well. And Sudarshan Chemical, we all know, they closed the deal in 2025. Again, a big deal. By virtue of which they become the second largest player in the pigments industry, that is Sudarshan Chemical. So these were the few notable deals which were recently announced from the Indian companies, especially the mid-cap Indian companies, the likes of Tega and all. But the list is quite long, right? And there are so many prominent names in this list which have done globally, which have done and acquired companies globally. Wipro stands out, Titan stands out. Titan, Mangalam tracks it very closely. Aurobindo Pharma and Natco Pharma. Ekta, you've been tracking that space. So across autos, across IT, across auto names, you're going to see this kind of deals happening. C8 was another example, a big deal that they announced earlier this year, $225 million. That was large one. Sun Pharma, TBO Tech, again a small cap company, but they've done a big acquisition globally, and so is Eicher Motors as well. So as I said, across sectors, we've seen cross-border M&As picking up. I spoke to some bankers as well. There seems to be a confidence now back for mid-sized companies to go out and acquire assets globally. The other important thing is, we are seeing a lot of deals from the Europe, essentially because there is so much of trouble. So you can see a lot of buyout deals, especially from Europe as well, because there are a lot of stressed assets there as well. Again, there is a lot of support as well. The domestic money is so large that that's helping. In fact, I spoke to Tegab, just after the deal got concluded, and he said the first time he saw the deal in 2017, but that time he didn't have the currency or the money power to chase it. Now they could do it, and that was one of the large deals. So almost, if you just do a comparison to last year, 2024, there were 121 deals all through the year, valued at $17 billion. And I just said, in the first 8 months itself, we've seen over 100 deals, and that value is close to $11.5 billion. So M&A is really picking up, and especially the outbound M&A from mid-sized company is what there is a lot of traction going on from the India Inc., and they've been looking at assets globally.
Okay, Nimesh, thank you so much for that. Very, very interesting data points coming in there. And look at the size, right? Nimesh just showed it to us as well. Already 100 deals in the first 8 months, and the value is already $11.5 billion. So that is something we'll be watching out for. But to talk about this and, where is now all this going to be headed in terms of deals for India? What are we watching out for? We have Vivek Gupta, partner, M&A and PE leader at Deloitte, joining us to discuss all of this. Vivek, good afternoon. Thank you so much for joining us on the show. And, let's start by just talking about the size of these deals, right, that have been coming as well. They've become much larger now in terms. How are you seeing in terms of size of the deals going forward? And do you think now companies are going to be focusing more on these outbound deals where they'll get a leg up even in terms of value chain, just apart from, looking at the geography expansion that they'll get?
Look, this is a trend that one has been seeing for the last 3-4 years. The fundamental macro factors are in favor of the Indian companies. They have access to finance, which is much cheaper than earlier. They have local currency, as you mentioned just now. They have local currency in the form of equity, which can be used to generate the money flows that are needed for doing deals of this size. You mentioned $11.5 billion for 2025 so far. And while deal activity tends to be transactional, our Deloitte estimate on the quantum of outbound investment deals that are likely to happen over the next 2 to 3 years is $30 billion annually, much higher than what we've seen in the past. And I think companies will continue to shop for larger ticket acquisitions as they see access to finance and as they see access then to markets or to supply chains. The traditional sectors that we've seen historically are pharma and IT. I think now we are seeing companies willing to acquire in other sectors like industrials, auto, etc. So we continue to be very sanguine on the fact that the trend that we've been seeing for the last 3 years will continue. $30 billion odd of outbound investments, of outbound acquisition investments, outbound M&A from India Inc. is something that's on the radar.
Vivek, thanks for joining in. I know you've been tracking this space for more than 25 years now, one of the senior banker there. You spoke about $30 billion, the size of amount that can happen annually. If you can just identify for us a couple of sectors where you think there is prominent interest from the Indian companies, and there are a lot of assets which are available as well. So a good match for Indian companies and stress assets available globally. So if you can just highlight some of the sectors where there could be a lot of interest.
The interesting trend is, and I will answer your question, but the interesting trend is it's not just stressed assets that India Inc. is after. India Inc. is now happy to pay for assets, pay value for assets and purchase them.
Wow.
As I mentioned, in terms of sectors, the traditional sectors always used to be IT and pharma. I think we are seeing a bunch of assets now in the industrial space. We're also seeing a bunch of assets in that space, which is the cusp between consumer and pharma. So not really regulated pharma, but OTC consumer pharma as well, where deals beyond $1 billion in size are on the anvil. So I think IT and pharma will continue to be strong sectors for Indian companies to purchase. But I will now not be surprised in seeing deals in other sectors like industrials, part consumer, and so on and so forth. India, with the currency that it enjoys now, can actually buy overseas at decent value.
Sure. Vivek, you spoke about pharma as one space. Will you be surprised if Aurobindo, if they loses out on Zentiva, they go for another large acquisition? Is there something that is available globally, a very large pharma asset up for grabs?
I will not comment on what Aurobindo will or will not do as a specific company, but I will generally say that yes, across the globe, there will always be interesting opportunities in the pharma space for acquisitions. I think there's a natural confluence of capital from India and these pharma companies with operations globally, and that will continue to be a sector which will be of interest to the Indian pharma companies.
Okay, so Vivek, I just had a question which was similar to that, and it's an offshoot. It's a $4 billion deal, whether or not Aurobindo buys it or not. Is the market ready to accept such a large acquisition, say across the sector, to give it, to put it into perspective, a company biting off possibly more than it can chew? But are companies or is the market ready to digest such large acquisitions? Because for Aurobindo, it's a $4 billion acquisition. There were concerns in terms of the size. There were concerns in terms of funding. And there was a little bit of a relief, when there were indications that they might not be the bidders.
The ability of the market to understand acquisitions is very fact-specific. So if I have a situation where a company is buying another company which is larger than its size, so long as there's an integration plan, so long as there's a robust financing plan, and so long as there are cash flows available to service that acquisition, I don't think the market has any trouble. At this point in time, the market is betting strongly on the Indian entrepreneur and the Indian growth story. So I would not go so far as to say the market will have trouble understanding in principle larger deals by the Indian companies. But of course, whenever there's a large deal, the threshold to convince the market is higher, which is, the threshold is, yes, I can finance this without undue risk to my core business. Yes, I'm doing this because this makes synergistic sense with my existing business. And so long as that story is clearly stated, I think the market is able to grant a lot of latitude to Indian businesses in terms of their global ambitions.
Well, Vivek, the fundamental story is fairly clear. Yeah, there are synergies. There is this opportunity outside of the country. It's more than just, looking at distressed assets. There are synergies in merging. What I was curious about, and it was an incredible list that Nimesh put out of all the marquee deals that happened, all of them, nearly all of them, barring one or two, were done in cash. At a time when you have global companies cashing in on their Indian chips to be able to buy their own, the valuation differential between the two, would it not have been a little more prudent to use their equity as currency as against cash?
Look, and I say this often, right? I think using cash is smart because you choose the amount of equity dilution that you want to do at a particular price. B, using cash is a combination of equity and debt, right? Most companies that were mentioned on the list actually would have done a QIP or some cash raise to fund the equity component of the acquisition. So effectively, they've used the Indian equity currency, but they're offering a cash deal to the seller so that the seller is then not exposed to the Indian equity market risk. The seller may basically say, look, I want this cash. And it's easy for Indian companies to generate cash on the equity stock markets through a mechanism such as QIPs. So a large component, I think, of the deals that you mentioned in the table that you showed are deals that were funded by a combination of debt, and QIP-based equity issuances, which is exactly the same thing as using equity by giving it to the seller. It's just a function of who holds your equity.
And the investment bankers who get fee for both.
Vivek, one last question to you, Vivek, before we let you go. I'm just taking some names and I want your view from an investor perspective. What should an investor watch out for? For example, the Tega deal. A $1.5 billion, the acquisition is bigger than the current size of Tega Industries. Similar was the case with Sudarshan Chemical as well. They went out and bought a very large company. They'll become the second largest player globally. From an investor perspective, Vivek, what are the things that investors should watch out for? Where can the companies falter? And which are the few red flags that you want to highlight that as an investor one should watch out in such large transactions?
I think, look, again, without specifically talking about companies,
yes, just an example.
In any such acquisition, the first and most important thing to watch out for is what is the financing structure of the deal. Sure. If the financing structure of the deal is such that it does not expose the business to undue risks, then I think it is a deal that that passes at least the financial test. The second and most important thing to watch out for is ability of the management to synergize and integrate. Sometimes deals are often induced by egos, by the sheer desire to become larger. I think the disciplined case on how the deal adds to synergies and how the deal can be integrated, coupled with the management's ability to be able to make that deal successful, is the second thing that I'd watch out for. So financing structure, core business synergy, and ability of management to successfully integrate the deal are the watch points, I think, for investors. And that is what the market typically ranks any of these deals on.
Sure. Okay. All right, Vivek. We're going to let you go on that note. Interesting conversation there, and I'm sure...
Perspective as well.
Yes. Thanks, Vivek, for joining in, and thanks, Nimesh, for bringing us all of that comprehensive
data. This is something which I track very closely. It's close to my heart, and I love tracking amenities.
Close to your heart, is it?
So I think it was good to get a perspective from someone who's so senior. Yeah. And this is exactly what in a large M&A transaction, how they're going to execute the deal and not a risk to the current core business. Yeah. That is something to. And Tega is a classic example. He's clearly mentioned that he looked at this deal way back in 2017, but that time he didn't have the money power to chase it and close it. Now they're going to make an announcement of a preferential issue as well. So they're going to raise money via equity, use that money as well, use the global parent's balance sheet to raise debt. Similar thing, something which even Sudarshan Chemical did. So in a way, I think some of these Indian companies are getting smart, doing it nicely, smartly, and using the equity as a currency to go out and buy.
The point that he made, that you're using equity as a currency for current shareholders, but paying cash to the foreign companies that you're buying so that they don't have any risks to the Indian equity market.
So we've definitely come of age when it comes to Indian outbound M&A. But $17 billion in 2024. Eventually, Deloitte is estimating $30 billion in terms of outbound M&A for Indian companies. So good going for us. And it's reflecting on the stock markets as well at this point in time. We'll take a short break, but we'll get you more on the markets. Lots of stocks, lot of discussion around the consumption theme once we're back. Stay tuned.
Welcome back. Ever since the GST rate cut has been announced, the possibility of that has happened. We here on CNBC TV 18 have been tracking the consumer space very, very closely. So we're now, looking at it as the consumption centimeter as we build towards the actual activity of, the cuts of the GST rates. That happens on September 22nd. And ahead of that, Goldman Sachs has written a very nice note on the sector post-GST rate cut, indicating that companies across the board may have anywhere between as low as 100 basis points to a 1,200 basis points reduction in their blended GST rate cuts across their coverage. And then there is that, table that comes up for you on the screen, which lists company and their GST rate cut impact and the potential EPS upgrade that comes in over the next couple of years as well. So that table comes up for you on the screen. The author of the table, Arnab Mitra, who is the India consumer analyst at Goldman Sachs, joins in as well. Thanks a lot, Arnab, for joining in. It's a wonderful note, that you've put out. You expect disruption in the second quarter. You expect volume growth to return in the second half of this year. The question is, how do you expect companies to pass on these cuts across the portfolio, and by when? Because, if it's just price changes on the MRP, new packages come by. But large part of the market, you and I know, is, the price point market. And we've had managements tell us that grammage changes are a lot more difficult to pass on than just price changes. So when is the earliest you expect these grammage changes to come to the street by? And how do you expect the companies to pass them on at the earliest?
Yeah, thanks, Mangalam, and thanks for having me on the show. I think one of the big differences between the GST rate cuts this time and what happened 10 years back in 2017 is that while the government has said that companies should pass it on to consumers, and I think companies are committed to pass it on to consumers, there is no strict anti-profiteering law like there was 10 years back. As per the 2017 anti-profiteering law, companies were required to pass on price cuts in every single SKU or pack that they sell across their portfolio, compared to this time where we feel there's a lot more flexibility. So ultimately, companies will pass it on, but the manner in which they do it across their category may be a little bit more flexible than in the past. So what we expect is the price corrections will land in the market, as you rightly said, after 22nd of September. We'll start seeing new MRP stock in the market. Of course, there is always a transition issue with higher MRP stock already lying with distributors and retail, which is where there could be a little bit of a pipelining issue towards the end of this quarter, which will be a short-term impact reverse in the October month. The grammage cuts, our view is for different categories differs, but could take a month and a half because of the changes that the calibration of factories have to happen. But around November, we should be fully seeing the new MRP stock plus the higher grammage stocks across categories land up. And that's when we will start seeing the impact on volume growth, revenue growth, earnings growth for these companies to flow through.
And what's your estimate on the volume growth in the second half of this year? Once you believe that, it'll come by, how much incremental volumes are you expecting? Let's put it that way.
Yeah. So if you look at how volumes will get impacted in the category, there are basically 3-4 main drivers. One is price point packs. In price point packs, when the grammage increases in a certain 1 rupee sachet of shampoo or a 10 rupee packet of biscuits, it gives you straight away higher volume growth because the consumer will end up consuming a single serve pack or a single biscuit, even if it is slightly bigger in size. The second is there is this unbranded to branded transition, which can happen in categories where there is some unbranded share. Third, actually very importantly, is premiumization. I was going back to my notes of 2017-18, and one of the biggest catalysts of GST cuts that time was premiumization. So as prices came down, consumers were able to move to a higher brand. Companies also very smartly sometimes can use recruiter packs of big brands or premium brands and drop the prices even more than the larger packs, which leads consumers to upgrade. And the last is there is some demand elasticity price elasticity of demand. So I would expect anywhere between, depending on each company, but let's say if there's a category where GST has got cut from 18 to 5, I would expect anywhere between a 3 to 5% increase in volume growth of that category. However, then we have to account for the fact that everything has not dropped for each company. The portfolio could be different, but that's the broad range of outcomes which we have built in this estimate that you've shown here.
Sure. Arnab, just wanted to drill down to stocks specifically because you are estimating that Nestle, Britannia, as well as, say, the likes of Dabur and Emami are probably going to see the maximum upside in terms of EPS, 5 to 10%. Incrementally, what would be the impact in terms of earnings for them? Would this sustain according to you, going forward, going into probably the next fiscal? And how are you placed specifically on these stocks in terms of a rating?
Yeah, I think one of the things that makes us quite positive on the sector is that we were already getting positive on mass consumption before the GST rate cuts happened. So we put out a report about a month back talking about a mass consumption revival, which was coming out of the lower food inflation, the government stimulus from the state governments, income tax cut, all the other catalysts. GST actually is the biggest of the lot in this series in terms of the absolute size, the impact it can create. So one is the reason why we feel this is not a one-off bump, but actually probably catalyzes the recovery, because there were other catalysts also. Because sometimes, when things are already deteriorating and you get a cut or a stimulus, it doesn't immediately help. But when you're already improving and there are other catalysts, it becomes a lot more potent. So I would expect some of these gains to actually sustain. It could be the catalyzation of overall consumption recovery for mass consumption, which has been weak for many years. Now, on a company-by-company impact, of course, I can't talk about specific stocks here, but the reason why we looked at earnings potential upside is that we also don't know whether companies will use it to increase EPS in the first year, or do they want to invest it back to further accelerate volume growth? Like a company could have a choice of delivering a certain volume growth and a certain EPS growth, or may choose to invest back and improve the volume growth even further. But if we look at 2 years out or 1 year out, I think this is definitely a permanent benefit. It resets the growth trajectory and the earnings trajectory of these companies, which has been very weak in the past. What we've shown in that analysis is how much is the potential upside if the company were to retain some of these benefits. And then, of course, it's their choice, which we will hear over the next 3-4 months from companies on how they should pass it on.
Arnab, what about Colgate or toothpaste companies, right? Single category companies. You're highlighting about that. The concern comes in on input tax credit over there. So what would that impact be? And are there any such other categories that one should watch out for? Maybe where we could see a bit more of an impact on the negative side.
Yeah, I think any company which is a single category company and where the GST has dropped from 18 to 5 and where input tax credit was more than 5 in the past will have this challenge. This also very interestingly opens up a differentiation between companies. So let's say there's a company which has one single category and gets a GST cut versus a company which has many categories and gets a GST cut. There is possibility to offset the input tax credit against other categories that they sell. But in single category companies, it becomes a standard GST. Their ability to cut prices is lesser than the competitors who have broader based categories. And we also don't have clarity whether the government will have some mechanism to refund input tax credit. We will have clarity over the next few months. So there could be some challenges there. The other thing we've highlighted in the note is the state government incentives. So many companies have set up factories in states where they used to get a refund of the state GST. Now what's happened is just mathematically the state GST is dropping from 9% to 2.5% in many categories. So the component of refund goes down, which is actually a core part of their pricing strategy today. So we will have to just watch out for these two specific impacts, which is input tax credit and state incentives, which again will differ a little company to company. The more broad-based the company, I think the better chances of mitigating these factors.
Just a final question before we let you go. Arnab, you said that this will catalyze volume growth more than all the other announcements that have come by in the past. But, from an underlying macro trend, from what happened when the GST 1 was announced versus GST 2.0, we have the D2C companies, which are eating into the shares of these companies from the premium end. The prospect of unorganized to organized, we've seen that a large part of that shift take place in the last 5 to 6 years already. So that headroom also perhaps may not be as much. And between the first time it was announced to now, the valuation multiples of these stocks have also gone higher, while the growth has only come lower. So do you think this announcement will only just be a temporary booster, or glory days of large cap traditional incumbent FMCG companies is ahead of us rather than behind us?
I think you make a lot of very good points. I think the starting point of valuations is higher, so we cannot expect, the kind of upside we saw 10 years back in some of these stocks. But on the other two elements, like let's say D2C companies or digital companies, that's a factor very specific to the beauty category. We've not seen too much of that in many other segments. In other segments, actually, the other challenge has been regional players and local players who have gotten stronger over the years. There, we also feel macro played a role. I mean, when the consumption demand is so low, when your real rural wage is not growing at all for year after year, the consumer was trying to lower the household budget. And there was an active downtrading in many categories. Tea, for example, is a good example where actually downtrading to loose tea had happened. Now, as the GST rate cuts come through, your affordability increases, your gap with unorganized sector further reduces, I think the chances are that some of these trends will also reverse. So we don't expect it to go back to the glory days of 2000, let's say 8 to 12, but significantly better than the last 5 years, which has been really anemic growth for the sector. But it should be a significant change in the trajectory is what we are looking at it. And as I mentioned, it's multiple things. It's not just GST, but GST is the largest of the 4 catalysts that actually have come through. And we think the street is probably slightly underestimating the impact. In our conversations, there's a lot of skepticism whether this can really be a big catalyst, but I feel bottom up, it looks like a much bigger factor than any of the other catalysts we've seen in the past.
All right, Arnab, thank you so much for joining in and giving us your views. Always a pleasure speaking with you. We'll keep our conversations more frequent, and we'll obviously keep getting a dipstick on what's taking place on the ground from your good offices as well every once in a while. Take a short break, come back, get you more on the markets and a lot of other stock-specific action. Stay with us.
Welcome back to Halftime Report on CNBC TV 18. Nifty as of now comfortably about 25,100 levels. We'll keep an eye on where that's headed. As of now, 0.4% of gain, 100 points uptick for the Nifty 50. A lot of individual stocks in the last 1 hour that have been moving. Just pull up Hind Copper. That's up 2% just in the last 1 hour. So that'll be interesting to see, as well as Graphite India. That's also seen a bit of a spike up. So keep an eye out on that. But we have Vivek joining in with us now to take us through the important stocks that are moving around in today's trading session. Vivek.
Well, thank you so much for that. Looks like we could see 8 successive sessions of up move as far as markets are concerned.
broader end of the markets are very, very strong, and the advanced decline ratio is very positive as well. What's doing quite well? Well, the entire pharma pack today seeing a bit of buying. Lupin, of course, on the back of the Investec upgrade is leading the pack almost 3% higher, but the remainder of the names or the rest of the names too seeing some buying activity emerge after a while. Hindustan Copper, a stock you just mentioned. So what's actually happened? Overnight, the company has gone ahead and uploaded an investor presentation. They've outlined aggressive, ambitious capex plans. Some important approvals is something that they're talking about. Stock on very strong volumes today. Clearly, stock of the day almost 9% higher. The capital market stocks yesterday, all of these stocks under significant pressure, 3 to 5% lower yesterday. But today, most of them have made a bit of a comeback. So names like BSE, Angel One, Nuvama Wealth, all of these stocks have seen some buying emerge or some short covering emerge after yesterday's fall. JBM Auto, one stock from the broad end of the universe. The company's subsidiary has managed to secure close to $100 million funding from IFC. On the back of that, that stock higher by almost 11%. And the entire defense pack, it's been a strong week for all of these names. So names like BL, BDL, MTAR Tech, all of these stocks on very good volumes today seeing some buying activity emerge. On the other hand, the consumption pack seeing a bit of profit booking at higher levels. Names so Hindustan Unilever, one of the top laggards on the Nifty, GCPL, Dabur, all of these stocks, Jubilant Food, almost 2% lower on that particular name. OFSS, day first raised stock higher by 10%. Yesterday, a clarification came down by 2.5%. And today, seeing further follow-on selling pressure. Tega, we highlighted the fact yesterday that this is a very large acquisition that the company has gone ahead with. Yesterday, down by almost 4%. Today, further selling pressure as the street tries to digest the size of the acquisition that the company is making. And Paradeep Phosphates is another stock from the broad end of the market that's under significant pressure today.
Okay, all right, Vivek. Thanks very much for that. So definitely a very lively market on our hands. For now, the mid-cap index is holding with a gain of around 0.3%. We have the advanced decline ratio, which has cooled off a little bit. So maybe that should come up for you in terms of the advanced decline ratio, currently standing at 1:1. But as you can see, it's narrowing in terms of the gap. We'll take a short break, but on the other side, we'll continue our focus on the consumption centimeter segment. We'll be connecting with Sanjeev Mehta, former chairman and CEO of Hindustan Unilever. Stay tuned for that conversation.
This one's a very special conversation because we've been talking about the consumer sentiment post GST 2.0 on our special consumer consumption sentiment. We have Sanjeev Mehta, the executive chairman at L Catterton India, but more importantly, former chairman and CEO at Hindustan Unilever. Mr. Mehta, you've seen it all. You know, you've seen the first GST, you've seen demonetization, you've seen the pandemic period, you've seen so many regimes and their impact on consumption. So with your experience, how would you rate GST 2.0 as a catalyst to boost consumption? And with the freedom that companies have been given right now to pass these prices on dynamically in the absence of the anti-profiteering law, how do you think this would catalyze volume growth? Analysts expect anywhere between 3 to 5% incremental volumes. What would your experience say?
Yeah, thank you, Mangalam. Delighted to be on your channel, and my greetings to all of your viewers. You know, if we just, Mangalam, for a moment step back and look at the construct of Indian consumers, you have about 3% of the households who I would say have the purchasing power of the West. Then you have about 11% who are the classical upper middle class. Then you have about 30% of the households which are lower middle class or the archetype middle class, you know, people who are striving hard and moving from very clearly from needs to wants. And then you have a large percent of India's population, which is over 50%, which I would still classify as within the Indian construct bottom of the pyramid, though they are not today people who go hungry, but their household income would still be less than 300,000. Now, in the last couple of years, many things have happened. First has been the disruption of COVID, followed by huge spike in inflation. And during the period when you had about 2 years of massive inflation, then obviously at that stage, the volume growth came down because most of the companies, they had to take the price up to protect the business model. Then we also had a period when the agri growth was very tepid. There was a year when it was less than 2%. That took a huge toll on the purchasing power of people living in rural India, especially those dependent on agriculture, which we are talking about nearly 45% of the national population. Now, when you put all these things together, it is not surprising that there was a stress on consumption. But the good bit has been that despite all this, if you look at the volume growth in the industry today, certainly in the categories where I led the business, there we are seeing volume growth of in the vicinity of 6%. Now, 6% from a global standpoint is not a bad picture at all. Yes, after the high period of inflation, the price growth has now disappeared. That's in many ways a good thing because the incremental inflation has not been very high. So your entire top line growth was driven more or less by volume growth. And now we are talking about the government stepping in to give a huge advantage in terms of GST reduction. Now, we must remember that a few months back, the corporate tax rates had come down. Now, corporate tax rate, of course, is not going to impact the people in the bottom of the pyramid because their incomes are low and they are not in the tax bracket. But certainly the middle class was given a boost. And here you have now a big step taken by the government to rationalize GST and give a huge benefit to consumers. In many categories, the tax rates have come down from 18% to 5%. I think the first thing that consumer goods companies should do is they should pass on the benefit to the consumers.
Sure.
This is not something that they should look at to fix their business model or increase their gross margin. They should pass this benefit to the consumers, and that would give a further fillip to the people at the bottom of the pyramid whose real wage growth had not kept in tandem with the inflation.
Right.
And the huge
Mr. Mehta, how much do you think would it mean in terms of incremental volumes were the companies to pass on these cuts immediately to consumers, in your experience?
You know, it would be very difficult because each category has different nuances. Each category, the impact would be different. But if you were to look at that, the benefit runs into over 40,000 crores.
Yeah.
And if a large part of that is passed on to the consumers, I wouldn't be surprised if an equivalent amount of growth happens from a perspective of the consumption going up.
Sure.
But there is also one very important factor which we should never forget, which is the behavior aspect, or what I would call as the consumer confidence. When times are tough, people hold back spending money. Yeah, when they look at that the government is taking series of steps, the inflation has come down, they would become much more liberal in spending. And when we talk about consumption, Manglam, it plays in different ways. You know, when you are at the bottom of pyramid, when times are good, every member in the family may want to have their own bar of soap. When times are tough, they might step back and say, the whole family will just consume one bar of soap.
Sure. Mr. Mehta, you know, that's exactly where I just wanted to get your opinion about the consumer confidence. While we do have this rationalization which has come through with regards to GST, on the other hand, we do have the rupee which is depreciated significantly. And we have other factors such as the uncertainty with regards to tariffs. While we have made headway there, there is still the uncertainty with regards to what could happen in gems and jewelry and textiles, and hence the impact on employment as well. In that context, do you think some of the GST fervor and the boost is probably offset by these factors, by these negativities?
You know, again, we must remember that India is not a homogeneous country. Yes, there would be workers in the diamond industry who might get impacted, but they would still be a small part of the total consumption base. A large part of the consumers in the country are going to get the benefit of GST reduction. I'm assuming that the companies are going to pass it back to the consumers. So certainly there will be a fill-in, no question about that. Of course, there is an overhang. And then we must look at it from different lens. Yeah, if the stock market doesn't go up because FII is not coming in, that certainly has an impact on the consumer confidence. But just look at it. We are talking about more than 50% of the households in the country in the bottom of pyramid, less than 300,000 family income. They would get a benefit. There's no question about that.
Sure. So, you know, quick one. I just wanted to understand what would be the main hurdle that comes in, right, to get into this transitioning phase for companies? And would we, even if they pass on the benefit, I don't think that it would be fully, right, that they would be able to pass on. If it's moved from that 18% to 5%, how are they going to be passing on that full benefit? Will it be full, or will it be through some distribution side of challenge or discounts that come in on that front? And look at categories like soap, right, where we have competition, high penetration. Why do they need to pass it on that time?
You know, look at it from this lens, that if your input tax doesn't exceed the total GST that you would be paying on the output, then the whole benefit flows down to the companies. And there would be a moral responsibility to pass it to the consumers. And you must also remember that these are very competitive categories. And if your competitor reduces the price and you don't reduce the price, you would become uncompetitive. So the sheer competition will also force the companies to pass a large part of the benefit to the consumers.
Right. You know, Mr. Mehta, just one question before we let you go, and this is beyond GST and perhaps on the future of, you know, the new leadership at Unilever. You've worked with Priya before. Your thoughts here, and obviously, you know, the global leadership also focusing on India, saying that not more capital would be deployed outside of growth markets, and one of their biggest growth markets is India. Your thoughts?
You know, India is the second largest market for Unilever. And when you look at it from a valuation perspective, India is the most valuable country for Unilever. So I'm not surprised that Fernando is focusing on India and the US. Those are the right calls. And as far as Priya is concerned, I know Priya well. I'm very confident that she's going to do a great job.
Okay, all right, Mr. Mehta. It's been a pleasure. Thank you very much for joining in and speaking with us. And I'm sure we'll definitely get you back on post the 22nd of September as well to get an assessment in terms of how things are panning out on the consumption front. As of now, we need to take a short break. We'll be back with more news. Stay tuned. Welcome back. Well, for the markets, 25,111 is currently where the Nifty is at. So doing well, up around 0.4%. We have the mid-cap index also, which is holding with a gain of around 0.2%. Well, in terms of particular stocks, we have stocks such as BEL, which is really topping the list at this point in time. So that stock is up around 3%. We have Shriram Finance, Axis Bank, both of these finance stocks doing well, so up around 1.5% for a couple of these counters, along with autos, which are managing to have a good week. So we have Eicher, which is up around 4%, as well as Maruti, which is up around 2.8%, obviously benefiting from the GST rationalization. But on that note, it's a wrap on Halftime Report. Thanks very much for watching. Business Lunch will take all of the action forward. Stay tuned.
Stocks trade firm after hope of a Fed rate cut keeps US equities upbeat. Industrials and auto notched some gains while FMCG and realty softened.
The board of Infosys has approved an 18,000 crore rupee share buyback, the biggest till date and almost twice the size of its previous 3 buybacks. The tender offer price of 1,800 rupees a share is a 20% premium to Thursday's close.
Veteran investor Manish Chokhani says the market is being held up by price-agnostic retail flows even as PE and promoters sell down. A turn in sentiment, he adds, can hurt investors with a less than 3-4 year horizon and over 15% return expectation.
US Commerce Secretary Howard Lutnick tells CNBC he's focused on India for a trade deal, but India needs to open up and stop buying Russian oil. Indian Commerce Minister Piyush Goyal reiterates the first tranche of the US trade deal should be stitched by November. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios, the final 2.5 hours of what has been an extremely promising week for the bulls. I'm Hormuz Fatakia. With me as always is Vamakshi Dhuria. Vamakshi, good afternoon. And it's a happy Friday for the bulls so far. We crossed 25,000 yesterday. We've crossed 25,100 today. And all eyes are now on the 21st August swing high, which is 25,154.
Absolutely. Good afternoon to you, Hormaz. Yes, the markets are doing extremely well in today's trading session. It's a century for now. And you know what's actually moved up in trade today is, take a look at Shriram Finance. That stock is, has picked up momentum. So has ICICI Bank, Bajaj Finserv, just some of these names that are doing extremely well in trade today. On the flip side, take a look at Trent, because that stock saw sharp selling pressure, in the last couple of minutes. That stock, yes, as you can see on your screen, was trading in the positive, but it has slipped into the negative, now down almost 0.5%. You know, the mid-cap end of the market, though, is not doing as well. Remember, the advance decline ratio, even though if it's in favor of the advances, it's still 1:1. The mid-cap end of the market is not performing at all. Other than that, what's actually doing well today is the Nifty Auto Pack. All of these counters are surging in trade. Take a look at JBM Auto. That stock is up over 10% in trade today, Hormaz.
Indeed, the advanced decline lines are converging. Just an hour ago, they were running at a parallel railway track, but they seem to be converging right now. What is also doing well today, though, is defense. All of these names, MTAR Technologies, Gardenry Chipbuilders, BEML, Apollo Micro, all of them trading with gains of anywhere between 11 to 12% now. MTAR Technologies is now up 13% at the highest point of the day. So sharp surge seen in MTAR Technologies. Of course, we spoke to the management yesterday and they highlighted the fact that they are aiming to double their revenue by FY28 and around 1,600 crore rupees. So a positive trigger coming in there from the management. So 1728 on the stock, 13% higher over there. But there are some losers as well on the downside in today's session. Paradeep Phosphates has had a forgettable week. 6.5% lower on that stock. Sagar Cements is down. Cement stocks in general are not doing well. Sagar Cements is down 4. Heidelberg is down 4. So some of these mid-cap cement names not having a very good session. Metropolis is down 3% as well. So a lot of these cement names, some pharma names, and Oracle also continuing to see some profit booking. And Ola Electric, of course, another 2% shaved off on that stock, is back below the 200-day moving average. Is Ola Electric, so 56.60 on the stock, 2.5% lower in today's session as well. But of course, the big news from last night and the story of the morning was Infosys announcing its largest ever share buyback, 18,000 crore rupees size, where it will be buying back 10 crore equity shares, price at 1,800 rupees. Rima is here with all of those details.
Thanks so much for that. So as you rightly pointed out, Infosys in focus on the back of its largest ever buyback, 18,000 crore rupees, much higher than market estimates of 14,000 crore. It's a tender buyback. The company will buy back 2.4% of the outstanding equities at a price of 1,800 rupees per share, which is a 19% premium to where the stock closed yesterday. Now, this is the company's largest ever buyback, the 5th one so far, and it's the size which has taken the street by surprise, because higher than estimate, and it's practically double of the buyback size, of the last one, which was in 2022.
Rima, thank you for that update. The other big story of the morning has been these capital market names. They were down yesterday, and they also were because of the CNBC TV 18 news break on the weekly expiries. Of course, all eyes are on the SEBI board meeting later this evening, and Jefferies has done a very interesting scenario analysis on the potential impact of in case the expiries are elongated. And what will that have an impact on stocks like BSE and Nuvama Wealth? What is Jefferies saying, Vamakshi?
Well, absolutely, Hormaz. Yesterday, Yash broke that story in which sources were suggesting that SEBI is likely to float a consultation paper within the next month to phase out weekly F&O contracts. In fact, SEBI is weighing a transition to monthly expiries is what sources were suggesting, and the regulators were also likely to consider a same-day expiry across exchanges. So this is what our source-based story was. But on the back of that, there was a scenario analysis that was done by Jefferies, and they've assessed various scenarios. So the first scenario that they've assessed is the fortnightly expiry. Now, in such a case, the overall industry index options notional ADTO could decline by almost 55%. The industry premium average daily turnover could decline by 45%. Now, there are two parts here. If the expiry is on different days for both the exchanges, BSE's market share is likely to remain stable at 29%. But the options revenue is likely to decline by almost 38%, resulting in a 22% fall in revenue and a 21% impact on its profitability. Now, on the other hand, if there is a same-day expiry in the fortnightly expiry, the market share is expected to decline from 29% to 20%. The options revenue is expected to be impacted by 57%, total revenue down 33%, and the net profit could be impacted by a much larger portion of almost 35%. The other scenario is under monthly expiry. Now, under this scenario, it's a much sharper impact is what Jefferies is expecting. Industry notional average daily turnover could decline by as much as 80%. Premium could decline by 70%. And expiry on different days, if we consider that, the market share remains stable. On the flip side, if there's a same-day expiry, the market share falls to 18%. And, the options, revenue, total revenue, profit, all of them are on the screen. And, such a huge impact is what Jefferies is expecting if the expiry moves from weekly to monthly. And as far as Nuvama is concerned, they believe that if we transition to fortnightly expiry, profit impact of almost 15%, and if it's a monthly expiry, then the profit impact could be around 25%. Just to sum it up, the potential impact for BSE could range between 20 to 50% as far as FY25 EPS is concerned, and 15 to 25% as far as Nuvama is concerned. So those were some of the names that we're focusing on. But Ria is here with a roundup of all of the other stocks which are buzzing on the back of news flow. Ria? Ria, over to you. All right, moving on then. Yeah, I think there was some technical issue out there, but amidst early signs of easing of trade tensions between the United States and India, Commerce Secretary Howard Lutnick said that India must make meaningful concessions, starting with reducing its reliance on Russian crude to maintain strong economic ties with the United States. Let's listen into that.
We're going to sort out India. India basically has to open their market, has to stop buying Russian oil. People don't remember, India didn't buy Russian oil before the war with Russia and Ukraine. They had 1% of their oil was from Russia. And now 40% of their oil is from Russia because we've sanctioned it so they can buy it, $7, $10 a barrel cheap. So they're buying it, refining it, and then selling it to the rest of the world and making a bundle. So the president called nonsense on that and said, you got to stop that stuff. So I think India will sort it out once they stop buying Russian oil.
We'll take a short break, but just as we do that, here are some views from our market master of the day, Manish Chokhani of Enam Holdings, who expects the final US tariff on India to be around 20%. He's also a little cautious on the Indian markets. Listen to what he had to say.
What's happened with US and India was a surprise to everyone, I think, including to the protagonists over here.
Yeah.
Something changed during Sindoor.
Yeah.
And then I'm guessing something's changed over the last 1 week again to bring things back to what looks like even keel. But yeah, I mean, if you zoom back in a larger context, India and US have been the two best performing markets in the world, the best democracies and the best sort of places for capitalism to thrive. Even if you get to the 15 which the allies have, which is Japan, Korea, UK, I don't think we get to 15. But if you're at 25 and you have some way around that, let's see, maybe we end up at 20. This market was being driven or is being driven really by price agnostic domestic flows. There are opportunities in the market, but overall it's a market which is very optimistic. Like I said, strategics are out, FDI investors are out, PE investors are out, a lot of Indian promoters have sold their stakes down. And the market's being held by price agnostic retail flows. And if a mood changes a bit over there, and I hope it doesn't, then we are in then you have to wait for the next cycle where you have similar optimism, which may be 3 years, 4 years later.
Welcome back. You're watching Business Lunch on CNBC TV 18. Now shifting focus to that much anticipated August inflation print for India. Now a CNBC TV 18 poll forecast a spike in that headline number. Retail inflation now is expected to come in at 2.2% for the month of August. Now this is following that 1.55% in July and 3.65% same time last year. Now remember, despite the likely spike, inflation will remain below the Reserve Bank's 4% target. Food inflation, meanwhile, is seen flat versus a decline to 1.75% in the month of July and 5.66% in the same time last year. Now the CNBC TV 18 poll also indicates no change in the core inflation print, which excludes the measure of food as well as fuel. Core CPI for the month of August is seen at 4.2%, which is broadly in line with a similar show in July.
Staying with the macros then, the US CPI also came in higher than expected in August. Jobless claims accelerated, presenting mixed signals for the Fed ahead of its policy decision next week. CNBC's Rick Santelli brings us the fine print.
Let's look at initial jobless claims, shall we? Now, given their seasonalities when you have things like Labor Day, holidays, but ultimately, just on the surface, 263,000 on initial claims. That's the biggest number going back to the fall of 2021. And it doesn't end there. We also had, of course, our August read on the Consumer Price Index. And that inflationary group of data points was warmer than expected. However, let me rephrase. It was very close to expectations, but sequentially warmer. Meaning, 0.4 on the month over month. That's higher than last month, but as expected. Take out food and energy, the core, 0.3. A little hot based on history, higher than our last look, but as expected. If you looked at the year-over-year headline, 2.9. As expected, hotter than the rearview mirror by 0.2. The only number that wasn't hotter, that was equal expectations and equal sequentially to the rearview mirror, was year-over-year core at 3.1%. But that's a 3 handle. The Fed's objective is 2%. And I know that the PCE is closer to 2.5, 2.6, their favored inflation gauge. But it seems to me that we see a market in equities continually making new highs. We see an interest rate complex that looks like rates want to go lower, but the 10-year seems to be fighting to stay above 4%. Ultimately, I think we're trying to match the data with the market performance. And I believe that the interest rate complex may find more selling going into the weekend, because I thought many traders looking at the flattening yield curve were expecting the 4% level to be breached in a much more significant way than the 1 basis point we saw today after the 8:30 numbers. As for tomorrow, University of Michigan sentiment, and that will be the end of an important week. And this week in particular, not only the last week of important top-tier data. We've had the job report, PPI, CPI, PCE data, which means it's up to the Fed next week on Wednesday to decide. 25 basis points is built in. They'll give us 25. Many thought we could see 50 with the data points today, but if the market doesn't price it in and Fed guidance doesn't allude to the fact that it is or isn't priced in with respect to whether they believe it to be accurate this close to a meeting, no surprises. 25 basis point cut most likely on Wednesday.
Well, absolutely. That is what the market will be hoping for. But let's also hear what economists had to say about the CPI data and the market's reaction to it.
It's going in the wrong direction, that's for sure. I do think we're seeing some tariff price pass-through. Core goods inflation has accelerated over the past couple months, which is where you would expect to see that tariff price pass-through. So, it does look like, as was mentioned earlier, the core PCE number, which is what the Fed focuses on, that's going to hang out pretty close to 3%, we think, when we look at both the CPI and the PPI together. So that's not a great story. On the other hand, I think there's clear evidence that the labor market is weakening, and that seems to be taking precedence in the Fed's thinking here. I'm not so worried about this morning's claims number. It seemed to be a lot concentrated in Texas, looked a little fluky. But last Friday, we did see an ongoing rise in the unemployment rate. And I think that's going to be, the real story here, because if that really continues, of course, then the downward pressure on wages presumably would halt any worries we're going to have about inflation in, 6, 12 months from now.
Certainly, we have seen that with the inflation numbers today, the Fed is probably not going to be cutting rates by 50 basis points in September. However, it did add another rate cut this year to 3 rather than our earlier expectation of 2. So I think that would be an encouragement. Also, when you look at the fact that we are seeing new all-time highs, not just here in the U.S., but also overseas, that is a confirming factor that tends to improve the average price performance 3 months out, as well as the frequency of advance, to the point where I think investors really are trying to find reasons to sell stocks when, in fact, that's probably what's going to continue to support and maybe even propel them.
Take a short break here on Business Lunch. More news and updates follow on the other side. Stay tuned. Welcome back. Today marks 3 months of the tragic crash of Air India flight AI 171 in Ahmedabad that claimed 260 lives. The Aircraft Accident Investigation Bureau blamed the movement of the fuel control switches from run to cut off during the takeoff to have caused the aircraft to crash. While the final report is still awaited, the preliminary findings have triggered a debate over whether the switches were deliberately moved or was it a system error. So where do things stand in terms of compensation that was promised by Air India? My colleague Madhiya Mujawar joins in with the latest. Madhiya.
Air India says that interim compensation has been released to the families of 207 of the 229 deceased passengers as well as the 19 victims on the ground so far. Remaining families are yet to submit their documents required for the claim. The delay could be due to differences within the family on the distribution of compensation. We have spoken to some families where all the deceased have not received the compensation of 25 lakh rupees due to such differences among family members. The Tata Group, which owns Air India, had separately announced 1 crore rupees compensation to be disbursed through a dedicated trust. In August, the group formally registered the AI 171 Memorial and Welfare Trust. However, no disbursement has begun yet from this trust. Meanwhile, American law firm Beasley Allen says it is representing over 100 families of the crash victims. The firm is preparing a lawsuit against Boeing. They have filed a Freedom of Information Act request with the US Federal Aviation Administration to obtain data from the aircraft's flight data recorder. According to Beasley Allen, Indian authorities have already shared this data with the FAA, and the lawsuit against Boeing will depend heavily on the evidence found in this data. Now, Beasley Allen also indicated that some families are preparing to file cases in the UK under the Montreal Convention, which governs airline liability in international air travel. Now, families will likely file individual cases within the next 4 weeks in the UK courts with Beasley Allen as their legal representative. However, not all families will qualify to claim compensation under the Montreal Convention. Families must demonstrate that the ticket was booked in the UK, the ticket was paid for in the UK, the deceased was a UK citizen or had clear intent to stay in the UK for the long term. Having a one-way ticket to the UK strengthens the claim as it suggests the intent of the deceased to stay for a longer period. The compensation amounts will differ family by family depending on individual cases and circumstances. Now, victims killed on the ground because of the crash and the 12 Air India crew members are not eligible under the Montreal Convention claims. So that is the update on the AI-17 crash so far.
Well, Madhya, thank you so much for bringing us all those updates 3 months since that unfortunate incident. But moving on then, C.P. Radhakrishnan earlier this morning took oath as the 15th Vice President of India at a ceremony at the Rashtrapati Bhavan. The oath was administered by President Draupadi Murmu and the ceremony was attended by senior leaders including Prime Minister Narendra Modi and Home Minister Amit Shah. Former Vice Presidents Jagdeep Dhankar, Venkaiah Naidu and Hamid Ansari were also present.
And with that, we call time on this edition of Business Lunch, the final one for the week. Vamakshi and I take your leave. Thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me is Vivek Iyer, and we are live from the CNBC TV 18 Motilal Oswal studio. Ending the markets on a positive, ending the week with the markets ending on a positive note. For today, at least so far, Nifty is above the 25,100 mark. That's been a comfortable level that Nifty is hovering around as well.
Advances. Good afternoon, Sonal. The important part is if we manage to hold on to these gains, it will be 8 straight sessions of gains for the Nifty, and that'll be something that the street really will cheer. We have a lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. Stocks trade firm after hope of a Fed rate cut keeps US equities upbeat. Financial services and autos notched some gains while FMCG and PSU banks soften. Mid-caps lag.
Shares of JBM Auto zoom after subsidiary JBM Ecolife Mobility secures funding worth $100 million from the International Finance Corporation to purchase and operate electric buses.
Schloss Bangalore surges after Ambit Capital initiates coverage on the stock with a buy rating and target at 540 rupees a share. Says that the lean balance sheet and industry-leading margins leave room for inorganic growth as well.
GAIL in focus. There's a Citi note with a buy rating. Target price of 220 rupees a share. They say that GAIL is looking at listing GAIL Gas, and if it goes through, it could unlock 5 to 6% of value for GAIL.
Well, welcome to Midcap Radar. You've seen some very important flashes at the bottom of your screen. Motor third-party insurance hikes, something that the industry has been asking for a long time. Sources indicate to CNBC TV 18 that there could be a revision. Most likely, they are tracking to see whether there can be an upward revision. This will be an important development, especially for names like ICICI Lombard and Go Digit, companies that do business in this particular segment itself. Along with that, have a look at some of the stocks. The pipe companies is something that we are keeping a track on. Remember, JP Morgan initiated coverage on these stocks. Both Supreme Industries as well as Astral doing quite well in the session, and both of these stocks actually have moved to the day's highest point. Supreme Industries up over 3%. Along with that, the entire metal pack, yesterday they did very well. Today, there has been some follow-on buying. So names like Hindustan Zinc, Vedanta, National Aluminium, all of these stocks near the day's highest point. But Sonal has now moved across to the wall. This is a special segment, Midcap Movers. Sonal, take us through the mid-caps that are moving around in the session.
Oh yes, a handful of names, largely on the gaining side actually today. So let me name some of them. Though mid-caps are underperforming the benchmark, still managing to be above in green in today's trading session. Sigachi is up 13%. The stock has been continuously doing really well. Atul Auto is the other one, 12.5% higher there. JBM Auto, we discussed it on the back of this investment coming in from IFC. The stock is up 12.5%. Hindustan Copper up 9%. We'll discuss it in greater detail in our Spotlight segment, what is leading to that big up move on that stock as well. We do have Gujarat Pipavav, the other one which is doing well, 6.5% higher there. GMDC also gaining on huge volumes today, 5% higher there. Bajaj Projects is the other one on our radar. On the losing side, the stocks are far and few. We have Paradeep Phosphates, which is seeing some some profit booking, down 6.5%. Green Panel was up 20%, so now it's down 1.6%. Some recovery from the lows is what this stock has seen. We have SMS Pharmaceuticals, big rally in last couple of trading sessions. We are seeing now some profit booking come by in this name.
Thank you so much, Sonal, for taking us through all of the mid-caps that are moving around in the session. It's a good time to welcome Hemen Kapadia from DR Choksey Finserv for a quick technical check on the market. Good afternoon, Hemen. Do you think we can notch 8 straight sessions of gains as far as the Nifty is concerned? What are your views from the market, at the current levels?
Very good afternoon to you, Vivek. Thank you for having me on the show. Well, thank God it's Friday, but this time it seemed like a good Friday. You guys just talked about the metal index. Metal stocks. The metal index is in a very positively typical situation, Vivek. One gets the feeling that it's on the cusp of a breakout, and this breakout isn't going to be exactly new. What I mean to say is we've been consolidating for around 15 weeks over here, and now it's breaking out. So, like you mentioned, I think every single metal stock is set for a very clear upside. And since it's a weekly chart, weekly breakout, and we are on the last day of the week, I believe this would hold true. So about 9786, that's the closing level for the Nifty Metal Index. We're at 9865. I believe the breakout is coming through today. Vivek.
What about individual names, Hemant? What do you have in terms of recommendation?
Yes, Sonal. Firstly, if I like metals, obviously one stock is a metal stock, Sonal. Firstly, a buy on Hindustan Zinc. Long consolidation, rounding bottom on the weekly chart, upper 55-week exponential moving average, oscillators, buy, positive divergences, ticks nearly all boxes, Sonal. So one can buy Hindustan Zinc at 455, stop loss 440, target 485. I think it's a modest target. It should get comfortably overshot. Obviously, it's not a very 2-3 day sort of a call. Second stock, which looks positively interesting, is ICICI Lombard, Sonal. Formed a bottom, is showing strength. The oscillators are reflecting a crossover buy. The weekly picture is improving. We've taken support at important levels. So I believe this is another stock which looks interesting from a long point of view. One can buy ICICI Lombard at 1895, stop loss 1845, target of 1995.
All right. Thank you so much, Hemant, for joining us. This is some technical aspects of the market, but a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV 18 Access, our premium members owning experience on cnbctv18.com. The membership includes access to CNBC TV 18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. Sanathan Textiles is the stock on our radar. It has begun commercial production at the new Punjab plant. We're now joined by Sameer D. Dattani, who is the executive director at the company. Besides this commercial production starting, we'll also be understanding the GST rate changes for textile industry, scrapping of import duty on cotton, and also understanding the growth outlook for the industry and the company as well overall. Mr. Dattani, good afternoon. Thank you so much for joining in. Before we talk about the macro aspects of the industry overall, I wanted to understand this new commercial production that has come by. What's the capacity? What will the initial capacity utilization be? And at peak capacities, what kind of revenues will you be looking at? And in FY26 itself, how much will it contribute to the P&L?
Hi, good afternoon. Thank you for having me on your show. So yes, very happy and proud to share with you that we've started commercial production at our new greenfield green manufacturing facility in Punjab. This facility is focused on producing polyester filament yarn. And the initial phase 1 capacity of this facility is going to be 700 tons per day, which on an annualized level is 255,000 tons per annum. We have successfully commissioned this capacity last week of August, on the 27th of August. And we started it at about 50% of the phase 1 capacity, about 350 tons per day. And we will slowly, over the next 3-4 months, be ramping this up to the entire phase 1 capacity of 700 tons per day. And I think in the next 3-4 months, we'll be at 100% installed capacity utilization of the first phase.
Okay, so the total capacity, currently you're functioning at 50% capacity. What is the total PFY capacity for this particular plant once the entire plant comes on stream? And secondly, taking this into account, we believe that you had given an FY26 guidance, top-line guidance in the range of 4,500 to 4,800 crore. Does that stay intact, or would you change that?
So the phase 1 total capacity of PFY at this facility alone is 255,000 tons.
Okay.
But the entire facility is designed to produce 355,000 tons, which will kick in phase 2 once we take that on. And yes, our initial large outlook was a revenue of around 4,500 crores. But now that we have a confirmed commercial production startup date, I think conservatively we'll be looking at 40 to 4,300 as our revenue for FY26.
All right, and how much will be coming in from this facility itself in FY26?
About 1,300 crores will be from this facility. And the Silvassa facility will continue to operate at its optimum installed capacity and give us a revenue same as last year, which is approximately 3,000 crores.
All right. With this particular facility coming on stream, is it margin accretive in any sense? If you can explain what the difference would it make to your bottom line overall, and if you'll have additional costs as well in terms of depreciation. So what will the impact on bottom line be?
So as far as the EBITDA margins are concerned, we are quite confident of, compared to our own Silvassa facility, looking at a better, stronger EBITDA margin at the Punjab site. We have many inherent locational advantages in Punjab as well as OPEX advantages. And let's not forget, it's a brand new facility with the latest equipment, and we've tried to set up a world-class facility in Punjab. So our operational cost, our cost of labor per ton, our power and heating costs because of the agri-waste we'll be using for heating, and our locational benefit. We are going to be the only manufacturer of PFY in this region in North India and serving our customers who have been our customers for more than a decade in the belt, in the region of Delhi, NCR, Panipat, Ludhiana, Amritsar from this new facility. So we are very hopeful to be their preferred choice of supplier because we'll be able to service them with just-in-time deliveries for the product that they need. Looking at all these advantages, we are very confident of having a much higher EBITDA margin at the new Punjab facility. As far as depreciation is concerned, of course, it's a new plant. So there will be new depreciation that will kick in the first year. And approximately 55 crores is what we expect for FY26 as the depreciation number.
Understood. Samir, moving on, the other big development that's happened over the last fortnight has actually been the GST rate cut. GST reduction across the entire value chain of textiles. How does it impact your company, especially taking into account input tax credit?
So firstly, at an industry level, it's a fantastic improvement from the side of the government. Now we have one GST on yarn and fabric on the entire textile value chain. So I think this is going to help as far as the consumption is concerned. But as far as man-made fiber is concerned, we still remain status quo in the inverted duty structure because our raw materials, which are petrochemicals, still remain at 18%, whereas our yarn remains at 5%. So we still remain in the inverted duty structure. There's no change on that front. We were really hopeful and wishing that we would have an improvement and we would be at a net, same GST slab for input and output. But unfortunately, that's not come through as yet. But as an industry, for the textile industry and for consumption, it's a very, very positive improvement.
Got it. Last question before we let you go. If you have any exports to the US and if there's an impact on the 50% tariff that has been announced?
So we, at a company level at Sanathan, our export exposure last year was around 4% of revenue came from export. And this year we continue to maintain that. Out of the 4%, the direct USA exports is less than 1%. So I'm quite hopeful we won't have any major impact on our operations or revenues this year because of the new tariffs. Having said that, we all know there are some positive developments going on. So if the positivity continues and there are some tariffs in favor of India, the textile industry does stand to gain further from where we stand today.
Okay, thank you so much, Samir, for joining in. Wish you all the best, as you ramp up the new facility, and wish you all the best for the way forward as well. Well, we'll now slip into a short break, but before we do that, we'd like to remind our viewers to tune in to the all-new CNBC TV 18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV 18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV 18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and for the Global Lens at 8:30 p.m. Welcome back to Mid-Cap Radar. Well, one particular stock that is surging despite the kind of volatility that you're seeing in the broader end of the market is Hindustan Copper. Nigel focuses on Hindustan Copper in our special segment, Mid-Cap Spotlight.
Well, that's right. Hindustan Copper is a stock that's flying away in today's trading session, and they put up actually a presentation yesterday. They're saying most of the things that is known, but it seems that the street is excited. One factor that's playing out is in all probability, we're going to see a Fed rate cut, which is good for base metal prices. And Hindustan Copper is the only company in India that you can play if you want to play the copper prices. If you're looking at Vedanta as well as Hindalco because Vedanta's Tuticorin smelter is shut. But if you're looking to play the TCRC, then you're playing Hindalco. But to play the absolute copper play, you can only play it via Hindustan Copper. To give you a few details, it's the only copper miner in India. It accounts for around 45% of India's copper ore reserves as well as resources. Now, if you look at the per capita consumption, which is up for you on the screen, India is relatively lower in comparison to our peers. So what's being highlighted is there's immense potential from here on. Whether you talk about EVs, data centers, they all find their usage in, with regard to copper. So that's why India's per capita consumption could move up from here on. Moving to the company-specific details, well, they're looking at increasing their capacity by close to around 3 times. From currently around 4 million tons odd, they are looking to increase their capacity to around 12.2 million tons, which is encouraging. That's telling you that there is a growth plan from here on. Moving to the capital expenditure, they have put it in that presentation that for the next 5 to around 6 years, the total capex spend will be around 2,000 crores approximately. And they've already signed up various MOAs with Indian PSUs, whether it's RITES, whether it's IOCL, Coal India as well as GAIL. So we'll have to see what comes out from there. Basically, they have outlined their plan from here on, the capex, the capacity increase as well. In fact, we had the management who joined us around 20 days ago, and they gave us a few details. They say in terms of their volumes, that's likely to grow by around 20%. The margins are likely to hold at current levels, which is around 40% approximately. And in terms of their capex, they said around 3,500 crores is what they earmarked. So the bottom line is, Hindustan Copper buzzing in today's trading session. Valuation-wise, it's not cheap. But the presentation and the prospects of a rate cut seems to be exciting in the street. That's why the stock is flying away. Back to you.
Okay, take that point. That's Hindustan Copper. Thank you so much for explaining that to us, Nigel. With that, we'll move on now to a CNBC TV 18 exclusive. Sources tell us that a revision in motor third-party premiums is expected this year. Yash joins us with all the details. Yash.
Well, considering what has happened, as far as GST on health insurance and the second-year impact of GST cut on auto industry is concerned, this will be quite crucial for the industry to watch out for. That is the revision in the motor third-party premium. What we've been given to understand is that, it's taken some time, it's taken long, but a motor third-party premium is indeed expected to come for this year itself. The government is looking and working, in what fashion this hike in motor third-party premium can be executed and delivered to the industry. But at the moment is still awaiting certain responses from various stakeholders as far as this particular matter is concerned. There are 3 important points on which stakeholder responses are awaited, and what we've picked up is that the first point is that the government wants to know, this is the Ministry of Road and Transport, wants to know whether it is a lump sum increase which the industry wants, or a graded increase for the next few years is what the industry would find more beneficial as far as motor TP hike is concerned. The second thing which the government wants to know is whether there's a re-examination and hike which is also required as far as motor TP or third-party premium for 3-wheelers is concerned. And finally, drivers who have cases of violations, traffic violations against them, should they be charged a higher premium or not? These are certain important questions which the government is expecting some feedback on as far as stakeholders concerned. But importantly, a motor TP hike very much on the table, being worked upon by the government for the current year itself.
Thank you so much, Yash, for joining us. So, motor TP hike in the current year is very much on the table. That's the key takeaway. And a lot of these stocks in focus, ICICI Lombard, Go Digit, as well as New India Assurance. Well, what's actually happened in the last 20 minutes or so is the fact that the market has seen a bit of a downtick, especially in the broader end of the market. Some of the auto ancillary names are seeing some selling pressure emerge. Look at names like Bosch. That particular stock has moved to the lower point of the day. Throughout the trading session, we've seen some pressure come about as far as the realty names are concerned. So look at Prestige Estate, look at Lodha, all of these names actually under a bit of pressure today. One stock that's actually moved to the high point of the day is ICICI Bank. That stock is holding the fort as far as the Nifty Bank is concerned. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
very good afternoon. Welcome to Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, it's a good Friday that's coming in for the markets. As of now, we're seeing 25,100 levels is what the Nifty is managing to hold on to even as of now. Looking at it, Nifty is up, how much? 115, 16 points as of now in the trading session. Sensex up almost 400 points. Approximately is what we're watching out for. Broader end of the market performing in tandem with the benchmark indices. Not much of a difference there, right? Mid cap is up 0.3%. So that is what we're watching out for. Small cap is up 0.5%. So in line with the benchmark indices. Keep an eye out on that. Let's look at Nifty PSU Bank as well, right? Because I think that's the one that was a bit subdued in today's trading session. But do not forget that this was the one that was gaining also in the last few trading sessions. So yes, some bit of that profit booking maybe we could see coming in on this side. But Nifty PSU Bank is something that is subdued in today's trading session. But that's the market setup that we are watching out for today. But your stock-related queries, that's what we'll be solving in the next 20-30 odd minutes. And to do just that, we do have Shaina Mukaddam, independent market expert, as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, to answer all those queries. Shaina, as well as Vaishali, good afternoon. Thank you so much for joining us. And Shaina, I'm happy that you're here this Friday again to party with me as well. Wednesday was surely there, but Friday, glad to have you back. Let's get started with those queries then. And the first query for today we have is coming from Saket, who's writing to us from Hyderabad. He's holding 219 shares of Jupiter Wagons. The price is 445 rupees per share. They're making a loss on this one. Wants to know the future prospects of his investments. Jupiter Wagons, Shaina, your view coming in for this railway company. What are we watching out for? While concerns around, the execution seems to now be easing off. Recently, we've seen a bit of a run-up this week for Jupiter Wagons. That's some order wins as well. Now, what should we watch out for? And could they actually achieve their 445 buy price anytime soon?
Yeah, so good afternoon, everybody. And Vinny, thank you very much for having me on your show. I really enjoy talking to not only you, but your viewers also. They are pretty smart, callers and, the questions. So which actually enables me to learn, more than anything else. So that keeps me interested. As far as Jupiter Wagons goes, I feel that, your point that, the stock did move up because of the order win of about 113 odd crores that they had recently. But at the same time, I think this opportunity for a bounce should be taken to switch from Jupiter Wagons. A couple of issues. One is that valuations are expensive. If you look on EB by EBITDA basis, it is about 25 times, which in my view is quite expensive. And secondly, the financial performance has been a bit, variable. First quarter numbers were a bit disappointing. And I would believe that while the long term may be good because they are expanding capacity, in the shorter term, it makes sense to switch from Jupiter Wagons to some of the other stocks in the similar sector. I prefer those stocks rather than Jupiter.
Okay. Keep an eye on those other names rather than Jupiter. Shaina has given you other options. Vaishali, your view for Jupiter Wagons? On the charts and technicals, is there any indication that maybe, they could recover that some bit of a loss and they could see some traction coming in terms of better gains or something that you could watch out for from Jupiter Wagons?
Hi, very good afternoon, all of you. So I think Jupiter Wagons technically is very well placed. It may take a little while, but I think the way the chartical presentation is, I think 300 is acting as a very strong support. And it's a matter of time. Once you see some momentum setting in, this can go towards 400 levels. But if, time is the problem, then I think Titagarh Wagon is already in a good momentum and well-placed too. So if time is not a problem, I would say stick on to Jupiter Wagon and wait for our target, and otherwise shift to Titagarh.
Okay. A shift to Titagarh also is an option that comes in there. But let's move on to the next query for today. This is coming in from Walusa, who's writing to us from Chennai. He's holding 102 shares of JSW Cement allotted during the IPO time. Now, wants to know the future prospects of his investment. His holding time period, he wants to hold it just for around a year. Shaina, your view for JSW Cements, given that this GST boost that is coming in as well for the domestic players, how should one view JSW Cements, sir?
Yeah, so the GST reduction is going to be a positive for volume growth for the overall sector. And also in terms of average realizations also, I think it would be better in current year FY26 versus the previous year. Having said that, I think, shorter term GSW cement is more or less fully priced, but I would continue to suggest to continue to hold for more than a year, I would say, because currently the capacity is around 20 million tons, which they are talking of going up to about 26 million tons by end of FY26. So FY27, if you consider valuations, the average, per ton would be about $110 per ton. So which in my view is not expensive for the longer term, given the fact that they're increasing their capacity across India, west, south, so and east, they already are there. So I would say you continue to hold for the long term. Shorter term, you may see certain, fluctuations. You may continue to see it consolidate.
Okay. And Vaishali, I know it's not enough in terms of charts, but any view that you have here?
Well, I would say, of course, there is limited data and it has hardly shown any trend or any movement. But still, with whatever can be gauged from here, this stock is purely into consolidation. Only about 154, there can be some strength seen. And then gradually we can go step by step, look forward to a target of 165. And then on from there, if there is further strength, to 180 to 190 levels. So for now, it's a hold with a stop loss of 138.
Okay, hold with a stop loss of 138. That's the word on JSW Cements. Keep an eye on that. Let's move to the next query for today. Avanti Feeds, that's the stock that we'll talk about. Debalina is writing to us from Kolkata. It's an investment query and she's asking if she can buy the shares of Avanti Feeds for the short term, and she wants to know the target also. Shaina, Avanti Feeds for the short term this week, we had seen all these stocks buzzing in trade as well, right? There was some announcements that came in from the EU side. What are we keeping an eye out on? Avanti Feeds, or would you look at any other, the shrimp exporter companies?
No, I would avoid this whole sector.
Okay.
It is better to avoid, catching a falling knife. And we really don't know where the US tariffs are going. And US is a big market for Avanti, especially given the fact that 70% of their revenues come from there. And if the current tariffs continue, so average what they were paying is, if you include duties, tariff, etc., it was about 10% on an average. And that will now go up to almost 50%. So in my view, it's like a risk. Well, Q1 numbers were decent, but I would say that, better to switch and avoid entering into the sector altogether for now.
Okay, avoid the sector as of now is the word from Shaina. Vaishali, any short-term targets that you should keep an eye out on, or for you also this sector is something that you're avoiding?
In fact, it's a little bit different to what Shaina is saying, because sometimes, market always preempts as to what is to come. So purely on technical terms, I would say it is showing signs of reversal. And if it is for a short-term view, well, one can always get into a disciplined trading. 680 is the support level. So ideal level to get into the stock is 680 and keep a stop loss of 650, because there can be further strength above 750. That is a tough resistance, what we witnessed just yesterday. So it has not managed to move past that. So I would observe a range of 680 to 750. Beyond that, that could trigger further strength going towards 800, 830. So this is how I would manage this trade.
Okay, different views coming in there, but keep an eye out on Avanti Feeds and the levels that, Vaishali has mentioned right now. Let's move on to the next query then for today. We have J. Surya Das, who's writing to us from Patna. He's holding 830 shares of Fusion Finance. This is at a price of 330 rupees per share. Wants to know whether to hold or look to sell this one. Fusion Microfinance, Shaina, what's your view coming in for this one?
I would say, though he's making a loss quite a bit, but at the same time, it is better to exit and switch. It's largely into, microfinance, and, it's a north-based NBFC. Here, they are facing certain problems. They had some repayment problems also on their debt. And because of which, I think they did a rights issue very recently at about 131 rupees per share. So they would have some money on their hands. But I think it's a high-risk story. And into microfinance, I don't even really, while the sector is looking up, I think it's better to switch. Valuations are not cheap even at current levels. So I would say switch or exit.
Switch or exit, that's a word coming in from Shaina. Vaishali, for you, Fusion Microfinance, what should they do? 330, right? It's like a very high price that they've bought it at versus what the stock is right now.
Well, so of course, my priority would be something like a Bajaj Finance or so on. But if you're already there and you are in a loss, I think wait for a bounce. Keep a stop loss of 170 because it is right now, technically sitting on a cluster of support of moving averages. So I would say hold on and exit in a bounce. And then from there on, we can have a relook to get into the other stock.
Okay, surely keeping an eye out on those levels over there for Fusion Micro, but Switch is a better option. That is the word coming in there. But that's the word on Fusion. A quick check on what the market has done in the last 10 or 15 minutes as well. Nifty is where it is, right? 110 points up. But there are a lot of individual stocks today that are buzzing in trade as well. And in the last few minutes, I just want to pull up one chart. GMDC, let's pull that up, right? Gujarat Minerals. That's the one that's suddenly seen a spike up as well. It's 2% up in just the last 10-15 odd minutes, right, when I'm checking right now. So that is important to watch out for GMDC. Look at it. It was up, then it fell down, and again it's come up. So let's keep an eye out on that. JBM Auto, that's still continuing to trend in today's trading session as well. So that is managing to hold on to gains. 14% up now in trade, 14-15%. So that is another stock that we'll be keeping an eye out on, but that's on the back of news flow that it's buzzing in trade. On that note, we'll slip into a very short break. Don't go anywhere. We'll come back and, here's some good news that is coming in for our viewers as we're slipping into the break, because India's business news leader is now a click away. Introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV 18 app from the Apple Store, Google Play Store, or you can just scan the QR code on the screens for you. Welcome back to Your Stocks on CNBC TV 18. We still have with us Shaina Mukaddam as well as Vaishali Parekh. Before I come to the next query, I just want to also highlight the defense names, right? They are buzzing in trade as well today. Look at the defense pack. Whether you look at a BEML, Bharat Dynamics, or even Data Patterns, all these names, all defense names, are surely managing to hold on to very good gains, almost 5 to 7% gains. And other than that, we have, Mascow Dock, Garden Reach Shipbuilders, even those shipbuilder stocks. That is also something that is managing to hold on to gain in today's trading session. So keep an eye out on these names in the last hour of trade as well. But let's move on and keep it going with the stock-related queries. A sector that's been buzzing for a while is going to be the EMS play, right? So this next query is coming in on Kaynes Technology. We have K. Narayanan, who's writing to us from Telangana. He's holding 40 shares of Kaynes Technology. This is at a price of 6,100 rupees per share. Short-term targets is what he's watching out for. China Keynes Technology, there seems like it's just a short-term holding that they want to talk about. Your view on the short-term for Keynes?
Well, I would say short-term, I still think that the stock may correct a bit. So you have the buying price that he has got, that could be, that is a worst case scenario. And short-term also valuations are a bit expensive. If you look at the very short-term next couple of months, it's okay about 55 times P. So FY27. So yes, it is expensive, but I would say that continue to hold for a slightly longer period, a year at least, because the plant at Sanand, which is their OSAT plant, the semiconductor plant, is likely to come fully on stream in I would say January FY26, 2026. So I would say that hold, because not only are the revenues for current year targeted around 4,500 crores from the existing EMS, but going forward over the next 3 years, this new plant also is expected to double the revenues with decent margins. So I would say keep a long-term holding period. Don't be short-term in this stock.
Okay. And don't be short-term in the stock. It's a long-term story, and China recently we also had the management, so they also were saying that, for FY30, they were guiding on 1,800 to 2,000 crore PAT is what they're watching out for. They're talking about, expecting revenues of 1,500 crore just from that semicon side of the business by FY28. So all these are some of these triggers that maybe could work out. Valuation is one play, obviously, we have to keep an eye out on. But a long-term story is what China is also highlighting. Vaishali, for your chartical point of view, short term, are there any triggers or targets that you would like to give them, or would you also say long term is a better story to hold on to? If you could give us both the targets.
Yes, so short term, I would not recommend a buy at least, but to those who are holding, even for a shorter term period, I would say keep a stop loss of 7,000 because it's already got into a very strong uptrend. The ideal buying opportunity was at around 6,000, 6,500 levels, So right now, I would say continue holding with a stop loss of 7,000 because if the momentum still continues, this can go towards 7,300 to 7,500. And long-term perspective, well, it is very likely to cross the previous high of 7,800, and we have the next projected target of 8,300. So that's the way to go about for this stock.
Okay. Keep an eye out on those levels over there. Next query for today is coming in from Selva Kumar, who's writing to us from Bangalore. He's holding 690 shares of Karnataka Bank. Price is 216 rupees per share. So they're making a loss on this one. He's asking if you should remain invested for the next 1 year or exit at current levels, or even maybe look to average also. Shaina, what's your view?
The stock has actually corrected a bit in the first quarter because of the changes in management. The senior management had exited. But I think things are changing. We have Mr. Bhatt who's come on board now as the MD. And valuations are very attractive. I would think in the private sector, of course, it's a small cap bank, but it is really cheap. It's just about less than 0.6 times price to book. And in terms of growth, they are targeting good numbers. They are talking of, 1 year down the line or 2 years down the line, 85,000 crores type of book. So I would say continue to hold at current levels.
Continue
can
to
average also.
Okay, can average and continue to hold at current levels. Vaishali, your view for this one. What is the target now for Karnataka Bank?
Well, I would say it's showing signs of bottoming out. So I would say you can add more at these levels because all the PSU banks have really not participated. And talking about Karnataka Bank, we have already seen a good erosion. So I think downside risk is very limited. At these levels, it's currently at a support level. So keep a stop loss. I'll tell you precisely, it is showing signs of bottoming out, a rounding formation at 170. So keep a stop loss of 170 and either add more or hold.
Okay. Add more or you can hold, keep a stop loss also is what Vaishali has indicated as well. We just have Texmaco Rail, let's pull that chart up. They've bagged an order of 129 crores from RVNL. These railway stocks in the recent week, we've seen a lot of order wins that have come in, and right now Texmaco Rail is up almost 3%. So keep an eye out on it. After that order win, we saw a bit of a spike up that's come in for Texmaco Rail. Shifting focus back to those queries that you all have sent us, we have Praveen Kumar who's writing to us from Kerala, and he's asking if he can accumulate Himadri Specialty Chemicals in every dip for the long term. Shaina, your view for this stock?
Yeah, that would be a good strategy to accumulate at dips, because maybe for the shorter term valuations may look about 20 times EV to EBITDA, which is not cheap. But and the first half also is likely to be a bit weak. Even the quarter was weak in terms of revenues. Profits were decent because raw material costs, crude oil prices were lower. So they had the benefit of that. But second half, the capacity constraints that they are facing is likely to be sorted out. And also with OEMs, the demand for auto picking up, the other raw material that goes in over there also for tires. So that actually should be a positive for the second half. I would say you can continue to accumulate at lower levels and hold it for a year plus.
Okay, that's a view coming in there. Accumulate at lower levels, hold it for a year or plus over there. Vaishali, your view?
Well, I would say so, that continue to hold. My views are the same as Shaina's. But I would say the strength on a technical front would be confirmed above 500. So till then, it would be a sideways move, but above 500, it would trigger a good strength.
Okay, above 500 is where it could trigger a good strength. But does this make it a right price to buy right now on the technical front? Is it okay if they start adding?
I would say so, because 440 is a triple bottom formation right now, if you see the near-term support. So that acts as a very good support level. So risk-reward ratio also is quite favorable at these levels.
Okay. Next query is coming in from Narayan, who's writing to us from Bangalore. 200 shares of Tata Tech. Average price is 857 rupees. Still making a loss on this one. Tata Tech, Shaina?
Yeah, it has been a disappointing performance for a stock which is led by such a strong management. But the valuations remain expensive. That is the biggest problem. If you look at it in terms of growth, the growth is subdued. Mainly because they are suffering in terms of their services business. The other business part is good, but it is facing a bit of a slowdown. So I would say that yes, you can switch. You can switch to something like an Emphasis, which with a market cap of around 55,000 crores, the valuation is also much better placed. So I would say it's a switch.
Okay, switch and Emphasis maybe is also a better place. Story is what Shaina is highlighting. Vaishali, your view for Tata Technologies, right? On the charts and technicals, what should they be doing? And they've given an average price, so I'm assuming they've already done some averaging. Does it merit averaging more, or any levels that they should keep an eye out on now?
I would say hold on, because it is showing signs of improvement even on the weekly chart. So I think for now, it's very likely that this person will get its buy price that is at around 800 levels. That would be a level to watch, because if we see some exhaustion over there, then that means the stock doesn't have so much of a strength. But if it sustains above 800, then I think it's ready for a takeoff.
Okay. Keep an eye out on those levels over there as well. Continue to hold. That's a word on the technical front. With that, actually, we're out of time on this edition of Your Stocks. So, Shaina as well as Vaishali, thank you so much for joining us as always, and hope you all have a great weekend. And viewers, thank you so much as always for tuning in. Happy weekend to all of you all as well. But remember that email address on top. You can send us all your stock-related queries, and we'll get them solved on Monday, Wednesdays, and Fridays at 2 p.m. Thank you so much for tuning in. Up next, you have Closing Bell now to take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Carrying on from where the US markets left off last night, it's a positive start to the Asian screen as well.
Nifty is at 25,000. It probably is going to meet some resistance around the 25,150 mark. 70 to 80 points higher on the index. The mid-cap index is actually doing slightly better.
Consumer staples are well penetrated across India.
The reforms have actually come at a time when the food inflation is very high for us.
This market was being driven or is being driven really by price agnostic domestic flows.
We are at the day's high, comfortably above the 25,100 mark for now.
The volumes yesterday were approximately double the 30-day average for BSE, Angel One and Novama. 361 WAM was, of course, an exception.
Now they're going to make an announcement of a preferential issue as well. So they're going to raise money via equity.
You have about 3% of the households who I would say have the purchasing power of the West.
Ending the week with the markets ending on a positive note. For today, at least so far, Nifty is above the 25,100 mark.
Good afternoon, hello and welcome to Closing Bell. We are here to count down the last hour for the day, for the week, and for Nigel's birthday party to begin. And we were discussing some historic trends in the morning that the market usually ends up closing in the green on Nigel's birthday.
On 12th of September.
On 12th of September. Looks like the trend is intact for now.
I'm the lucky charm. I mean, it'll be great, right? I mean, and if it goes into the red, then it's because of Surabhi.
Nice.
But good to see. You know, the screen is looking pretty okay. And the most encouraging aspect, Surabhi, for this week itself is at least the markets are keeping in step with the globe. Otherwise, the globe is parting and we are missing out.
Yeah.
So that's good, right? I mean, we're keeping in step. Maybe we're outperforming some global markets as well. And it's telling you, India-US trade tensions, that's top of mind. You get positive, sound bites coming out of there, the street likes it.
Oh, absolutely. And that's what this week has been about. I mean, depending on which index you're looking at, Nifty, mid-cap, small-cap, the market's up between 1% to 2%. So it's been decent going, one would have to say. Let's very quickly talk about the movers and shakers today, this afternoon. Stocks on the upside. It's a fully powered and charged up defense rally, and we'll talk about that as we go forward. A lot of defense stocks, PSUs, small defense companies, large defense companies, private sector, everything is up. That's the Nifty Defense Index. Look at that performance, 4% up on the overall defense index. On the Nifty, that translates into BEL being the biggest gainer on the index. BEL, Bharat Electronics, up about 3.5%. The other gainers include a couple of names from the financial side. So Bajaj Finance and Finserv are having a good day. Axis Bank is up about 2% as well. So these are some of the financials. And then a couple of the big boys are firing quite well. There is L&T. There's Infosys, of course, on the buyback excitement. There's Reliance. So plenty of legs in this market on the upside. Just to explain the picture on the downside, a couple of consumer names. They continue to lose some ground, see some profit taking. So Eternal, Lever, Hindustan Unilever, Trent, Nestle. These are some of the names on the downside. Mahindra and Mahindra. Stocks run up so much over the last couple of years. So there's some profit taking coming in. But otherwise, Nigel, financials broadly looking good. And the other heavy hitters, RIL, etc., for the time being, all on the positive side.
Well, that's right. Surabhi, a lot of stocks moving around. By the way, Advent has entered into an agreement to sell Zentiva to GTCR. I think that's what... that
was the rival entity that was looking to acquire. So it seems that this acquisition has not gone Aurobindo's way.
All right. Yeah. So we'll have to, we'll just get some clarity on that front. For the timing, let's run you through what we have lined up on the show on Closing Bell. Friday cheer playing out on Dalal Street. Nifty consistently trading above the 25,100 levels. The sectorial gainers include metals and pharma, while PSU banks and FMCG, well, they are on the back foot. Shares of capital market plays up and about in trade today. A shift to fortnightly expiry and separate settlement seems to likely be priced in scenario. That's what global brokerage firm Jefferies has to say. An impact analysis coming up on Closing Bell in just a bit. Hindustan Copper unveils a 2,000 crore rupee capex for the next 5 to around 6 years with ambitious capacity expansion plans inside. The stock is surging in today's trading session. And among other gainers, JBM Auto secures $100 million funding from International Finance Corp. The stock skyrockets. All right.
Just on this, since Nigel, you were referring to the flash on the screen, why this is relevant for Aurobindo Pharma is because earlier this entity, Zentiva, and this is a US-based pharma company. Earlier, there was a lot of buzz about Aurobindo being in the fray. And this was always going to be a very, very large acquisition. So there was a lot of nervousness around it. But it seems that Aurobindo has decided to take a step back. And it is another private equity firm, GTCR. It's a private equity firm. They have gone ahead with the acquisition. And it's a large one. I think roughly, the valuation is just below $5 billion. It's a giant one. Aurobindo has not done it. And we saw this yesterday as well. I mean, when this news was doing the rounds yesterday, it wasn't confirmed. There was a bit of a relief move on the Aurobindo stock earlier this week as well. For the time being, Aurobindo is just making it official to the stock exchanges, I believe. So that's how it has played out. A lot of M&A talk this week, right? From Tega to, this one at least is not, gone in the Indian company's favor. But M&A top of mind.
Well, that's right. A lot of M&A actually, Surbhi. Even if you look in the last 45 days, we've heard of Tilaknagar Industries as well, right? They went ahead and, they acquired Pernod's Imperial Blue. And Tega, after that large trade that took place, where around 3%, I think 0.6% equity did change hands, the stock actually has recovered from the low point of the day. I think sometimes these block trades are what is in the works, and then in fact to see the stock running away. Tomorrow, I think, is the big meet where they have to go ahead and raise some money. $250 million is what they're looking at raising. The promoter is going to be participating. Apollo is going to be participating. I've heard various other names, but we'll wait for the confirmation tomorrow. And what sort of a role does the acquired company, that's Molycorp, have to play in this particular fundraise as well? All of that top of mind. How do you position yourselves on the final hour of trade? Mitesh Thakkar from Bonanza Portfolio joins us on the show. Hi, Mitesh. Good afternoon. Pretty good trading session. Tell us more.
Oh, yes, Nigel. I think it's going very well. We did make a high of around 25,114, slightly tapered out, but I think the overall structure, if you look at the hourly, 2-hourly chart, even the daily chart now, I think it started to improve, which means that while 25,150 is a historical pivot, we had the high there around 21st of August. But I think 25,150 will be crossed, and we should now prepare for 25,260 to about 25,320 as the minimum. I think once we cross 25,300, 320 zone, then I think the market might accelerate much higher, but I'm not sure whether that will happen now. But at least that level looks like gettable, and that's where the index most likely is heading towards. So with that kind of view, trade with more of long buys. Though after, I think, about 3-4 days, I have one sell call right now and one buy call. Bosch, which had a very good rally in the last few weeks, is showing first signs of profit booking and correction. So sell here with the stop at about levels of 40,350 and look for a target of around 39,000. HPCL is on the buying side. Keep a stop at 393. Look for targets of 410, 411.
Okay, all right, got that. Mitesh, thanks very much. We'll come back to you for some more trades and more ideas in a bit. For the time being, let's put the spotlight once again on the capital market related stocks. Remember yesterday, BSE and a bunch of other brokers like Angel, etc., those stocks had fallen 4-5%. And this is after our colleague Yash put out that story that SEBI could be considering completely doing away with the weekly product, weekly options expiry. And perhaps the regulator would want to move towards just a 1 monthly expiry day. So I think Jefferies has done some analysis on what this will mean in terms of business impact, whether it's capital market stocks, the brokers or the exchange itself. We've got Vamakshi joining in with the details of this. Nothing official on this as yet. There is a SEBI board meeting, of course, today. But as of now, what are Jefferies' numbers saying, Vamakshi?
Well, absolutely, Surbhi. Jefferies has conducted a scenario analysis of, in case the weekly expiry is done away with. So the first scenario that they've created for BSE is if the expiries move from weekly to fortnightly. Now, out here, they're expecting the industry index options notional average daily turnover to decline by almost 55%, while the industry premium ADTO could see a dip of almost 45%. Within this fortnightly expiry as well, there are chances that, the expiry could be on the same day. That is what Yash had indicated yesterday. So they've again created two scenarios out here with the expiry on different days as well as the expiry on the same day for both the exchanges. Now, in case of the former, the market share is likely to remain stable at 29%. But in case if the expiry day becomes the same for NSE and BSE, there could be a fall of almost 900 basis points to 20%. Now, as far as revenue is concerned from the option segment, if it's on different days, a dip of almost 38% is expected, which would result in a decline of almost 22% in revenue and 21% in net profit. While on the flip side, it would be much larger if the expiry is on the same day, a decline of almost 57% for options revenue, resulting in a 33% dip in the overall total revenue and a 35% decline in the net profit. Now, the other scenario is of that of a monthly expiry. Out here, the fall is expected to be much larger. Industry notional ADTO could fall by almost 80%, while the premium could decline by almost 70%. And again, two scenarios out here. Now, if the expiry is on different days, the market share is likely to remain stable at 29%. Options revenue for FY27 is expected to dip by 67%, and the net profit is also expected to see a decline of almost 41%. Whereas, if the expiry is on the same day, the impact is expected to be the highest amongst all scenarios, wherein the market share is expected to decline to as low as 18%. The options revenue is expected to see an impact of almost 80%, and the net profit could see a dip of almost 50%. So this is the scenario analysis for BSE. They've done a similar scenario analysis for Nuvama as well, and they believe the impact would primarily come in on its asset services segment, and if the expiry shifts from weekly to fortnightly, the profit impact could be around 15%, and if it's a monthly expiry, it could be much higher, 25%. So just to sum it up, the potential impact on BSE could drive an almost 20% to 50% cut for FY27 EPS estimates, while for Nuvama it ranges between 15 to 25%.
Those are big, big numbers, and I mean, yeah, it would be really painful if these scenarios indeed play out. Vamakshi, thank you very much for that important analysis. We'll keep that at the back of our minds till this, becomes finally clear. Well, let's welcome in our first guest on the show. We have Deepak Shenoy of Capital Mind joining in. Deepak, always great to have you on. Rarely is it that you have something as big as this continuing to be as uncertain as it has been. F&O regulation. Now, it's been weeks and months, and we've changed and we've moved from expiry on Thursday to expiry on Tuesday, and now we don't know if it's weekly or if it's going to be fortnightly or monthly. So one just hopes that there's clarity once and for all. But like our colleague was pointing out there, I mean, this has serious business implication for stockbrokers, for exchanges. What would your advice be on this segment, given, the way the stocks ran up? They've cooled off from the highs, but still, I mean, they're seen as long-term wealth creators.
Yeah, I mean, I don't disagree with the long-term wealth creation concept, Surbhi. I think the idea of owning an exchange where transactions will happen regardless, and now that we could argue on the type of transaction, whether they'll be F&O or running perhaps in the phone call oriented, which is what used to happen earlier in equity and now happens in debt as well. But the F&O piece specifically, I think it's, come from a worldwide concept where we've seen the US see a lot of 0-day to expiry options, which is why a lot of weekly expiries came on different days of the week. That was, I think perhaps a little too complicated. And remember, it's only indexes that seem to have mattered here. Stocks, individual stock expiries don't happen on a weekly basis. So there is very little meaning for players like, say, us, like mutual funds, to participate in weekly option expiries at all. So institutions, by and large, stay in a way. It's mostly retail and HNI and prop traders who are doing this, and obviously FIIs who seem to, kind of do an arbitraging kind of a position, and sometimes what seems to be more than just arbitrage. I would say here that it's suspect about how much actual liquidity it's adding to overall markets for all players. It's adding liquidity for a certain set of players on a weekly basis, but that does not meaningfully contribute to institutional volumes. But having said that, I think you're right in that business implications are high if they removed this entirely. And given that the amount of regulation has already been put in, I don't know if there's any need to put in more regulation to remove this entirely. They've come to a much lower number now, and Tuesday and Thursday seem to be fine. NSE just wants more days. For Tuesday, you get Friday, Monday, and Tuesday. For a Thursday expiry, you get only Wednesday and Thursday because the other exchange takes the other 3 days. So NSE does tend to get a little bit of benefit by having Tuesday as their expiry day. But by and large, I expect this to continue, at least unless you get to a point where this becomes a social problem and therefore a political one. Otherwise, I don't see this going away meaningfully.
Okay, all right. Hi, Deepak. Good afternoon. Good to see you. And as always, what about tech? Is it a flash in the pan, or do you think it's good for more? You know, there's a bullish, equally bullish and bearish argument, because the bullish argument is the balance sheet is clean. You have some kind of buyback, some kind of stock price support. Valuation-wise, things are pretty okay. If you look at the cash flow as yield, or you look at the dividend yield, or all of those things. The problem is growth is going to be very, very subdued, and there's still a lot of uncertainty. So should they be trading at these sort of multiples? Which camp are you in?
So I think one of the reasons they trade these kind of multiples, Nigel, is the fact that, relatively speaking, their float is taken away because a lot of the mutual funds and FIs want to own these stocks. They're relatively large stocks. They have extremely good ROEs. That's why they pay these dividends. To a large extent, if you're not able to utilize the cash and you're actually a cash generating machine, you actually have to give back the extra cash that you have, because if you do need more cash, it's coming in from future projects and so on. Of course, you could argue that they could invest this into something else, but by and large, I think the past experiments of investing into products for many of these tech businesses, IT services businesses, hasn't worked. So I would say here, some of the smaller players that were venturing directly into products themselves, doing acquisitions around productized plays both in domestically and internationally, they might end up getting a higher margin downstream, but they'll still be small players compared to these larger IT tech firms. So I'd say over here, the answer is going to come from when the tariff situation kind of evens out and businesses are willing to expand and spend more and outsource more. This will still take some time, but I feel that by the end of this year, we'll get more clarity. And till then, tech is not going to be so nice in terms of returns. But once you get there, you have the potential to do different types of acquisition, different types of growth, not product-led, but more service-led. That's when I think we'll see more action from tech companies. Till then, one just has to have patience. These companies aren't going to go bankrupt because they simply don't have any debt.
Got it. All right, Deepak, what's really twinkled this week and in the past 2 weeks is the metal space. And, one of the reasons that metals are coming back is because the street is bracing for that Fed rate cut. And normally it has a positive impact on base metals. And obviously the hope is that consumption as well perks up. Now, Hindustan Copper, a stock that is corrected from 400 rupees to around closer to around 200 rupees, that's rallying in today's trading session. Now, first, let's just tell you about the basics. Copper demand boosters, you have affordable housing schemes that are being pushed forward, rural electrification, renewable energy, electric vehicles, focus on urbanization. All those factors are playing a role, right, in terms of demand. What's giving demand an additional booster shot? AI, artificial intelligence, and rising military spend as well. Those are the two other kickers that are playing out. Now, late last evening, Hindustan Copper went ahead and they uploaded a presentation. I'll tell you what, the management has been silent for many, many years. Now, at least they're doing interactions on TV. They're putting up presentations. The street likes it. Let's run you through a few points. Hindustan Copper is the only play you can have on copper prices. Hindalco plays on the TCRC. That's a treatment and refining charges. But Hindustan Copper is the only pure play on copper prices moving up or down. It's the only copper mine in India. It has access to about 45% of India's copper ore reserves as well as resources. Next up, the per capita copper consumption in India is much lower in comparison to the world consumption, and that comes up for you on the screen. So the hope is there'll be some kind of catch-up. Hindustan Copper, on their part, they are doing their bit. They're going ahead, they're increasing capacity by close to around 3x from around 4 million tons. They're increasing it to around 12 million tons. They've told us about this in the past. And the capital expenditure that they are looking at is around 2,000 crores in the next 5 to around 6 years. And additionally, they have also signed various MOUs with Indian PSUs to expand mining portfolio, whether it's with RITES, IOCL, Coal India, as well as GAIL. And finally, we had the management here on CNBC TV 18 in in the second half of August. That's around 20 days ago. And they said that on volume growth, they're guiding for around 20%. Copper prices, they're expecting it to hold at current levels. Margins, though, profitability, they have been delivering around 40%, and they're saying they can hold at around 40%. And the capex spend that they've earmarked for this year is around 350 crores. So a bit of a demand booster shot. You have a Fed rate cut that's in the offing, and copper prices that are perked up a little bit. All this contributing to Hindustan Copper up and about. Deepak, what do you have to make of Hindustan Copper? Very difficult to justify Hindustan Copper even at current prices, but the street is looking ahead. They are saying the 6-7 rupee EPS per share is going to go up drastically. So current reckoning is 40-50 times odd, but they're saying that EPS can go up. Hopefully it does for those that are buying the stock. But what's your view?
So at 50 times earnings in general for a metal company, I would just say that, it's difficult to, and I can't comment on individual stocks over here, but in general, the metal space gets single-digit Ps over a long period of time. So remember that Ps in metal companies in general are low in bullish times and high in bearish times. So relatively bearish times, their Ps will be high, and in bullish times, the Ps will come down. So even if you grow earnings and your P comes down, you don't get a magnificent, price growth from here. So, other than an opportunistic trade that is relatively short-term in nature, when you might see a pull up from maybe from inflows or from sentiment, I don't think long-term copper has a meaningful role to play in general, because any company can make copper, and while you may not get the only copper miner in India may be one person, but there may be also imports of copper that will happen simply because copper is, it's just copper is copper. So unless your copper is not better than my copper in any meaningful sense, so I don't think that becomes a sustainable advantage. So short term maybe, but I wouldn't play metals in general for the long term. At this point, I haven't analyzed, this company or looked at it in any meaningful way, but I would just say be wary. This is more a short-term play than a long-term one. And in general, when a company that does not do presentations for a long time suddenly starts doing presentations, I'm just more cynical about it than otherwise. But hopefully this is a good thing and it will last. So if it becomes a continuous approach, it's a good thing.
Maybe it's a PSU finally getting its marketing act together. That's another way of looking at it, right? You never know. They realize they have to savvy up to give investors what they want. But I take that cynicism. Deepak, the other space, I was just looking at the stock JBM Auto. We've been tracking it since morning. It's really flying. 15% now. They've got funding to get more EV buses. How are you looking at autos as a theme? I mean, there is the overall GST, so everything in autos is now running, components are running. And then there are, players which have a clearer EV play to them. For instance, a JBM. What part of auto would you want to play in a more durable way?
It's a good question, Surabhi. In fact, I think right now the whole auto pack will do well, because anything that's 10% straight away off of your prices is going to cause demand to come back, and demand hasn't come back, to be fair, for the last 6 or 7 years, especially in four-wheelers. For the buses and all that stuff, one of the problems in EV in general has been the acceptance ratio and the rate at which growth has been coming, mostly because these are buses bought by state transport departments and so on, has been relatively slower than I would have thought. I thought by now they would have been very excited about taking a lot of buses on, but we've seen that penetration has not been quite as high. So it's nice, and I think some of these companies will benefit in a portfolio that you have for auto. Having some of these companies is a useful thing. But I would say at this point, I'm actually bullish about all of auto, and mostly about four-wheeler personal transportation. Probably second is at the buses and trucks level, and maybe third is two-wheelers. mostly because they may not get as much of an impact from this, other than the components. Who the two-wheelers will, when they buy them, they will obviously pay lesser GST, and there will be an overall impact to this. I think in that order is, four-wheeler transportation, trucks, and two-wheelers is where this thing. Tractors, I think, independently will do well as agriculture mechanization continues its play. So I don't think, the GST impact will be as important for it, but they will be a separate track itself. They're not as much retail demand as anything else.
Okay, all right, Deepak, thanks a lot for joining in. Wishing you all the best, and we look forward to having you on the show yet again. Good weekend ahead, Deepak. Time to slip in a short break. But on the other side, we'll bring you excerpts of our conversation with the big influential investor, Mr. Manish Chukhani. Stay with us. Welcome back. A few stocks actually are bucking the trend. Tega is definitely deserving special mention. I'm not sure who would be part of that large trade. Tomorrow's the fundraise. But Tega has actually recovered close to around 4% from the lows of the day. We had the management yesterday. They had a con call earlier today. At the day's low, the stock was down more than 5%. So it's pulled back a goodish bit. And from the broader markets, I think Vascon is another stock that's moved up on rather good volumes. Another big underperformer that as well is finding its way up. But we have Hormuz who's joining in. He puts the spotlight on some of the big movers of the day. Hormuz, besides you, what all is moving?
It's a weekly special today. It was a bit of a dilemma today to choose either between the weekly names or the daily names, because the daily ones have had some insane volumes today. But we'll keep a balance of both of them. Look at MTAR Tech. It's up 10% today. After the management spoke to us yesterday, the stock has been on a tear. It's up 20% this week. The best since September of 23. The weekly volumes are the highest since December of 24. Even in today's session, more than 24 lakh shares have changed hands, and the 20-day average is only 90,000 shares, and it has broken above all of its moving averages, be it the 50, 100 or the 200 DMA after this move in today's session. The other one is SMS Pharma. We spoke about this earlier in the week. It's down today after 5 days of gains, but it's still up 24% this week, the best week that the stock has had as a listed company. The weekly volumes over 2 crore shares, which is also the highest on record, and more than 25 lakh shares have changed hands in today's session, the 20-day average of just over 7 lakh shares, but still remaining below the 52-week high that the stock has had of close to 400 rupees. Sula Vineyards is been in focus through this week. The stock is down today as well, but it's up 14% this week. But this is only going to be the third time that the stock has posted a weekly gain in the last 10 weeks. And this 14% advance for the week is the best since March of 25. And the over 2.5 crore shares have been traded this week, which is the most since February of last year. And despite having a good week, the stock remains well below its IPO price of 357. And the last one on the list is a daily mover and a weekly mover, Sigachi Industries. Now look at the volumes here today. 18 crore shares have changed hands today, 20-day average of 58 lakh shares. The stock is up close to 40% this week, the best week it had since its debut week when the stock had tripled on its listing day. And Thursday and Friday's trading session are the highest ever traded on the stock since its listing. And it has gained only in 3 out of the last 11 weeks. But this week has more than offset the losses that the stock has had in the last 11 weeks.
Okay, all right. Thanks very much for that, Hormaz. Lots of buzzers today and through the week. Thank you. Well, with that, let's move on to that promised conversation. CNBC TV 18's Prashant Nair caught up with Manish Chokhani, director at Enam Holdings. Manish spoke at length over US tariffs and how the Indian IT sector needs to change its business model.
Even if you get to the 15 which the allies have, which is Japan, Korea, UK, I don't think we get to 15. But if you're at 25, and you have some way around that. Let's see, maybe we end up at 20.
Yeah.
But again, like I said...
Likely is 20 or 25? Just for the...
My bet would still
I won't hold you to it, but...
Well, I would still hope for 20, but clearly can't be more than 25. I would hope for 20. But having said that, what is this 20? If it's still only textiles, gems and jewelry, because the whole premise was that we'll be able to become friend-shoring, to bring US manufacturing to India. And if you take the India narrative of the last 10 years, what have we done? Compared to the 1990s, when we took white-collar people and put them into making pharma generics and IT, the last decade has been the, the formalization of the blue-collared guys to become a Zomato or an Amazon delivery boy or someone working for Indigo.
And I'm sure you have points on valuations there as well in terms of how we price. We should get to which piece.
Valuation is what it is. I'm just saying as an economy, you need some drivers.
Yes, absolutely. And I'm going to come to that. But I want to ask you, just to complete that point, should we still expect stuff on pharma? There has been some this fear-mongering around services. I mean, actually, in a way, I said that's our rare earth. I mean,
if you switch off the GCCs from India, you're going to hurt yourself because like saying I'm going to...
So logically, it doesn't make sense. But I think we should not think about that.
I won't worry about that.
And pharma, which is the other sectoral
pharma generics, I mean, they are so cheap that whatever they put, they'll have to bear it. So it doesn't make sense, which is why it was exempted. His problem is with US pharma and healthcare costs, which have gone completely crazy, and the profiteering. And it's very odd. If you look at the top pharma stocks there, just put Eli Lilly on a side. But Bristol Myers, Pfizer, Merck are all sub-10 PE multiples, which are innovator companies. If you take even the Europeans, Novo Nordisk, Roche, are at 13, 14 multiples. So I can't understand how Indian generics, facing this patent cliff, after which what else do you copy if there are no patents to be broken? How can we keep trading at the multiples we are trading at? Same thing with Indian IT, that we have these next few years where we have to create these data sets to make them AI enabled. But beyond that, the business models have to change from the pyramid structure of IT service companies to becoming a lot more AI enablers and using AI agents and so on.
So, this is, as you put it, this is a world market which is starved for growth. Growth is in what you call AI in that sense, very clearly. So, Mag 7 versus the other 493 companies.
Mag 6 actually now.
Max.
Because Tesla and NVIDIA have Tesla and Netflix have not kept pace. The others are all 100 billion plus profits.
So let me ask you this, and it's just something that I've asked others as well. Do you think a lack of a pure play AI kind of story here in India has hurt? Because this is the dominant, if this is the apex technology of our times and people want in, then in that sense we have IT services, etc. to offer, but nothing in that.
Yeah, that's like a slow decline. It's like, you were in broadcasting and now the world's gone to OTT. It's a slow decline. It'll still be there.
We have OTT as well. I mean,
No, I'm not referring to you specifically, but how a sector like how these ICE engines slowly have decayed in the world as the world has gone to EV. Is the same thing happening, that what worked for us in the last 20, 30 years is not going to work in the next 10 or 15. And we have to create new growth engines. And I've been saying it for last 10 years, as long as we've been speaking, that we need to have a lot more control of IP, technology, brands. And so far, for example, you see the auto guys, they are the ones who are playing the game to at least play on technology, that they can get into defense. Or like I saw this Motherson presentation where they've gone into, for example, into airline. They supply to Airbus and Boeing. They can also get into medtech. They can get into electronics because they have the core engineering skills to scale. And I've seen every country as it grows. When US grew, they became the technology leaders. Then when Japan came in the 80s, they became the technology leaders and they were bringing product to the world. Then it was the rise of Korea. Then it was the rise of China. India doesn't yet seem to have something which can go and be dominant on world stage. And we kept harping on we are the service champions. And we sort of missed a trick over there.
But I have to say this, and you would know better since you meet so many companies. And for example, you brought up aerospace. I recently spoke with the former heads of, long-serving heads of Boeing and Airbus. And now they are sort of trying to build up this aerospace ecosystem in the country.
More as MROs, right, for maintenance stuff.
Maintenance, but there's aerospace
and engineering design
also.
Yeah, but who controls the IP then? So the issue is, like, say the Indian IT guys did all the work for the big six. But the IP sat in the West. So each of the companies over there makes $100 billion PAT. Our largest company here will be, TCS will not even make a $10 billion PAT. I mean, that's the scale difference of someone who's doing work as a, how do I say, a contractor for someone as opposed to someone who actually controls the IP.
Semiconductor is a space, right? I mean, we're building packaging. There's one fab. But the point is, there is, again, I mean, we had that Semicon event. There's the second phase of the subsidies which are going to be rolled. I mean, the efforts at least are being made over the last...
I mean, look, you have to start somewhere. It's like back in the 80s, if you only had Ambassador and Padmini, if you did not come with Maruti and therefore that ecosystem got built, eventually you get to an automobile industry of some size. And I did say the coming of Apple in India was that moment for our EMS sector and the semi sector, that you'll get years of 40-50% growth. Now, it's like it happened with IT that, you priced it to 100p multiples and then, suffered for many years after that. So some of that is happening even now. And a lot of the action is happening in the unlisted space where, Tatas may be, actually emerging as the leaders over there. Foxconn and others have come and put their own factories over here and so on. But like I said, the value capture sits at the design stage. I mean, the money NVIDIA makes is more than all these fellows who will make whatever they want for the rest of their life combined. But it's a game you have to play. I mean, 10 years later, hopefully we get there. But
you have to start somewhere,
today,
as you said, right? So let's just close up this point. World starved for growth. What is your broad thesis? Money will keep chasing AI and hard assets? Is that the broad way to think about this?
So the hard asset bit is about, currency debasement. That if they keep printing money, and even now I'm amazed that the US talks of interest rate cuts at a time where their inflation target is 2x of their own target. The market's at all-time high. Home prices are at all-time high. Gold is at all-time high. Bitcoin is at all-time high. And the Fed talks of cutting rates. If you did that in India, for example, the rupee would have collapsed. The world has taken note of this, and therefore all central banks of the world have been shifting reserves away. So gold has now crossed dollar in terms of percentage holdings of forex reserves of the major economies of the world.
All right, interesting conversation there with Mr. Manish Chokhani. By the way, just keep an eye out on the markets, broader markets. We have Apollo Microsystems, that one has spiked up. And High-Tech Pipes, that's another one. There's been a big underperformance. It's half from the top. That as well has moved up a little bit. But as promised, it's 3 p.m. odd. Time for our favorite segment, D-Street Chatter. Nimesh joins in to give us all the insights that he's picking up. Nimesh, take it away.
Well, Nigel, it will be a good Friday, right? I mean, Nifty is up 100 points. We've broken first technical support or resistance of 24,950. Now, the next level to watch would be 25,200 on the upside. If that gets taken out on a closing basis, the feedback is you'll see further short covering rally. And today it looks like it's a day of large caps outperforming the broader market names and the broader market indices. So that's the kind of day which is, again, flow. It's quite mixed is what I understand. Not very large buying or selling. But at least some bit of money seems to be back on the table from larger institutions in some select sectors. I've been saying about PSUs for the last few days. That trend continues in today's market. I guess within PSUs also, you're seeing a bit of a churn now. So today is a day for the defense stocks to do well, but no specific reason per se for the defense to do well. But in general, it looks like it's a bit of a sector rotation within the PSU basket as well. A bit of profit booking in FMCG names after the recent outperformance. But broadly, it looks like the momentum seems to be back. And as I said, if 25,200 is taken out, you will see further short covering rally, especially in the Nifty names.
Okay, all right. What about individual stocks, Nimesh? What are you picking up?
Well, there are every day we have a couple of large blocks coming. So the first stock on my list today is Green Lamb. A large block, 4% equity got changed hands in the afternoon trade. And then you've seen a bit of a reaction in that stock. So it's almost a day's high. And I understand one leading HNI investor was a buyer in today's block deal. So disclosures will be quite interesting in Green Lamb Industries, the first stock. Second stock is Axis Bank. Some bit of traction seems to be back in the financial names. But for Axis Bank, it's more of HNI buying than institutional buying. And I understand some large HNI investors have been accumulating Axis Bank in the last couple of days. The third stock is Lodha Developers. We saw a bit of an uptick in the morning trade after that big announcement of getting into data centers, but that got sold into, and essentially because there are sell flows from larger FIs in Lodha Developers. And the last one is Good Luck India. I remember you doing an interview with the management, and since then the stock is corrected almost 20% last 2 days. But for Good Luck, there is some sense of indication that maybe the company is going to announce a small order win from the railways very soon. So that's the buzz as far as Good Luck is concerned.
Well, that's right. I think on Good Luck, if I'm not mistaken, railways has Nimesh is picking up, and I believe even a defense order could be in the offing. So let's see how that goes. We just spoken to the management a couple of days ago. Thanks a lot, Nimesh, for joining in and giving us all of those details. For the time being, we slip into a short break. Come back. We'll tell you all the stocks you need to buy or sell. That's what our technical experts will help us out with.
Welcome back. You're with us on Closing Bell. We've got Mitesh back with us for some final ideas before this week winds up. Mitesh, so it's been a good week, actually. Nifty's managed a 1.5% move. Individual stocks have done even better. Final advice and any stocks?
Sorry. So I think the Bajaj pins are doing well, and Bajaj Finservice caught my eye for a BTST call. Take a stop at around 2065. Look for a target of around 21. 10, 20 for tomorrow, but positionally also the stock can do well. The other stock which I like is Tata Nexi, which I would recommend taking EST position again. Giving a pullback and reversing after correcting in the last 2 days. So good levels to enter. It's a BTST with a stop below 56.95 for a target of around 57.65.
Okay, so those are some of the names to watch out for. Mitesh, before we let you go, this whole defense rally that's played out today, big move across the board, right? It's a full sector move from BEL to your smaller names, everything and anything. Mazgaon is up 4.5%, Cochin 5.5%. Anything that comes to mind? Any trades for next week here, or do you think it's best avoided?
No, I think it would be the disclaimer that I have positions in BEL, HAL, Cochin, and Garden Rich Builders. So there's vested interest. The only stock which I don't have positions in, regret missing it out, is Mazagon Dock. I think Sudarshan mentioned that day before yesterday, very good breakout and did a consolidation around the 200 average and has reversed. I think the first target on the stock is around 3,100, so still gives about 200, 240 points on the upside, and possibly we may even look at 3,350. So all these stocks are very good, but the one which I can recommend without any vested interest is Mazagon Dock.
Okay, all right, got it. So you're going to have a great weekend, given how these stocks are closing out on Friday. Have a good one, Mitesh. We'll see you with the markets again on Monday. For the time being, let's take a look at the final F&O cues that we're getting for the day. Nigel, how's it looking?
You're going to have a better weekend, right, Surabhi?
They're always, Nigel.
All right. Well, let's focus on the market cues. What's encouraging in this week itself is that the Nifty Bank, that managed to go ahead and conquer the 20 DMA, and it's still holding above those levels. On a closing basis, it can get a bit of a spurt, 50, 100 points odd. The bulls will take it positively because that's where the shorts are piled up into the system, and if that has to be a big short covering bounce. That's the index that's going to see an outsized move after underperforming in the in the last few trading sessions. Focusing on the put side, then the 25,100 put, good amount of open interest built up. You're seeing a sharp contraction on the premium of this, so keep an eye out on that. The 25,050 put as well, solid open interest built up. So put writers, they are following this market up. Remember we started with support at around 24,700. That was the start of this week. We're ending where the bulls believe that 24,900, 25,000 odd, that's the level that they want to protect. So basically, the base of the market just in the near term has moved up. On the upside, 25,100 call. Yes, the premium has moved up, I think, by close to around 20, 30 rupees approximately. From around 60 rupees, it's moved to around 90 rupees. So those call writers, they're in the money. However, now the bears will try to defend a higher level, which is 25,200 odd, given that the premium is close to around 100 rupees. Stocks that we're looking at in today's trading session, well, a couple of them. Nuvama, normally not very, very active, but today the open interest built up is quite large. So there is some fresh long addition out there. Vedanta started off the week as a relative underperformer. The global tailwind really is there for them. The street will be a little bit concerned about whether or not they're going to be very, very adventurous and go and buy, the JP assets. There are shorts in the system. For today's trading session, there's fresh buying out there because if you want to play metals, Vedanta is the way to go. That's the global play on metals. It's got everything over there. So that stock up and about in today's trading session. A few stocks did see a good amount of shorts that got built in. Whether you look at MCX, the stock had corrected, shorts got built in. Today, they're getting squeezed out a little bit, as is the case with Mazagon Dock. Shorts were in those as well, and you did see a bit of a short covering bounce that's taking place on that one. Two stocks that are in the F&O band, both RBL Bank as well as, OFSS. Indications are maybe they continue to stay into the F&O band as well. There is some shedding out there, but I think those stocks, they'll continue in the F&O band. So, interesting times. Those two should stay in the F&O band. The bulls will feel quite good at the end of this week because there are shorts in the system and the markets have recovered from the recent low. Can we trend higher? 25,250 is the next crucial mark. Back to you.
Okay, all right. Thanks for that. So that's the F&O setup and how things are looking. Let's revisit that move on JBM Auto that I was earlier discussing with Deepak Shenoy. I mean, what a move. 15% up on JBM Auto. Let's get Surin. So what's happened? I mean, sure, they're getting buses, but is it that it's a large, large financing that they've secured? Is that what's getting the market excited?
So before I get into the details of the news, so if you look at today's trading volume, total volume of the stock is more than 3 crore versus 20-day average of just 3 lakh. And the stock has moved higher as much as 17%, posting biggest single day gain in nearly 2 years. Now, why the stock has seen such a move? So it's on the back of securing loan of more than $100 million. And it's important from where exactly it's coming from. They have secured this fund from International Financial Corporation, that is the member of World Bank. So it's very important. Now, what exactly they use this fund for? To buy and for the operation of the buses, and the number is of 1,455, and they will deploy these buses majorly in 3 states. Those states are Assam, Gujarat and Maharashtra, for which under the tender they have bagged the order under PM e-bus scheme. Now, apart from this, their order book is already of more than 11,000 buses, which companies looking to deploy over the next 2 to 3 years. And now, it's more important because government's target is to increase the penetration of electric bus to almost 40% by FY30. So we'll have to see how the stock moves forward. Already it's up almost 50% from 52-week low that stock had seen in April of 2025.
Okay, all right, got that. Thanks very much, Sud. So JBM Auto hitting the headlines today. Well, with that, let's move on. We have Sudeep Bandyopadhyay joining us from IndiTrade Capital, market expert. Sudeep, thanks so much for being with us. So JBM Auto, I don't know if you've had a look at this company, at the stock, but it's quite a high flyer today. Any thoughts?
Well, definitely, I think it's very good news. They've got this $100 million line from International Finance Corporation. This will definitely help them in the execution. And of course, the cost will be reasonable. So definitely, it'll have a positive impact on their P&L. Of course, the government's plan to have e-buses, more and more e-buses, is encouraging for JBM Auto. But the fact remains the valuation, Survi, is such level that it doesn't give that comfort to buy or recommend a buy.
Okay. Sudeep, any view on defense stocks? Big rally today. You know, the news has been there for a while, this 15-year roadmap. We spoke to a couple of defense companies as well. They're all very optimistic about more procurement, better order books. But I'm not sure what specifically triggered this today. Your thoughts and your favorite picks here?
Well, my favorite survey has been for last 1 year BEL. I continue to maintain that view. I think it's a fantastic company. Even before that, this defense rally, we used to find the company fascinating because they were operating very efficiently in a niche area which was in demand. Good balance sheet. Operational execution excellency was there, and of course now with all the wars being fought all over the world, we know how electronic warfare is important, and BEL plays a very important role there. They cater to Air Force, Army, Navy, all three components of the armed forces. Yes, the valuation is not cheap, but if you look at from a 2 to 3 year perspective, I think one can buy even now BEL. The shipyards, of course, have a good future. Again, the valuation is not cheap. Mazagon Dock does look good even at current level from a long-term perspective. My only thing is, unless you are a day trader or looking at a very short-term flip, don't buy into these defense stocks with a 2-3 month horizon.
Okay. All right. That's on defense. Keep a longer-term view if you're getting in. That's the advice. Since we're talking about the theme and the sector, let's play out some of the soundbites that we got from the managements of Astra Microwave Products as well as Paras Defense. Both of them sounding very, very optimistic about securing more orders and looking at bigger revenue over the next couple of years. Take a look.
Astra has a guidance, if I'm not wrong, of about 1,300-1,400 crores for the year, incremental order book, which shall come in. The incremental part, right? Okay, which grows on, and then from that is reduced what we produce for the year. I think what we are looking at is, you're aware that we discussed last time, we have a significant order which has come in from BEL. And if we are able to procure that quarter end, it adds nearly 1,500-1,600 crores over the years to our order book, right? Of which certain part will come in almost immediately. So we are fairly well placed, and we are quite confident they will achieve the order book that we are talking about. In 2-3 years, we are talking of this 1,500 odd incremental going up to 3,000 plus.
Our current order book is closing to between 900 to 1,000 crores. We are looking at a good inflow of orders and a good revenue output as well. So with all of this put together, we should be closing this financial year with at least 50% better order book than what we have right now. But what is interesting to see is the impetus is being given on the legacy platforms, the legacy technologies, the upgradation of your existing military might. And there is a good blend of the new threats that you can see. You can see a lot of loitering munition. You can see a lot of UAVs. You can see a lot of anti-drone technologies being given that importance, because what we have seen across the world, these are the technologies we have now started influencing your security infrastructure.
Okay, that's as far as these defense players are concerned. Let's take a look at some other movers and shakers. Defense obviously is one big theme. Some other stocks that are catching the eye today would be a Blue Jet Healthcare, 5%. Dilip Buildcon, Shakti Pumps. There's MTAR. MTAR anyway is also, part of it is a defense play indeed. And there's also the clean tech element to it. Any views on MTAR in particular? MTAR, we were speaking to just earlier. I mean, they had big orders from this US company announced just earlier on the clean energy side of it. Sudeep, have you had a look at the stock?
Yeah, I think the order win was very interesting because beyond defense, I think clean tech is also an area which I think has got significant potential. The company is definitely doing well and they have access to good technology. So, and of course, the defense is a huge, huge area and the opportunity size is humongous. They are also trying to capture. Again, Surabhi, I think the challenge is the valuation. I think, valuation has reached a level where the margin of error is so limited that it's difficult to recommend buying into these stocks at these levels. If somebody has to look at, beyond the typical PSU defense companies, then I would rather them go and buy a Bharat Forge, which has got a defense component, which is kind of increasing rapidly. And they are also announced that they want to work on that and increasing the size of the defense portion of their book. So Bharat Forge can be looked at. If you are still wanting to take a bite, go and buy Larsen & Toubro. It's got a fantastic defense book as well, and that's also growing rapidly. In any case, it's a good buy. So look beyond the obvious and do remember that some of these companies we were just discussing, MTAR Technologies, Paras Defense, and all are much, much, much smaller compared to the Bharat Forge or a Larsen. And they have a way of cushioning the impact if something goes wrong in one segment. So I would recommend an investor rather buys a Bharat Forge or a L&T at current levels than a MTAR or a Paras.
Okay, all right. Got that. Stay with us, Sudeep. Well, just keep an eye out on one stock should be. I just did the F&O chat and Oracle as well as RBL Bank, both are likely to stay in the F&O band. But one stock that could potentially go in is HFCL. Because I just checked, the open interest as a percent of the MWPL, that's a market wide position limit, has gone to 101%. If it's above 95%, it moves into the F&O band. That's the stock that could potentially go into the F&O band today.
Okay, all right. So that's an important, facet to keep in mind. We do have to take a break. As we do take this break, just a reminder for our viewers, you can unlock a world of exclusivity, expertise, and influence. Become a member of CNBC TV 18 Access, our premium members-only experience on CNBCTV18.com. The membership includes access to CNBC TV 18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back. Keep an eye out on a few stocks actually from the broader markets. High-tech was the one that we had highlighted a little while ago. I think, that one has popped up in trade. I recall they did a fundraise closer to around 200 rupees. And in the last few minutes, actually, it's popped up. High-tech pipes, not gears. I think we should get that one up. Big underperformer, now popped up in trade. And DCX Systems. On the exchanges, they've gone ahead and put out a release with regard to an MOU that's signed with the Tamil Nadu government. And that's suddenly seen a big spike. Just take a look at the volume spike on that one. Remember, it's been a big underperformer. They're sitting on a solid order book of more than 2,700 crores approximately. But execution is something that the street will eye. And also the movement with regard to that JV they have with the Israel company. So, important one. Any comment on this, Sudeep, on either of these two, DCX or maybe High-Tech?
Well, DCX, definitely there were a lot of concerns regarding execution. I mean, the potential is obviously there, but it has definitely disappointed the markets on earlier occasions. So, of course, I mean, this order seems to be interesting. We have to still find the details of this. But if they can execute on the orders they're sitting on and utilize the potential with the Israeli JV and others, I think the company is in good state. Let's wait and watch this space.
Okay, let's wait and watch the space. Keep an eye out on that. DCX and the other one, the pipe maker, because if the economy is going to recover and if steel is going to do well, metals is going to do well, then sometimes the second round impact will happen on some of these other companies. APL Apollo Tubes, JTL, we've seen some kind of movement, big underperformer. High-tech pipes as well, another big underperformer. So, one would say APL Apollo hasn't given returns in 2 years, but at least it's not crumbled like the other stocks, the smaller names. What's your view?
No, I completely agree with you, Nigel. And by the way, happy birthday to you.
Thank you so much, Sudeep.
So look, I think definitely these will have significant secondary impact. Also look at the entire infrastructure spending which is happening by the central government, and this definitely helps indirectly all these pipe companies. So yes, the potential is definitely there. Some of these companies are also started performing well. Their last quarter numbers were decent. I won't say outstanding, but they were decent, and I expect them to pick up momentum post the monsoon. So yes, definitely they're worth looking at. And they haven't rewarded the shareholders for quite some time. Probably the time is coming for them to do well. But if I have to pick up, still probably I'll go and pick up Apollo.
Okay, all right. So those are some names. Sudeep, I think it's time we let you go to kickstart your weekend. Just about a minute to go, so we'll wrap it down then. Thanks very much for joining in today. And let's take a look at the final tally. It's a decent looking screen, a 100-point gain on the Nifty for today, and a total gain of about 1.5% for the week. Better for the mid-cap index, which is up almost 2% for the week. Today's gainers, I mean, of course, PSUs and in particular defense PSUs have had a absolutely rocking time. So it's BEL and BEML among the larger names. Then you have, of course, all the ship makers. Mazgaon Dock Shipyard, then you have Cochin Shipyard, Garden Reach Shipbuilders, all of them up and about. But like I've been saying, even private sector names like Data Patterns, Astra Micro, MTAR, all of them have had a very, very good session today. Talk about the other contributors on the Nifty. There's ICICI Bank, Axis Bank, there's Bajaj Finance. So financials have also played their part. Names like Reliance and L&T have supported. So it's an all-round win for the market. Some profit taking coming in the consumer space. HUL, Trent. These are some of the names on the downside. Titan losing about 0.5%. Eternal down about 2%. But the bell has gone. I guess it's time for us to take your leave. But don't go anywhere, because Nigel and I will see you right after this quick break on Editors Roundtable. The Lal Street posts its biggest weekly gain in nearly 3 months, up for the second week in a row. IT and PSU stocks gained the most. Mid-caps have outperformed the blue chips this week. Over the course of the next 30 minutes, we will decode the week gone by on the street and put the spotlight on India Inc.'s big shopping spree. Yes, the M&A clock is really ticking, and we'll talk about that. Welcome to Editors Roundtable. I'm Surbhi Upadhyay. With me, as always, Nimesh as well as Nigel. And joining in today, we have Nilesh joining in to make our Friday afternoon much better. Nilesh, great to have you here with us. And, you know, you're joining us on a special day. Look at birthday boy is here. Maybe some special, you know,
parties there.
Tips for him, and maybe some party after this.
Birthday greetings, Nigel.
Thank you so much.
There you have a rocking year.
Thank you so much. Thank you for your
He's already having a rocking year.
Can only get better from here. But yeah.
No, but by the way, your birthday, you know,
hit record continues. It continues.
Apparently, the market's been closing positive.
Absolutely. Last year there was a
Every time
2% gain. Today there's a 0.5% gain. So next year, whether I'm there or not, should be please keep in mind. You know, if I'm there on air, that I meant. But I'll tell you what, next year it won't go up on my birthday. I think it's the weekend.
Well, I guess
that's the kind of mood we are in, right? Markets have recovered, some kind of stability, some positive noises coming in from Trump, GST. Hopefully, you know, the cuts will help out in the economy recovering as well. So pretty decent times, and that's why N3 is smiling.
N3, NQ. Okay, let's talk about, let's get the view from this one in. Nilesh, how are you feeling about the market, given kind of changes, GST, the way, you know, prices have started moving again, at least slightly?
Yeah, no, absolutely. I mean, the news in the last few days have been at least very comforting, especially with what we have gone through for so many weeks and so many months. I think in that context, clearly the news flow has been positive, and at least it's at least cheered us up a bit. It's lifted the sentiment, it's cheered us up, especially, of course, the GST thing. GST coming in actually has been really, truly not just a face-saving, but a huge game-changing event. And I think that's something which is definitely worth celebrating.
So Nilesh, is that going to push your focus towards consumption theme? I mean, from capex to consumption broadly, because that's been the big talking point as well in the market. That now look at consumption, because that's where the government focus also seems to be. Is that a logical thing to do?
No, absolutely. I think consumption is coming out of a very, you know, a phase of underperformance, or a phase of not going anywhere. They've been having challenges of growth, challenges of margins. And that's obviously led to derating.
Yeah.
And there have been many other brighter spots in the market over the last few years, whether it's cap goods, capex, defense, aerospace, whatever you name them. I think it's clearly been more about that. So I think versus that, clearly consumption, I think, is set to kind of now get back onto its outperformance mode. With the GST cut, with the tax breaks that we got in the budget, lower interest rates, more liquidity. I think a combination of all of that. I think everything seems to be auguring really well for consumption.
Absolutely. You know, actually, speaking of consumption, let me just quickly put the stats of the week in perspective and put it out there. So for the week, like we've been saying, the Nifty is up about 1.5%. But the broader indices have done even better. If you're looking at the mid-cap index, 2% higher. Even the small-cap index, 1.9%, close to 2% higher. So the broader market and individual stocks have done a lot more. The leadership sectors, interestingly, have been IT and defense. The defense index, can you imagine, is up over 7% this week. And the bulk of that gain actually came in on Friday. But it's been building for a while with this 15-year defense roadmap that was laid out by the government earlier in the week. The IT sector is up 4.2%. You have Infosys to thank for that, really sparking the lights once again, giving money back to shareholders via that big buyback. The PSU Bank Index is up about 3%. CPSE overall is up about 2.5%. Metals have done well, 2.5% up on metals. And in fact, there's been some profit taking in consumer durables, and relatively FMCG is a bit quieter. After the big run-up, throughout August, building up to the GST cuts, there was some profit-taking on those stocks. Now, very quickly, the factors at play, we all know it's all eyes on the progress of trade negotiations, because those tweets and those posts have come in and they sound really, really reassuring. But we need to move forward on, figuring out when the tariff number will come down from 50%. So that's number one. Flows are not a problem for the market, the local flow number. Remember that this week we got the mutual fund number. It's 20% lower than July, but at 33,400 crores, it's not a bad number at all. SIPs are steady. And finally, there is the rate cut expectation from the US Federal Reserve. So overall, global markets are in a very happy place. We anyway have those global tailwinds, so no problems there whatsoever. Nilesh, I want to pick up the IT piece with you. And we know that you have much more love for the new age platform companies and the legacy companies. But what do you make of it? I mean, for an investor, it goes back to the old story that, the moment someone's coming out to give you some cash back via, a buyback, the market likes it. So what do? Do you make some sort of a defensive allocation to large cap IT also? Or would you stick to, the platform companies? And there's a new one now coming, urban company as well. So more choice for investors.
No, absolutely. I mean, the platform companies essentially are a multi-year kind of an opportunity. I'd probably say the platform companies are where the IT services sector was in the 90s, which was the early years of the IT services, and they basically registered whatever, hyper growth for, probably a period as long as a decade.
Yeah.
I think platform companies are in a similar situation, if not hyper growth, but maybe 20 to 40% growth, quite possible. Versus that, the IT services companies, the large cap IT services companies now are pretty much consigned to a single digit growth rate. Buyback or no buyback, I don't think it changes the growth prospects. It's good that they're basically giving back the surplus money back to investors and the shareholders. Because if you think you have surplus money, you ought to give it back to shareholders. That's at least a good thing from a governance and a capital allocation point of view. But does it change the business outlook? I don't think it changes the business outlook. I think the business outlook will change materially when some of them will actually start implementing AI solutions for their enterprise customers. When they develop agentic AI tools and start implementing those solutions.
Which all of them are actually talking about.
Yes, Surabhi, yes.
They're not right now giving a value or a number to it in their quarterly calls.
Because I think A, it's not material enough yet. And two, they don't know how they're going to price that. Earlier, it was all very linear. I'm going to put so many people are required in this project. I'm going to charge you this.
Bill you X number of hours.
Yes. Now it's going to be outcome driven. Now, how do you measure those outcomes and all that? I think still is kind of at a very early stage.
Sure.
So I think buyback, great. But I'm not sure if it's good enough to move the needle in terms of business growth.
Sure. Nilesh spoke about the platform businesses. One of your investing company, so to speak, had a bit of a roadblock in that sense. Cartrade ended almost 20% lower. I know valuation is a bit of a challenge for that company, but what's your sense? There was just one sell note, and that led to a bit of a correction there. But broadly, are you convinced about the story, about the valuations as well?
Oh, absolutely. I still think it's a great growth story. I mean, and that too for the next many, many years. I still think it's at a very early stage.
What is the moat for Cartrade to do well?
No, I think the fact that it still basically attracts so many people to come onto the platform to check out basically car options, to check out used cars. I think these are some of the kind of modes which it has, and nobody else has been able to do it so well enough.
Okay.
In addition to that, obviously over the last 1 year, the big trigger has been the OLX acquisition.
Yeah.
That's obviously been a game changer for them. Nimish, keep in mind that the stock is kind of up 3x in less than a year. Okay, so to that extent, you just needed something which would kind of come in and start a bit of that correction.
Sure.
And I think it's healthy. I think when you have corrections in these kind of situations, it's always healthy. I mean, you have one big correction, but that becomes the base or the foundation for probably the next uptrend. So I think we continue to be very, very constructive.
Nilesh, besides the entire platform, trade that's going on, as you said, that OLX acquisition that they did, both, Cartrade and the other one I was looking at is Delivery. They went ahead and they picked up the smaller peer, which in turn helped them expand their market share itself.
Yes.
And that's another factor that's played out in both these two stocks. After doing not much, in the last 1 year, they've been big outperformers.
Yes.
That said, well, let's focus on Deal Street. And Nimesh, on a day-to-day basis, tells us more about that. But India Inc. has gone on a shopping spree, with 100 outbound deals worth around $11.5 billion getting sealed just in the first 8 months of 2025.
Absolutely, Nigel.
Tell us more, Nimesh. Give us
so
the
I'll go to the wall and talk about more, but I guess what we've not done, as you, me, and even Nilesh not going out and shopping, India Inc. has done for sure. So let me go to the wall and explain what they're up to. So, as I said, India Inc. has been on an acquisition spree in 2025 as well. So that's what the whole number will show up for you. In the first 8 months of 2025, we've seen outbound deals of nearly 100 deals, and that value is nearly $11.5 billion. That's the kind of acquisition the Indian companies have done going abroad. Essentially, this has been done to accelerate India's play in the global supply chain. The targets have been largely to plug that gap. Now, look at the first big size of deals. The latest has been the Tega Industries. They announced a large $1.5 billion deal acquiring Molycorp, which is a Latin American company. That's a $1.5 billion. Tata Motors very recently announced an acquisition of an Italian company for 3.8 billion euros. So that again was a large deal. And Sudarshan Chemical this year closed the very large 127 million euro deal. And by virtue of this, they will become the second largest players in the pigment business globally. So that's the kind of global reach these companies will have. But if you look at the 2025 list, it's across sectors. Big names have done acquisitions. Wipro is in an acquisition of $375 million. Titan, they acquired Damas Jewelry for $280 million. Aurobindo and Natco also did acquisitions worth $250 billion, and all are overseas acquisitions. There are some other places as well, like CEAT did an acquisition of $225 million of Cosmo Inc., Sun Pharma, TBO Tech, a small company, but they also went ahead and acquired a company for $125 million. So that's a big list of companies who've gone ahead and done acquisitions and of larger size as well. What are bankers saying? The bankers are seeing this as a lot of mid-sized companies are now in the market and they're doing a lot of cross-border deals. And one of the reasons for that is the buoyant domestic market. That's been the key reason why they've been able to raise money and acquire assets globally. So the money pushes now with the Indian companies to go out and put out big checks. Now, just to compare with what happened last year, in 2024, the total deal was 121 deals, and that was worth $17 billion. So compared to that, 25, as we've already seen 100 deals and $11.5 billion worth of it. So clearly, it looks like there is a lot of appetite for smaller, mid-sized companies to go out and buy a lot of the global assets. And one of the reasons is the domestic liquidity is so strong that it helps them to have that currency power and that stock power as well. Nilesh, I showed that data. I think one company which is not there in that list, but Zydus did a very good acquisition in the global market, almost $300 million deal. You own that company. What's your sense? Generally, you as an investor get excited when they do a meaningful overseas acquisition?
By and large, yes. I think clearly, what the big change that we are seeing, Nimish, this time around is most companies are making acquisitions which are bigger or significantly bigger.
Absolutely.
And which can actually make a huge impact.
Yeah.
It's something which can add another layer of growth for these companies for a very long period of time, especially if it's in a very interesting category. Like say Zydus Wellness, which we own, I think it's a very interesting acquisition. They earlier did a small acquisition in the nutraceutical space, but this I think is an addition to that, which again is in the whole area of vitamins and all of that. Obviously, the big caveat is, can they manage these acquisitions? In the sense, the whole integration process, the balance sheet, the toll it can take on the balance sheet if it doesn't turn out. I think that's the only risk to it. But otherwise, and I think some of these companies have learned lessons of the past. I mean, Zydus Wellness has done an acquisition in the past. It has taken a lot of time for them to basically absorb that acquisition. I think lessons learned, hopefully these are things which will be a lot more value accretive.
Okay, all right. Well, let's take a break on that note, but we'll have a lot more coming up for you on the other side and also talk about, of course, the whole capex versus consumption. Within consumption, we'll ask if Nilesh is convinced about anything specifically. Back with that in just a bit.
Welcome back. You're tuned in to Editors Roundtable here on CNBC TV 18. Well, we're still in conversation with Nilesh Shah of Envision Capital. Nilesh, the other big theme, that played out very well in the last 18 to 24 months is the capital marketplace. Whether you look at stock exchanges or you look at, brokerage firms, all of them, they rallied big time. Now the problem is volumes have dried up a little bit. The regulator obviously has tightened their grip as well. And there's fear that there's further tightening that's coming. And that's why these stocks have corrected. Problem is, even after the correction, they're not very, very cheap. But the longer time frame, some of these companies still could potentially look attractive. What's your take?
No, clearly, Nigel, I think the short term looks very challenging. I think they are going to basically face a lot of challenges for the next maybe at least 4 to 6 quarters. I think it's a new reality. I mean, a lot of them have grown on the back of rising volumes. You're not going to see those kind of volumes there, especially if the proposed changes which are being talked about, if they really become a reality and get implemented, I think it will take a toll on volumes. What that will also mean is that the investor or the trader's interest will shift to cash markets, where the commissions can be more, the brokerage rates will be more. But it's going to be a time period. This basically transition will take 4 to 6 quarters. So I think it'll be good post that, but there is going to be some pain for the next few quarters or so. And I think firms which make that transition will emerge to be the eventual winners, because the markets still are underpenetrated. I still think in terms of potential, the whole SIP culture, the growth of mutual funds, the growth of investor universe, I think all of that has yet a long way to go. But in the intervening period, they definitely have a lot of headwinds in front of them.
Okay. Nilesh, any new theme or any new company that you've looked at or exploring among any of the recent IPOs which have come through? Anything that stands out for you?
So I think Urban Company surely is, I think, an interesting kind of a business. But I think apart from that, company which went IPO about a year back, a business called Interact, and we own it. I think that's a very interesting business. I mean, I think at the surface, PEBs look like a commodity because there are many players doing it. But the bottom line is that most businesses which want to scale up immediately in manufacturing, who want to create these mega factories, if you want to have a faster or quicker way to do it, you need to have pre-engineered buildings. I think that's a reality. And that, I think, is a space which looks very, very exciting. Obviously, over the very long term, when you have prefab buildings even coming into very large buildings, commercial buildings, residential buildings, obviously those are the optionalities sitting out there. But I think for now, if you're bullish on Indian manufacturing, Indian warehousing, I think that's an interesting space to be in.
Sure. Nilesh, next week is going to be quite crucial from a global perspective. We have the Fed meet as well. You have a slightly different view that if there are rate cuts in the US, it's actually going to be negative for equities globally and for India as well. Take us through that.
So, Nimish, it's a bit of a slightly different view because in the past, whenever the Fed has started to cut rates,
everybody seems to get excited.
It's a very exciting period because there's a crisis all around.
True.
Right? I mean, if I go back 9/11 and then GFC and taper tantrum and COVID, and these were pretty much almost like existential crisis. Today, there's no existential crisis, so to say. Yes, there are headwinds, but it's not a crisis. And in that, if the Fed is going to start cutting rate, what does it signal? The economy is cooling off, jobs growth is not happening, and then on top of that, there is basically this whole thing around inflation. So it's more about concern around economic growth rather than anything else. And equity markets love growth. And if you have growth which is kind of becoming a challenge as far as the US Fed goes, I'm not too sure whether rate cut is a great signal. So I think this time, truly, it could be different. We'll have to watch out.
For the US market, it's going to be interesting because that's been the mother market has done very well. S&P 500 things, it trades at around 27 times, right? It's been running along. Earnings have been okay. Now, the problem is if there is a rate cut, and then after this, in the next quarter, you're going to see the impact of these higher tariffs because still now the importers are taking the hit. Next, the consumer will take the hit. Besides that, even the dollar index has weakened. So it's a double whammy for them. So the economy is going to be running into rough weather. So the mother market takes a pause. I'll be wondering how the other markets will react. The only good news for India is we have underperformed in the last 1 year by a large margin. So maybe that gives us some kind of cushion, and our domestic economy is expected to recover. So I think that's something that will hold us in good stead.
Absolutely.
So when is the recovery starting? When is the index first hitting all-time highs? Then where does it go from there?
Well, that's barely, I think, I don't know exact, but it's probably 2-3-4% away, right? So I don't think
some
that's
1,200 points away.
Sorry?
From 1,200 points on
1,200. So that's basically what, 4-5%. So that's not a, that's honestly not a big
वो
deal.
तो हो ही जाएगा.
I think so. Yes, yes.
So
I'd
we
like-
do what's in your hands, right? You're continuing your SIPs and all, right? Besides covering it.
No, that always. But speaking of that, any other themes, I mean, in terms of just a portfolio call, what would your advice be? We've spoken about IT, you've given some other interesting manufacturing idea. Defense, for instance, it never goes out of fashion, right? There could be a period of lull, but then suddenly the stocks roar back to life. Anything else?
So I think clearly not from an immediate perspective, but I still think from the next 3 to 5 years, it's going to be the 3 Ds.
Okay.
The first one is around digitization. Digitization, data, all of that in one basket. The second is clearly defense, undoubtedly. I think for the next 3 to 5 years, they have a massive runway. And lastly is decarbonization. I think that still has got a runway. And obviously earlier we were looking more like renewable energy and all of that. But this whole EV space is looking very interesting. The two-wheeler guys seem to be kind of stabilizing. That space seems to be stabilizing.
I was just coming to that. Do you think Ola has turned a corner?
I won't comment on an individual. No, I think turning corners, I still think is about at least 2 years away. I still think we have another 8 to 10 quarters of them kind of being actually profitable. Because they made huge investments. There's going to be a huge amount of depreciation charge. They're going to keep investing in R&D. But I still think that there's going to be value migration, a shift away from conventional to essentially the electric. And these are guys who can grow at 30, 40, 50% CAGR. And maybe in another 8 to 10 quarters, you would actually see them starting to kind of churn out serious cash flows. But markets will start to kind of price a lot of that in advance. So I think that's one interesting space to watch out for.
The 3 Ds, so decarbonization, defense and digital.
Digital. Yes.
There you go. That's the formula on Nigel's birthday. The 3 Ds.
Drinks.
With 3
I didn't even go there. It was I think that's a good note to call it a day on. Thank you so much, Nilesh, for joining in. Always so good when you drop in in person. So we really look forward to these sessions. Thanks so much. And we'll take our viewers' leave as well. Thanks for watching. Have a great evening. Keep watching all the news and updates right here on CNBC TV 18. See you with the markets again on Monday morning.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we are tracking this evening. Sensex and Nifty gained for the 8th straight day to mark the longest winning streak in a year. Nifty reclaims 25,100 after posting the biggest weekly gain in 3 months. Washington sends conciliatory signals to New Delhi. Sergio Gore, ambassador designate to India, tells lawmakers that the US and India will resolve their tensions over the next few weeks. Secretary of State Rubio says India is one of the top relationships USA has in the world today. Commerce Secretary Lutnick says they can sort out India, but they will have to stop buying Russian oil. Infosys shares rise after the company's board approves its biggest share buyback till date at 18,000 crore rupees. This is twice the size of its previous 3 buybacks. The tender offer price of 1,800 rupees a share is a 20% premium to Thursday's closing price. India Inc. goes shopping with 100 outbound deals worth $11.5 billion getting sealed in the first 8 months of 2025. Most of the acquisitions are aimed at bolstering global supply chains. 3 months since the Air India crash in Ahmedabad killed 260 people, grieving families continue to wait for answers. American law firm Beasley Allen prepares to file lawsuits in the US and the UK. The law firm claims to represent families of over 100 victims. Nepal remains on edge days after a violent anti-corruption stir toppled the government. Police reports 51 deaths so far. No official word on who would become the interim leader, even as former Chief Justice Sushila Karki emerges as the frontrunner. China issues a strong warning to Mexico over tariffs seen as appeasing the US. Beijing urges Mexico to think twice after it plans to increase tariffs on Chinese cars to 50%. China alleges the decision was made under caution. Brazil Supreme Court sentences former President Bolsonaro to 27 years in jail for plotting a military coup and seeking to annihilate democracy. 4 out of 5 judges find him guilty of attempting to cling on to power after losing the 2022 elections. US authorities released a video of the suspect who shot and killed conservative commentator Charlie Kirk at Utah University. The manhunt continues for the 3rd day as authorities ask public for information. The suspect has not been identified yet. Prime Minister Modi to visit Manipur tomorrow, over 2 years after the ethnic violence swept the state. The Prime Minister is scheduled to announce new projects in Churachandpur, a Kuki stronghold, and Imphal, a Meitei majority region. The visit to Manipur is a part of Modi's 3-day trip to northeastern states, Bihar and West Bengal. A founding member of the Association for Democratic Reforms and a pioneer of electoral reforms in India, Jagdeep Chokhar, dies of a heart attack at the age of 81. His organization led the fight to ensure politicians declare pending criminal cases and force the scrapping of electoral bonds through which political parties were getting opaque funding from corporations. All right, let's start with the day's market action. Indian equities extended their winning run for the 8th straight session, making it the longest gaining streak in a year. The Nifty climbed back above the 25,100 mark, rising to a 2-month high. Frontline indices closed firmly in the green, with benchmarks outperforming relatively on a weekly basis. Markets logged their biggest gain in nearly 3 months, rising for the 2nd week straight. Sensex, Nifty and Nifty Bank advanced more than over 1% each, while mid-caps registered gains of over 2%. 39 out of 50 Nifty stocks delivered positive returns this week. From equities to the currency market, the Indian rupee gained about 16 paisa against the dollar after plunging to a record low yesterday, but the rupee remains under pressure. $1 now costs more than 88 rupees. The 10-year bond yield remained largely stable in trade today. And the top story this evening, US President Donald Trump's ambassador designate for India, Sergio Gore, has signaled that the president shares an incredible relationship with Prime Minister Modi. Addressing a US Foreign Relations Committee hearing, Gore also said India and US are actively negotiating a trade deal and that India's ties with the US are warmer than India's relations with China. He also added that Washington will strengthen its ties with New Delhi and pull India away from Beijing. Further, he also added that the US fully intends to enter India's crude oil, petroleum and LNG markets while the ongoing trade talks. U.S. Secretary of State Marco Rubio, who was also present at the hearing, said that India remains one of the top relationships for the U.S. and ties between both countries are going through a period of transition which will be resolved soon.
We're actively negotiating with the Indians right now. In fact, the president has invited their commerce and their trade ministers to come visit us next week, and they'll be meeting with Ambassador Greer here in Washington. Part of that will include a hopeful deal. We're not that far apart right now on a deal. In fact, they're negotiating the nitty-gritty of a deal. Secondly, look, we hold our friends to a different standard. Frankly, we expect more from India than we do sometimes from other nations. I do think it will get resolved over the next few weeks. While we might have our moment of hiccups right now, we are on the track of resolving that. Our relationship with the Indian government, with the people of India, extends many more decades, and it's a much warmer relationship than they have with the Chinese. Frankly, they are concerned by Chinese expansionism, and Chinese expansionism is not just on the border of India, it's all over the area. And so we share a lot in common, and we share a lot of the same concerns that other nations in the region do. So should I be confirmed, we will make that a top priority, that India is pulled into our side and away from them. Fully intent in these trade talks that are ongoing right now to open the markets to crude oil, petroleum products, liquefied natural gas. You're talking about a population of 1.4 billion individuals there. Their middle class, by our definition, is larger than the entire United States of America. And so we have countless possibilities to expand into those markets, and we fully intend to do that.
India, which is, I would say, one of the top relationships the United States has in the world today in terms of the future of what the world's going to look like. 21st century, the story is going to be written in the Indo-Pacific. In fact, it's so important we've actually changed the name of the combatant command to the Indo-Pacific. India is at the core of that. And we are in a period of extraordinary transition in that relationship with India. We've got some really important issues coming up that we need to work with them on and work through on that implicate what's happening from Ukraine, but also implicate what's happening in the region.
Commerce Minister Piyush Goyal hosted the European delegation, which included the Trade Commissioner, Agriculture Commissioner for dinner last night. The delegation is in the national capital to hold the 13th round of talks on the India-EU Free Trade Agreement. In a post on social media platform X, Goyal said both sides have reaffirmed EU's commitment to an early conclusion of the trade deal. He added that a balanced and mutually beneficial FTA would open new opportunities for people and businesses on both sides. The Chinese government has warned Mexico against imposing 50% tariffs on Asian-made cars. In a statement, China's Commerce Ministry urged the Mexican government to be extremely cautious and think twice before acting. The ministry said that China and Mexico are mutually important trade partners, and the government will take necessary steps to safeguard its legitimate interests. The tariff imposition is a part of Mexico's broader budget proposal. Moving on, shares of Infosys rose in trade after the company's board approved its biggest share buyback of 18,000 crore rupees. The company said that it will be repurchasing 10 crore shares from shareholders through the tender offer route. The offer will be priced at 1,800 rupees a share, and this is a 20% premium to yesterday's closing price. India Inc. is on an acquisition spree. More than 100 outbound deals have been inked in the first 8 months of 2025, worth more than $11 billion. Tata Motors buying Iveco Group in Italy is the biggest acquisition, followed by Tega Industries' acquisition of mining equipment maker Molycorp for $1.5 billion. Most of the acquisitions are aimed at bolstering global supply chains. Now, the Delhi High Court has agreed to remove the name of late businessman Sanjay Kapoor's sister, Mandira Kapoor, from the inheritance proceedings. This comes after Kapoor's widow, Priya Kapoor, moved the court, saying that Mandira was wrongly mentioned as a party in the suit filed by Karisma's children. Priya Kapoor claimed that her sister-in-law seeking a backdoor entry for her brother's assets. High alert at the Delhi High Court after a bomb threat triggered panic on the premises. Multiple benches abruptly rose and hearings were adjourned as judges vacated their courtrooms. Security was tightened immediately and a bomb disposal squad was deployed outside the court complex. As per reports, a threatening letter was received earlier with a warning of a possible explosion inside the High Court building this afternoon. While investigations are underway, initial reports suggest the threat could possibly a hoax. After Delhi High Court, the Bombay High Court also received a bomb threat via an email. This also created panic and led to suspension of hearings. The High Court complex was immediately evacuated and a search operation was launched. Mumbai police told CNBC TV18 that a private investigation suggested that it was a hoax call. It's been 3 months since the Air India plane crash in Ahmedabad killed 260 people, with grieving families still continuing to wait for answers. American law firm Beasley Allen is preparing to file lawsuits in the US and the UK. Madiha Mujawar joins us now with more. Madiha, take us through what you're picking up.
Air India says that interim compensation has been released to the families of 207 of the 229 deceased passengers, as well as the 19 victims on the ground so far. Remaining families are yet to submit their documents required for the claim. The delay could be due to differences within the family on the distribution of compensation. We have spoken to some families where all the deceased have not received the compensation of 25 lakh rupees due to such differences among family members. The Tata Group, which owns Air India, had separately announced 1 crore rupees compensation to be disbursed through a dedicated trust. In August, the group formally registered the AI 171 Memorial and Welfare Trust. However, no disbursement has begun yet from this trust. Meanwhile, American law firm Beasley Allen says it is representing over 100 families of the crash victims. The firm is preparing a lawsuit against Boeing. They have filed a Freedom of Information Act request with the US Federal Aviation Administration to obtain data from the aircraft's flight data recorder. According to Beasley Allen, Indian authorities have already shared this data with the FAA, and the lawsuit against Boeing will depend heavily on the evidence found in this data. Now, Beasley Allen also indicated that some families are preparing to file cases in the UK under the Montreal Convention, which governs airline liability in international air travel. Now, families will likely file individual cases within the next 4 weeks in the UK courts with Beasley Allen as their legal representative. However, not all families will qualify to claim compensation under the Montreal Convention. Families must demonstrate that the ticket was booked in the UK, the ticket was paid for in the UK, the deceased was a UK citizen or had clear intent to stay in the UK for the long term. Having a one-way ticket to the UK strengthens the claim, as it suggests the intent of the deceased to stay for a longer period. The compensation amounts will differ family by family depending on individual cases and circumstances. Now, victims killed on the ground because of the crash and the 12 Air India crew members are not eligible under the Montreal Convention claims. So that is the update on the AI-17 crash so far.
Right, thank you, Madiha, for that. On to some global stories now. Nepal remains on edge days after a violent anti-corruption stir toppled the government. Police have reported 51 deaths so far. There's no official word on who would become the interim leader, even as former Chief Justice Sushila Karkri has emerged as the frontrunner. As Israel continues to bomb Gaza, Prime Minister Benjamin Netanyahu has signed an agreement for an expansion plan that would cut across land that Palestinians seek for a state. Netanyahu warned that there will never be a Palestinian state. This comes after Israel bombed Qatar's capital Doha to target Hamas leadership. In a statement backed by the US, the UN Security Council condemned the strikes but did not mention Israel. Meanwhile, Germany has said it will back a UN resolution for a two-state solution to the Israel-Palestine conflict. From one war-torn region to another, Russia has claimed that its forces have taken control of a settlement in Ukraine, along with downing at least 7 Ukrainian drones that were headed to Moscow. Ukrainian President Zelensky has pushed for a tougher response to the suspected Russian drone incursion into Poland from its allies. Poland's foreign minister has said that the UN Security Council will hold an emergency meeting. This comes after Russia violated Polish airspace earlier this week. Brazil's former president Jair Bolsonaro has been sentenced to 27 years and 3 months in jail for plotting a military coup. The Supreme Court held him guilty of leading a conspiracy aimed at overturning the results of the 2022 presidential elections after he lost to leftist Luiz Inácio Lula da Silva. However, Bolsonaro denied wrongdoing and has been under house arrest since last month. His ally, US President Donald Trump, condemned the conviction as a terrible thing. The Federal Bureau of Investigation has released a video of Charlie Kirk's murder suspect. In the footage, a young man was seen wearing a cap and sunglasses and was captured walking down a stairwell of a building. The FBI has also announced a reward of $100,000. Officials said that the shooter assassinated Kirk and vanished off a roof and into the woods. He has remained at large for more than 24 hours now. All right, time for a short break. Coming up next, retail inflation accelerates in August but comes lower than estimates. We decode the CPI numbers with economists up next. Welcome back. Inflation has accelerated marginally in August by more than 2% after hitting an 8-year low in July, but this is still below the CNBC TV18 estimates, which had predicted a rise of 2.2%. Prices have remained benign now for the last few months, but the RBI has warned of a spike in inflation by the end of this financial year. Food prices continue to contract. Food inflation has been shrinking for the last 3 months, but the pace of the contraction was slightly better in August. Vegetable prices remain under pressure, contracting by nearly 16%. But this was also slightly better than the 20% contraction we saw in July. Core inflation remains above 4%. We are now joined by Kanika Pasricha, Chief Economic Advisor at Union Bank, and Madhvi Arora, Chief Economist, Emkay Global. Thank you so much, ladies, for making time and speaking with CNBC TV18. Let me start with Kanika first. What do you make of the numbers?
So thanks, Archana, for having me on the show. First and foremost, as you yourself stated, good numbers, lower than estimate as well. So while CPI has bottomed out at 1.55% in the month of July, the pickup in August on fading base effects is also trailing initial expectations. For instance, MPC's estimate for this quarter is around 3.4%. And that's also now, it's around 2.1%. That is also trailing estimates given the kind of numbers we are getting. What's interesting is we were at around 2.5. The sole driver of favorable surprise has been vegetables, which has clocked lower than estimates and remains in deflation zone for many months now. In fact, going forward, this is despite a positive sequential momentum in August. In the month of September, the first fortnight is tracking negative momentum in vegetables. This is despite concerns that floods may lead to disruption in food inflation. We may see another round of spike. That's not visible in on-the-ground prices as yet. And the broad-based spike in food prices, which is a worry on floods, is also not visible. So two key points from policy standpoint, we think this number is, of course, favorable. The next number may be lower than even the August estimate. It's tracking very close to 2% or sub 2% to some extent if prices remain benign for the rest of September. That's one. Second, while core inflation was in line with estimates at around 4.22% in this month, core ex gold also stayed benign at around 3.1, 3.15. So overall, good numbers. And we think it's likely to open door for easing, as we've been saying, 25 to 50 basis points in the second half of the year. Thanks.
Right. What do you think, Madhvi Arora? Good numbers overall. Any expectations from the RBI? Because the Monetary Policy Committee is meeting at the end of this month.
Hi. So I think Kanika has largely covered the numbers bit of it. The implication for me is basically, is sort of reinstating the fact that the Reserve Bank is behind the curve. I think to a large extent, the Reserve Bank's last, policy, which sort of indicated that they are largely done for the time being, would be definitely questioned by this number. And as Kanika was mentioning, the next month also looks to be quite benign to us. So overall, excluding the GST rationalizing impact, we are still looking at inflation below 2.5% for the year, which is much lower than the RBI's recently revised number of 3.1%. So clearly, the pressure is pretty much there on the Reserve Bank. And we've been sort of arguing that, the RBI's policy making at this point in time is quite misplaced in an evolving world where they're looking at the forward 1 year ahead inflation, which is, as per them, is tracking above 4%. We are in a global scenario where there is a massive disinflationary bias in Asia. There will be a demand depression. There's also a massive supply glut, which is available in the Asian subcontinent, which will have a disinflationary effect on India as well. Apart from that, we also would have some demand destruction because of tariff. Of course, a part would be taken care of by the policy initiative, which will take time to play out. But overall, I think that massive disinflation bias has to be taken into account in the near term, instead of, totally focusing on a 1 year ahead expected inflation when you know that, the world is in an evolving space and you would see a disinflationary bias across the world. So I think we have been arguing that Reserve Bank should be easing at least 50 bips in this cycle. And with this number, I think that belief is getting reinstated.
Right. Kanika, if I may ask you, while this number is in the comfortable range, but what about core inflation? It's still above 4%. Do you think it's a concern right now?
So as I stated, Archana, that, while core is above 4.2%, this is something that MPC members have also highlighted in the past, that gold has been, so one of factors like the spike in gold prices has been the prime driver of that core inflation. Core ex gold is very benign at 3.1, 3.2%, and has been staying benign for the past many months. So which is why we don't think core will be a concern. We are overall, from a growth perspective, as well as Madhvi is also pointing out, demand pressures remain subdued. And even globally, tariff hikes may lead to some demand destruction. So core inflation pressures, in our view, overall remain benign if you take out the one-off factors like gold.
Right. And Madhvi, do you agree with Kanika?
Yeah, to a large extent, it's the same view that I just mentioned. Just like to add one aspect of it, the GST rationalization would also be another disinflationary force, which we as of now are not including in our numbers, which will play out largely over the next 3 to 6 months, depending on how the pass on happens and how, depending on the price sensitivity, of a product line. But that could also have a disinflationary impulse of as high as 50 to 60 bips. So inflation could potentially look much lower than what we are looking at this point in time. So I think largely the policymakers will have to rethink in terms of their reaction function. Just to add another important data point to watch out for would be the US macro dynamics. The markets are pricing almost 3 rate cuts this calendar year for the US, which also would augur well for emerging markets in terms of their own reaction function. So I think it's sort of playing well for the Reserve Bank to now relook at their stance in terms of policy making, and probably it would open up room for them to cut.
All right. Thank you so much, Kanika and Madhvi, for weighing in on the inflation numbers. We have run out of time, but thank you for making time for us and weighing in on this important data point. With that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18.
I'm sitting here in the heart of India's financial markets, the National Stock Exchange, a fortress of technology and trust, a place where billions of dollars of trading is executed across equities, derivatives, commodities in a microsecond. At its peak, NSE executed 2.2 crore trades in a single day and $23 billion in turnover in a single session. It is the world's largest derivative exchange for 6 years in a row, home to 12 crore unique investors. But beyond the tickers, the symbols, the charts, today we go behind the scenes. We look at surveillance rooms, IT infrastructure, cybersecurity, and of course, the National Operations Command Center. And we do all of this with NSE's current MD and CEO, who was also instrumental in setting up of the exchange, Ashish Kumar Chauhan. Hi Ashish bhai. Hi. How are you?
Good to see you.
Good to see you. And I think we're meeting here in your cabin for the first time. Yes. We see you at the atrium, at the opening bell. We see you in our studios. But I think this is your den.
Thank you. Thank you for coming.
It's a lovely office, by the way. I want to start by asking you, Ashish bhai, what does a day look like for you at the NSE?
In a way, our days are 24/7 by 365 because markets run only for a sort of shorter period.
Right.
We have to prepare and ensure that the markets continue to run, prepare them for the next day. Even the weekends we have to work. So in a way, the life is kind of continually rolling.
Right.
And then, of course, you have a time of the day where you go to sleep. But broadly, you are available on your screen, on your mobile continuously.
Machines have not taken over yet completely, or have they?
No, broadly.
But they need supervision.
Yeah, they need supervision. And of course, there are changes that happen. So we need to plan for that. The regulations have to be...
So hour by hour, not hour by hour, but maybe 2 hour, 3 hour blocks. What is it? When do you get to office and how does it flow?
No, I come, if it's a listing, I come a little early, like 9.
Right.
Otherwise, I come...
Which is pretty much every day nowadays.
Yeah, nowadays. Otherwise, I have a little more flexibility. Sometimes I have to go out to sort of attend events, but broadly, I try to be in office at the exact time so that I'm aware of what's happening. And normally, I try to be available at 9:15, at least on phone, even if I'm traveling. 9:15 a.m. is like the starting time of the market, and you want to be there in case something goes wrong. If it goes right, so there is no issue, but you have to be available. So that's how the life works. And then once you come, lots and lots of meetings happen. You need to read a lot, and then you need to go out for meetings and committees and all. And then at some point in time, you will go out to attend some events in the evenings. Usually evenings, there are a lot of events. And then go home at whatever time you're allowed to.
I mean, activity has just exploded, right? Both on the cash front, derivatives front, etc.
If you recall, when Mr. Modi took over in 2014, because that's the time I still remember some numbers, India had 1.67 crore investors.
Wow.
Today, India has 11.8 crore investors, unique. Both. Because those are the NSE numbers, right? 11.8 crore investors, 25% women. That's 8.5 crore or 9 crore households. And that's almost 25% of India's households now. And that time, India's market capitalization, when he took over, was I think 67 lakh crore. Today is 450 lakh crore, So both have gone up 7 times. And that tells you how much of India has become middle class. Because you come to the markets to invest, and there is a perception that has been created that India, most Indians overtrade. That is not true, because 11.8 crore investors, once you have invested even in one share, you don't trade every day. You can trade once in 10 years and still you are an investor. But out of that, around 25 lakh, maximum 30 lakh people trade in derivatives. And so literally 2% people trade in derivatives. And out of them also, most of the people, almost 85-90% people,
also trade in equities as well, cash as well.
Yeah, so it's like they're buying insurance, right? And so for me, lots and lots of misperceptions get created. But overall, the amount of wealth that this organization has generated when it started in 94, on November 3, 94 equities market, it was the total market cap of India was 3.7 lakh crore. Today, it's 450 lakh crore. It is, of course, the transaction processing, reaching out to people across India. Now, 11.8 crore investors are in 99.85% of all PIN codes. India has more than 19,300 PIN codes, out of which only 28 PIN codes don't have an NSE investor. I have investor in Ladakh, remotest corner, means 6,000 meters in the hills, to Andaman Nicobar, which is near Indonesia. I have people in Arunachal Pradesh, I have people in Dwarka, I have people in Kanyakumari, every nook and corner of India today.
Except 28
PIN codes, and out of that, probably 25 are airports where you can't stay full time, so I can't do KYC, right? You can't say that that's your house. So broadly, the middle class sization of India is what is basically creating a framework where India's savings, India saves 30% in that range, 28-30%. Out of $4.2 trillion economy, now we are saving above $1.1, $1.2 trillion. Most of it earlier used to go into gold and
fixed deposits and banks.
And today, some portion has started coming up in what I call risk asset. Assets. Equity is a risk capital. And they have got some brilliant returns. I mean, Nifty is going to celebrate 30 years. In terms of the base date, it started with 1,000 in 1995, November 3, 95 base date. Today, it's close to 25,000. If you take the dividends, it would be probably 30,000 in that range, right? So 1,000 rupees invested has given you 30,000 rupees, right? 13% plus
kind of compounded returns.
13.6, and even in dollar terms,
it's about 12. I think about 25 years, 12% odd. I mean, so which is
but if you take total returns, because you take only the absolute returns, but if you take
dividends included, I think it'll be
that 13.5 or something, and in dollar returns also, it's competing with S&P 500. So effectively, India has done well, and it's not true that all countries where the country has done well, investors have done well. Like China, 30 years back, whatever their index was, today also is very similar.
Correct.
People, I mean, the industrialists have made money, not the investors.
Small
investors.
investors.
In India, because of the corporate governance framework, which SEBI and NSE have been together able to provide for. And that's why, for me, the capital formation, $5 trillion, 1/3 of India's wealth, is now wealth of trust at NSE. Right?
You know, you said that activity has grown, what you said, over the last, since NSE was founded, how many times?
I mean, in terms of the number of trades, the BSE in those days, the best days, they couldn't do more than 10,000 trades. Today, I get 2,000 crore orders in 6 hours, right?
So has the infrastructure to do all this also expanded at the same pace? Let's find out. Let's, I think, go to, what is it called? The National Operations Center, right? It's called the NOC.
Yes.
Let's go there and find out how it all works.
Absolutely.
Well, as promised, we are showing you a rare behind-the-scenes sort of, footage or visuals of the National Stock Exchange, the largest exchange of the country by far. And of course, we have help in the form of the MD and CEO of NSE, Ashish Kumar Chauhan. Ashish bhai, so this is the National Operations Center, right? Yes. NOC. It's got a military-sounding terminology to it because it requires precision, it requires discipline, and I think this is where it's all sort of controlled from.
Absolutely.
Tell us a little bit about what we're seeing, and I mean,
this is an entire floor, but floor is divided into different rooms. Each team has their own work.
Correct.
And there is a full backup, even in terms of the number of people, number of computers, number of screens in Chennai.
Right.
So anyone doing anything here as a checker in Chennai, and anyone doing something in Chennai has a sort of checker.
But that is only for
it's for disaster recovery. But when disaster happens, when you try to recover, it doesn't work. You have to make them on. So whatever things happen here,
it's fully operational.
It's fully operational, and actually we do mock trading from Chennai every month, at least once, and twice a year, at least for 2 days consecutively, we run the live operations from Chennai. So it's a fully functional thing, but how do you continue to make it run in a heightened sense is by involving them on your day-to-day activities as if they are next to the computers, and which is now allowed by the communication systems. So that's where the team here and team there are like working as one. And in case this place by chance goes down for whatever reason, that team should be able to
seamlessly pick
up and run without anyone.
So as an investor, as a trader, I should not feel the difference. I mean, basically.
You probably will get logged out, and then you will your broker will log in, and it'll be business as usual probably in few seconds.
Right. So what happens from here? I mean, what kind of activity?
This place is what we call business NOC, where all the companies that get listed or IPOs that happen, or daily price bands of companies, the new derivatives, contracts getting introduced in equities or currencies or commodities or in bonds, all that thing starts being set up. Even sometimes we have to set up a new broker, or sometimes we have to actually stop a broker from functioning because of the SEBI regulations or orders, or sometimes even specific investors are not allowed to trade by some of the court orders or otherwise. So everything happens here, but during the market hours, especially between 9:15 and 3:30, this people who are working here have to do nothing actually. They have to just monitor, and it's like an autopilot. If they are doing something, then there's something has gone wrong, right? So that is where physical manual sort of override is required. Otherwise, their work happens 24/7 by 365 days. During the day, they are not supposed to do anything, but end of the day, they have to create files, download to all brokers, then they have to prepare for the next day all the new contracts coming in, the price bands, other things, 2%, 5%, ASM, GSM.
The much awaited Bhav copy comes from here? Or?
Absolutely. So everything which has to do with business comes. Similarly, there is another room for cyber security where we get a lot of.
And we're going to go there in a bit. So.
And then we also have hardware operation center, which is basically where we have several sort of machines which we need to ensure that there are no queues. And this was the first public digital infrastructure of India.
Yeah.
This is the first fintech of India. It's still the largest fintech of India. And it allowed India to create capital formation on a scale where no similar sized or similar per capita income having country. I mean, today, after so many years, our per capita income is only $3,000. Although we have become $4.2 trillion economy, but we are still per capita is still no country has with $6,000 also have that kind of market. $12,000 also no market. $24,000 there is one market larger than us called China. But when the prices go down, the government has to go and buy the shares. In India, government is actually hands off, right? So there is no similar market. And if you look at it in a poor country, per capita income country, people investing in other people's businesses is not unheard of. There are books written in economics which says that poor per capita income countries cannot or societies cannot have well-functioning capital markets because they cannot save. And if they save, they don't trust their brothers also. In India, this has happened where 20% of India is now households.
And we spoke about the long track record of returns, which has been spectacular, matched only by, I think, the US, right? As a market over a long period of time.
That's why I call this trust markets. Because trust has developed.
You know, I want to show our viewers the cyber sort of control center as well. So let's go there and why don't you tell us about that? Okay, we are in another room now, and this is, of course, also an important place. This is the Hardware National Operations Center, the Hardware NOC. And you can see the screens behind me. This is where they monitor, Ashish bhai, the hardware. And
there are thousands of servers which NSE manages, and each server has different work and different softwares. And so all of them have to work well. And that's where basically each person has his own job. But there are what we call dashboards, which are giving you aggregate numbers. So in case again, they are not supposed to do anything real life, except they do their normal office work. But if something goes wrong, that is the time they need to intervene. Otherwise, during the day, it's on autopilot. And there are softwares which are self-healing and things like that. So overall, it's basically on a good day as like we get 2,000 crore orders, 30 crore trades in kind of different markets. So all the hardware, literally whatever people do here is sent to a nearby site called NearDR, and a Chennai site, literally gigabits of
information
is transferring. And we have like petabytes of data stored. Some people access from there, some people access from here, and so it's like a very large setup which needs to be monitored on a.
So there's we were in the business NOC, there's the hardware NOC,
and then we have a security NOC, which is
the cyber security and security NOC. So let's go there and check it out as well. So that is the hardware NOC, and what we're going to do now is show you the cyber NOC, Ashish bhai. And I think viewers can see what is inside the room. So tell us a little bit about what happens here.
No, in a way, we use many softwares and tools and hardware to ensure that the working of the exchange continues without
disruption,
any disruption, even from the hacking and other activities. So that's where, again, we have a Chennai site that's connected here, and naturally, some of the government agencies also are able to look into what we do. But there are like lots and lots of softwares, tools, and we use, and each person working has a a specific job. But again, we have dashboards which tell on an aggregate level what has been there today, how many attacks are coming, if we are running in a red zone or a amber zone or a green zone, and so those are the things.
You were telling me earlier during on the day of Operation Sindoor, I mean, there were the attacks kind of peaked at.
Yeah, like in 20 minutes we got 40 crore attacks, right? So these are some of the most attacked entities in the world today.
Okay. So this is a significant area of focus in terms of upgradation, keeping...
The costs are also humongous, but without that, you cannot operate, right? So you need to be, like any country, if you don't have a defense, whatever you do in the business has no relevance because somebody will come and subjugate you. Similarly, whatever business you do, if you don't have a good information security in today's world.
So strong physical security, as I noticed at the gate, but strong digital security.
It has to be.
I mean, there is digital public infrastructure in that sense, so it has to be on without disruption.
Absolutely. And especially outsiders or insiders, knowingly and unknowingly, doing wrong things cannot be...
Has to be monitored, has to be checked and tracked. Well, from the National Operations Center, and we showed you quite a bit, as much as we could, upstairs. We are here now to take a walk down the memory lane with Ashish Bhai. This is, of course, the wall with lots of pictures, and I guess Ashish Bhai lots of memories as well, right?
Yes, of course.
Because I spotted that photograph, which is July 1994, when an NSE was inaugurated. And that is, I don't think you can see it, but that is a very young Ashish Kumar Chauhan explaining to then Finance Minister, Dr. Manmohan Singh. What is happening then in that picture?
And next is our chairman, Mr. Nadkarni, who became chairman of SEBI later on. He was IDBI chairman beforehand. And so, in a way, this project was like very ambitious. And everyone was clear this is not going to work. Even when it was thought through, because bankers were trying to implement a stock exchange which they have never run before. And in an IT, pure IT exchange, which was not the case anywhere in the world before. So it was all sorts of complexities, and we were trying to use satellite telecom and also a lot of things which could have gone wrong.
The idea germinated in 92.
Yes.
And
post Harshad Mehta scam, the government wanted to create a framework which is not owned by brokers, operated by brokers. And that's why they wanted to create an independent exchange owned by investors, but run by professionals. And so, and completely automated so that it will have transparency, fairness, efficiency, and all that. And so, in that context, we made presentations to Finance Ministry in 92, lots of to and fro during 92, 93, 94. So, what happened is we first started with the wholesale debt market because Harshad Mehta scandal actually originated in the RBI Secretary General Ledger and all. So they wanted to first do wholesale debt market. And so we started operating without inauguration, like a beta test in those days. And I think Google had not come then. So beta was not so popular, but we started trading, real trade. And then Dr. Manmohan Singh gave time to come and inaugurate in July. And on that day, he woke up early. He used to be a very diligent man, So he decided to visit NSE. The inauguration was in Nehru Center at Worli. And our office was at Mahindra Towers. Again, Worli, but probably 1.5 kilometers away. And so I used to sleep in the office most days. And that was an important day, So when the dogs started coming to check around the dog squad, then I realized something is happening. I had to tell my bosses that he's coming to visit NSE, and then everyone sort of came hurriedly. And so that time I was explaining to him how the IT system works.
And that is you were how old in that picture?
I was 26 years old then.
26-year-old. I mean, that is just I mean 2 years into your work life, right?
Yeah,
2 or 3 years into your work life. Must have been a high.
No, it is. I mean, this, as I say, this has been, and setting up NSE has been the greatest privilege of my life. And the amount of service it has given to India, it is way beyond what one had imagined or what one can even fathom.
And we're going to go now to the most used facility, the NSE, by the general public, by companies, by new corporates who want to
list and ring the bell. So we're going to go to the bell there now and check it out as well. Well, I hope we've given you a 360 degree, if not a 360 degree, a 180 degree kind of view of how NSE as an organization runs. I mean, some of the stuff that we showed you, of course, behind the scenes, as I said, the National Operations Center. And of course, we jogged our sort of memories back to when the exchange was founded as well. This is also an iconic place. This is the, Ashish Bhai, the atrium, right? Yes. And I think corporates who may be watching this, for a lot of them who are recently listed or even listed for a while, I think they would remember this place. With the ringing of this bell,
absolutely,
the listed journey starts.
Yes.
And it's been such a vibrant place, right?
Yes.
Ashish Bhai, last couple of years especially.
Yeah, every day there are many listings. The largest company usually does bell ringing here. We have other places where there are bells, including in other cities also.
Yeah.
But this is the most coveted sort of listing place today in the
And
country.
you're here, as you told me, for the big ones at least, 9:15.
If I'm in Mumbai, I try to be there.
You try to be there.
For listing, because again, it's an important occasion for the company's life. And as what I call a head priest of this temple, it's my duty
You have to be
there.
present.
Yes.
When do we see NSE's bell going off in terms of listing?
Once the SEBI gives no objection certificate, that's the minimum we require as a regulated entity by SEBI.
Right.
After that, we'll prepare the DRHP and then submit to another department of SEBI, which will go through it. And broadly, it would take probably at least 4 months to prepare the DRHP.
Right.
4 months for them to do queries and ask us any issues,
Questions, etc.
Clarification.
Right.
And then so.
But from the day that the NOC is received, whenever it is, we don't know when that
probably
is.
8-9 months is what looks like after that.
To the listing
going
date,
live,
basically. So, I mean, the work in terms of having the background, etc., is work in progress.
In 2016, NSE had filed. That time I was not there in NSE. But 2016, NSE had filed the first DRHP. So since then, NSE has been in a way in a status of some readiness, not always, because it's almost now 9 years.
Right.
But in a way, we are sort of prepared.
And in terms of the size of listings, you said big companies. I think this is going to be the biggest of all.
No, in a way,
in terms of,
and we are also 100% public. See, unlike other companies, we are already 100% public. I have like 172,000 shareholders already.
Correct.
Right, and so 0% is with any promoter. I have no identifiable promoter.
In terms of the shareholding, last 5 years is when the numbers have really exploded.
In fact, since March only, it has gone up from probably 30,000 to 172,000. Right.
Last March.
That is 25 March.
Wow.
Right. So because earlier we used to approve each transaction with fit and proper, and then
correct. It used to take time. There used to be 4, 5, 6 months
and things like that. Now it's all automatic in the depository, so that's why many more people.
So transactions are taking place a lot more, and all those. What you said, 172,000 shareholders now. So and they're all waiting and watching.
Absolutely.
When this is going to happen. I mean, what, close to 5 lakh crores in market capitalization? At least in terms of, because transactions are taking place.
Transactions.
Right?
But again, when you go to do the IPO, that is the time you need to see.
Depends on
the situation, your profitability and other things.
Right. So, well, I hope that day is not very far. The NOC comes soon, and as you said, within the next 7 or 8 months after that, it is listing. So let's do some practice, Ashish bhai, in terms of the listing.
Yes, of course, it will not be done here. It will be another
of course.
Hello and welcome to the Global Dialogue. I'm Shireen Bhan. EdTech company Coursera has built a strategic relationship with India both as a market and as a talent base. Under its new CEO Greg Hart, Coursera is working towards making India its largest market by localizing content, stitching together partnerships with academic institutions, enterprises and the government. but it faces the prospects of intense competition, with OpenAI pushing into online learning and upskilling. Joining me now to talk about Coursera's global plans and its strategy for India is its global CEO, Greg Hart. Greg, many thanks for joining us here on CNBC TV 18. It's great to have you with us. Almost a year since you took over. Greg, let me start by asking you how Coursera and your journey at Coursera so far has been.
The journey has been fantastic so far. Obviously, the mission for Coursera has never been more relevant for the world in terms of providing people the skills that they need to transform their lives, particularly in this time of incredibly rapid change with Gen AI transforming how all aspects of work are done. So it's been a fantastic start, and we're really looking forward to what we're unveiling at Coursera Connect, our annual conference that I'm at right now. We have a slew of different AI-powered features that we're rolling out and announcing this week, and so happy to share more about those with you.
I'm glad that you talked about what you're rolling out at Coursera Connect. Let's focus on AI, Greg, because that was going to be one of my questions to you. You've preempted that. Are you going to be building more proprietary AI tools? Because that's what the future seems to suggest at this point in time. Take me through what the plan is on AI for you specifically.
Absolutely. So in the same way that everybody is reading about AI, we have been using AI really since its very earliest days. So very shortly after ChatGPT launched in November of 2022, we rolled out a number of AI-driven features, Coursera Coach, Coursera Course Builder, and a slew of others, and we continue to improve on those. And so a few of the things that we are announcing at Coursera Connect this week, Skill Tracks, which is a data-backed learning solution that really maps the relationships between jobs, skills, and learning content so that we can ensure that learners can master the right skills that they need for the role that they are in or that they want to have. Role Play, which builds off of Coursera Coach, which is our AI-driven tutor, and it helps learners build job-ready skills and practice those soft skills through interactions with AI personas. Course Builder, which is another AI-driven feature that's been live since 2023, and we're now making that available to all of our university and industry partners to help them build and scale content fast. An interesting point on Course Builder, which has been available for our enterprise customers since 2023, we have roughly 4,000 courses that our enterprise customers have built since then for their workforces. Nearly half of those, 1,900, have been built by our enterprise customers in India. So it's been a phenomenal tale of success for Coursera and particularly for companies in India. We're also announcing a bunch of new partnerships with world-class universities, University of Cambridge in the UK being an example, as well as industry leaders. And so it's a very exciting conference.
Well, plenty there as far as what you intend to launch on the AI front and, of course, your partnerships with other universities. But I want to specifically talk to you about what we're seeing happen as far as OpenAI is concerned, doubling down now on education in the edtech space. How do you intend to take on OpenAI? What is going to be the strategy to be able to differentiate yourself as OpenAI makes its big push into this space, into this market, specifically in a market like India?
Well, I don't view OpenAI so much as competition, so much as a huge tailwind for everything within AI. We see an incredible amount of interest in AI on Coursera. So far this year, we're seeing an average of 13 enrollments in Gen AI content per minute this year in 2025. And in part, that's been driven by the fact that we now have more than 1,000 courses on Gen AI available on Coursera. And those come from world-class universities. And so one of the things that I think really differentiates Coursera's offering versus others in the online education space is those deep partnerships that we have with universities. We obviously grew out of academia with our co-founders, Andrew Ng and Daphne Koller, being professors at Stanford.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, Professor Jagdeep Chokhar, one of India's most steadfast advocates for accountability and transparency in politics, died in New Delhi today after suffering a heart condition. Months ahead of his 81st birthday. An academic, a lawyer and an engineer by profession, he was also a professor. Professor Chokhar was one of the founding members of the Association for Democratic Reforms, ADR, an NGO known for its pioneering efforts in the field of electoral reforms over the last 25 years. Professor Chokhar had been the lead petitioners in several of ADR's legal crusades that helped usher some of India's most consequential electoral reforms. A few of them include mandatory disclosures of candidates' criminal, financial and educational records, the right to register a nota vote. More recently, he was a key figure in the case that led to electoral bonds being declared as unconstitutional. Separately, ADR has also paved the way for voters to be better informed by sharing pivotal data-based analysis on politicians from time to time. With his passing away, we've lost one of the greatest defenders of democratic ideals in contemporary India. And well, joining me now to discuss his legacy, his contributions, his journey over the last 25 years, I have with me T.S. Krishnamurthy, former Chief Election Commissioner. Also with me is Major General Anil Verma, the head of Association for Democratic Reforms. Gentlemen, thank you so much for joining us. Major General, let me come to you first. You've worked very closely with Professor Jagdeep Chokhar. He's been hosted. We've hosted him on this network multiple occasions. Last we spoke to him, of course, was in light of the electoral reforms exercise. Just a quick glimpse back at his 25-year journey and his contributions in terms of the most critical changes for electoral democracy here in India.
First of all, it's a very sad day for us at ADR. I mean, he was our sort of face of ADR, a relentless crusader for electoral reforms and transparency in the political system. And he was a fearless fighter and a multifaceted personality, I would say. He was a teacher, researcher, writer, bird watcher and conservationist, and also a trained lawyer. He began his career in the Indian Railways and later on went on to the academia, did his MBA from Delhi, then went to do his PhD from Louisiana State University in USA. Thereafter, he joined the Indian Institute of Management, Ahmedabad, where he was teaching, and he retired in 2006. There in IIM Ahmedabad, he met Professor Sastry and some other like-minded professors who, worried about the state of the criminality and money power in the Indian political system, decided to do something about it, and that is where the ADR was formed. And as you are aware, ADR has played a critical role in enhancing transparency in Indian elections for the last 2 decades or so. Personally, I have been with ADR for about 11 years after my retirement from the army and was in close touch with Professor Chokhar. He was an institution by himself. We learned so much from him, and he mentored and guided the ADR throughout its journey, along with the other trustees, of course. And as you are aware, there have been a number of landmark Supreme Court judgments in favor of ADR because we took up cases wherever we felt that the citizens' rights are being denied or there is a need to have more transparency in the political system. And because of his experience as a lawyer, basically he used to guide us and in the various PILs that were filed by our team. And he was a prolific writer, researcher. I mean, his research papers have been published in all over the world.
Right.
In very prestigious this thing. He's taught in several countries. And not only with ADR, he was associated with a number of organizations. Like one was this Ajivika Bureau. For over 10 years, he's been working with them. They work on the issue of migrant labor and all that. And then he used to also teach at certain universities pro bono on certain management issues and all. And basically, I would say a very fine human being he was. A bit short-tempered, of course, but he would fight for whatever he felt was wrong. And his contribution towards the civil society of our country is immense. And I think it is a very major loss for the civil society as well as the whole nation.
Right. In fact, speaking of his contributions, amongst his very first was a PIL that he'd filed way back in 1999. And at the time, that was the PIL which resulted in the 2002 and then the 2003 verdict from the top court, which mandated the antecedents, the criminal, financial and educational backgrounds of all political leaders to be submitted with the Election Commission. Speaking of the EC, Mr. Krishnamurthy is also with us, joining us live. Mr. Krishnamurthy, when you look back at this journey of Professor Chokar, what to your mind, as far as the Election Commission is concerned, were the key changes that you observed on account of his intervention, on account of ADR's intervention?
Very good afternoon. I'm thankful to you for inviting me on this occasion, very solemn occasion. I'm extremely sorry and feel very bad about his sudden passing away, Mr. Chokar. I knew him from the very first day that I was in the Election Commission in 2000. Well, you asked me to judge about his contribution. I think he was a remarkable human being who started a remarkable institution with a lot of credibility. Most of the electoral reforms that came into existence in this country, at least since I joined the Election Commission, he had a role to play because although the decisions were given by the Supreme Court on most of these issues, like filing an affidavit or nota, or any other electoral bonds and so on. They were all given by Supreme Court, not by the government of the day. And these results, these judgments of the Supreme Court came primarily because Association for Democratic Reforms and the Election Commission joined together and supported each other in the bringing of the necessary electoral reforms. I feel very sad about his sudden passing away. I'm sure this credible institution that he has built and the remarkable research activities of this institution on various issues related to the Indian elections will always be a testimony to his contribution for electoral reforms.
Right. Let's dive into some specifics. Major General Verma, let me come to you. His journey, at least in terms of the impact that he's had, was at a pinnacle with the electoral bonds case. 2024 Supreme Court scrapped it and saying that there is a right to information, that people should know where their political parties are getting their money from. Give us, for the benefit of our viewers, the essence of that verdict. How important was it in terms of cleansing political funding in India? And is the journey over? Is there more work that's required?
Well, the journey is not over. There's still more to be done because muscle power and money power are still ruling the roost in our political system. And we all know the major, this thing was, the electoral bond scheme was introduced by the government in the name of transparency, whereas it was actually the opposite. Everything was opaque. If you do not know who the donor is, then where is the transparency? But be that as it may, the Supreme Court did not do anything for a few years. It was only in 2019 that the case was taken up, though we had, the hearing was done for the first time, though we had filed the petition immediately after the electoral bond scheme was introduced, saying that this should be scrapped because this is absolutely non-transparent. And of course, then some other people also joined in and helped with the PIL, and when the hearings took place, and ultimately the Supreme Court gave a verdict and scrapped the thing. But I would say a large amount of money, as we know, a few thousand crores had already been donated to the various political parties. Of course, initially it was with the ruling party, then the other smaller parties which were in power in the states also benefited because they also said, why should we be left out? And later on, we all saw how the State Bank of India resisted giving the details of the electoral bonds per se, the paper. And when they were literally forced to do it, then they came out with the details. And after that, we know that various journalists and activists and media houses dug out the whole truth, and so many corporates were found to have donated money to the ruling dispensation. And the quid pro quo, the twisting of arms and whatever, I mean, the various things which came out. But the issue was that nothing much was done after that. A lot of hue and cry was raised. So SIT request was made by various activists to the Supreme Court, but that was not done. So therefore, whatever the money had been received by the political parties went into their coffers. And the right thing would have been for that money to be recovered, because most of it was ill-gotten.
Right, so that's clearly what you're saying is a journey and effort that Professor Chokar had begun that you'd have to continue. Mr. Krishnamurthy, let me come to you. One of the key decisions, one of the key areas where Professor Chokar had an impact was a Supreme Court decision that required an interim direction at that, which required the appointment of election commissions to be done by a collegium consisting of the Prime Minister, the LOP, as well as the CJI. That was, of course, undone with the central government legislation. How critical are decisions like those, are initiatives like those for ensuring accountability and neutrality of the Election Commission?
I have always taken the stand, going in service and thereafter. I have always taken the stand that the collegium system on the lines of appointment of the CBI director or the Central Vigilance Commissioner should also be followed in the appointment of the election commissioners and the chief election commissioner. But there are two other areas which I think I need to mention. One is about the law relating to political parties. In fact, ADR, under the aegis of both Mr. Chokar and Mr. Tirulochan Shastri, drafted a model law for regulating the political parties. I remember that I was in the committee headed by Justice Venkatachalaya to review the law, and we suggested a lot of changes in the law, which need to be seriously considered by the government. But unfortunately, the law regulating political parties seems to be in the back burner even now. The second point is about the funding of the political parties. He rightly objected to the lack of transparency in the electoral bonds. And I feel it is still an open issue. Unfortunately, he has died prematurely. I think some changes are required in the political funding. I have covered all these aspects in my new book on Beyond the Ballot, Paradoxes of Democracy. Mr. Chokar and Mr. Shastri, because I have visited them when they were in the IIM Ahmedabad. I have addressed the meetings of ADRs both in Ahmedabad and Delhi. And it is indeed a very unfortunate thing that his work is not completed, but I am sure his institution and like the person who is representing the ADR now, Major Verma, I think they should all take it up and they should not leave this any unattended. I think we have to aggressively fight for electoral reform, because almost all political parties do not seem to be giving any importance to electoral reforms, which in my opinion are very important. One more thing that I think I should mention is the kind of first past post system that we follow is outdated. It needs to be replaced by a more authentic representative democracy.
Right. We're completely out of time. Major General, I'll come to you for one final comment. Speaking of work that needs to be continued, the SIR matter, the Bihar SIR matter, special intensive revision. ADR is a petitioner there that's being argued before the Apex Court as we speak. Again, what to your mind are some of the important takeaways that ADR will need to be pushing for? Is a delinking of the SIR with the election is something that is required, something that you'll be batting for in the Supreme Court?
Yes, that was one of the prayers of ours, and since the matter is sub judice, I wouldn't like to say much. The hearings are going on, and the next one is, I think, on Monday. So let's hope that it works out in the interests of the common voter and the citizens, and it becomes a exercise in inclusivity and not exclusion of people.
Right, Major General, thank you so much for joining us. Mr. Krishnamurthy, thank you for taking our time to speak to us about Professor Chokar, his journey. Again, number of contributions, last 25 years, which have taken electoral democracy a step forward. But as both the former CEC, Mr. Krishnamurthy, as well as Major General Verma were pointing out, that there were various initiatives which are still awaiting, which still need regulatory clarity, whether that's regulation of political parties, whether that's instances and exercise of power under the special intensive revision. These are efforts which ADR says they will continue going forward. But that's unfortunately all the time that we have. We're heading into a very short break, but don't go anywhere. With 10 days to go for India's festive season, Samsung India is positive that the consumer sentiment will be robust this time around. An exclusive conversation when we come back. Welcome back. With 10 days to go for India's festive season, Samsung India is positive that the consumer sentiment will be robust this time around. I caught up with Raju Pullan, Senior VP and India Head at Samsung Mobile, where he has said that the GST rate cut will boost consumer spending and he expects the company to be ahead of the industry this festive season.
India has almost 700 million consumers who are Gen Z and millennial consumers. These are consumers who are fast adopting technology, right? And as I mentioned a couple of minutes back, is that we see the demand for smartphone pre and post the announcement to be steady. We've not seen an up and down, which means that the inclination of consumers to adopt technology will continue to be there. And our endeavor as a brand will be, how do we make technology accessible to consumers, technology affordable to consumers, and technology aspirational to consumers. And that's the philosophy of Samsung Galaxy for everyone.
Let's talk about the festive season. Days away now, November 22nd is when the Navratri season kicks in. What is your expectation from festive season this year? You mentioned you've had an impressive H1. What are your expectations from H2?
We expect the volumes to be muted during the festive season. We are seeing a very strong uptick in case of the premium segment even now. In spite of the GST announcements that is there, we have not seen any major ups and downs in the overall smartphone business. There is a steady run up to the festival season, which is a very, very positive sign, which means the consumer sentiments are up. We expect that during the festival season, we expect to be ahead of the industry with these new launches, almost a double-digit growth with these new launches that we have got in the smartphone category.
Just a couple of days back, Local Circles had come out with a very interesting survey. In that survey, they revealed findings that 6 out of 10 households, they're looking to spend about more than 5,000 rupees this festive season. The same report also says that 4 out of 10 households are looking to spend over 20,000 rupees as a part of the festive spend. This data coming in with respect to there being a willingness to spend, what does that do for your expectations? You mentioned that volumes may be muted, but on the value side, you're looking at a pull towards premium devices?
Ashmit, the way we look at it is that every festive, consumers save to build up to the festive because they know that they're going to get the best offering, they're going to get best ecosystem, multi-buy offers and all that. We believe that this time, the consumption economy will be a little more positive, right? And because of the savings that's going to get built up because of the announcement that is there, I see that in the Bharat markets, that is in the tier 3 and 4 towns, we see that momentum to be a little higher because of the consumption economy stronger there. It's more self-reliant economy there, and there could be higher amount of saving there. And that is where we are pivoting. We are definitely looking at premiumization there. We are looking at consumers, not only looking at products which are at the entry price point, but also looking at we are hopeful that consumers will upgrade to the next level of products during the festival season.
Well, India represents a gaming population of nearly 500 million. That's 500 million. With the size of the pie this large, South Koreans' Krafton India subsidiary is doubling down at a time, especially interesting at a time when there's a law banning real money gaming while promoting esports and social gaming that has been enacted by the Indian Parliament. So what is the impact? Why is Krafton India bullish on India? And what are the challenges in the Indian market? To seek answers to some of these questions, I spoke to Sean Sohn, CEO of Krafton India.
We have been investing in India since 2021. We have invested roughly 200 million so far. And we are actively looking at more investment opportunities and also looking at more acquisition opportunities. So we are planning to at least invest around 15 million every year or more. And I believe that there are lots of opportunities in India, especially in gaming industry.
Give us a sense of the challenges that you face here in terms of pricing, in terms of monetizing, as far as the Indian geography is concerned.
Yeah, that's also, again, very great question. So, as you said, India is boasting of 400 or 500 million gamers in terms of, number. But then the size of the market, based on the revenue, is relatively small, which I believe on the social gaming side, it's maybe slightly above 1 billion-ish in US dollars. So I think given the size of the number of users, I think the revenue is still yet to grow. While Petrobras Mobile India has 240 million downloads for the last 4 years, which is also very big numbers in terms of, compared to other global markets. While the revenue itself, I think it's a modest size. So I believe overall India is still lower in terms of paying user ratio. I think mobile games, as you might be aware, it's mostly free-to-play games. So users doesn't have to pay to play. Users are supposed to spend money when they feel like to. So that's how free-to-play model works. I think India has a lower ratio in terms of paying user ratio, and also in terms of ARPU, which is average revenue per user, is also lower than global averages. So that makes India market is smaller than the number of, given the size of the user base. But I think it has a very strong potential that we will see at least double-digit growth every year in the coming years.
talking about India again, we have to address the elephant in the room. We've seen the online gaming law passed by the parliament, has been approved by the president, awaits notification. Tell us first, big question, the impact that you are feeling, that you are experiencing. How are you accounting for this new law in your plans going forward for India?
Well, I mean, obviously, I'm not in the position to, to make comments about the government policy. While when we look at the impacts from the bill is, I mean, we are in like non-RMG side, we are in the social gaming space, so we are not directly impacted by the law. But given the direction of the law, we believe that there will be further rules and regulations and guidance from the government. So we are still yet to see the detailed rules and regulation and guidelines from the governments. But I believe the government will, and also the interviews from the government's bureaucrats who are involved in this bill. We believe that government has the intention to promote and encourage the development of gaming industry. For the benefit of economy and the job opportunities. So I believe that we expect that there will be productive and constructive discussion between industry and the governments. We are hopeful that we also want to be part of the consultation process.
At the time of operationalizing the law, there was few niggles that were experienced, few teething issues. Have you managed to get clarity on issues such as in-app purchases, subscription rewards for users, for gamers? Is that something you've managed to get clarity on?
Well, I believe mostly what our games and most of social gaming players has been utilizing in terms of in-app purchase and subscription. I think it has been in line with the global standards. I believe that there's no issue with the clarity or whether it is allowed or not allowed. So I believe that we are in the safe position in terms of continuation of our business.
Can we see Krafton India listing on the Indian stock markets?
Well, I think we still have a long journey to go before we can talk about IPO. But definitely, I would be very happy if we can make it happen.
Well, that was the CEO of Krafton India, not ruling out a possible Indian IPO. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here on CNBC TV 18.
welcome to Standard Chartered presents CNBC TV 18 Leadership Collective. We are meeting in a city that has always been more than just the capital. It's the corridor where policy ambition meets enterprise execution. We'll be in conversation with leaders who are defining what it means to lead in this pivotal moment, anchoring new era of growth, and charting fresh corridors of opportunity. Now let's start this power-packed evening. Will India's decade forward in the growth will be built on hype cycle or on resilience, deep tech, and power of new talent? To lead this conversation, may I please invite on stage Shireen Bhan, Managing Editor, CNBC TV 18, and to help us decode where the opportunity lies in this push and pull, please welcome Sanjeev Bikhchandani, Founder and Executive Vice Chairman, InfoEdge India, and Ashish Dhawan, Founder and CEO, The Convergence Foundation.
Sanjeev, from your vantage point, not just at InfoEdge, but from the many companies that you invest in, 140 companies at last count, including the multi-baggers like Zomato and Policy Bazaar, how would you size up the India opportunity today?
I'm a founder of several businesses, so I know startups, or I think I know startups. I like to believe I know startups. I may be right, I may be wrong. And therefore, we invest in startups. And we've done 140, and some have worked, and some haven't. I do believe startups will take India forward. The startup ecosystem is buzzing. It's never been better. There are enough very good founders who are trying, many more than there were 25 years ago or 35 years ago when I started out. The quality of the founders is also, I think, a lot better than it was 30 years ago, 35 years ago. Their ambitions, their audacity, their vision, it's significantly different. There is now funding available. There's a whole ecosystem to mentor them, to help them. The market is much larger than it was 35 years ago, and therefore the opportunity is larger. So I'm an India optimist.
Ashish, let's talk about the India story and how you size up the opportunity.
If we put aside some near-term challenges, I think the trends are generally very positive. We have a banking sector that's in great shape. We have a government that I think seized off this ease of doing business and deregulation. It's a big push now, which is a huge, has levied huge friction costs in India. We've grown at 6-7% despite regulation and despite how difficult it is to do business in India. So if we can change that, I think we can grow at 7-8-9% going forward. There are near-term challenges with the US trade deal, etc. But I think once that gets solved and we open ourselves up to other markets, as Sanjeev said, I think with startups now, there's a more competitive, healthy ecosystem in India. Companies are becoming more productive as well. So I'm a Burma bull, as you said, an optimist. And I actually think we will grow faster after this challenging period of the next year. We're already growing at 7.8%.
Sanjeev, your bet on deep tech, because again, there's question marks on whether India has the prowess. Can India really do deep tech? And I know that we are starting to see signs of deep tech companies being built out of India. Your bet through InfoEdge Ventures on the deep tech ecosystem, take us through that.
So I'll tell you, I have a hypothesis. In early stage investing, startup investing, you've got to invest today in a sector, area, company that is not fashionable. Because then you get in at the right valuation, but the company and founders have to be really good. And then if things turn out your way, then the herd follows maybe after 2 years or 3 years. So you got to be there before the herd comes. When the herd comes, valuations go up, you get a great return. So can you predict where the herd will go and then go there before?
Ashish, the deep tech story that's playing out. We've just got Semicon the 2.0 at Yashobhoomi, which is currently underway. How do you play this deep tech story? Do you believe that beyond the government backing, support, subsidy, what have you, that, private capital is likely to venture into this area?
Government support is critical, and it can help crowd in private capital. I think the semiconductor is a great example where, because of the center putting up a huge capital subsidy and then state governments also, that really you only had to put in a quarter of the capital. And that's what brought in private capital and then joint ventures and other things. PLIs played an important role in initially getting assembly, but also pushing up the value chain with components now in electronics. I think this RDIF that government has announced, the 1 lakh crore fund, will be a game changer in terms of stimulating through a fund of funds, deep tech funds, because we really don't have deep tech funds in India. And some of the existing VCs will start to have a higher percentage of their portfolio. And I think money will then create supply as well. People coming out of PhD programs, people who are founders teaming up with them. I mean, you already see some buzz in a few spaces, but I think that supply is still small.
Yeah.
And that could change in the next 5-10 years.
Let me end by asking you, Ashish, I'll start by asking you, the one big takeaway from your own career as an investor and as an entrepreneur that you'd like to share with us this evening.
Separate the signal from the noise. India is a growth market. You should obviously be cautious at periods of time, but long-term, be positive, be an optimist is very important. And the best opportunities come when there is this short-term pessimism, in a sense.
Sanjeev?
I think it's good that the government is emphasizing manufacturing. I think it's good that a lot of the media is saying manufacturing. While it's important to push manufacturing, understand that your natural strength is services. So don't ignore that. Because that is what is delivering results right now. Manufacturing may take 10 or 20 years to deliver results. So services ko bhulna mat.
Ladies and gentlemen, a big round of applause for Sanjeev Bikhchandani and Ashish Dhawan. While our last session focused on where the capital flows, this one is about how companies will scale. Ladies and gentlemen, please join me in welcoming Mr. Sanjeev Puri, Chairman and Managing Director, ITC Limited, and request Shireen to please join us. What is the current R&D investment that ITC is doing? And I know that this has been something that has been part of the culture and the DNA at ITC for many years now, Sanjeev.
R&D for us is very important. In many of the categories that we are there, we are challengers. So we realize we cannot just succeed by, doing the same thing. So innovation and differentiation is very, very important for us. And we have a large R&D center at Bangalore. We are incidentally some years back, a private research identified that the ITC Life Sciences and Technology Center was the largest private sector innovator in India. And we are, of course, not in the kind of sectors where R&D index is of a very high order. We are not in those kind of sectors. Yet, we were classified as the largest private sector innovator. In our research, there is stuff that takes 5, 7, 8 years to come to the table. Even when I'm developing, plantations for our paper business, which are disease resistant or weather resilient, by the time the whole thing gets commercialized is about a decade. So there are long-term investments there. So there is a lot of work happening on R&D
so there's
long-term also.
Enough patient capital at work.
Yeah, there is no hesitation from investing that. I think it's about citing the opportunity and the business case. And we remain committed to that.
Let's talk about investment. You are actually putting money into investments. You've got a 20,000 crore rupee capex plan for Bharat, so to speak. What are you seeing as trends on the investment side from an ITC perspective as you build out for the future?
So we are very optimistic about the potential in the Indian market for the reasons I alluded to. The headroom to grow. At the end of the day, the economy, despite all the global challenges, Q1 was 7.8, which is brilliant. And we have been, the forecast around 6.5 or so. So it's a significant growth there. And that opens up many opportunities. And that is why we are investing that kind of money. Although we are not in I would say, a capital intensive sectors, though paperboard a little bit, but others are not that capital intensive. But still, we are putting that amount of capital because of the opportunities we see in FMCG, in agriculture, in paperboards, and tourism. So all of these sectors have enough headroom to grow.
Leave us with what could potentially be a category that you hope to get into, that you hope to disrupt, or you hope to create?
For competitive reasons, I don't want to name too many of them.
Okay.
But one area certainly that it's a well-known area, and I think India needs a lot of it, and India needs India-centric solutions, and I think that's the area of proteins.
So proteins, that is going to be the category that ITC intends to disrupt as the next big thing?
In future, yes. In future, yes.
And
because we want to create an Indian solution. We want to create an Indian solution.
The one thing that's most exciting to you today as far as the India story is concerned?
I think what is exciting to us is that there are very strong structural drivers in India, huge amount of opportunities, and we have a government that has, of course, done a lot of things and has very clearly stated the intent to do a lot more. And the first demonstration is the GST. I think that really adds to the excitement and dynamism in India. That's what excites us.
Sanjeev Puri, a pleasure speaking with you. Thank you very, very much for joining us.
As global tensions rise and US doubles tariffs, trade routes and risks of being reciprocal in real time. Yet amidst this turbulence, new lanes are accelerating, particularly between nations of Global South. To understand what this means for capital, compliance and confidence, please welcome PD Singh, CEO, India and South Asia at Standard Chartered for a fireside chat, the Corridor Code, Banking the Global South with Shireen Bhan.
You know, a lot of the conversations that we've had so far continue to focus on the changing dynamics that we're seeing, whether it's tariffs or it's geopolitics. What does all of this now mean as far as trade in itself is concerned?
Global trade is completely disrupted. We're living through a complete historic change in the way lines have been drawn. New blocks have been formed, new alliances, new trust factors. India is at the center of West Asia, Europe, and in many parts can use its geographical advantage in a very strategic manner. Now, in this aspect, how will we adapt and how quickly will we move forward on this aspect? So when we look at the multilateral alignment that we've tried to already build in a very short period of time, so whether it's the Europe FTA, whether it is the $70 billion of investment that Japan has committed, our own conversations with the India-China corridor, I think a lot has happened very quickly, and that will continue, and that will shape the way we look at global trade from an India perspective. But if I look specifically at the Global South, which is what is of great interest to a lot of us, 133 countries, 62% of the world's population, 30% of all trade that happens in the world happens in this part of the world. In fact, this could be $14 billion of trade by 2033. And we are already seeing the shift in this trade happening from the more traditional minerals and traditional products being exported and imported. We are now seeing this move to automobiles, manufacturing, a whole lot of more sophisticated products that are going through the pipe. As we evolve, we're going to have to make sure that all of this is done in a more sensible manner. Why first the Global South and what are the risks? That's what I think is on top of our mind. So why the Global South is because I think logistically probably the most convenient, where you can add value. There's been a lot of investment in ports, roads, connectivity, data, a whole lot of things that can enable these corridors very easily and take it to the next level.
From a readiness point of view, whether it's treasury, compliance, and so on and so forth, how geared up are we to make good this opportunity that you spoke of?
Yeah, it's a very relevant point. We're living through a complete global reset. In this global reset, we are seeing new alliances that are being formed. The way we do trade finance, the way we manage our liquidity, the way compliances are being done. So banking is going to change completely from what we see. So banking cannot remain completely isolated from where we've been so far. Let me start with probably trade finance. So trade will move from paper to platform. LCs will be probably digital contracts. AI can work faster than any analyst in looking at risks when it comes to trade finance. All of this is moving at such a pace that is very encouraging, and I think this is where we're all spending a lot of time. But for us, I think it's not a tech shift. This is actually a global strategic opening. So what can India do to do this? So one is, of course, digital at scale, think multipolar, which we're doing, strengthen the regulatory agility, which we heard about from some of the other panelists. And last but not the least, I think we need to empower our banks, strengthen our banks. Banks by capital, by human capital, and make sure that the regulatory flexibility exists as things change as quickly as they do. So in conclusion, I can say the map of money is changing.
You know, you talked about raising capital offshore as well. And I think since we are discussing global aspirations as far as Indian companies are concerned, how critical is that also going to be as we play for global markets, as we play for scale?
So I think the role of banks is not just one of financiers, but that of enablers. When I say that, I mean the bank needs to understand what is the structure, what is the risk, what is the capacity, and understand global financial markets for their customers. It's not a simple bring your investor and get the customer's job done. I'll give you an example that has, for example, State Bank of India has closed a $500 million bond at the tightest price ever. And this is just on the heels of a similar transaction they did, which we thought could not be beaten. But using opportunities and windows like this, I think that's where advisory, structure, capability, and making sure that the right risks are highlighted. And unless that is done, I think the trust coefficient that is required from a banking institution is something that needs to be balanced very well. And if that can be done, doing your business along maintaining the trust coefficient, I think then you have a win-win for everybody on the seat.
Let me end by asking you what looks good at this point in time from your vantage point as far as the India opportunity is concerned, in light of the many opportunities that you just spoke of. What is Standard Chartered going to be focused on?
A lot of our customers want to exploit these new corridors, if I can use that word, want to use the opportunity. And again, it's a first mover, it's a winner gets it as quickly as you can. So to help Indian corporates, MNCs, and large financial institutions in the country become corridor natives is our key ambition as of now.
Corridor natives, we have coined a new term here. PD Singh, thank you very, very much for joining us here at the Leadership Collective. Appreciate your time, and thank you very much for being a part of the conversations here this evening. Ladies and gentlemen, a big round of applause for PD Singh. Thank you very much for being here this evening.
Now let's direct our conversation to the topic that is both urgent and essential: sustainable infrastructure. To lead this discussion, may I please invite on stage Parikshit Luthra, CNBC TV 18. And to explore the path forward, please welcome Sumant Sinha, Founder, Chairman, Renew.
You took a bold bet in 2011. What made you take that risk? You were with Suzlon Energy before that?
The bet, when I look back on it, was bolder than I had imagined when I was taking it. But it was clear to me even at that time when I was looking at this whole area that climate change was going to become a very important issue. And I don't know how much you all follow climate change issues and where we are, But even back then, in 2009, 10, it was quite clear to me that it would become a pretty central and defining issue of our times. And getting into clean energy was one way, obviously, of dealing with the whole issue. And I felt, in going from a corporate career and trying to become an entrepreneur, I did realize that whatever you do, you have to get in there early. And so I thought that getting into that particular sector at that time was early enough where I could, as an individual, go and raise third-party capital and build a business.
As one of the early leaders in this space in India, what were some of the challenges that you faced?
Many challenges at that time. I think, first of all, of course, renewables was more expensive than the alternative, which was thermal energy or coal-based power at that time, which was going through its own challenges. If you recall, there was this whole issue of cancellation of coal blocks. A lot of companies had set up capacity without either coal linkage or PPAs. And a lot of the banking sector that had lent to the coal sector had suffered quite a bit at that time. And so they were a little bit wary of lending to the power sector in general. And we were, of course, a power generator at the end of the day. And so it took a lot of education to the lenders that, look, this is a different kind of sector. And this is a different kind of business. We don't have any fuel risk because obviously it's natural. And we were only doing things on the back of long-term PPAs, so that was also not a risk. But it was still very early. And so convincing and educating all the bankers, I think, was very important.
Today, if people are getting into this business, new entrepreneurs, they have the broad policy goals there in place. But currently, do you feel, has the climate agenda, the renewable energy transition agenda taken a backseat because of the wars that we are seeing, because of geopolitical realignments, the kind of trade tensions we're having with the US?
I think as far as our sector is concerned, there are two aspects, two ways to think about it, right? One is the imperative coming from a climate change standpoint. And there, clearly, the pressure has weakened in that, the US has obviously pulled out of the Paris Climate Accord. Now they're actively trying to push the fossil fuel agenda, which is not at all good for us as a human race and as a world. But that's what they're doing. The European Union, which is a big driver of some of these actions, has also got distracted. So they are also not moving as much as they should be right now. They're having to spend more money on defense. The whole geostrategic issue and defense issue is uppermost in their minds. But I think as far as India and China are concerned, which are two of the big drivers of our sector, I don't think anything has changed fundamentally. China continues to roll out the capacity that they were doing earlier. India continues to do the same. Now, I would say that while, of course, at a government level right now in India, the thought is obviously about how to deal with all the trade disruptions that are being caused. But I think our sector is on a bit of an autopilot right now. Things the systems have been put in place, the structures have been put in place, the policies are there. We just need to go out and keep rolling it forward. And that's really in some ways what is happening for us. So it's fine. I think we are okay.
What's the one leadership advice that you'd like to leave our audience with?
As a leader, you really have to build things for the long term. India needs it right now. We need a lot of infrastructure. We need a lot of really good quality companies. So I would say whatever you do as an entrepreneur, build a business for the long run. And one very important part of that is to really build a strong organization with really strong governance, strong value systems, and really great people operating in a way with each other, which is really the kind of openness, transparency that is required. Okay, so I think building an organization is something that most entrepreneurs don't realize when they're building their business, that you're actually not just building a business, but you're also having to focus on building the organization for the future as well. So I think that is an incredibly important thing to consider also.
Thank you very much, Sumant Sinha, for an excellent conversation this evening.
The future of Indian growth will be built on the back of resilient corridors, corridors of capital, corridors of trade, and corridors of talent. This evening, we have heard from the leaders who are not just talking about these new paths, but they're actively building them. On the behalf of Standard Chartered and CNBC TV 18, thank you for joining us. We'll see you in the next one.
Hello and welcome to another episode of Market Masters. Today we have with us Manish Shukani, Director at Enam Holdings, one of India's most respected financial minds. It's been 5 months since we last spoke with Manish. Manish, welcome back.
Thanks for having me back.
The hot seat. Manish's big call when we last spoke, and it's been his call for longer than that, was that hard assets will do very well. Given the state of the world, I mean, given the general, should I use the word despondent state of the world, I went back and checked what has the Nifty done, what has gold prices done since last time we spoke, since we had Manish here, which is from the 15th of April. So, from that point on, MCX gold, so we want to compare, same currencies. MCX gold, which is in rupee terms, is up 17-18%. The Nifty in the same period from the 15th of April till now is up 6%. So you got, a 3x kind of outperformance on gold as compared to what the Nifty has done. Of course, this is a very short time period. You can stretch this longer, and I think the outcome does not change, maybe even gets even sharper in that sense. So he's got that particular call bang on. His other big call was that India is uniquely placed in the new Trump world. Now, the outcome for this has been a little mixed. We are uniquely placed, but on the other end of the spectrum. Manish,
sure.
So I want to start with that.
You want to get me thrown out of the equity markets, yeah?
I mean, just crazy, right?
Yeah.
I mean, who would have thought?
Yeah, I mean, honestly, for what's happened with US and India was a surprise to everyone, I think, including to the protagonists over here.
Yeah.
Something changed during Sindoor.
Yeah.
And then I'm guessing something's changed over the last 1 week again to bring things back to what looks like even keel. But yeah, I mean, if you zoom back in a larger context, India and US have been the two best performing markets in the world, the best democracies and the best sort of places for capitalism to thrive.
Yeah.
So that narrative doesn't change. You get, as people say in geopolitics, from time to time you have spats with friends and you only have a spat with someone you love, I guess.
Yeah.
So I think that comes back on even keel. Having said that, this market was being driven or is being driven really by price agnostic domestic flows. And you saw it kind of shrugged off this tariff shock.
Yeah.
As if nothing had happened.
Yeah, the market has barely responded.
Yeah, but it's actually a small segment of the market which would have been affected because he exempted pharmaceutical, because generics, half of what the US consumes comes from India. So they would have been shooting themselves if they did that. And then they had to exempt electronics because all the iPhones which go would have landed up more expensive to them. So of the 80 odd billion, 40 billion was anyway excluded from this tariffs. And the big numbers which got affected were unfortunately textiles. Textiles constitutes a very small portion of the market.
Yes.
And there are 2, 3, 4 companies which are relevant over there, which also did not really fall as much because market also looked beyond ki 6-8 mahine mein ye kuch na kuch ho jayega. And which seems to be the case. Plus there was also on the horizon the EU FTA. Which also should then come and then give a fillip to all these exporters. But the larger issue, of course, remains that India, as an emerging third largest economy of the world, is still not a player in global trade. So we don't seem to have stuff which the world really misses, and therefore we didn't have cards, whether it came to China or, like Trump famously says, you don't have the cards, you don't have the cards. So there were no cards really.
What are rare earth?
Yeah, so like how China just switched that off and, boom, there was no noise about China buying oil from Russia and so on and so forth. So we clearly will need to step up our act to become a little more important in the world.
So let me ask you this.
I'll just close on that, but it's also created some difficulty with every country in the world now wanting to localize and bring back investments into their country. It puts a question mark on FDI. Because if you were looking for Americans to invest in India, Europeans to invest in India, it may be written into our FTAs, like we signed one with the Europeans, excluding the EU, the one he did with Switzerland and others.
Yeah.
But it's over 10 years. And if everyone is going to, for example, even in Europe, invest in their infrastructure, invest in their energy and invest in their defense, US wants to bring semiconductors and everything back to the US. What is the 2-3% FDI flows that we were looking for? What happens to that? Number two, if this domestic flow keeps pushing asset prices up so much in India, the other smart money, which is private equity, tends to then not make investments in, and rather they've been taking investments out. And thirdly, you're finding the strategics to whom typically we sold our companies are now, the Akzo Nobels are selling to our Jindals, for example. And the Bhartis and the Singtels are selling down to our retail investors. The Koreans are coming and selling down to our retail investors. So that's a bit of a muddle we are in. And in that context, if you don't have an export engine firing, you don't have an FDI engine, you don't really have a capex engine, I think it was inevitable that what happened with this GST to kickstart this consumption cycle is a necessary and a great thing that the government has done.
Manish, so just to tie off that US-India point, what is your forecast? You think it'll get done before the end of the year?
I mean,
look, I mean, the 25% of course has to go.
Yeah, I mean,
right?
you're not going to get to, I mean, again, it doesn't change anything. Yeah. Even if you get to the 15 which the allies have, which is Japan, Korea, UK, I don't think we get to 15. But if you're at 25 and you have some
convened to brief you on the key policy decisions taken in today's SEBI board meeting. It is now my privilege to invite SEBI Chairman Sri Tuhinkant Pandeyji to address you. Following his address, we'll open the floor for questions. Each of one of you are requested to limit yourselves to 1 or 2 questions. And please mention your name and name of the media organization before putting on the questions. Thank you.
So good evening, friends. The SEBI board met today, and I will just explain to you some of the decisions. The first one is relating to the minimum public offer and the timelines to comply with minimum public shareholding for issuers in terms of SCRR rules. Now, these are SCRR rules are notified by the government. So, the board has only a recommendatory power here. The actual decisions will be taken by the government, and then as per the decisions, then due notification will take place in due course. As you know, the public consultation papers have been circulated and comments have been received. It has also been discussed in the committee, which is relevant to the primary market. So, one of the main issues being faced in the large issuers, they face challenges in undertaking substantial dilution of equity shares through IPO, as large offerings may be difficult for the market to absorb. These constraints can act as a deterrent for large issuers from considering listing in India, thereby limiting the investment opportunities for the Indian investors. So now we are recommending, the board has recommended that there are 2 share thresholds, post-issue market cap. One is 4,000 crore to 1 lakh crore. So there's no change before that. The post-issue market caps, less than 4,000 crore remain as it is. But we are creating 4 more thresholds after the 4,000 crore. 4,000 crore to 50,000 crore. 50,000 crore to 1 lakh crore, 1 lakh crore to 5 lakh crore, and more than 5 lakh crore. Then for 50,000 crore but less than or equal to 1 lakh crore, in this category, it is proposed to revise the minimum public offer from the current requirement of 10% of the post-issue market cap to 1,000 crore plus 8%, at least 8% of post-issue market cap. So this is a scale-based thresholds we are bringing. Now for 1 lakh crore and above, so it will be, 6,250 crore, and at and at least 2.75% of post-issue market cap. So this is plus. And which is market cap above 5 lakh crore, it will be 15,000 crore plus 1% of post-issue market cap. There is another proposal regarding the timelines. Now, where we have the post-issue market cap above 50,000 crore but less than or equal to 1 lakh crore, is proposed that the timeline for compliance with the MPS requirement of 25% may be extended from the existing 3 years to 5 years from the date of listing. The next proposal in this chain is that wherever the post-issue market cap above 1 lakh crore, it is proposed that the timelines to comply the MPS will be bifurcated into 2 buckets. If it is the public shareholding is less than 15% as on the date of listing, then MPS of 15% is to be achieved within 5 years and 25% within 10 years. In case public shareholding is 15% or above as on the date of listing, then the MPS of 25% is to be achieved within 5 years from the date of listing. Under the current rule, MPS of 10% is to be achieved within 2 years and 25% within 5 years, which is now being changed, in terms of recommendation. Now, the proposed extended timeline, of course, may also be grandfathered, may be made applicable to the listed entities who haven't achieved MPS still, but whatever shortfalls, whatever fines are happening, that will continue due to the non-compliance till, of course, the new rules take into effect. Another important proposal in this regard is, if you recall, that there were initially a proposal to reduce the retail reservation for retail individual investors from 35% to 25% in order to address the same problem. Now that this problem is being addressed through change in structure of the MPO, so therefore a reservation for retail investors is being retained at 35% of the net offer. Now I move to the next proposal. The next proposal relates to the amendment to SEBI ICDR Regulations 2018. The purpose is again ease of doing business and also ensuring that the existing limits on anchor investors, they are constraining fund level participation by large FPIs in terms of numbers of anchor investors. Also, there is lack of reservation for long-term institutions like insurance companies and pension funds limits, and this limits diversity in anchor books. So therefore, the amendments, number one, we are proposing that the anchor investor allottees, there are 2 categories. There will be only 2 categories now. So there is another category, anchor allocation up to 10 crore. That category 1 and category 2 is being merged. So it is less than 250 crores, up to 250 crores allocation and more than 250 crore allocation. So one is the category change. Secondly, reserve 40% of anchor book for mutual funds, life insurance companies and pension funds, in which 1/3 of the reservation will be for mutual funds solely, and the balance 6.7% will be for life insurance companies registered with ADAI and pension funds registered with PFRDA. Again, this has been due to during the long deliberations in PMSE deliberations, and consultation paper was also released and comments had been received as well. The next proposal is relating to amendment to SEBI LODR regulations and the circulars thereunder for the objective of facilitating ease of doing business related to related party transactions. Now, in this category, we are addressing the following issues. The current provision at Regulation 23, subsection 1, sub-regulation 1 of LODR requires shareholder approval for RPTs exceeding 1,000 crore or 10% of consolidated turnover of the listed entity, whichever is lower. This has become onerous for listed entities with high turnover. Okay, before I come to the proposal, let me make it clear that the related party transactions, so far as the disclosures are concerned, so far as the audit committee approval is concerned, nothing is being changed. So therefore, disclosure will remain as it is. The audit committee, you know that they are chaired by independent director, and it has to go through RPTs, have to go through the audit committee. That will remain the same as well. Only the shareholders' approval. If some of the material RPTs go for shareholders' approval, and what I'm saying is a change is only for the shareholder approval, where it is becoming onerous for listed entities with high turnover. This limits of 1,000 crore, the 10% or 1,000 crore turnover was fixed some time back. And if you have a very large turnover company, so obviously 1,000 crore becomes a very small proportion of their turnover, and there will be much larger number of transactions which will require shareholders' approval. So the attention of shareholders is required on the material transactions where the more attention will have to be needed rather than larger number of RPTs. So therefore, this problem we are addressing. I'll come to that, how we are addressing. This problem we are addressing through changing we are bringing the scale-based threshold has been introduced to annual consolidated turnover as per last financial statements for determining material RPT. Then the second problem was relating to, in some cases, there was a mismatch. While the subsidiary having audited financial statement where 10% of the annual standalone turnover of the subsidiary or the scale-based threshold for material RPT, we are bringing whichever is lower. In many cases that the subsidiary, there was an RPT which was as per the subsidiary turnover was relevant, but it was not going to the audit committee of the listed entity. That particular loophole has been plugged through these changes. The third change is that if an RPT does not exceed 1% of annual consolidated turnover or rupees 10 crore, whichever is lower, then the listed entity shall provide less information in simpler form than compared to the RPT industry standard. You may recall that we have recently made changes where industry standards have been brought in, where there is information has been standardized in order to, for the audit committee as well as for the board as well as for the shareholders. There has to be information in a proper format. Industry standards have come. But there, if it is if the RPT is less than 1% of annual consolidated turnover or rupees 10 crore, whichever is lower. So effectively saying either 10 crore or below, in that case, the simpler form of information may be necessary rather than the full RPT standard. So this has been based on certain difficulties that being faced on very small RPTs in terms of the amount. Then the fourth change is again more in terms of clarification, because there is a circular which provides for validity of omnibus approval for RPTs granted by shareholders. Now these are today in the master circular. We are bringing that in the regulations for greater clarity, so that all RPTs regulations around RPTs are in one place rather than split into regulations and circular. And the fifth item in this is retail purchases from any listed entity or its subsidiary by its directors or key managerial persons or their relatives. Now, this is already there, but there have been some problem areas in that. In terms of related party definition, some of the other relatives of directors are also come in, and relative of key managerial persons. So they also need to be excluded. Like we have excluded the directors and the key management personnel, but since there are other relatives of these parties are also related parties in terms of the LODR, so they have not been exempted. So that loophole has been plugged. Also the fact that employees were inappropriately included earlier. They are not in related party, but they were in the earlier version they were included. So they need to be excluded because employees are actually not the related party in terms of definition of LODR. Another technical point here has been the holding company in terms of Regulation 23(5), where some element of doubt has been there whether the term holding company refers to the listed holding company, and that through an explanation is made clear. So this is again for the purpose of removing ambiguity and bringing clarity. The next proposal relates to give a regulatory fillip to accredited investors in AIF. I think before that, let me first take up the IFSC issues. So, as you know, that if GIFT IFSCA, there have been many changes and enablement. Now, we already have, in terms of AIFs, a provision that now the IFSCA has made a request to enable retail scheme with resident Indian non-individual sponsor manager to register as FPIs. Now, this may be, this is already for AIFs, this is already permitted, now being permitted also for the retail schemes. Then the second one is the condition of resident Indian non-individual to be sponsor or manager of the FPI may be substituted with fund management entity or its associate for IFSC-based FPIs. This is to bring it in consistence with the IFSCA regulation. Then the maximum limit in contribution by resident Indian non-individual as FME or its associate in AIFs and retail schemes set up in IFSC may be specified at 10% of the corpus of the fund or of the AUM in case of retail schemes. This is actually varying in the FPI regulations, varying from the regulations of IFSCA. So this has been brought in alignment with that. Then overseas mutual funds and the trusts, unit trusts registering as FPI may be permitted to have Indian mutual funds as a constituent subject to the conditions as mentioned in the circular dated November 4, 2024. So we have already permitted, SEBI has already permitted the mutual funds to be constituent of the FPIs who are registered as overseas MFs who are registered as FPIs in IFSCA. But FPI regulations had not been amended, so this has been now amended to this will be amended to ensure that that particular dispensation will now will be made operational. Now, the next scheme is to give a regulatory fillip to accredited investors in AIFs. If you please recall that in the last meeting, we had press meet also, we had mentioned this, that accredited investors need to be, because they are investors who are, having three kinds of investors are there, as you know. AI, accredited investors can, the eligibility conditions are 7.5 crore net worth, or out of which 50% is financial net worth, or 2 crore income, or 5 crore net worth plus 1 crore income. Either of the criteria, they can be called as accredited investors. They have to be registered. Now, we are now proposing a definition of, we are actually making amendments for the AIF regulations to provide for AI-only funds. That means the specific schemes for AI-only under the AIF. This will provide relaxations, because AI we consider as who know the risks better, and AIF schemes, as you also know, that AIF window is more like for those who understand risk, they can come to the AIF. So therefore, we can provide for more relaxed dispensation regulation for AI-only funds, which includes exemption from pari passu requirement, extension of tenure to be permitted up to 5 years from 2 years, exemption from NISM certification requirement for key investment team of AIF manager, exemption from restriction on number of investors in a scheme. So then the second part of the proposal is that we have a large value funds where additional flexibilities are being extended, reduction of minimum investment amount in large value funds by investors from 70 crore Indian rupees to 25 crore Indian rupees, and exempting large value funds from responsibility on members if investment committee set up by manager of AIF to approve decisions of AIF. So another point is that we can provide option to existing AIF schemes to convert themselves to AI-only schemes or LVF schemes to avail the benefits subject to meeting conditions specified by SEBI. Now it's proposed to specify also through circular a certain benefits to the LVF. Now, these initiatives align with SEBI's long-term vision of ensuring that sophisticated investors with necessary risk appetite and understanding efficiently fund good quality capital raising by entrepreneurs and risk takers. Another important issue is that we are taking a staggered approach or glide path for transition of AI-only regime. And AI framework, we feel that, so it's proposed to have a gradual transition from minimum commitment threshold to only accreditation status as a metric of risk sophistication of investor. The next item is we have a proposal to introduce single window automatic and generalized access for trusted foreign investors. We call it Swagat FI framework for FPIs and FPCIs. The purpose is to have a much more relaxed onboarding and compliance regime for certain set of FPIs who have been objectively identified through and they are really trust and verify principle. The identification criteria are government and government-related investors such as central banks, sovereign wealth funds, international or multilateral organizations, agencies including entities controlled or at least 75% directly or indirectly owned by such government and government-related investors. Second, appropriately regulated public retail funds with demonstrably diversified investor and investment base with independent fund managers as mandated by their home regulator. This could be appropriately regulated mutual funds and unit trust, and they could also be appropriately regulated insurance companies or appropriately regulated pension funds. Pursuant to this approval today, SEBI in consultation with industry shall come out with a jurisdiction-wise list for above fund structures on the basis of trust but verified principles in line with the approach adopted earlier. Now, what are the relaxations that we'll have for Swagat FI framework? One, they'll be granted option to also register as FPCI without any further documentation. Second, FCI requirement that at least 66% of their investment should be in FCI eligible unlisted investment would not apply to Swagat FI entities, which means they can have a flexibility of how much they want to put in as unlisted investments in FCI eligible unlisted investments. Third, periodicity for continuance of registration and review of KYC of Swagat FI to be 10 years as opposed to 1 or 3 years for other FPIs currently. Fee of $2,500 shall be applicable for such 10-year period as opposed to 3-year period for other FPIs. Then the cap of 50% on aggregate NRI, OCI and RI contribution will be removed for Swagat FIs. Swagat FIs will be provided option to use a single demat account for holding securities acquired as FPI or FVCI or as foreign investors investing in units of investment vehicles. And depositories will provide for adequate tagging to identify the investment as FPI or FPCI or as a foreign investor investing in units of investment vehicles. Now, this is only actually a beginning, but eventually Swagat FI framework could pave the way to a broader remit covering other investment schedules of FEMA, which will require approval of the Government of India and the RBI separately. But what was possible within the SEBI's remit is being attempted here. Once more than 70% of total FPI AUC will then be accounted for by proposed FIs according to our estimate. This has also gone through FPI advisory committee and a public consultation process. I would also like to inform you, I think we can do it later or right now. So I think just for a break, because we move into other agenda, I would like to inform you that for the ease of doing business and to facilitate the availability of all the relevant information that may be useful for current and prospective FPIs across RBI, CBDT, SEBI regulations to access and transact. What has been really missing, this has come out that, information is not in one place and we are not able to, there's no single website where information is available. So we are launching today the phase 1 of information website for foreign portfolio investors called www.indiamarketaccess.in. So I will invite Aparna to give you a little bit of a demonstration here of the website.
Thank you, sir. Good evening, everyone.
and welcome to Startup Street. I'm Shruti Mishra, and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. The parent company of Pernia's pop-up shop, Purple Style Labs, is set to raise 750 crore rupees through a fresh issue from the public market. This comes after the company's board approved its IPO bid as per Tracker. In April this year, the company had raised $40 million in Series E funding round.
Shares of Brainbees Solutions, the parent company of FirstCry, ends with modest gains. This after FirstCry completes its investment of 146 crore rupees in its subsidiary Global Bees. As part of the second tranche, it made an investment worth 73 crore rupees.
A D2C pickle brand, Farm Didi, secures 7 crore rupees worth of investments in a seed funding round led by Samved Ventures. The capital will be used to strengthen the team, enhance tech-led systems and expand community of rural women entrepreneurs.
Space startup Apex's valuation hits $1 billion after its $200 million funding round. This surge in valuation comes on the back of expectation around demand in defense systems in the space sector.
FMCG company Marico takes full control of HW Wellness Solutions, the parent company of health foods brand True Elements. Initially, it picked up nearly 54% stake in the Pune-based startup in 2022. Marico shares gain in trade.
Gaming platform Zupi is set to lay off over 100 employees following the real money gaming ban. With this, the number of layoffs among the gaming companies have crossed over 1,300.
The Indian government unveils 100 crore rupee scheme to boost green hydrogen startups. The scheme is set to offer 5 crore rupees in funding per project. The focus will be in areas like production, storage, transport and utilization.
Well, those are the headlines that we're tracking for you today on Startup Street. Now, Myntra and the makers of Sugar Cosmetics are joining forces to launch Molten Beauty, which is a Gen Z-focused brand at the intersection of skincare and makeup. The launch comes just ahead of the festive season and Myntra's festive season sale. But beyond the product itself, the partnership raises some questions about Myntra's potential strategic shift, the competitive landscape in India's fast-growing beauty segment, and of course, the impact of recent GST cuts on pricing and margins. To unpack all of this and more, I'm joined by Nandita Sinha, the CEO of Myntra, and Vinita Singh, the CEO and co-founder of Sugar Cosmetics. Nandita, Vinita, thank you so much for your time here on Startup Street. Nandita, I'll start with you about what exactly is the nature of this partnership? Is it a one-off collaboration, or should we see this as a larger strategic shift in your strategy?
I think, as we were looking at the opportunity of beauty in this country, which is really, really exploding and driven by the Gen Z consumer and driven by products or driven by needs which are probably, I would say, unfulfilled right now. There is a wide space. And a lot of the brands have not been Gen Z first brands in the country. I think that was the starting point of the partnership. And therefore, we decided to come together to be able to build an iconic brand for the Gen Z consumers in the country, bringing the strengths that both Sugar and Myntra bring in this partnership, which is one of really understanding beauty and understanding what consumers need from beauty and how they are evolving, and being able to build great products and brands. I think that's what Sugar has been able to do over the last so many years. And then Myntra as a definitive platform for the Gen Z consumers, where our Gen Z consumer base has been growing significantly. Almost 50% of our consumers now are Gen Z consumers. The need for beauty in their lives is ever growing. We will start with Myntra from a distribution standpoint. So that's the other piece of it. But I think the idea is really to how do we really capitalize on the Gen Z opportunity?
Well, Vinita, on your side, why build a completely new brand instead of extending Sugar into this hybrid skincare makeup space? Was there a gap you couldn't fill that needed a fresh identity?
Yeah. So yes, there was a big white space that we identified. If you look at younger Gen Z consumers, I think they're currently getting very overwhelmed by the whole 14-step skincare routines and a lot of different products for different solutions. And they believe in less is more. And they believe in authenticity, ingredient clarity, just understanding claims behind every single product that is put in front of them. And they want to do their own validation before they actually try any product. And we realized that for these consumers, there is an opportunity to do a collaboration with a partner who really gets Gen Z consumers because of their tech-first approach and their ability to serve Gen Z consumers at a large scale, not just in metros, but even in tier 2, tier 3 cities. So we realized that with their understanding of the data, the consumer, our understanding of products, formulations, access to R&D and the labs, we can come together and have a brand which is very focused, which is neither skincare nor makeup. It sits in between.
Well, Nandita, every brand out there is chasing the Gen Z, building for them. You've spoken about Myntra having 25 million Gen Z users. Tell us exactly what kind of opportunity this collaboration or this partnership presents for you, and how do you avoid cannibalizing or clashing with the existing clean beauty brands that are already on the Myntra platform?
Sure. No, I think this year we will have 25 million in this calendar year, 25 million Gen Z customers who are transacting with us. And if you look at beauty consumption, also almost 45 to 50% of beauty consumption is coming from Gen Z consumers. I think what we are seeing in terms of the consumption is that consumers are wanting to really get products which are working for them and which are hardworking, I would say, in a way, but very gentle and soothing in nature. So there is this need for this multitasking product. Like Vinita said, I want to be skin first, but I want to have color, but I also want this product to be multitasking so that I don't have to go through that 14 skincare regime. And I think while consumers want this efficacy and delivery from the products, they are also looking at accessibility as a very important point, because they want products which are accessible from a price point perspective. So I think if you look at all of this coming together, there isn't really anything which exists in the market today. And therefore, we do believe that we have the opportunity to really reach out to the Gen Z consumers on the platform.
Vinita, how are you positioning Molton's pricing so that it doesn't really undercut Sugar's existing line while also staying competitive? And are we going to see more pivots like this, more launches from Sugar along these lines?
Yeah. So this is priced at a mass premium, the sweet spot that we've seen where Gen Z consumers, not just on Myntra, but on e-commerce, really shop. So the entire range is priced between 250 and 400 rupees. The idea is that younger consumers believe in making sure that they are getting value out of their products. Sugar continues to have relatively more masstige positioning. Products are in the range of 500 to 800 rupees. The brand is Sugar is currently 90% color cosmetics, and we do have a few skincare products. But the philosophy, the labs in which these products are created, the manufacturing, all of this for Molton, which is the partnership that we have with Myntra, is completely different.
Nandita, for you, of course, the GST cuts impact a wider segment of your offerings on the platform. To what extent will these cuts boost demand and also reshape pricing dynamics? And how is Myntra leveraging this, especially coming ahead of the festive season?
I think, like Vinita said, I think one coming ahead of the festive season, so it's really timely in terms of how the consumption and how the customer sentiment and buoyancy gets impacted. So I think we're very, very happy that we've been able to, this has happened just at the start of the festive season or the beginning of the festive season. And again, I think while there are opportunities in our own categories where GST, there have been GST cuts and all of the benefits will be passed on to the consumer. But overall, I like Vinita said, I think consumption will see a boost because this is money in the hands of the consumer. So I would say that's how we are really looking forward to this.
But Nandita, could you put any numbers to how much better this festive season could be in terms of sales and demand versus what we saw the last time around?
if you look at, how we plan for our festive season, we always plan for a bigger festive season than the previous year. And that is definitely going to be there. And with this GST boost, I think whether there are brands or sellers and the kind of consumption boost that will happen for these brands or sellers, I think we're looking forward for the entire ecosystem to really get that boost. So we've always, we are looking forward for a bigger and better festive season. And with this, I think this is going to help the entire ecosystem, whether it's consumers or brands or sellers.
Well, Nandita and Vinita, it's been a pleasure chatting with both of you. Thank you so much for your time here today on Startup Street. Thank you.
Well, moving on, and also on what's brewing, Tern Group has raised $24 million in Series A funding to scale its AI-powered platform that helps Indian nurses and care workers build global careers. The IIT Bombay-founded startup has grown 10x in the past year, is nearing 200 crore rupees in revenues, and now operates in 13 countries. With this fresh capital, it's doubling down on AI, training, and global expansion. Joining us now is Avinav Nigam, the founder and CEO of Tern Group. Avinav, welcome to Startup Street. You say Tern is making global careers faster, fairer, and more transparent. First, give us a sense of what's broken in the current system, and then if you could tell us how your AI-powered platform is changing the way Indian nurses and care workers pursue careers globally.
Thanks for having me, Shruti. Great question, very important moment in time. We've essentially got one of the largest shortages in healthcare workers that the world has ever seen. Essentially got close to an 18 million shortage. What that also means is that it's collapsing healthcare systems across the global north, UK, Canada, Australia, US, and so on. And what we're finding because of that is there's an incredible amount of aspiration built into people trying to achieve and get into these roles. So, a country like India, essentially booming with talent, the talent density is extremely high, also has a massive issue in terms of the information arbitrage between, let's say, the talent and the opportunity. So what's happening as a result of that is you've got a lot of these agents and, experts in migration pretending to help people out, essentially charging them 20, 30, 40 lakh rupees to go overseas and find those roles. So there's a lot of scams being operating in this space. That means it's slow, it's costly, it's opaque. So what we've essentially realized is if you could collapse the entire system, these 7 steps between the talent and the opportunity into a two-sided marketplace, essentially a zero-fee AI-powered system that essentially does everything from the first phone call to the credentialing, to the document and data gathering, to the predictive matching, as well as the compliance pieces around visa and immigration. What you've done is reduced hiring timelines by 60%. You've increased success rates of placements by 4x in our case. And you finally built the infrastructure of overseas migration. It's fast, it's ethical and transparent.
Sure. And like I mentioned earlier, you've grown 10x in the past year, nearing 200 crore rupees in revenues, a footprint in 13 countries. Avinav, what's been the biggest unlock for scaling at this pace? And with this fresh round, what's next? Which new markets are you eyeing?
Yeah, I think the biggest unlock in a category like this, as you can imagine, is solving for trust. And it's trust not just at a consumer level, in this case, the candidate, it's also trust with the hospitals that these people are serving, it's with the regulators, it's with the policymakers, it's with the education institutes at a grassroots level. So I think one of the most critical unlocks for us right from the beginning was really focusing on creating trust in the ecosystem. And that is what has actually helped the business the most. Apart from that, the other big thing I think I would argue is technology. Like this was not possible. This company couldn't have been built in the same way 3 years ago before AI, because we've been able to create a perfectly symmetric level of information and provide people access of qualitative information at any given point in time. So it's a seamless system. The capital being used, look, we're sort of doubling down on the markets we're operating in. We're going deeper into Germany, into the UK, into the Gulf states, where we're seeing a lot of migration happening. Japan is another market where we have presence, and the USA in 2026. The other areas we're investing into is AI. We're sort of going fairly deeper into AI researchers, PhDs that we've hired and sort of onboarded into the platform, HR experts, as well as ensuring automating compliance and language training at a grassroots level as well.
All right. Avinav, you're already training 1,000 to 2,000 Indian nurses every year. You claim to hold over 25% of the German language training market in India. What are the next big verticals you're eyeing with this fresh capital?
So we essentially started with nursing, sort of went into physicians, doctors, looking at elderly care as one of a big vertical, given where the economies are going. Average age of 45 to 50 years old in many of these countries. Allied health professionals, lab technicians, radiology, OT staff, and so on. The other piece we're sort of getting into is also academies. So on the training side and the compliance side, specifically for the UK, GCC, and Japan.
Sure. Abhinav, you also claim, and you mentioned earlier in the interview that, you've shortened hiring timelines by 60% and delivered placement outcomes 4x higher than the national average. How do you ensure that ethical recruitment stays core while chasing aggressive growth targets?
That's a fantastic question. I think one of the key challenges in this always tends to be the human becomes a number on a sheet. For us, it's been very important in aligning values of the company towards ensuring that we're actually creating grassroots change. I think that's the core and the culture of the company. I think because we are a zero-fee platform, from a candidate point of view, they're never in the dark about having to spend 20 lakh, 30 lakh, 50 lakh rupees that people are charging them. So that's one big part of the process the employers fund it. Secondly is that AI is actually ensuring complete lack of bias, right? So you're ensuring there's compliance, there's transparency, the documents are verified, you're ensuring people always have access to the full information. And finally, I think the one key thing that I've realized is that if you are, if you're building things in a certain way, if you're ensuring there is high NPS between the talents, between the employers, in the trust deficit system, the business keeps coming back.
All right, on that note, I'll have to wrap up our conversation. But many thanks, Abhinav, for joining us today and wish you the very best with all your growth targets.
Thanks, Shruti. Appreciate it.
And moving on the hot seat, AI is fast becoming the backbone of global healthcare, as we just also did another interaction on that. And an India-US-based startup is right at the heart of that transformation. Reveal Health Tech has raised $7.2 million in Series A funding, led by Leo Capital, with backing from Sanos Capital and W Health Ventures. Founded just 2 years ago, Reveal is positioning itself as an AI specialist for US healthcare and life sciences, helping hospitals, pharma giants, and innovators use AI to improve patient care and streamline operations. The company now plans to scale its solutions, strengthen sales, and deepen its global footprint. Joining me now to discuss this further, Sachin Mullick, the founder and CEO of Reveal Health Tech. Sachin, thank you so much for taking time out and being here with us on Startup Street. Begin by telling us what was the gap in the US healthcare system that Reveal Health Tech is solving for with AI that others haven't been able to.
Yeah, that's a great question. So, across the world, I think from a healthcare perspective, there's been this move from what we used to call episodes of care, so treating for ailments or sicknesses, to managing epochs of care. So you're looking at patient wellness end to end. And when you start taking that lens of patients and start looking at creating these longitudinal views of patients, that's where data comes into its own. Now, over the last 20 plus years, there's been a lot of digital plumbing that has been put in place in terms of enterprise software, EHRs, et cetera, being implemented. And there was the digital plumbing in place to then leverage it to drive better insights, drive better engagement with patients, and so on and so forth. What was missing was probably an operating model which operates at that intersection of deep clinical expertise and deep tech capability, right? So if you look at a lot of the discourse around AI, it's about technology advances, new foundational models, and so on and so forth, and very less commentary around how to use AI effectively in business context. And that's what
absolutely.
we brought in.
Yeah, and if you could quickly tell us, you've raised the $7.2 million in a Series A funding round, and specifically to accelerate your next phase of growth, right? Which is product innovation, sales, and global expansion. Can you outline a little bit about how you plan to use the funds?
Absolutely. So, we've developed 3 core solutions from all of what we've learned over the last 2.5 years. One is called BioCanvas, which is a multimodal data science platform. The second one is called Care IQ, which is an AI-enabled care coordination and provider scheduling optimization platform. And a third one called Prism AI, which is a modular platform for accelerating AI agents. So with a lot of this capital, what we intend to do is really double down on these solutions and build scale go-to-market efforts around these solutions and taking them to both, of course, clients in North America, but hopefully expanding beyond North America to a larger client base as well.
Sure. And, with India sort of emerging as a hub for healthcare AI innovation, right? Do you see Reveal expanding into the Indian healthcare market, or will your focus currently, remain on US for now? And what other markets are looking interesting to you?
Yeah, so US continues to be our real focus. We will double down with this raised capital on US as a segment, US as a geography. We will look to expand into adjacent segments. Our core theme is, wherever there is clinical data, one can leverage AI. So medical devices, for example, is the next obvious subsegment to double into. India, there is definitely an opportunity. It's not on our radar just yet. I think as the data infrastructure evolves and advances, and there's sufficient depth and width of data available, I think we will certainly seek to bring our learnings from the US market into the India geography as well.
So right now the focus remaining firmly on the US, but what about revenues? What are you currently clocking, and where do you hope to end this year? What are the targets you sort of set for yourself?
Yeah, so, we're north of 60 crores in terms of where our revenues are tracking. We hope to double next year and continue to see that kind of growth. We have very healthy pipeline, a lot of interest emanating in our platform offerings, in our products. And that is also powering very unique partnerships. Just before our fundraise was announced, we'd announced the fact that we created this AI collective with some leading product and consulting firms in the US, which is called Cypher Collective, which now enables us to go and have very meaningful transformational conversations with health systems in the US.
Sure. And, the thing with the healthcare and AI is that you can't have a one-size-fits-all sort of a solution, right? So what are the biggest challenges you face in driving AI adoption in a highly, regulated, complex industry like healthcare?
Yeah, that's a great question. So, if you ask me, regulatory aspects can be managed, whether it is complying with HIPAA guidelines or making sure that PI and PHI data is secure, building the necessary guardrails. Perhaps the biggest entry barrier or biggest adoption challenge is actually enabling psychological safety in the end users, right? So there's this, unfortunately, there's been this huge narrative around AI will replace people, AI will replace jobs, or so that creates a sense of nervousness, a kind of sense of fear amongst the end user community in terms of using these AI products, platforms that we work with our clients to develop. And the way we solve for it is by engaging and empathizing and involving end users, and bringing their perspectives into bringing these solutions very early on. And very frankly, again, there's a lot of conversation around AI and clinical decision support, but we feel, there is a lot of workflow automation, clinical insights that one can generate using AI, which doesn't necessarily involve decision-making, it essentially drives automation and engagement.
Sure. So AI can drive a lot of things in the healthcare sector. All right, Sachin, thank you so much for joining us on the show today, and we wish you all the best on this journey going forward.
Thank you very much.
Well, with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned to CNBC TV 18.
I'm sitting here in the heart of India's financial markets, the National Stock Exchange, a fortress of technology and trust, a place where billions of dollars of trading is executed across equities, derivatives, commodities in a microsecond. At its peak, NSE executed 2.2 crore trades in a single day and $23 billion in turnover in a single session. It is the world's largest derivative exchange for 6 years in a row, home to 12 crore unique investors. But beyond the tickers, the symbols, the charts, today we go behind the scenes. We look at surveillance rooms, IT infrastructure, cybersecurity, and of course, the National Operations Command Center. And we do all of this with NSE's current MD and CEO, who was also instrumental in setting up of the exchange, Ashish Kumar Chauhan. Hi Ashish bhai.
Hi.
How are you?
Good to see you.
Good to see you. And I think we were meeting here in your cabin for the first time.
Yes.
We see you at the atrium, at the opening bell. We see you in our studios. But I think this is your den.
Thank you. Thank you for coming.
It's a lovely office, by the way. I want to start by asking you, Ashish bhai, what does a day look like for you at the NSE?
In a way, our days are 24/7 by 365 because markets run only for a sort of shorter period.
Right.
But we have to prepare and ensure that the markets continue to run, prepare them for the next day. Even the weekends we have to work. So in a way, the life is kind of continually rolling.
Right.
And then, of course, you have a time of the day where you go to sleep. But broadly, you are available on your screen, on your mobile continuously.
Machines have not taken over yet completely, or have they?
No, broadly.
But they need supervision.
Yeah, they need supervision. And of course, there are changes that happen. So we need to continue to plan for that. The regulations have to be...
So hour by hour, not hour by hour, but maybe 2 hour, 3 hour blocks. What is it? When do you get to office and how does it flow?
No, I come, if it's a listing, I come a little early, like 9.
Right.
Otherwise, I come...
Which is pretty much every day nowadays.
Yeah, nowadays. Otherwise, I have a little more flexibility. Sometimes I have to go out to sort of attend events. But broadly, I try to be in office at the exact time so that I'm aware of what's happening. And normally, I try to be available at 9:15, at least on phone, even if I'm traveling. 9:15 a.m. is like the starting time of the market, and you want to be there in case something goes wrong. If it goes right, so there is no issue, but you have to be available. So that's how the life works. And then once you come, lots and lots of meetings happen. You need to read a lot, and then you need to go out for meetings and committees and all. And then at some point in time, you will go out to attend some events in the evenings. Usually evenings, there are a lot of events. And then go home at whatever time you're allowed to.
I mean, activity has just exploded, right? Both on the cash front, derivatives front, etc.
If you recall, when Mr. Modi took over in 2014, because that's the time I still remember some numbers, India had 1.67 crore investors.
Wow.
Today, India has 11.8 crore investors, unique. Both. Because those are the NSE numbers, right? 11.8 crore investors, 25% women. That's 8.5 crore or 9 crore households. And that's almost 25% of India's households now. Right. And that time, India's market capitalization, when he took over, was I think 67 lakh crore. Today is 450 lakh crore, right? So both have gone up 7 times.
Correct.
Right. And that tells you how much of India has become middle class. Because you come to the markets to invest, and there is a perception that has been created that India, I mean, most Indians overtrade. That is not true, because 11.8 crore investors, once you have invested even in one share, you don't trade every day. You can trade once in 10 years and still you are an investor. But out of that, around 25 lakh, maximum 30 lakh people trade in derivatives. And so literally 2% people trade in derivatives. And out of them also, most of the people, I mean, almost 85-90% people
also trade in
they trade in equities
as well, cash as well.
Yeah, so it's like they're buying insurance, right? And so for me, lots and lots of misperceptions get created.
Right.
But overall, the amount of wealth
right.
that this organization has generated when it started in 94,
right.
on November 3, 94 equities market,
right.
it was, the total market cap of India was 3.7 lakh crore.
Right.
Today, it's 450 lakh crore.
Right.
It is, of course, the transaction processing, reaching
Correct.
out to people across
Correct.
India. Now, 11.8 crore investors are in 99.85% of all PIN codes. India has more than 19,300 PIN codes.
Correct.
Out of which only 28 PIN codes don't have an NSE investor. I have investor in Ladakh, remotest corner, means 6,000 meters in the hills, to Andaman Nicobar, which is near Indonesia.
Right.
I have people in Arunachal Pradesh. I have
Right.
people in Dwarka. I have people in Kanyakumari. Every nook and corner of India today.
Except 28
PIN codes, and out of that, probably 25 are airports where you can't stay full time, so I can't do KYC, right? You can't say that that's your house.
Right.
So broadly, the middle class
Right.
sization of India
Right.
is what is basically creating a framework where
Right.
India's savings, India saves 30% in that
Right.
range, 28,
Right.
30%. Out of $4.2 trillion economy, now we are saving above
Correct.
1.2 trillion dollars.
Correct.
Most of it earlier used to go into gold and
Fixed
real
deposits at
estates
banks
and today some portion has started coming up in what I call risk asset.
Risk
right?
assets.
Equity is a
Yeah.
risk capital,
Yeah.
and they have got some brilliant returns. I mean, Nifty is going to celebrate 30 years in terms of the base date.
Yeah.
It started with 1,000 in 1995,
Yeah.
November 3, 95 base date.
Yeah.
Today, it's close to 25,000. If you take the dividends, it would be probably 30,000 in that range, right? So 1,000 rupees invested has given you 30,000 rupees, right? 13% plus
kind of compounded returns.
Compounded 13.6. And even in dollar terms,
it's about 12, I think about 25 years, 12% odd. I mean, so which is...
But if you take total returns, because you take only the absolute returns, but if you take
dividends included, I think it'll be,
in that 13.5 or something. And in dollar returns also, it's competing with S&P 500. So effectively, India has done well. And it's not true that all countries where the country has done well, investors have done well. Like China, 30 years back, whatever their index was, today also is very similar.
Correct.
People, I mean, the industrialists have made money, not the investors.
Small
Whereas
investors.
in India, because of the corporate governance framework, which SEBI and NSE have been together able to provide for. And that's why for me, the capital formation, $5 trillion, one third of India's wealth, is now wealth of trust at NSE. Right?
You know, you said that activity has grown, what you said, over the last, since NSE was founded, how many times?
I mean, in terms of the number of trades, the BSE in those days, the best days, they couldn't do more than 10,000 trades. Today, I get 2,000 crore orders in 6 hours, right?
So has the infrastructure to do all this also expanded at the same pace? Let's find out. Let's, I think, go to, what is it called? The National Operations Center, right? It's called the NOC.
Yes.
Let's go there and find out how it all works.
Absolutely.
Well, as promised, we are showing you a rare behind-the-scenes sort of, you know, footage or visuals of the National Stock Exchange, the largest exchange of the country by far. And of course, we have help in the form of the MD and CEO of NSE, Ashish Kumar Chauhan. Ashish bhai, so this is the National Operations Center, right? Yes. NOC. It's got a military-sounding terminology to it because it requires precision, it requires discipline, and I think this is where it's all sort of controlled from.
Absolutely.
Tell us a little bit about what we're seeing, and I mean,
no, this is an entire floor, but floor is divided into different rooms. Each team has their own work.
Correct.
And there is a full backup, even in terms of the number of people, number of computers, number of screens in Chennai.
Right.
So anyone doing anything here as a checker in Chennai, anyone doing something in Chennai has a sort of checker.
But that is only for
it's for disaster recovery. But when disaster happens, when you try to recover, it doesn't work. You have to make them on. So whatever things happen here,
it's fully operational.
It's fully operational, and actually we do mock trading from Chennai every month, at least once, and twice a year, at least for 2 days consecutively, we run the live operations from Chennai. So it's a fully functional thing, but how do you continue to make it run? in a heightened sense is by involving them on your day-to-day activities as if they are next to the computers, and which is now allowed by the communication systems. So that's where the team here and team there are like working as one. And in case this place by chance goes down for whatever reason, that team should be able to
seamlessly pick
up and run without anyone.
So as an investor, as a trader, I should not feel the difference. I mean, basically.
You probably will get logged out, and then you will your broker will log in, and it'll be business as usual probably in few seconds.
Right. So what happens from here? I mean, what kind of activity?
This place is what we call business knock, where all the companies that get listed or IPOs that happen or daily price bands of companies, the new derivatives contracts getting introduced in equities or currencies or commodities or in bonds, all that thing starts being set up. Even sometimes we have to set up a new broker or sometimes we have to actually stop a broker from functioning because of the SEBI regulations or orders, or sometimes even specific investors are not allowed to trade by some of the court orders or otherwise. So everything happens here. But during the market hours, especially between 9:15 and 3:30, this people who are working here have to do nothing actually. They have to just monitor, and it's like an autopilot. If they are doing something, then there's something has gone wrong, right? So that is where physical manual sort of override is required. Otherwise, their work happens 24/7 by 365 days. During the day, they are not supposed to do anything, but end of the day, they have to create files, download to all brokers, then they have to prepare for the next day all the new contracts coming in, the price bands, other things, 2%, 5%, ASM, GSM.
The much awaited Bhav copy comes from here? Or?
Absolutely. So everything which has to do with business comes. Similarly, there is another room for cyber security where we get a lot of
and we're going to go there in a bit. So
and then we also have hardware operation center, which is basically where we have several sort of machines which we need to ensure that there are no queues. And this was the first public digital infrastructure of India. This is the first fintech of India. It's still the largest fintech of India. And it allowed India to create capital formation on a scale where no similar sized or similar per capita income having country. I mean, today, after so many years, our per capita income is only $3,000. Although we have become $4.2 trillion economy, but we are still per capita is still no country has with $6,000 also have that kind of market. $12,000 also no market. $24,000 there is one market larger than us called China. But when the prices go down, the government has to go and buy the shares. In India, government is actually hands off, right? So there is no similar market. And if you look at it in a poor country, per capita income country, people investing in other people's businesses is not unheard of. There are books written in economics which says that poor per capita income countries cannot or societies cannot have well-functioning capital markets because they cannot save. And if they save, they don't trust their brothers also. In India, this has happened where 20% of India is now households.
And we spoke about the long track record of returns, which has been spectacular, matched only by, I think, the US, right? As a market over a long period of time.
That's why I call this trust markets. Because trust has developed.
You know, I want to show our viewers the cyber sort of control center as well. So let's go there and why don't you tell us about that? Okay, we are in another room now, and this is, of course, also an important place. This is the Hardware National Operations Center, the Hardware NOC. And you can see the screens behind me. This is where they monitor, Ashish bhai, the hardware and
there are thousands of servers which NSE manages, and each server has different work and different softwares. And so all of them have to work well. And that's where basically each person has his own job. But there are what we call dashboards which are giving you aggregate numbers. So in case again, they are not supposed to do anything real life, except they do their normal office work. But if something goes wrong, that is the time they need to intervene. Otherwise, during the day, it's an autopilot. And there are softwares which are self-healing and things like that. So overall, it's basically on a good day as like we get 2,000 crore orders, 30 crore trades in kind of different markets. So all the hardware, literally whatever people do here is sent to a nearby site called NearDR, and a Chennai site, literally gigabits of
information
bytes, is transferring.
Okay.
And we have like petabytes of data stored. Some people access from there, some people access from here, and so it's like a very large setup which needs to be monitored on a.
So there's we were in the business NOC, there's the hardware NOC, and
then we have a security NOC, which is
the cybersecurity and security NOC. So let's go there and check it out as well. So that is the hardware NOC, and what we're going to do now is show you the cyber NOC, Ashish bhai. And I think viewers can see what is inside the room. So tell us a little bit about what happens here.
No, in a way, we use many softwares and tools and hardware to ensure that the working of the exchange continues without
disruption,
any disruption, even from the hacking and other activities. So that's where, again, we have a Chennai site that's connected here, and naturally, some of the government agencies also are able to look into what we do. But there are like lots and lots of softwares, tools, and we use, and each person working has a specific job. But again, we have dashboards which tell on an aggregate level what has been there today, how many attacks are coming, if we are running in a red zone or a amber zone or a green zone, and so those are the things.
You were telling me earlier during on the day of Operation Sindoor, I mean, there were the attacks kind of peaked at.
Yeah, like in 20 minutes we got 40 crore attacks, right? So these are some of the most attacked entities in the world today.
Okay. So this is a significant area of focus in terms of upgradation, keeping.
The costs are also humongous, but without that, you cannot operate, right? So you need to be like any country. If you don't have a defense, whatever you do in the business has no relevance because somebody will come and subjugate you. Similarly, whatever business you do, if you don't have a good information security in today's world.
So strong physical security, as I noticed at the gate, but strong digital security. I mean, there is digital public infrastructure in that sense, so it has to be on without disruption.
Absolutely. And especially outsiders or insiders, knowingly and unknowingly, doing wrong things cannot be.
Has to be monitored, has to be checked and tracked. Well, from the National Operations Center, and we showed you quite a bit, as much as we could, upstairs. We are here now to take a walk down the memory lane with Ashish bhai. This is, of course, the wall with lots of pictures, and I guess Ashish bhai lots of memories as well, right?
Yes, of course.
Because I spotted that photograph, which is July 1994, when an NSE was inaugurated. And that is, I don't think you can see it, but that is a very young Ashish Kumar Chauhan explaining to then Finance Minister, Dr. Manmohan Singh. What is happening then in that picture?
And next is our chairman, Mr. Nadkarni, who became chairman of SEBI later on.
Right.
He was IDBI chairman beforehand.
Right.
And so, in a way, this project was like very ambitious.
Right.
And everyone was clear this is not going to work.
Right.
Even when it was thought through, because bankers were trying to implement a stock exchange which they have never run before, and in an IT, pure IT exchange, which was not the case anywhere in the world before. So it was all sorts of complexities, and we were trying to use satellite telecom and also a lot of things which could have gone wrong.
The idea germinated in 92.
Yes.
And
post Harshad Mehta scam, the government wanted to create a framework which is not owned by brokers, operated by brokers.
Right.
And that's why they wanted to create an independent exchange owned by investors, but run by professionals.
Right.
And so, and completely automated so that it will have transparency, fairness, efficiency, and all that. Right.
Correct.
And so, in that context, we made presentations to Finance Ministry in 92.
Correct.
Lots of to and fro during 92, 93, 94. So, what happened is we first started with the wholesale debt market because Harshad Mehta scandal actually originated in the RBI Secretary General ledger and all. So they wanted to first do wholesale debt market. And so we started operating without inauguration, like a beta test in those days. And I think Google had not come then. So beta was not so popular, but we started trading, real trade.
Right.
And then Dr. Manmohan Singh gave time to come and inaugurate in July. And on that day, he woke up early. He used to be a very diligent man, right? So he decided to visit NSE. The inauguration was in Nehru Center.
Right.
At Worli, and our office was at Mahindra Towers.
Right.
Again Worli, but probably 1.5 kilometers away. And so I used to sleep in the office most days.
Okay.
And that was an important day, right? So when the dogs started coming to check around the dog squad, then I realized something is happening. I had to tell my bosses that he's coming to visit NSE, and then everyone sort of came hurriedly.
Right.
And so that time I was explaining to him how the IT system works.
Okay. And that is you were how old in that picture?
I was 26 years old then.
26-year-old. I mean, that is just I mean 2 years into your work life, right?
Yeah,
2 or 3 years,
yes.
into your work life. Yes. Must have been a high.
No, it is. I mean, this, as I say, this has been, and setting up NSE has been the greatest privilege of my life.
Right.
And the amount of service it has given to India.
Absolutely.
It is way beyond what one had imagined or what one can even fathom.
And we're going to go now to the most used facility, the NSE, by the general public, by companies, by new corporates who want to list and ring the bell. So we're going to go to the bell there now and check it out as well. Well, I hope we've given you a 360 degree, if not a 360 degree, a 180 degree kind of view of how NSE as an organization runs. I mean, some of the stuff that we showed you, of course, behind the scenes, as I said, the National Operations Center. And of course, we jogged our sort of memories back to when the exchange was founded as well. This is also an iconic place. This is the, Ashish Bhai, the atrium, right?
Yes.
And I think corporates who may be watching this, for a lot of them who are recently listed or even listed for a while, I think they would remember this place. With the ringing of this bell,
absolutely,
the listed journey starts.
Yes.
And it's been such a vibrant place, right?
Yes.
Ashish Bhai, last couple of years especially.
Yeah, every day there are many listings. The largest company usually does bell ringing here. We have other places where there are bells, including in other cities also.
Yeah.
But this is the most coveted sort of listing place today in the country.
You are here, as you told me, for the big ones at least, 9:15.
If I am in Mumbai, I try to be there.
You try to be there.
For listing, because again, it's an important occasion for the company's life. And as what I call a head priest of this temple, it's my duty.
You have to be
there.
present.
Yes.
When do we see NSE's bell going off in terms of listing?
Once the SEBI gives no objection certificate, that's the minimum we require as a regulated entity by SEBI.
Right.
After that, we'll prepare the DRHP and then submit to another department of SEBI, which will go through it. And broadly, it would take probably at least 4 months to prepare the DRHP.
Right.
4 months for them to do queries and ask us any issues,
questions, etc.
Clarification.
Right.
And then so.
But from the day that the NOC is received, whenever it is, we don't know when that is.
Probably 8-9 months is what looks like after that.
To the listing date, basically. So I mean the work in terms of having the background, etc., is work in progress.
In 2016, NSE had filed. That time I was not there in NSE. But 2016, NSE had filed the first DRHP. So since then, NSE has been in a way in a status of some readiness, not always, because it's almost now 9 years.
Right.
But in a way, we are sort of prepared.
And in terms of the size of listings, you said big companies. I think this is going to be the biggest of all.
No, in a way,
in terms of,
and we are also 100% public. See, unlike other companies, we are already 100% public. I have like 172,000 shareholders already.
Correct.
Right, and so 0% is with any promoter. I have no identifiable promoter.
In terms of the shareholding, last 5 years is when the numbers have really exploded.
In fact, since March only, it has gone up from probably 30,000 to 172,000. Right.
Last March.
That is 25 March.
Wow.
Right. So because earlier we used to approve each transaction with fit and proper, and then
correct. It used to take time. There used to be 4, 5, 6 months
and things like that. Now it's all automatic in the depository, so that's why many more people.
So transactions are taking place a lot more. And all those, what you said, 172,000 shareholders now. So, and they're all waiting and watching.
Absolutely.
When this is going to happen. I mean, what, close to 5 lakh crores in market capitalization? At least in terms of, because transactions are taking place.
Transactions.
Right?
But again, whatever, when you go to do the IPO, that is the time you need to see.
Depends on. I'm sitting here in the heart of India's financial market.
What's it been like? 11 years of Swiggy and 5 of Instamart.
One of the first things that I did when quick commerce actually started with Instamart was to say that, it's not going to work. Who needs anything in, I don't know,
in 10 minutes? Yeah, naysayers.
Absolute naysayers to that.
What is the relationship like as far as the FMCG business is concerned with them?
I refer to it as the OTTification of commerce. We are probably the cheapest way for a lot of these brands to put products in the hands of consumers who care for it.
I mean, it's giving hyper-local a completely new meaning, isn't it?
There is one consumer base in the same geography that are looking for cheese. There is another consumer base that is looking for paneer. So the way our assortment comes in, it allows for that level of identification.
Is it still about the 10 minutes or has that changed significantly?
A consumer that depends on quick commerce, when they come up and fire search for the item that they look for, needs to be available in less than 10 minutes.
At this point in time, it seems to have emerged as a 3-horse race.
Every one of us probably has grown up on a Parle or a Cadbury or a Surf, right? And then you realize that you are one amongst them.
You're the Parle and Cadbury of this
just
generation.
Swiggy it is a verb in many parlances.
What is the dream 5-10 years out for Swiggy and for Instamart?
100 million people coming to our platform and transacting 15 times.
Now, what would you consider as the big pain points?
There are a lot of flirters in our quick commerce business.
What are they flirting with you for?
They come for Rakhi. right? I think compared to
last... And then forget about you.
Not forget. They still come back, but they have not transferred all of their buying onto Instamart.
From 0 orders on day 1 to millions each month, Swiggy is hoping to redefine convenience for India. What started as a food delivery app is today a multi-service platform with over 2.5 lakh restaurants, 5.4 lakh delivery partners, and a growing suite of services from dining out to entertainment. And then came Instamart. Launched in the middle of a pandemic, in just 5 years, it's expanded to over 125 cities, delivering everything from fresh vegetables to smartphones and, yes, even gold. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan, and on the show today, we decode the journey of building category-defining businesses with 2 leaders at the heart of this evolution. Funny Kishan, co-founder and chief growth officer at Swiggy, and Amitesh Jha, the CEO of Instamart. It's 11 years of Swiggy and 5 years of Instamart. Funny, Amitesh, many thanks for joining us here on Young Turks Reloaded. Funny, I'm going to start by asking you, you've pretty much been through this journey, 11 years of Swiggy and 5 of Instamart, and it's literally just 1 year exact to this month for you, Amitesh. Funny, what's it been like? 11 years of Swiggy and 5 of Instamart.
Yeah, no, I think firstly, thanks a lot, Shane, for having us over here. And it's great to be back. You guys have been, as I said, seminal in how startups have been covered over the years. And it's great to be back on the show after a long time, right? I think we were just speaking about it. It's relativity, right, at its best. You know, when you love what you're doing, it doesn't seem like 11 years at times. So lots of memories. I think, when people ask about my professional career, I say, I don't know what I did before because everything.
Yeah, you consulting and then decided that you wanted to get a slice of the startup ecosystem, right?
And so it's been here. So we've grown up together in many ways, whether it's me, Harsh and Andy. We've had our ups and downs. But I was telling this recently someone as well, if I could do it all over again, there's nothing else I would do. I'm perfectly at the place where I would like to be at this point in time. So quite an awesome journey in the last 11 years.
Yeah, well, it has been for you and it has been for the business as well. But Amitesh, 10 years almost at Flipkart before you then decided that quick commerce was going to be your calling. How different is the quick commerce world from the e-commerce world?
Yeah,